relatively lower, but the ROC on cables and wires is relatively better. So that's the mixed bag coming out of there. What the street will not like, though, capital allocation was. That could be one factor that will weigh on them. And the other factor is, some part of the street believes they could have done it under Grasim. How do the numbers stack up? They're going to be putting 1,800 crores. The revenue potential will be 7 to around 8,000 crores with margins in the vicinity of around 11 to around 12% or thereabouts. For them, the total capex is only around 10% of their annual capex. So very, very small. And as we know, the operating cash flows per year for Ultratech is more than 10,000 crores or thereabouts. Jefferies, they highlight there could be a capital allocation concerns, but they say if there's a knee-jerk reaction, it provides a buying opportunity. Expect the stock, though, to open up in the red because of this diversification away from their non-core business, that is, towards a non-core business like cables and wires. But Upasana, your companies may feel the heat. Suddenly you have a new player in there, and the fear is this the pains moment for the cables and wires guys? Give us a quick analysis.
Certainly, Nigel. Now, cables and wires space will be in focus today with the entry of Ultratech as competition may intensify for the existing large players. Mind you, Birla Group has a strategy to remain in the top 2 position across the business verticals it operates in. Now, if we look at the FY24 market share of the top players, Polycab stands at 26%, KEI stands at 12%, followed by Havells, which stands around 11%. Now, in terms of valuation, the current multiples of the existing players are on the higher side, but 20% of its peak seen 6 months back. Now, looking at the capex plans of majority players, they are on the higher side is what they have highlighted in Q3 FY25 as well, giving a higher capex guidance for upcoming years. Hence, the margins of these companies will also be in focus of how they scale it up going forward. Now, Jefferies believes that they foresee a lower impact on Polycab as compared to the other housing and B2C players like Finolex Cables and Havells. And lastly, Morgan Stanley believes that the new competition is certainly a surprise, but not a concern going forward. Hence, all these companies will remain in focus, and I expect all of them to open in red today.
All right, Upasana, thank you very much for that. In fact, we have the management of KEI Industries joining us to talk about this, and we'll get their perspective. We'll also have Mahesh Badang of Centrum Broking to talk about, the other side, right? What does it mean for Ultratech for a diversification like this? So that's coming up at 9:30 this morning. NBFCs and MFIs in focus, some reprieve, some relief, maybe. Abhishek is here with that. Abhishek, morning.
Well, largely to do with the NBFCs as well as banks loans to NBFCs. So that will be in focus, not the NBFC MFI, because this rule of, relaxation of risk-weight asset that RBI has put out is largely for bank loans to, NBFC MFI players and not for NBFCs lending to the MFI sector. So RBI has reduced risk-weight requirement that if you take a look, the banks, loan growth to NBFCs has come down from around 30% YY loan growth that it was prior to November of 2023 to right now, as of December, it was just 7% on a YY basis. So this has or might have given some, good feeling to RBI that it's time to reduce the risk weight asset requirement that they had actually increased in November of 23. So they have restored or reduced the risk weight asset requirement for lenders, microfinance loans by 25%. So if a bank has loans to microfinance segment, that RWA requirement has been reduced by 25%, and bank loans to overall NBFCs also will reduce by 25% with respect to risk weight assets. So we have IFL Securities note which states that 7 to 170 basis point of CET1 benefit is seen for lenders, especially banks. So higher benefit for Bandhan Bank, Bank of Baroda, Ujjivan and IndusInd Bank. Back to you.
Thank you for that. But Abhishek, you're also watching Azad Engineering.
Well, sources tell CNBC-TV18, Rima, that Azad Engineering has launched a QIP. The issue size is about 700 crore. Issue price is about 1,280 crore, which is at a discount of, 1.8% to SEBI floor price and about 5.6% to Tuesday's closing price. So equity dilution would be around 8.5%. The promoter lock-in post this fundraise is about 60 days, and the BRLM to the issue is ICICI Securities and others. Back to you.
Okay, all right. Thanks a lot for that, Abhishek. Let's hop across to Vinny. She's here with some more stocks and news. Morning, Vinny.
Good morning, Nigel. So firstly, let's start up with Dr. Reddy. We're expecting green on the screen for this one. US FDA has concluded the inspection at its Hyderabad API manufacturing facility, which is an important one for the company. API accounted to around 11-12% of the revenues in FY24. While obviously this is an EIR, which is Establishment Inspection Report, coming in for this facility with a voluntary action indicated. So positive sign for this one. No major concerns coming in here, and that is why a green. Prestige Estate, on the other hand, we're expecting red here. The Income Tax Department has conducted some search operations in its registered offices as well as branch offices. That was on February 25th is when they started it, and the details of the investigation are still pending, but the impact of the financials is also something that we're watching out for. As of now, the company is cooperating with the Income Tax Department, but this will be key to watch out for if there's going to be any major financial impact coming in on this front. Lastly, we have Mastag that is also in focus. They've secured a multi-year, multi-million-dollar contract. This is from the UK Public Service Department. The estimated value of this is around $85 million spread over a period of 2 years. So keep an eye out on Mastag. We're expecting green here as well. The stock had seen a decline of 22% on a YTD basis. Positive sign is what we could see here.
Okay, all right, Vinny, thanks a lot for that. Well, I'm looking at Vesuvius India, and the numbers actually were mixed because on the top line, you had a super growth of close to around 23%, good going out there. However, the margins came down to around 16% or thereabouts. Remember, for a brief period, we had margins at 19 to 20%, so they've cooled off a little bit. The problem was in terms of the gross margins, which did see a contraction. So that's why we have the EBITDA margins as well that did come out. The profit number, though, was a little bit higher. That's because the other income was more or less flattish, and the effective tax rate was relatively lower. The kicker for the stock was that, in fact, they've announced a stock split, so now to become more affordable, high amount of participation could be there. Going with a tinge of green on this one, though the numbers were more or less mixed. Well, let's hop across to Manisha. She's here to tell us about ONGC as well as Oil India. Morning, Manisha.
Morning, and thank you for that, Nigel. Well, I'm looking at crude oil prices because we've seen a very sharp decline come in for this one, so much so that we are now trading below $69 a barrel for the U.S. crude oil prices. That's a 2-month lows, and with this, not just that we've broken below 70, but the trajectory clearly seems on the weaker side. Two things to watch out. One is U.S. and Russia conversation, where that war seems to be now taking a step forward in sense of peace there. And if the Russian supplies start coming into the market, well, you could be looking at higher supplies then. The second thing is about the U.S. crude inventories, which also have surged, and markets do believe that the tariffs, if they do come as the conversation continues to be reiterated, then you could be looking at the Chinese demand going down and the economic slowdown leading to further decline in fossil fuel demand there. So these are the three factors that are weighing onto the crude oil prices right now. We are looking at a negative in sense of crude prices for this year also, down by nearly 4% YTD.
Manisha, thank you for that. Here's a quick recap then of the top stocks this morning. Stocks with positive news flow are Vesuvius India, Dr. Reddy's, Mastech, NBFC's, banks, microfinance stocks. Stocks with negative news flow are Ultratech Cement, Cables and Wires stocks, Azad Engineering, Prestige Estates, Oil India and ONGC. We will slip into a break on that note. On the other side, we'll connect with Dipan Mehta for some fundamental stock talk. We'll also have the management of Sirma SGS joining in to discuss the quarter gone by and the outlook going forward.
Influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself as India's longest running show on startups and entrepreneurship. Celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21. Only on CNBC-TV18 and CNBC-TV18.com. CNBC-TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhan.
India Business Hour, live on YouTube at CNBC-TV18, weeknights at 7 p.m.
A bit unusual but not totally unprecedented, because in the last decade, 2015, we had a similar situation.
Welcome back. You're tuned into Bazaar Morning Call. As promised, Deepan Mehta, Director Elixir Equities, joins us on the show. Hi, Deepan. Good morning. Good to see you in. Deepan, I had a busy, holiday yesterday actually, because had to go through this deal with regard to Ultratech. All of a sudden saying that cables and wires is the space we want to be in. What's your initial reaction to this? There could be a knee-jerk negative reaction on Ultratech Cement because it's not in their core cement business. And also, do you think cables and wires players will feel the heat? Though you need to keep in mind that paints companies were trading at 60 multiples. These cables and wire business are at around 30 multiples. So in that case, that could be some cushion. Your take.
Yeah, good morning, Nigel, and thank you for having me on your show. I think that it's not a very big, serious diversification for Ultratech. We need to understand their reasons for getting into this particular business. See, when they went into paints, they went, completely inside, setting up several plants and making massive investment, that too through Grasim. But in this case, it's a small 1,800 crore capex plan. As I heard from you, it's just 10% of their overall capital expenditure plan. And it's not going to be such a big venture for them. And we need to understand what exactly the thinking behind the cables and wires entry for this particular company. But I don't think it's going to impact any of the existing players. I think they are very strong brands, a distribution network, relationships. A lot of them are very good exporters as well. So it'll take time for it'll take time for Ultratech to catch up, if at all.
Okay, all right. So you're saying that if there is weakness in some of these cables and wires business, it'll be a good entry opportunity. Is that what you're trying to tell us, Deepan?
See, I still feel that these cable companies are trading at very rich multiples, considering it is a type of a cyclical business and there's volatility in earnings. Raw material costs do impact their operating profit margins. But sure, I mean, if there's a correction, one could look at these companies if you are fundamentally very comfortable with the valuations. But by and large, our preference is for consumer-oriented businesses or consumer appliance companies. And within that, I think Havells particularly comes to mind, which has got a cables business, but as a solid air conditioning as well as other home appliances business. And if that valuation comes at reasonable levels, I think it could be more appropriate than some of the other pure play cable companies.
So Havells, but just one more question. Would you have preferred that they have actually done it through Grasim rather than Ultratech?
Yeah, I would agree. So, I mean, because Ultratech is a cement company, India's largest cement company. And sometimes when you want an exposure to a pure play cement company, you would go to Ultratech. But now you have this cables division also within Ultratech. But as I said, it's going to be a very small division. And over time, the management will explain the logic of getting into this particular business.
But one thing is clear, right? All industries are seeing, it's not disruption, but newer players, hospitals, all these conglomerates coming in. Paints, Ultratech first, and now JSW, and now, of course, the cables and wires.
The biggest beneficiary could be consumers, and because ultimately earlier there was this unwritten rule that I will not get into your space, you will not get into mine. But now that's clearly broken over the last few years, and that could bring pricing down, which will ultimately be good. So, interesting.
I don't know if you have the number. What percentage of the cables and wires segment is unorganized?
That's 30%. So 30%? The total industry is 80,000 crores. Approximately 30% is unorganized. So that could 26 to 30% roughly.
Yeah. So the point is that sometimes we think that a large company enters the space and it's bad for existing players. Yeah. But if a large segment is unorganized,
then it could.
then it doesn't necessarily need to hurt. Many of these cable and wire companies, when we speak with them, have guided for what, 15-20% kind of growth rates, right?
Yes.
So it's not necessary that the entrant is taking market share away, although it will in some degrees. The margin incrementally is negative, but it's not necessarily in that sense hugely negative over a period of time. Today, of course, stocks are another matter. Deepan, banks and financials with the RBI cutting risk weights, there is, of course, a significant shift as we are seeing. I first started sort of mentioning this when we started to see the rupee depreciate, so on the forex management side, and now we are starting to see some actual measures as well. Your thoughts?
Yeah, I think that, Prashant, after several quarters, maybe years of underperformance, you may see banks having a cyclical upswing and improvement in their earnings. Base effect also will benefit them because provisions have been increasing for these companies over the last 4 or 5 quarters or so, and now perhaps they will flatten out, and core pre-provisioning operating profits also may start to look up. So you would see, I would say, year-on-year growth in bottom line and a cyclical upswing in stock prices. But 3-5 year period, our view on banks is slightly cautious. It's becoming a bit of like a red ocean, and there's going to be pressure on net interest margins. The minute these banks start to lend into high yield products like personal loans or microfinance, their NPAs are going up after a few quarters or so. So some additional risk factors are coming in. So while we're heavily invested in banks, 25-30% of our portfolio, and we would remain invested for the next 4 or 5 quarters or so, but over the longer period of time, one need to have a proper kind of a strategy to be underweight in banks.
Deepan, request you to stay on. We've got the first management joining us on the show, and that's Syrma SGS. Now, they reported the numbers a while back. It was a strong quarter. We saw a revenue growth. There was an improvement in margins. And the company says that they're confident that they will grow in line or beat the industry growth rates of 30 to 35%. J.S. Gujral, MD at Syrma SGS, is now joining us on the show. Mr. Gujral, thank you very much for joining in. Good morning. This is Reema here. So first, just to get some numbers out. For FY25, you were guiding for 4,500 crore of top line and 7% plus EBITDA margins. That stays, right, as we are close to wrapping up the year?
Yeah, I think, thank you very much for having me on the show. I think we are in line to achieve the 7% EBITDA margin. And the top line could be marginally here or there because if the product mix changes, if the consumer business goes down, the top line goes down, but it has a positive impact on the EBITDA margins. So we stand by the absolute numbers of EBITDA margin, which we had guided. It was 300 plus 310 crores for the current year. And we are in line with achieving that.
Okay. And revenue should be close to 4,500 crore.
I'm not committing 4,500. It could marginally vary because if my product mix varies, the top line varies.
Got that. Okay. What about FY26? What is the outlook? You've got the Pune plant, which is commissioned. It will start generating revenues as the year progresses. So what is FY26 looking like in terms of top line and even on the EBITDA margin, since you are focusing on higher margin businesses and products?
You see, for the FY26, I think we are in line with what we had guided, that we grow at the industry average or plus industry average, which is 30-35%. And this year we'll achieve a EBITDA margin of 7% or little more than 7%, which guides us that we should be achieving around 7.5% next year. The Pune plant has started, it has been commissioned. It's undergoing approval from the customers. So in a business like us in automotive and other things, after you commission the plant has to be approved by the customer, and that's a 3 to 6 month cycle. But I expect that next year, 9 months, we'll have revenues coming in from the Pune plant.
Okay, all right. Hi, Mr. Gujral. Good morning and good to see you. I wanted to ask you about, how you're seeing order activity. Is there any kind of slowdown that you're experiencing? So that's point number one. And point number two is around 35% of your order book is consumer facing, right? So how do you see revenue recognition from this part of your business? FY25 and then FY26. I think it's around 35 to 40% or thereabouts.
See, for FY25, we had guided a consumer business contributing about 40% of our revenue. And I think we are in line to achieve that. 1% here or there, it could be there. Next year, we are targeting that the consumer business should come down as a percentage of my total revenue. Our wish is it should come down to 35%. Whether it is 35 or 37, I really can't say today. But the wish and the sort of the strategy of the management is to focus on growing the high margin business. And once the high margin business grows, even if the consumer continues to grow, as a percentage of the total sale, it will come down. We are targeting it should be about 35, 37% in FY26.
Okay, all right. And there is no big slowdown in terms of ordering activity. Is that correct?
There is no slowdown as such on the ground, but the general ecosystem is one of caution. You see, with all these global events taking place, I think it will be a while before the dust settles down and people start taking forward calls, long-term calls. Currently, it's America with all the tariff wars going on and everything. It's a sort of a caution in the minds of the decision makers.
So talking about the global uncertainty, exports were 23% of your revenues. You wanted to increase it to 25 to 30%. But there is that slowdown in Germany also. So on exports, what kind of a year will FY26 be? Will you still see that 30-35% growth rate that you expect for the consolidated business, or exports will be slower? And what could the revenue contribution increase to?
The exports in FY25-26, I expect them to grow about 20%. This year has been a subdued year in terms of exports because Germany was really down. And the contracts which we got from USA, they are kicked in only in the second half, or rather the third quarter of this year. Next year, I expect the exports to grow, and I think it should cross the 1,000 crore mark. And what we are strategizing is adding more customers, which we have already added, and they're coming on stream in FY26.
Okay, all right. Another important factor for your company as well as for the industry is the PLI benefits. So how will these PLI benefits accrue for your company in FY25 and FY26, if you could quantify it?
See, PLI benefits for our business is only for about 30% of my revenue. My total consumer business is about 40%, out of which the PLI business may be 32%. So the 68% business or 70% business is not dependent on PLI revenue. And for the current year, we will account for about 18 to 20 crores of total PLI benefits. And going forward, also, it will be about the same figure because PLI is already approved. The CapEx is already approved. The incremental revenues we have to do. So there is no scope for significantly increasing the PLI revenues because there's a cap on the total sales which we can do, which are covered under the PLI. But as I said, 70% of my revenues are non-PLI related.
Quick question, Mr. Gujral. In the next 3 to 6 months, do you think you'll raise money via the QIP route? Because you've got an enabling resolution.
See, we have an enabling resolution that was essentially if we have to do some inorganic acquisition, which we are always looking at. And the philosophy of the management for the inorganic acquisition is that it gives me access to certain technologies or certain regulatory approvals, which I don't have in my company today. For my organic growth, which I'm projecting, I don't really need the funds. So it was an enabling resolution that should the opportunity come in for an inorganic acquisition, then we access those funds. But for my organic growth, I really don't need them.
Right. So good morning, Prashant here. Just one briefly, if you can tell me, you said it'll be a while before this dust settles. The uncertainty is on with regards to what? Demand uncertainty, or whether, basic considerations like where to manufacture and those kind of things?
Yeah, hi, Prashant. See, when the tariff things, which is in the news on the front lines every day, I don't think on the electronic part, the tariffs will be that significant or they will be material. But till that thing settles down, we have to re-strategize. For example, if a 5% tariff comes in on my exports to America, we have to re-strategize how do we do it.
Sorry, you may have... Sorry.
Orders for 25, 26 are firm. It's a long-term thing which we have to strategize. That is beyond 26.
I see. No, very helpful. Thank you very much, sir. Appreciate you joining in and good luck. And we hope the tariffs are sufficiently low. But we'll have to see and we'll know when we know. Thank you for joining us with that perspective.
Always a pleasure. Always a pleasure.
Deepan is still with us. Deepan, you heard that conversation from Sirma. I mean, a stock-specific takeaway of the EMS space.
Prashant, I was just checking while you were interviewing the management. The stock is off 40% from its peak, and it's a blue chip company in a very high growth space. I think valuations have also come off. If you analyze their fourth quarter earnings, then it is trading at a P multiple about 38 times or so. And management seems pretty positive that they can sustain that 25% type of top line growth. It does appear to be so based on the order book as well. So I would say that this is a good time to get into EMS companies like Sirma. There are anyway very few pockets where there is sustainable secular growth, and EMS is one of them. So considering the kind of position of the management and the risk return profile, definitely I think Sirma SGS looks like a good buy at this point of time.
All right. You know what we'll do is we'll take a quick commercial break here. Deepan, stay with us. We're going to come back. We'll also get some price action in focus with some trades. Sudarshan Sukhani and Mitesh Thakkar in focus on the other side.
2017 also, at least 4 to 5 occasions in the last decade, temperatures have been in the range of 37 to 39. So you can't call it unprecedented, but yes, it's a bit early, a little bit unusual.
So ma'am, can we expect a dip in the temperature in the next 5-6 days? Is that a possibility?
You can expect a small dip, but not a dip that will give you any respite.
Welcome back. 9 minutes to go for the pre-open session. We have Sudarshan Sukhani and Mitesh Thakkar who are with us with price action and what to expect. I mean, the only big price action globally over the last 2 days that we're reacting to, of course, is US yields, which are down 15 basis points. I mean, there's a very sharp sell-off. Otherwise, I mean, equities are slightly down. Dollar's not moved very much. Oil, though, is down about 2.5%. GIFT Nifty is flat. Mitesh, to you first. What's the trade here? What would you do? Flattish kind of day, of course, going into the holiday on Tuesday. On the indices first, and we'll talk about stocks.
Morning, Prashant. On the index, I maintained that the market has kind of reduced the intensity of the decline, but still no sign of a reversal has taken place. I think the first sign will come in case we start capturing 22,700, 720 zones. Till then, I think it's a market which I would want to sell around those levels. And 22,500 and then 22,350 are my two targets on the downside. So it's a market which is declining slowly. But let's see if we get a reversal as yet. Similarly, on the bank Nifty till 48,800 is captured, I think I would maintain a slightly or mildly negative bias.
Sudarshan, good morning. Thanks for joining in. What about you? What would your sort of bias be in that sense as far as indices go?
Well, good morning. I think after a long time, it is possible that the Nifty is giving signs of at least a short-term low. Now, it's too early, but it's worth finding out whether that is a valid proposition. And for that, I think today would be a day when we want to buy. We keep a stop at 22,400. That's a decent, place giving enough room for the Nifty to make some volatile moves. Remember, today is also FNO expiry. But with that caveat and stop, I would be a buyer in the Nifty. There is a very decent basing pattern for the last 3 days that's valid for swing traders and short-term traders. Maybe that works out. So, but the bias for the Nifty is clear. Look to buy it today.
Look to buy. And what about stocks? Would your bias be towards buying individual stocks, Sudarshan?
Yes, then there are a lot of stocks which are giving similar patterns. For now, you know, so many times these patterns have failed in this mini bear market. But we'll just have to take the trade and find out. ABB is a buy with a stop under 5,200. Grasim is my only intraday short with a stop above 24.20. Nestle is a buying opportunity. Again, a basing pattern there, stop under 2,205. And Volta, similar sharp correction, small sideways pattern, possible up move. So Voltas is a buy with a stop under 1250. So my bias is clear, 3 buys and 1 sell.
Nestle, Voltas buy, a sell on Grasim. Mitesh, what about you?
I have a mix of buys and sells. On the buying side is Ashok Leyland. It's a stock which I've recommended many times in the last few weeks, purely because of the fact that this is one stock which is showing signs of maintaining an uptrend in a declining market. So for the time being, buy with a stop at 223, targets of 236. A similar story, or even the stock is making new highs, is happening on the charts of Bajaj Finance. So that's a buy with a stop below 83.95 for targets of 8,700. And on the sell side is LIC Housing Finance. Keep a stop at 531. Look for targets of 500 here. And IDFC First Bank is a sell with a stop at 60 for targets of 55.
Okay, all right. Gentlemen, thank you very much, both of you, for joining us with that. Mitesh and Sudarshan, we'll talk again soon. There's a flash at the bottom of the screen. There's a 255 crore order for Jupiter Wagons, which has come through for some 9,100 odd wheel sets. We'll take a break. We'll be back with the pre-open session. We'll also have Santanu Chakrabarti of BNP Paribas to talk about their call into the financial space. Lots of news flow recently as well. Stay tuned.
Over the last decade, if you're a global asset allocator, like, where would you have made money? Like, you didn't need to put money offshore from the US over the last decade. What we would say there is that the valuation differential between EM and DM now is at its largest point that it's been for many years. Therefore, you know, when we're being approached by our global clients, they're very much aware and cognizant of the fact that they have a large overweight in the US and they tend to have large underweights in emerging markets. What I would say is that when we look at emerging markets at the moment, we're very constructive on emerging markets. When we're looking at India itself, I think the selling pressure here really has come about from the tremendous bull market which we've had in India over the last 3 years. And as we went into the end of last year, valuations on India became stretched. So all it took was a slight slowdown in the credit markets, in the credit cycle.
Okay, welcome back. Let's just look at the, okay, so 16 minutes to go for the market open, but I think we're 2 minutes away from the pre-open session. Deepan is still with us. Deepan, thanks for staying on. Now, I just want a quick word on Religare, right? We had last week, we had that big, I think it was a massive move, some 15-16%. I think it was last Friday, I think. And then from there, it's corrected quite a bit, back to about 236. So high that day was a very sharp move. Yeah, it was that Friday. 267 was the high. We're back at about 236. Any thoughts here?
See, Prashant, at least one uncertainty is out of the way now that they have a new promoter in place and the Dabur Group has got deep pockets. And this is a business which requires capital from time to time, which they can certainly subscribe or arrange for the company. But, gradually, I think the overall business momentum as far as wealth managers, mutual fund distributors, insurance companies, all the capital market players, I think they've had 2-3 very good solid years. And you could expect a cyclical softness within that sector. So from that point of view, I want to be a bit cautious on the entire industry. And I have actually not studied Religare that closely and what are going to be the actually moving parts which will take the revenues and profitability higher. So I would just say wait and watch. Let's see how the business evolves. And then perhaps you can take a call on Religare.
Okay, all right. Deepan, I wanted your view on the two new entrants into the Nifty in the next 1 month or so, Zomato and Jio Financial. Now, both of them, from the peaks, they've seen a good correction. Now, there could be some kind of allocation because obviously when you're adjusting yourself and coming into the Nifty, what's your view? Zomato has come off considerably, as is the case with Jio Financial, which bulk of its SOTP comes in because of its holding in Reliance. Your take?
Yeah, Nigel, I'm a bit surprised with the inclusion of these two companies, but nonetheless, I think Zomato, our view is very positive. We have a long-term view on the long-term positive view on Zomato, and it's kind of part of our core holdings as a measure of disclosure. We want to own it for next several years or so, and do feel that it can give great returns. Can't they say the same for Jio Finance? A bit disappointed with the kind of growth which has come through since listing. And look, again, it's a very competitive space. And I would say in terms of valuation, there are better plays within the NBFC, like say Bajaj Finance or the Cholamandalam. And I'm not sure that Jio Finance will be able to scale up as well as a lot of people on the street are expecting.
Deepan, I don't know if you tracked this one. We don't actually talk about it at all, but there's a stock called E2E Networks. L&T had bought stake, if you remember, right, in two tranches. One tranche was around 3,700. The other one was about, I think, less than that. The weighted price we'll have to see. It's under 2,000 rupees now. Any thoughts here if you've looked at this?
Yeah, Prashant, we have had a look at it, and it's a great business, and they seem to be in the right place at the right time. Fantastic momentum when it comes to revenues, but look at the valuation. I think you need the stock price to half from these levels to justify buying into E2E. Yeah, I know. When you look at the price, also look at the PE multiple. I think it's trading at 70-80 times. I'm not pretty sure you can pull that up. So at these valuations, I think a lot of the positives are captured. But keep these stocks under the radar. If a quarterly number comes which is surprisingly very positive, or the stock corrects significantly from these levels, and you get it in that sweet spot where the PEG, price earnings to growth, is about 2 times or 1.5 times or so, then that's a good entry point. But definitely a company worth watching. They seem to have a very different type of a business model, and as I said, I think growth momentum is very strong.
In the jewelry space, Deepan, right? After the sharp sell-off in Kalyan, there was some view emerging that, well, better to be with the one big name, Titan. On Friday, but last day, Tuesday, Tangamail was up 20%, circuit up. I don't know if you've got a view here.
See, I think what we are seeing is that after a long time, a lot of the tier 2 jewelry companies, be it Kalyan, Tangamail, and some of the other new listings, their growth profile is very much similar to Titan, slightly better as well. And they seem to have got a lot of their issues sorted in terms of distribution, growth, branding, so on and so forth. And now with the budget offering that no income tax up to 12 lakhs, definitely consumption is going to get a boost, especially discretionary consumption, and jewelry is one of it. So I'm very positive on the space per se, and definitely willing to look at some of the tier 2 players, including Kanjan and Tangamil and some of Senco Gold, and there are so many other new, at least 7 or 8 new listings which are there. And these companies, I think, are at far more reasonable valuations than Titan, where growth rates, frankly, have been disappointing for the past 2-3 quarters. So you could look at a shift out of Titan, some of the tier 2 jewelry companies, and that could be a good strategy for short to medium term as well.
Dipan, thank you very much for that. Let's focus on the financial space now. Shantanu Chakraborty, India analyst of BFSI at BNP Paribas, is now joining us on the show. Shantanu, the big takeaway over the last couple of weeks has been that the RBI has turned a little more accommodative. We've got liquidity injection, a rate cut in the prior meeting, and now the risk weightages for MFIs, etc., have come down back to 100% versus the earlier 125%. So that's been restored. So on the whole, in a nutshell, should one be incrementally more positive on the financial sector?
Good morning. Yes, absolutely. You have nailed it. So when I looked at the risk weight changes that they have made, whether it's for top-rated NBFCs or whether it's for MFIs, to put this prism of immediate growth would be actually a little premature, because frankly, if you look at NBFCs like Bajaj Finance or Chola, etc., where they're growing slowly, not really. I mean, the biggest beneficiaries of risk weight reduction in terms of banks' incremental willingness to lend to them, in any case, do not have a whole lot of dependence of their growth plans on such things. Similarly, if you go within MFIs, you'll realize that a lot of the reticence or reservations that banks have with lending to certain MFIs has to do with how they perceive the fundamentals of the MFI business today. But you have nailed it when you said that this is a critical communication of regulatory intent. Yes, there's been focus on liquidity. We have already seen rate cuts, and these are probably the first signs we are seeing of credit policy easing, and that bodes very well for the sector, both banks and as well as NBFCs. It shows that the regulatory focus is shifting from towards growth accommodative in a meaningful way, and that has to bode well. I absolutely agree with you.
So, Santanu, morning, Prashant here. Straight off the bat, before we talk about some of the more macro stuff, in your opinion, which are the listed players which stand to benefit the most?
In terms of these changes, as far as the arithmetic of the capital release goes, it obviously favors or has a greater marginal impact with those who are nearest to the minimum capitalization red line. So you are thinking PSU banks. That's the first order impact. Second order, at least within the MFI space, those companies whose early warning signals on portfolios will start to look up will now incrementally get more funding from banks. So, the winners among the MFI space and most of the larger PSUs are probably the biggest immediate beneficiaries of this. But as you started the discussion by noting, ultimately, the change in this regulatory attitude, if you will, is probably beneficial for overall lending as a whole.
But should one expect, as you said, right, that banks are anyway a bit hesitant to lend to MFIs because of the cycle that we're currently in? So for, calendar year, say 2025, will there be an incremental increase in the lending rates? Will the cost of borrowing for MFIs come down in that order, or it's too premature to think like that?
The way one should think about MFIs, in my opinion, is that ultimately it's a fairly high yield, high margin business, right? So they are not so much worried about cost of funds. And today, if you go speak to any MFI CFO, the first thing they'll tell you is if they can lock up funds, whether it's 25 basis points cheaper or dearer, is not their clear priority right now. They want to build enough and more cushion within the balance sheet for the cycle to play out. How this regulation change helps is as the as the numbers start to settle down, as they will for specific geographies, specific MFI names over the next 3 to 4 months, what you'll see is the blanket risk reduction approach that a lot of banks might have gone with as far as MFI is concerned is going to become more and more nuanced. So those MFIs which actually do not get impacted that much by the specific geographies which seem to be under stress will be the earliest beneficiaries of the changes that you have seen today.
Any names?
So, obviously we are thinking about in terms of delta, you'll have to think of single name MFIs rather than banking MFIs because, banks which have high MFI exposure do not have a liability side problem. They have their own deposits to deal with.
All right, Santanu, we'll leave it there. Thank you very much for joining us and running us through all of that. Appreciate your time here on CNBC TV18. I think we should be able to look at some of these prices, right? And how they're opening up. Maybe look at Bajaj Finance, Shriram Finance, Bandhan, Chola. So all of those should come up on your screens.
I think, Prashant, two clutch of stocks that are important. Some of these NBFCs as well as the smaller banking name that have got a relief because of this. Chola, you have RBL Bank, Bandhan Bank.
Bandhan for a bit.
Yeah, Bandhan's up 3.5%. But on the flip side, the paint moment for the cables and wires business. There is a knee-jerk reaction that we're seeing out there. UltraTech is down 1%. It's very small for them in their scheme of things. Only 1,800 crores. They generate cash flows of more than 10,000 crores per annum. They do capex of 9,000 crores or thereabouts per annum. So for them, it's a very, very small thing. For the time being, capital allocation, so it's down. But take a look at KEI. Pull up Polycab. Pull up Havells. All of them, they're getting a little bit nervous whether or not this is that moment. We'll have the management of KEI in just a bit. But for the time being, these guys, they're nervous.
And it doesn't help, right? They're all trading at punchy valuations of 40 times, etc.
Yeah.
So when you are, and it's a commoditized business. So, yeah, you can feel the heat right now, KEI.
PE derating. Right? I mean, if anything, growth baad mein dekhenge, but immediately the reaction comes through on the stock with regards to some of the P multiples getting maybe... it becomes very hard to justify any increase in P multiples, let me put it that way. And then there is some compression, I guess, as well. So I think we'll have KEI coming up at 9:30. That should give us a real sense of what this would mean and, whether this would take away from the listed players, their market share, etc. So Mr. Anil Gupta is going to be with us. And of course, on that capital allocation question for UltraTech, Mangesh Badang will be able to answer some of those questions as well. I think there's 5 minutes to go for the market open. Let's bring in Sudarshan and Mitesh. Sudarshan, any trades?
Well, consider buying Voltas with a stop under 1250. Voltas.
Mitesh, Voltas. Mitesh, what about you?
I think Bajaj Finance, which has been in a range of 85.50 to about 81.75, is a buy for me for targets of 8700. I think it's opening around that 85.50 mark. Once it clears that high, I think it should head towards 8700 shortly.
And all these KEI, Polycab, these kind of names, Havells, if you're looking at the pre-open rates coming up, Mitesh, I think looking,
So, Prashant, I think, exactly. So I think that's because of the news flow. But I think I'll keep a close watch on Havells. Havells on the last 3-4 occasions has taken support around 1490, 1500. If it starts breaking that, then I think there's a significant correction coming in.
Okay, all right. Well, thanks a lot for that, Mitesh. We'll come back to you to revise the calls with regard to the markets. Let's focus on one of the metals names, though, Hindalco. Kotak has come out with a note and they have upgraded the stock to buy from reduce. The target price as well goes up to around 725. They've gone ahead. They've increased the EPS estimates by around 2.5 to around 3.2% for the next couple of fiscals on better margins at Novelis, and they see some kind of upside risk. They are saying all this talk with regard to, this tariff concerns, with regard to the pressure on the spreads. At current, at current levels, well, they are saying that the valuations actually are attractive. And that's why risk-reward is attractive from here on. Scrap spreads, that was the concern, right? They're saying that has bottomed out and it will only improve from here on, which bodes well for Novelis. With regard to this Trump's tariffs, they say that in the past we have seen that this is actually a pass-through. Even in 2018, Novelis had a pass-through clause. So they're saying that should give some kind of comfort. Besides that, they're also focusing on the volume aspect. Novelis volume growth could be around 6% on a CAGR basis over the next few years. Remember, the last few years, they've been functioning at optimum utilization levels. So the volumes have been stagnant. So volumes will come back for Novelis. Even in the Indian operations, they're undertaking some capex. And that's why volume upturn will be seen even out there. So what they're basically highlighting is those concerns seem to be overblown on scrap spreads, the tariffs in the United States, and the pressure on aluminium prices. That explains why Kotak has gone ahead and upgraded Hindalco.
All right, so that is Hindalco for you coming up. Now, the other one, of course, is Ultratech, right? And we want to just pull up the stock price, as Nigel earlier pointed out. It's just about 1.5% lower. Nigel, but what's the street making of this one?
Well, you know, the street basically is a little bit disappointed because this has come out of nowhere. It's the cleanest play in cement. It's the king of the ring. It's battled all competition. But for the timing, the reason the stock has opened up a little lower is because of the capital allocation concern. Some part of the street was said, well, you'd rather do it in Grasim. Why are you doing it through here? To give you the basic numbers, 1,800 crores is what they're putting over the next 2 years. They're going to set up a facility in Bharuch. And by December 2026, they believe the operations will commence. What attracted them to the cables and wires business is growing at 13-14%. The market size is 80,000 crores, headed to 1 lakh crores. So there is potential out there. And 30% is the unorganized market. Also, they could gain from backward integration with regard to raw material coming in from Hindalco, aluminium as well as copper. And they're basically focusing on strengthening Ultratech building solution, which has around 4,400 outlets. Margin-wise, well, it'll be relatively lower. ROC-wise, it'll actually be relatively better if you compare Ultratech cement business with the potential that they could get from the cables and wires business. What the street doesn't like, capital allocation worries as well as Grasim. It could have been done under Grasim. How do the numbers stack up? 1,800 crores you're putting in. Revenue potential could be around 7,000 crores. Margins could be in early teens. For Ultratech, it's very small. They generate 10,000 crores of cash flows. This will be less than 10% of their annual capex plans as well. Jeffrey says if there's a knee-jerk reaction, which we are seeing, it'll provide a buying opportunity. So that's the big story today. Ultratech moving into the cables and wires space. Not too good for them, but even worse for the cables and wires players that are seeing sharp downtick.
All right, we've got the first rates coming up on your screen. Right in queue, what do we have? It's kind of mixed, but blinking literally on the Nifty Bank, at least red and green. Now, okay, there you go. I think settling down now. 0.2 higher on the Nifty, so let's go with that one first. 0.4 on the Nifty Bank, so it's up. It's up in a decent way, at least to begin the day. IT index is flat on your screens. You got some 2:1 in terms of advances to decline ratio. More up than down. The Nifty heat map is coming up into view as well. Let's just have the Nifty Bank as well. Yeah, there you go. Half of 0.45 on the Nifty Bank at this stage. And it's opening up as we speak. Lots of banking and financial names at the bottom of the screen. And of course, we'll look at how names like Ultratech and that cable and wire segment is opening up as well. But I mean, at the index level, it's a good start, guys.
Well, banks outperforming. The Nifty Bank is up nearly 200 points, 0.5% gain at opening. The top gainers include Shriram Finance, Bajaj Finance, IndusInd Bank, where 9.5% of its loans go into the MFI sector. IndusInd Bank has seen some buying. That's up 1.5%. And big boy, HDFC Bank too, is holding up in the green with a gain of more than 0.5%. So banks on the front foot today. Other than that, Wipro stands out in the tech pack. It got very close, or it maybe even breached the 200-day moving average in Tuesday's trade. But Wipro has bounced back from that critical support, and that's up nearly 1%. Reliance Industries is stronger today, so that's holding up and helping the Nifty and the Sensex keep itself up in the green. Hindalco on the back of the upgrade is up 1.2%. JSW Steel also up nearly 1%. Tata Steel up in the green. Metals had a rough session on Monday and Tuesday, and there is some rebound that you can see. On the way down, Ultratech Cement, it's a big 3.5% fall on Ultratech Cement. Top Nifty loser, two-wheelers in the red, 1% lower for Hero MotoCorp and Bajaj Auto. And other stocks down in the red include Trend, SBI Life and BPCL. All in all, it's a mildly positive green tick on the Nifty and the Sensex. So benchmark indices holding up in the green. It helps that the RBI has turned accommodative, so that's pushing up the banks. Crude prices too have eased to about $72.5 per barrel. But the mid-cap index is absolutely flat, in the red right now at
Well,
the
that's
index
right.
level.
That's right, Reema. You know, Ultratech cement, that's a little bit lower because of capital allocation woes. The street would have liked them actually to focus on their core cement business. So that's down close to around 4%. But take a look at the nervousness in the cables and wires business. Polycab, 10% down. Massive volumes out there for the first minute of trade. KEI, down 10%. Massive volumes out there. Havells, down close to around 9%. RR Cable, down close to around 8%. Those stocks are taking it on the chin as we speak. Big downtick is what we're seeing out there. A few more stocks are a little bit lower on high volumes. You have Inox Wind. That stock is lower. RVNL, well, that one as well has, both of them have opened up a little bit lower. Inox Wind, in fact, is actually opened up. So good up move is what we're seeing on that one. RVNL is down close to around 2%. What else is moving around? Credit Access Grameen, I think there was a good green start out there. AB Capital as well. Big green start is what we saw, so a good uptake on that one. And Transformers and Rectifiers, they're guiding for better times ahead. Well, that stock as well is, up and about in today's trading session. So the headline index still holding in the green. The level you need to look at on the upside is 22,650. And the Nifty Bank, the good news this morning is it's made yet another higher high. Over the last few days, the trend was it was making lower highs, lower lows. So the hope is that that one could lead it for the bulls from here on.
All right. The market open is good, right? 40 points is bad for cables and wires, but otherwise it's a decent kind of start. I'll just mention a few names very quickly. Bandhan is the biggest volume-led gainer. It's up 7.5%. It's followed by Chola, which is up about 4%. IndusInd is up next 2%. Shriram Finance is up 3.5%. So the top 4 volume-led gainers are all from the banking financial services space. And actually throw in a RBL, which is up 5%, 167 on RBL. Look at Credit Access, 7% gains on Credit Access, 922 in the MFI space. We'll have the Muthoot management join us in a bit. Stock's up 2.5%. It's back above 2,200. The management of Sirma was with us in the morning at 8:30. Sirma is starting 8% in the green. So 456 on Sirma. So the stock taking, the market taking note of some of the commentary, I guess. I don't think there's any fresh news flow it's reacting to except that. IDFC First is up 2.25%. There is Inox India, which is up 6%, all with decent volumes here. So 962 on Inox India. There is AB Capital, which is up about 3%. AG's Logistics is up about 3%. And so it goes. But this is, the bulk of the big volume-led gains that we have on our screens at this point in time. And of course, I think, on the downside, by the way, the market breadth is flipped. It's 1,300 stocks down and about 850 stocks which are higher right now. It's the overall NSE market breadth. And of course, cables and wires taking a hard knock this morning. We have Manishi Ray Chaudhary with us, Chief Executive Officer at Demur Capital Partners. Manishi, good morning. Good to have you with us here. So if an institutional client calls you this morning, Manishi, for a view on cables and wires and says, well, guess what? You got Ultratech entering the space and I own Polycab and I own Havells and I own KEI. What would you tell them?
I will tell him 2 things. Number one, as Finance 101 tells us, unrelated diversification, non-core diversification is always bad news. And if the promoters of the company decide to set up a new company entering this business with their own money, that's fine.
Manishi, from the point of view of cable and wire companies, Ultratech we'll talk later.
Right.
But for the incumbent players in the space, sorry, go on.
Right. That's the second bit. And secondly, when company or a group which is cash rich and has the proven ability to raise cash in the capital markets, when they enter a new segment, that's always bad news for the incumbent players. This particular segment is, it had been for the past several years a benign oligopoly. So when you have a large group entering this sector, it creates a degree of, it obviously creates a degree of uncertainty. And that is what we are seeing now here. Many of these companies that have today declined about 9 to 10%, they were also trading at rich valuations. So a very small piece of bad news is enough to prick that bubble.
So better to get out on day 1 of the fall, Manishi, if one is an investor in cables and wires?
It would obviously depend on the kind of position that one has. Over the longer term, over the next maybe 3 to 5 years, this sector is definitely attractive. But what investors should do now is to very carefully assess the kind of valuations that they're paying for, get out of the relatively expensive stocks, may stay invested in the relatively cheaper ones, and also the kind of niche market leaders. We're actually seeing this not just in this sector, but in all across India. It's the market leaders who are able to command pricing. It's the market leaders who are able to gain market shares. So I think for the foreseeable time horizon, that would be the strategy to play.
So Manishi, now back to the broader markets. We've had a very nasty knock. We knew it was coming, given the kind of one-way rally, the valuations. It's just that when it comes, you feel so unprepared, and there is pain. Do you think there is more pain that lies ahead of the Indian markets, or are we closer to the bottom for the large caps and the mid cap and small caps?
Honestly, it does not surprise me. I have been saying this since late last year, and on your channels also, that India is overvalued. And at that time, in late September, early October, Indian valuation premium compared to Asia ex-Japan was about 90%. Now that has declined. Nifty 50 or BSE Sensex, the frontline indices, their valuations have declined. 1-year forward P declined from 24 to 25 to about 20 right now, which is closer to the long-term average. Having said this, I must still point out that earnings estimates are still declining. Over the past 6 months, I think both small caps, mid caps, and the frontline indices, EPS estimates, consensus EPS estimates have declined about 10 to 12%. I personally think that in certain sectors, it's likely to continue for some more time. There are some sectors, let's say IT services or some of the other exporters, where I think the currency has been a tailwind. So there has been a bottoming out of those earnings estimates. But it's difficult to take a call on the market bottom right now. I would possibly be in a wait and watch mode. There are two variables I would look at. Number one, I talked about the earnings estimates on an overall basis bottoming out and beginning to recover. And second, the currency. We are seeing some good signs there also. The dollar seems to be moderating, but I would possibly, be in a wait and watch mode for these two variables right now.
Okay, all right. Hi, Manishi. Good morning and good to see you in. Manishi, but, India has gone through a period of underperformance, right? I mean, if you compare MSCI India with China, with, the developed markets as well, do you think that from here on, give and take everything, the valuations, the economic activity on ground, the accommodative stance from the RBI, the kind of measures we've heard from them in the last 50 days or so with regard to the rate cuts, OMOs, Forex swap, and now, they've been mostly accommodative. Do you think India has a good chance to outperform from here on?
I think there are a couple of variables, domestic variables, that have changed for the better. First, as you rightly pointed out, the RBI's relatively more accommodative stance compared to even about a month or two ago. Second, this injection of money into the hands of consumers, which we saw in the budget, 1 trillion rupees of tax breaks. It would obviously take time for the beneficiaries to spend more. And for that, maybe another quarter to get that reflected into corporate top lines and earnings. But at least these are, variables that have turned for the better. But remember that at the same time, there are some other variables that have turned for the better in some of the larger markets in Asia. For China, DeepSeek changed everything. It focused attention on the Chinese tech companies and their ability to reduce the tech usage costs across the world. At the same time, China also expanded their consumption support program in January. Their own version of Cash for Clunkers program was expanded significantly to include smartphones, wearables, etc. So it seems that China is now increasingly focusing on consumption support, and that would get reflected in the meetings that are coming up. As you might be knowing, between March 5th and 6th, they had the 2 sessions meetings which are possibly the most important trigger to look at, as far as the Chinese markets are concerned. So, while domestic variables have changed for the better in India, some of the other options in the Asia ex-Japan markets are also increasingly looking more attractive to the foreign investors. And I think, we have to balance both sides. So it's for the next 1 quarter or so, I would possibly be in a kind of a wait and watch mode on India, as I, kind of said just now.
All right, Manishi, we will, no, absolutely. Wait and watch seems to be broadly the theme out there. Let me just quickly take a look at, if things have changed around at all for these cables and wire companies. Nothing at all. KEI is down 10, Polycab is down 10, Havells is down 8, RR Kabil is down 11. So these are steep, sharp knocks which are coming through at this stage. And Ultratech is down 4. So Ultratech started down, with a 1% cut tentative, but is down a full 4%, and is the #1 volume-led loser at this stage. So that's what's coming through. I mean, the mood in any case is not all that great. And on top of that, negative news flow. I mean, you basically get hit twice with twice the impact than in sort of up markets. Manishi, thank you very much for joining us. Great speaking with you. Appreciate it very much. Nigel.
Well, let's focus on the big story. Ultratech Cement. They are focused on entering the cables and wire segment with a capex of around 1,800 crores. To understand the impact on the company, that's Ultratech, we have Mangesh Badang, who joins us to help us out with what would his preference be from cement and what they should have ideally done. And the stock that's under pressure, KEI Industries. Mr. Anil Gupta, the Chairman and Managing Director, joins us on the show. Good morning, gentlemen. Thanks a lot for joining in. Well, Mr. Gupta, I'll come across to you first. Another big name coming into your space. You have close to around 10% of the market share. Do you think the industry is big enough to accommodate a large name like Ultratech Cement? Do you think that, in fact, you're going to be under pressure from here on? Because that's what the stock market believes.
Nigel, I'm absolutely clear that this and the market space is big enough to give space to another player. Number one. Number two, Ultratech will take minimum 3 years to start their production. Whatever somebody may say on paper, 2 years, but we have our long experience in developing the industries. Number three, it will take minimum another 3 to 4 years to, or 5 years to develop the brand for wires, and also to get the, if they come at all in the cables, it will take many years to get the approvals from different customers, different utilities, different departments, and also develop their channels. Secondly, this space is having thousands of customers. It is not like cement that you sell to some distributors and then they further distribute. Here, lot of businesses we are doing B2B, where we are having direct relationship with the customers, and our SQs are too many. Our number of items we deal with, the number of type of cables we deal with is too many. I mean, no company can do it in unless they are focused on an industry for at least 15 to 20 years. So I have no reason. We are export focused. We have a lot of marketing team in place. So I don't have any fear about it.
Okay, all right. Mr. Gupta, you're putting down some points, and you believe for the next few years, at least, Ultratech will only be able to make a material impacts in the next 3 to around 4 years, according to you. And you believe the industry is large enough to accommodate another large player as well. My question to you is, going by what happened in the paints division, and their foray out there clearly disrupted the space, and margins came under pressure as well. Do you think it will put a risk to margins of cables and wires companies like you?
Absolutely not. We are already working on very thin margins of anywhere between 10.5% to 11%. And I mean, a newcomer, their costs will be much bigger. I don't think that, and they will take time to scale up the production. So I don't think that it will bring any pressure on the margins. Also, they are a listed company. They also have to make money. So they may not be able to disrupt the market by just slashing the prices, because it is in this space it is very difficult to increase the prices once you slash them.
Just one more point, sir. The unorganized market is around 25 to 30%. So do you think all of you all will prosper and you all will take away market share from the unorganized market? Is that the way you see things, from 25-30%, the unorganized market, say, goes down to mid-teens? Is that the way you're working with?
Unorganized market will always work differently. Means, till even now we have no competition with them. They have a separate segment of, markets where they work. But our markets are always organized, and we have to compete with the organized players.
What is the difference, Mr. Gupta? Hi, good morning, Prashant here. That question is in the context of basically whether Ultratech, a new player, will go after your and other organized players' share, or will they kind of organize the unorganized? So what is the difference? As you say, you compete with organized players and not really unorganized, and that's a separate segment.
Yeah.
No, what's the basic difference in your industry between, as you said, you compete with the organized space and the unorganized will remain, is a separate segment. What's the basic difference here?
See, it's not unorganized means the companies, who may be working with bill or without bill. I don't know. I'm not commenting on that. But I don't know what is the definition of unorganized. Unorganized may be very small players in the market, and whom you call unorganized. I can only say that we are going to continue to compete in the organized market, and the market is growing rapidly, and not only in India but also geographically. We have a lot of footprints in India as well as outside, and I don't see any impact on our business for next 10 years and our growth also with Ultratech coming to this business.
Will you have to spend more on distribution? Will you have to just give us a size? What is the size of the industry? What is it growing at? And what's the growth rate you see for the next few years? And will you quicken the pace of how well you distribute it across the country? Is there a geographical aspect to it? Just some of those things, sir.
See, we are already present all over the country, and so far as distribution is concerned, we have our distribution channels in every part of the country now, and our models will continue to take our distributors along with, so that we continue to get the market entry into new spaces. Market is growing rapidly in terms of industries, real estate, where the wires goes. So far as cables are concerned, they goes into the infrastructure, new industries, and power energy sector, and as well as exports. So the market, I think, will be growing anywhere between 13 to 15% year after year, and no one player can garner this kind of market. It is not copper or it is not cement that one or two players can monopolize.
Okay. Since you mentioned copper, Mr. Gupta, I wanted to understand, do you think Ultratech will have some kind of benefit because their group company Hindalco is into aluminium as well as copper, or you believe that raw material availability is not a big benefit to them? Your analysis?
Yes, it will not be a big benefit to them. Reason is, no company would like to subsidize one business to the another. So and even if one subsidized by 1%, how does it matter? Import channels are also open. So I have seen that in this context, we can continue to depend on imports. There are other players in the copper coming up, like Kutch Power of Adani, and Vedanta is already there, and imports are already easily available. I don't think that there will be any problem so far as supply chain of copper is concerned.
Mr. Gupta, just a couple of questions. Just to reiterate, you don't expect margins to come under pressure. It should stay at 10 to 10.5%, right?
Yes, absolutely.
But you have plans to expand your margins by 150 basis points by FY28. You've guided for that in the past. So what happens to this margin expansion target?
There will be no problem in margin expansions, because this comes by economies of scale. And I said that we have no fear in our growth plan of 20% plus for next 5 years, doubling our turnover to 25,000 crore. And we are rapidly growing in the export markets. I see that in next 2 years, 20% of our sales will be coming from export markets. We are already well established. We have a lot of approvals in many developed countries. So I can assure that there is no reason to worry.
So no risk to 150 basis points margin expansion by FY28. You maintain your revenue target of 25,000 crore by FY30, which means a 20% plus kind of revenue CAGR from here, and exports should hit 20%. Is that correct, Mr.
Yes,
Gupta?
absolutely.
Okay. And you also have a capex plan. I think you've already acquired 60 acres of land. Do you get the sense that, with Ultratech also coming on board, many companies are planning their capex, there could be a bit of an oversupply situation? Or would you rethink your capex?
No, there is no question of any rethinking of capex. In this year, we are doing a capex of close to 800 crore, or next year the capex will be 1,000 crore, which is ongoing at our new plant coming up at Sanand. And in the next financial year also, we will be doing a capex of close to 800 crore. We will not be reviewing or reducing our capex plan, and our growth trajectory will remain the same.
Okay, all right. Thanks a lot, Mr. Gupta, for joining in. You're trying to allay concerns of investors. For the time being, they're very, very nervous. But as you're saying, no change in your growth plans, no change in profitability. Industry is big enough to accommodate another big player. Thanks a lot for joining in. Well, let's hop across to Mangesh. Hi, Mangesh. Good morning. Thanks a lot for waiting by. Mangesh, why did they do this, right? I mean, Ultratech, the purest play on cement, the king of the ring, they have been maintaining their profitability. Why would they do something like this? Your first take on it.
Yeah, good morning, Nigel, and thanks for having me. Yes, the same question. So basically, what we have seen is that historically, the Aditya Birla Group has tried to, create certain pure plays who have growth bigger in the segments that they operate in. And most of the conglomerate business was in Grasim, which is basically the holding company of the group. Even the paints foray that they announced was announced through Grasim, and this is a relatively smaller investment compared to the paints business what they have invested. So we are also surprised that why they choose Ultratech as a vehicle to invest in, and whether the next stage of investment. So they basically mentioned that they want to be part of the entire construction value chain. So the jitteriness would be on whether next set of investment would also be routed through Ultratech, whether it will have an impact on capital allocation through cement. So that's the big question, and it's in that sense it is quite interesting to see whether where this corporate structure goes from here on.
So you're saying there's a risk that there could be further capital allocation in this non-cement play, and that could be a risk, right?
Yes.
Okay. The stock is down now 4%. If I put in the numbers, this is less than 10% of their annual capex, this 1,800 crores approximately. Their cash flows are superb, 10,000 crores per annum. In that scheme of things, the stock is down 4-5%. Do you think part of the bad news is in the price? And if there is no additional capex in non-cement businesses, do you think then the stock looks pretty well placed? Because after all, it's corrected from more than 12,000 rupees plus to these levels.
Yeah, see, the current correction is not because of any cut in numbers, because anyways, the foray that Ultratech has announced, that will probably get completed by end of FY27. And as my former speaker said, that probably it's going to take 3 years. So basically 2 to 3 years, I don't see, financials getting impacted much. But as I said, it's largely based on sentiment. So we need some more clarity in terms of where the next set of investment is going to come from. And whether now Ultratech is, because probably the operating cash flow of the business is relatively better, whether this will be used as a vehicle to finance most of the new ventures of the group. So that's where the uncertainty lies. So if there is more to come from here on, definitely I don't see this as a buying opportunity. But if I have to look at it purely as a cement play, definitely I would buy it.
Okay, and in your cement picks, where does Ultratech come in there? What is the top buy?
Yeah, those are large cap names that we like. We like both Ultratech as well as Ambuja. And the third one we would like to pick currently based on the regional dynamics is Shree Cement, which we feel is interesting.
Okay. All right. Thanks a lot, Mangesh, for joining in. That's the only question I've heard from all sell-side analysts. Why? Just why would you do something like this through UltraTech Cement? For the time being, the stock is down close to around 4%. We'll have to wait by to see whether or not they have bigger plans with regard to putting money in non-cement businesses. For the time being, UltraTech is down, but the bigger pain is in the cables and wires businesses. Let's slip into a short break. On the other side, we'll get chatting with George Alexander Muthoot of Muthoot Finance. We'll be joining in to tell us about RBI's approval to open 115 new branches. Stay with us for that conversation.
and some earnings expectations, and that led to money coming out of India. I certainly don't think the bull case for India has changed, but I think with all long-term bull markets that you have, and that's what we believe is happening in India, you will get these pullbacks and a reset, and I think you'll see a return of FII, certainly in the second half of the year, once those valuations get back to those long-term averages. There are a couple of themes I'd like to go through there. I think the internet platforms in India, the duration of growth that you have within the Indian internet platforms is quite extraordinary. And I think that's something we'd be very interested in. So whether that's the food delivery side, whether that's the online travel side, whether it's the fintech side, those are all businesses that we're familiar with, and we'd be very positive on those on a longer term basis. And I think this pullback gives a good opportunity within those individual areas.
Welcome back. The mid-cap index is down nearly 0.5%. And outside of the cable and wire stocks, Inox Wind has a cut of 7%. Vijaya Diagnostic, it rallied hard on Tuesday towards the end of trade, and now it's giving up some of its gains. IEX has taken a knock. Ola Electric is under pressure, and Ola Electric is now 63% off from its 52-week high. And railway stocks like RVNL, Ircon too are weak in trade. Cuts there of about 2.5%. But what's holding up in the green and going strong are the banks, NBFCs, MFIs. So Abhishek is here with more.
Rima, RBI has reduced risk-weight asset requirement for bank loans to NBFCs, and this is with respect to the momentum that you are seeing with the growth rate that has actually tapered down. So when the growth rate was about 30% YOY with respect to bank loan to NBFCs last year in October-November period, at that time RBI had put brakes and RBI had increased the risk-weight asset at various categories. Now that growth rate has declined to 7%. 7% YOY as of December sectoral data that RBI gives out, and that has put the comfort lid with respect to, pulling down the risk-weight asset requirement that RBI had placed when the going was very aggressive. So restored, risk-weight asset requirement with respect to bank loans to MFI sector by cutting the risk-weight asset requirement by 25%. Bank loans to NBFCs also by 25%. So this augurs well with respect to, the funding requirement that NBFCs do get in, as lower risk-weight asset would make it attractive for them to go to bank borrowing as well. So some of the, analysts have written note on the same. We have from IFL Securities, which states that, about 7 to 170 basis point of CET1 benefit is seen for banks, with a higher benefit for Bandhan Bank. About 170 basis point of CET1 ratio benefit occurs due to this risk-weight asset requirement being lowered down. Bank of Baroda, Ujjivan as well as IndusInd Bank. So some of the key movement with respect to stock price that you are seeing is of Bandhan Bank, Credit, RBL Bank, L&T Finance, Chola, Shriram as well as AU Small Finance Bank. Back to you.
All right, Abhishek, thank you very much for that. So that is financials, but let's just stay with financials with specific news flow with regards to Muthoot Finance. We have George Alexander Muthoot, Managing Director at the company, now joining in. RBI has given them approval for opening 115 new branches. Mr. Muthoot, great to have you with us here. Thank you very much for your time. Prashant this side. Good to see you always, sir. You've got approval to open 115 branches. Could you give us a sense of what that means for business momentum at Muthoot?
Thank you, and good morning to you, Prashant. So, occasionally or periodically, RBI gives approval to Muthoot Finance to open branches. Last year also, maybe around this time, or maybe a little more later, earlier last year, we also received permission to open about 115 branches. So 150. So I think when we finish that, we have for the next list of branches, and now it's just a usual routine procedure that they give us permission for these branches. Now, the fact that for gold loan companies, customers are more comfortable to bring their gold or precious ornaments to the nearest branch and give it to them. In fact, 99% of customers prefer to come to the branch banks to deposit their gold, and gold has to be deposited for giving a gold loan. So opening of branch will definitely help us to increase our reach in newer locations and also increase the customer convenience for gold loan sector. Today, gold loans is a flavor of the market. More and more people are using the gold loan finance to get their money or their cash requirements. So opening up these branches or giving permission to start these branches is definitely good for Muthoot also.
In terms of the growth guidance, does that change because of this?
At this point of time, I don't want to change any guidance. We have given some good guidance last time also. So let us wait for a month. But on that question, the business is looking quite good this quarter also. So we are quite happy with the growth which is happening in this month also. So I'm not changing any guidance, but certainly there will be better performance this quarter also.
Your guidance was for 25% AUM growth. Is that correct?
Yeah, I think 25 to 30 was your guidance, I think. So
25 to
probably, we usually give a 15% guidance year on year. We don't have been not changing that. Of course, we have been able to do much better in many years, maybe 20, 25, 28, etc. We've been able to do. And this year looks good, actually.
Okay, so 25 to 30% AUM guidance stays. How has Q4 been for gold loans? Because Q3 was solid. Your AUM growth was about 37%. I know that's boosted by festival demand, but how has Q4 shaped up so far in the first 2 months, sir?
As I said earlier, Q4 is also looking good. We see good demand, especially in newer areas, and more and more customers are, as I said, utilizing this facility to get their funding requirement. As I said earlier, today, with all this noise in the unsecured loan space, etc., many banks and NBFCs have gone slow in the funding for unsecured loans. So there is definitely a need for funds, and people are using the gold loan as a easy method, easy way to get finance. And finally, money needs to go into the hands of people. The purchasing power of people definitely needs to improve, and I think this is helping. And together with the with the RBI's note about the risk weight of loans to NBFCs. I think all this augurs well for NBFCs and certainly augurs well for Muthoot also, because the availability of credit from banks will certainly be higher. The allocation by banks to NBFCs would be higher. Of course, about the interest rate reduction, maybe it may take one quarter or more to see some reduction in the interest of loan from banks.
So for your Belstar MFI, you're saying Q4 things may not change, but Q1 FY26 onwards, we could see a reduction in cost of funds. And how much do you think it could bring it down by?
I'm not very sure. Probably 50, 60 basis points is what we see there. But of course, one important thing there is that microfinance in the last quarter, this quarter, etc., nobody is growing. Everybody is just consolidating their books. So the need for funding also is much lesser. Having said that, probably the reduction of cost reduction may certainly be there in the next few months.
Okay, so that 50, 60 basis points is cost of funds for you, is it? Eventually,
yes,
it
exactly,
could be that much.
Exactly. Cost of funds, yeah. Cost of incremental borrowings.
Okay. For gold loans, Mr. Muthoot, what is your incremental loan to value ratio, sir?
The loan to value today, actually, if you look at the total portfolio today and today's gold price, our loan to value is only about 63%. But we give up to 75%. People take 60, 65, 70, and quite a few people take 75% also. So whatever is the requirement is what we give. Today, because the gold price is also high, if you see the whole book today, the loan to value is only about less than 65%.
Overall, it's less than 65%.
Yes.
A loan to value. But you can go up to 75 is essentially what you're saying. Mr. Muthoot, just one quick thing. I mean, we've had a dizzying rally in underlying gold prices, right? Very, very sharp move. It's like, in a way, maybe not like any other financial asset, but it's also like any other financial asset. We can see sharp moves either way. If we were to see a sharp pullback, Mr. Muthoot, in underlying gold prices, how would that impact you, a lender?
Yeah, the incremental lending would be based on the current gold price. So today the gold price is falling. The new loans loan tenure is only 4 months, 4 months, 5 months. So the new loans will be given at the new LTVs only, the new price. So since we do that, there's certainly a risk mitigation mechanism. And mind you, we go only 75% maximum.
Okay, maximum of 75%. Mr. Muthoot, thank you very much for joining us. Appreciate you sort of being here on the program, and good seeing you as always here on CNBC TV18. Thank you and good luck. I think we have the management of Titagarh Rail with us, Rima.
Yes, Titagarh Rail Systems is on our radar. In Q3, it was a muted performance for them. They were impacted by order execution delay. But the companies also announced its ventures into 2 new areas of growth. One of them is shipbuilding. They're present in it right now, but they want to expand it. And the second one is setting up safety and signaling systems. Umesh Chaudhary, Vice Chairman and Managing Director at Titagarh Rail Systems, is now with us on the show. Umesh, morning. Thank you for joining in. This is Rima here. So first, let's talk about these, 2 new growth areas. One is shipbuilding and maritime, where you're already present, but you want to expand it. So what's the current size and how much do you want to scale it up to, and what are the steps that you're taking? And secondly, in the safety and signaling systems, lay out your growth plans.
Sure. Good morning, Rima. So as far as the shipbuilding and maritime systems is concerned, we have done a number of vessels for the Indian Navy. We have done some vessels for the Indian Coast Guard with GRSA. We have also exported a vessel. We have done ocean research vessels, but they were all done in our yard in Titagarh, which has physical capacity constraints. There's the water draft and the air draft capacity constraint. So considering the policy initiatives of the government of India, which in the budget we heard about shipbuilding and maritime systems by the Honorable Finance Minister being said a number of times, the board decided that since we already have the pre-qualifications, We already have the necessary soft skills, etc. We should look at this as a growth area. When we took up the passenger rail system business expansion a couple of years ago, I had also on your channel said that we would not be making any capital allocation for next 1.5 to 2 years in the shipbuilding. But now that we have almost come to a completion of the passenger rail system investments, we thought that this can be the next engine for growth for the company. And that's how this is being set up. The plan is to set up another yard, maybe both in the eastern side and the western side. And we will come back with the announcements as the story develops.
What's the size of your shipbuilding and maritime business? Sorry, let's just finish
So on the shipbuilding and maritime systems, we have an order book just about 300 crores. We are building about 10, 11 vessels for the Indian Navy as we speak, but these are smaller ones. And with this planned expansion, we would like to take up even the larger vessels. So as far as the scope, the growth potential of this is concerned, it is phenomenal because a very small percentage of the ships that actually, even for inland water or for specialized vessels that are operating today in India, a very small percentage is actually produced in India. And that's what the government is kind of emphasized. And we believe that the possibilities that exist in this sector are quite enormous. And having all the necessary skills, we believe we'll be able to make a very quick entry into this.
What's the capex you've earmarked?
We will announce that. We are still working on it. We've appointed the CEO. We've appointed the team. We are looking at the new yards, exploring at the different parts of the country where we would set up the new yards. So in due course, we would definitely, once the business plan is finalized, once the capex is approved by the board, we'll announce that.
And how soon, to your mind, once you complete all the setting up, the commissioning, how soon can it start generating revenues?
So the revenue will start generating immediately, but the ramp up will happen in a couple of years. So the revenue we are already generating because we have this is not a completely brand new business that we are starting. But those revenues are insignificant, I would say. So the meaningful revenue, I would say, would start getting generated from 2 to 3 years. But what is going to be important in the next 6 months is finalization of the infrastructure plans. And from the next 6 months to the next, say, 1.5 years from thereafter would be the order book that we can build up. So that's how the progression of this business in terms of the KPIs would look like.
Okay, but that's the next engine of growth, as you called it. And for safety and signaling, this is a new business vertical for you.
So again, we are already the leaders in the freight segment. We are establishing ourselves on the passenger segment. And if we really look at the railways complete ecosystem, you see, when we changed our whole focus from just being a wagon manufacturer to a rail systems provider, we had this in our mind that we should be end-to-end in terms of not the construction activity, but in terms of the system. So after the freight and the passenger, we believe that the kind of requirements that are there, both in terms of technology and in terms of quantity for the safety and signaling systems, it made immense sense for the company like us to be in that. We already have an MOU or a joint venture rather with a leader in this segment called Mermec, which was not very active. It was dormant over the last year or a couple of years. So we have initiated that, and we've already started participating in the tender. So we believe that the kind of budget, even if you look at the budget allocation that happens from the railways, a substantial part is happening and will continue to happen on safety and signaling. So we believe that it is a segment that we should not give a miss to.
Okay. And just one final question then. Q3 was a bit muted. There were delays in execution. Has there been a pickup in execution in Q4? And what are you likely to end the year with?
So, in terms of the delays of execution and Q3, it's not relating to us because our capacities are already at 1,000 wagons a month and we are fully on track to deliver 1,000 wagons a month. The problem happens because the railways were not able to give us the wheel sets, and this has been a perennial problem that has been existing for, I would say, decades. Ever since I came into this business, we've been having sporadic problems on wheels, and the Railway Ministry and the Government of India really took a definitive step for the first time in independent India, wherein they awarded a contract to set up a new wheel plant, which is being done by us and Ramakrishna Forging in a joint venture. So, of course, that will take its time to come in. It will take by 2026, it will start production. But for the time being, railways have been ramping up the production in their own rail wheel factory. It's not yet completely streamlined, or it's not become normal. We expect that in the next month, maybe March or April, wheel supplies from the railways will start getting normalized. But till then, we are continuing to have problems on availability of wheel sets.
Thank you, Umesh, for joining in. Look forward to the next one. We will slip into a very short break. We'll come back and talk commodities on the other side. Stay tuned.
But, again, and I link this back to what we were talking about, the need to adapt as well as the change as far as the business model is concerned in a Trump era, with the H-1B issue being the way that it is being dealt with at this point in time.
Welcome back. Let's talk commodities now, and Manisha is now joining in. Manisha.
Well, thank you so much for that. I'm taking a look at the crude oil prices right now because yesterday we saw 2% of a decline coming in for prices, and with that it's trading at a 2-month lows right now. Well, that is the report card on what the crude oil prices have done in last months or years. So in 1 week itself, we've seen prices decline by 5%. It's down 7% in last 1 month. And in this year until now, the crude oil prices have declined by 4%. If you look at the year-on-year prices, we're down by 12% in case of crude oil prices. Also remember 2023 and 24 as well. Crude did post both of these years into negative, and 25 hasn't started on a better note as well. As you can see, we are down 4% already in this year. But there are contradicting fundamentals on crude. When you talk about the factors which are weighing onto the prices, the major clearly comes in from potential Russia-Ukraine peace deal. If that happens, that would mean that you will have Russian oil coming into the markets as well. That would increase supplies and that could weigh onto the prices. The other point is about the tariffs on in case of crude when it comes to Mexico and China, even Canada for that matter, and that could really disrupt the markets, not see economic growth come in, and that's weighing onto the space as well. But I also want to take you through factors which seem to be supporting crude oil prices at this point in time. The major in this is the crude inventories itself. If you look at the last 7 weeks, we've seen the US crude inventories continue to decline. The latest decline has been by 2.3 million barrels, and that is supporting crude prices. And then you have to look at the US crude production itself, which is at record highs at around 13.1 million barrels. This is a major news that came in overnight where US is talking about revoking Chevron's license to operate in Venezuela. But at this point in time, Chevron really is 25% of Venezuelan exports. And if you look at that overall number, that stands at 240,000 barrels per day. If that goes out of the market, then you are looking at support coming in for prices. Apart from that, it also has to do with US buying crude for its strategic petroleum reserve. Remember, US has been saying that every time the crude prices come down, US would want to buy for SPRs. And now that the crude prices are trading at $68 a barrel, you could be looking at that buying coming in from US as well. But there are some factors which also are leading to a lot of uncertainty into the markets, with the US especially reaffirming plans to impose tariffs on energy imports from Mexico and Canada. It has talked about 10% on Canada and 25% on Mexico, but we still have to see that final paper there. And then US also is threatening tariffs on European Union goods. So that uncertainty continues to keep the markets very, very volatile and jittery as well. If you look at the Goldman Sachs report, which came in overnight, it says that the Brent prices will trade between 75 to 80, exactly where we are trading right now. So it's going to be a range-bound trend for the crude oil prices, but volatility perhaps would just about continue.
Thank you, Manisha, for that. We will slip into a break with the news that the Nifty Bank is the only sector which is currently in the green. All other sectors are in the red. And if it wasn't for the 200 to 300 nearly point contribution from the Nifty Bank, we would have been firmly in the red. The mid-cap index is now down 3/4 of a percentage point. Small-cap index is down 1%. And the advanced decline ratio now stands at 1:4. Get into a break. On the other side is our special segment, Indianomics. Lata will be in conversation with a host of guests to discuss the NBFC and MFI risk weight cut and the prepayment penalty waiver.
Mean as far as the services sector is concerned? What could it mean for Indian IT in the next few years?
So there, I think two parts to what you ask, and there I'll talk a little bit more about Infosys. We've built over the last few years a more resilient business, especially for the US. We've made sure we built out more and more local delivery and digital centers. We've got now more staff which are local. Over 60% of our teams in the US are local. We built quite a strong nearshore capability for the US. So we feel better prepared if there are any changes. So far, we've not seen any changes.
We're talking about human genius and human ingenuity as well, and we were just talking about moving from people to platform. Now, what actually happens on the workforce? Because this is a sector that has been driving, employment for a young country, for a young demographic like India. What happens to the people part of this business now? Let's talk about that. What happens to entry-level jobs, for instance? What are we talking about in the next 5 years?
So there, first, in the existing employees that we have, there's huge reskilling. So there's a constant move, especially with generative AI, but all through when we were having digital or cloud or cyber, a lot of reskilling today, at least within Infosys, over 270,000 people more ready for AI. So that's the first element. Second, in terms of new roles, we've already shared this last quarter. For the next financial year, starting April, we will recruit something like 15 to 20,000 new campus hires, which shows the same sort of direction of what we were discussing earlier, which is there is growth, there is productivity, and there is new work from these technologies. All of that combined gives us confidence to have new people joining from the campus.
Hello and welcome to Indianomics. On Tuesday, the Reserve Bank reduced the amount of capital that banks need to set aside to give loans to NBFCs and microfinance companies. Immediately, the cost of funds for NBFCs and MFIs falls, but the bigger message from the loosening of rules is that RBI seems to be determined to do everything to spur growth. Look at the sequence of events in the past quarter. First, on December 9th came the CRR cut, which brought in 1.13 lakh crore immediately into the system. Second, since Jan 1st, the Reserve Bank has infused 1.38 lakh crore by buying bonds through the open market operations, OMOs as we call it. Third, it started daily repo operations since January 15th to give banks temporary liquidity comfort. Fourth, it has done $5 billion of FX swaps in January and is doing another $10 billion swap on February 28. Together, they will infuse 1.3 lakh crore into the system. That's a liquidity increase. That's on the liquidity increase. On policy, we got the first rate cut, the first in 5 years, on February 7th. And finally, earlier this week, as I just said, lowering the curbs on loans to NBFCs. Now, separately, the Reserve Bank has also reduced prepayment penalties, and that can spur in its own way MSME borrowing. So now the big question, is all this enough to spur bank lending? More importantly, is it enough to spur growth, and will economists now increase their GDP growth forecasts for FY26? What more can RBI do? I have with me an elite panel, Mr. S.S. Mundra, former Reserve Bank of India Deputy Governor and former Chairman of BOB, now Chairman of Samman Capital, of course, Chairman of BSE as well. Suresh Ganapathy, the finance company's expert from Macquarie Capital, and Nikhil Gupta, the economist from Motilal Oswal. Gentlemen, thank you very much indeed for your time. Mr. Mundra, to you first, sir. A huge set of policy announcements, but most important is the last one, that the NBFC loans will now cost less. Do you have a confidence that Reserve Bank is going all out to improve credit growth, or should we look at it as a very incremental step? You know, if you can wear your DG hat, the NBFC's loan to NBFCs was growing at 30% in 2023. Now it has come down to 7%. We are happy, we have changed. This has got nothing to do with overall policy reset. How should we look at it?
Okay. First of all, Lata, I would look at it like this. Probably to my mind, at least I don't recall a series of events. It will be one of its points that the risk weights have been increased and then they brought down within such a short, window frame of the time. Normally, this kind of action is taken. It remains for quite some time, and before the things settle down. So, at least you may correct me, but I don't recall. So it means quite clearly the data point which are available to RBI and also the data point which are publicly available, there had been a sharp deceleration. RBI is surely, I think, looking to boost the growth. Okay. I look at it like probably the first action was kind of a message to the lending community. Lending community has responded to that message, as we can see from the data point. And now that action is reversed. So probably with the expectation that a message has been conveyed, and now this message would be kept in mind in the future behavior of the lender. So now it is for the lending community to stick to the discipline which has been brought by this. But coming back to the point, now with this kind of change in risk weight, I think around 40,000 crore of capital would be released, which can translate into 4 lakh crore of incremental lending. And now if you look at the other measures of providing the liquidity, because, okay, if you have the capital, but if you don't have the liquidity, then the end result would not be the same. So it's a combination that the capital is made available, liquidity is made available. Key question would be, to my mind, whether this incremental lending would go to the productive sector or it will go to boost the consumption. Nothing wrong in either way, but again, I think the lending going to productive sector is a more welcome situation, but then depends on what kind of demand is coming, what kind of confidence level that sector is looking at it. Consumption growth is fine, only the precaution, it should not again result into making the people over indebted. Which has its own set of problem, and then there could be in the federal system there could be actions by other players which we have already seen. So I stop it here, but this is how I look at this big picture.
Fair point, sir. Actually, to be fair, the Reserve Bank has not reduced the risk weight on unsecured loans. They're very correctly giving a message that NBFC loans need not suffer anymore because NBFC sources of funds appear to have gotten more balanced. It was too dependent on banks. Now they have kind of corrected it and depending more on market. It seems to be the spur to consumption, at least I can't see it. They've still kept the cork on unsecured loans. But Suresh, for a more immediate, reaction, do you think we can see NBFCs as the biggest beneficiaries? Their margins improve and their loan growth improves. Can we come to that conclusion?
Yeah, look, all these things will take time, Lata, to play out, right? It's not going to be quite immediate because of the fact that the liquidity in the current markets are still pretty tight. So nothing is going to happen before the end of this financial year. And then, of course, you start off on a weaker footing on April to June because seasonally it's a pretty weak quarter. So all these things will take time. A point which I would like to just drive across on this 40,000 crores and 4 lakh crore number. Look, I mean, this is all notional calculation, right? See, at the end of the day, you have to understand that the system common equity tier 1 was already running at 13.5%. This only adds an additional 20 basis points, theoretically, right? You can anyways go down to 12-11% and could have lent that money. The bigger problem is that of demand and not of supply, to be very honest. At this point in time, the RBI is doing whatever it could do from the supply side angle. We really need to see demand picking up. And for that, we have to see what could be the implications of the tax cuts and how exactly the overall market responds to that. So, of course, at the margin, the NBFCs get the relief, but I would not really immediately pencil in growth numbers coming into the financial statements for either banks or NBFCs in the immediate future.
Okay, well, actually, as we speak, Shriram Finance up 4.4%, Bajaj Finance at a 52-week high, 2.2%. Of course, it didn't go up either, so that's why the correction also is only 2.2%. But do you at the moment are not changing any of your EPS numbers for FY26 for any of these companies?
None, because look, the multiples have already gone up, right? I mean, the initial reaction to any such move usually tends to be re-rating. And then the earnings are expected to come with a lag. Right now, even despite all these measures which have been enacted, the growth outlook is still a little bit more patchy, right? I mean, if you look at it, I'm not an economist, of course, you can speak to the economist who's going to speak on this matter, but the overall GDP projections are expected to remain broadly flat. 6.3 may go to 6.5, 6.6%. So unless and until we see a very clear visibility of growth coming back, we don't want to press the gun and go ahead and
EPS button. Okay. Well, Nikhil, so this question squarely falls to you. Mr. Mundra very clearly pointed out that he has never seen such a quick policy reset. That I think nobody pointed that out so far. November 23rd, 2023, you increase risk weights, reduce it in 13, 14 months. We've not heard of this. So should we look at it as RBI in a hurry to ensure that growth comes back?
Thank you, Lata. Lata, that is not for me to say whether the RBI is in a hurry. I hope.
Is that the opinion? Is that the impression that the investors should take home?
No, I think every investor has their own opinions. I am not thinking too much on whether the RBI has done it in hurry. What I am concerned about is what the RBI has done and what could be the macroeconomic implications of that. Yes, Mr. Mundra pointed out that we have not seen RBI reversing such kind of policy so quickly ever in the past, in the memorable past at least. But just because it hasn't happened doesn't mean that there is something wrong that it has happened now. And I don't know on that. I have no view on whether it has happened so quickly or not. As I said, I hope the RBI has done its homework, and that's why they have made this decision. So, yeah, I mean...
No, my question to you is that do you see all this as a concerted policy push towards growth? And therefore, are you changing your opinion, if not your actual number, on growth, say, 3 quarters down the line?
All right. So, no, I'm not changing my growth projections as of now. And I would also want to point out that, yes, if you look at all you mentioned at the beginning of this show, various steps that the RBI has taken, but we also need to understand that what happened recently is a part of the entire sequence. And you rightly pointed out that they have not touched the risk weightage on unsecured loans. Right. So this is a very targeted measure. They want to provide probably some relief to NBFCs and MFIs, which are too dependent on bank, and especially for non-PSL borrowings. It is PSL was never into risk weights were never changed for PSL borrowings. So it's only for non-PSL, and they are still keeping those unsecured risk weightage what they were revised to in November 2023.
That's right.
So it more looks like a targeted measure where they want to probably provide some relief for NBFCs and MFIs, not definitely to boost GDP growth or to boost the consumption-led loans. Overall, it is possible that all these measures may allow some extra room to the NBFCs and MFIs to lend out more. But again, if anything, it would be only incremental, because I don't think NBFCs were too tight on supply front. They did not have money to lend to the borrowers if there was any demand. Because again, when I spoke with our NBFCs analyst, he was very clear that when in November 23, these risk weights were increased, the impact on NBFCs in terms of their cost of borrowings was not very significant. And if that is so, now when those risk weights have been reduced out, the impact would again not be so significant. So I'm not very sure if I would take it as a sign that credit growth is going to be much higher than what we were expecting.
So Suresh is not raising EPS estimates, and Nikhil is not raising growth forecasts for the coming year. But you know, why speak to an analyst, Nikhil? We have here a person who has lent loans as a banker and is still supervising an NBFC, which is lending loans for housing finance companies. So, Mr. Mundra, you know, how will a bank chairman or a bank MD or a NBFC chief look at the sequence of events? Will they press on the accelerator and lend more because they see policy in favor? Or do you think that the reality on the ground, I mean, you would know better, is the reality on the ground not such that loan growth will necessarily increase?
I think the dynamics with the RBI is thinking, if I can say so, about NBFC looks like, you know, sometime, coming nearer, then again getting far away. So there had always been concern about the interconnectedness between the bank lending to NBFCs, but at the same time, realization keeps on coming that despite the number of banks increasing, network increasing, the NBFCs continue to remain an important cog in the wheel as far as the last mile lending is concerned. And I think for a variety of reasons, banks had also been finding it a good vehicle for their overall credit growth to keep on accommodating the NBFC, which has quite constrained, as you can see from the recent data point. So while I don't think that suddenly it will create a huge kind of enthusiasm that you just open the tap for NBFCs, NBFCs would also not be expecting that. But I believe that from the point where we are at this point of time, probably there would be a more benign attitude in accommodating NBFCs for their credit needs. And NBFCs would have that capacity, while Nikhil has mentioned some point of time, but I think is a diverse field. There are many players, but I think they would, it will enhance their ability to little push up their credit. So on both sides, on the bank's books as well as the NBFC book, I won't say it will be something revolutionary or something that suddenly a great change will come, but there would certainly be an incremental positive move from this. This is what my reading is.
Okay. Incremental positive move. You know, ultimately growth comes not because there is demand, but because there is animal spirits. People somehow have the confidence to consume and take a loan, or bankers have the confidence that there is growth and they lend. Is that confidence returning? The RBI has taken another big step, allowing MSMEs a prepayment option without any penalty. That's also a very pro-growth measure, I would think. Those questions to my panel after the break. For Bazaar viewers, it'll be Chartbusters. You can hear the entire show after market hours.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC-TV18, now streaming live 24/7 on YouTube. How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajar at these times on CNBC-TV18 and CNBC-TV18.com.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest running show on startups and entrepreneurship, celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21. Only on CNBC-TV18 and CNBC-TV18.com. CNBC-TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhatt.
India Business Hour live on YouTube at CNBC-TV18, weeknights at 7 p.m.
Ultratech Cement announces its plan to enter the cables and wires business. The new business foray will require a capex of 1,800 crore rupees over 2 years. The stock corrects 4% on concerns over capital allocation.
Well, Ultratech Cement's foray into the cables and wires business sees incumbent cables and wires makers see a lot of selling pressure on fears of higher competition in the segment. Polycab, KEI Industries, both of them are down close to 15%. RR Cabell as well is down more than 10%, while Havells sees a cut of close to around 5%. The stocks are down, however, they've recovered from the low point of the day.
Microfinance lenders, on the other hand, surge as RBI relaxes risk weight requirement for bank loans to NBFCs and microfinance loans by 25%, causing a relief rally in names like Credit Access, Grameen, Shriram Finance, Bandhan Bank, all of them up between 4 to 8%.
Sirma SGS rallies closer around 1.5% to 2% on encouraging guidance. The management tells CNBC-TV18 that they expect to grow at an industry average of around 30-35%, and they're expecting margins to improve from 7% in FY25 to around 7.5% in FY26. Hello and welcome to Chartbusters. We are coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Nigel and with me is Mangalam. And as we speak, no big move in the Nifty at all. The Nifty is as flat as can be. The broader markets, they continue to see some selling pressure. But I think the banking names, that's where you're seeing a bit of an outperformance. The RBI's recent accommodative measures are boding well. And that's why that's the index that's up 320 points.
Right above my head, Nigel, but as we speak about the banking space itself, there are sources at the bottom of your screen telling you that UCO Bank may actually now defer its QIP plans. I remember correct, here itself on Chartbusters, after the third quarter results, the management of UCO Bank came by and said 2,000 crore is the enabling provision for the QIP that they have, which will take the government stake down by 3%. More importantly, roadshows were beginning and they were looking to launch their QIP in this quarter itself. But turns out market volatility may have found the QIP guys a little less takers than what the company had anticipated earlier. No big moves on UCO Bank in an otherwise strong day for financials.
Well, that's right, Mangalam. And because of the market conditions, many stocks from the broader markets have seen a big correction from the top. Some of their businesses may pretty much be intact. One such stock is Midani. Mishra Dhatu Nigam, well, if you look at the stock at the peak was more than 500 rupees, that stock has come down by nearly around half. The company, though, has guided for around 1,000 crores of order inflow in FY25. And also they are guiding for better times because of exposure to defense as well as the space segments. How are things panning out and what is their guidance with regard to the future? We're now joined by Mr. Rao, the chairman and managing director of the company. Hi, Mr. Rao. Good morning and thanks a lot for joining in. Good to have you on the show, sir. Let's focus on a couple of aspects. If I look at your performance as of the 9-month mark, there is barely any growth. But Q4 for you is the seasonally strongest quarter, right? Because bulk of your revenues are registered in that particular quarter. Given that scenario, tell us what you expect to end this year with. That's FY25 on the revenue parameter. On that base for FY26, what kind of growth are you likely to see? And give us your margin guidance. Please go ahead, Mr. Rao.
Okay. See, FY24 is the best year for Midani as we have achieved more than 1,000 crores, 1,072 crores we achieved, which were not there in earlier. But in the same way, if you see from 24 onwards, we are getting order book is booking. Earlier, we are below 1,000 crores. Now we are reaching nearly 2,000 crores. If you see January end, our order book is nearly 2,000 crores. And we are expecting some more orders for the balance period. And as far as turnover is concerned, maybe the turnover is same as last year, as our space business has come down. Space orders have completed. New orders we are expecting. So that's why the same turnover is maintained. As you rightly said, Q4 is the very important, crucial quarter for Midani, because in any defense industry, Q4 will be the boom. It will be the order book execution will be whatever 9 months executed, more than 60-70% will be executed in 9 months, with 60-70% of that book will be executed in fourth quarter. That means for this year, if you see FY25, we have executed 660 crores for 9 months, whereas for this quarter itself, we expect more than 400 crores. If that comes, definitely, our turnover this year also will surpass the last year. 1072, whatever is there, we are hoping that we will cross it.
So mildly positive revenue growth, sir, for this year, flattish year. But as you said, encouraging to see that your order book is 2,000 crores. So what does that mean in terms of execution for FY26? Are you more optimistic on prospects over there? And also, you were just going to tell us about your margin picture. So give us both those.
First, if I talk about the execution for FY26, definitely it will be more, because most of the orders what we got from the naval sector or aerospace, some development orders are there. You know, Midani is the company which is established for development of several grades. So once the grades were developed and successfully established, we will get some more orders, and whatever this is called trial order. After trial order, production order will be there. The trial order is completed, production order will be higher value. Like that, I will get more turnover next year.
So
revenue
how much
will be more.
How much more will be the turnover next year, sir?
We expect it will be, because I told you today we have 2,000 crores order.
Yes.
2,000 crores order book is there. Another 300 crores we are expecting, including space also. So definitely it will be more than the current FY25.
By how much, sir? Will you do 1,200 crores next year? 10%.
I can't tell. But
10% growth is possible, sir, next year? 10% growth?
Easy.
20% is difficult?
Little bit.
Okay, so 15%.
Why difficult I am telling? Because the grades have to be established. As I told you, some grades are under development.
Yeah.
Unless the development is completed and it's successful, production cannot be done. Clearance will not be given for production by the customers. So definitely the growth will be there more than 10%. 20% we will try to achieve, but I cannot tell as it is. Coming to margins, see, because of the geopolitical situation world across, in the year 23-24, the raw material prices have gone up. As Mr. Dhatu Nigam Limited, almost all raw materials are to be imported only. It is not available in India. So because of this Russia-Ukraine war, sponge prices have gone up by 50%, nickel prices have gone up. Certain materials, the prices have gone abnormally. But now in the year FY25, it is little bit stabilized. I mean stabilized means it is at a range of some 10% increase over the last year it has come. Due to that reason, our EBITDA margins have gone up for the year FY25. If you see last year it is 20%, now it is 25%. Third quarter is a good quarter where we were able to get good EBITDA. That is two reasons. One is the raw material prices. Second one, see in Midani, almost all materials will be used virgin materials, and we can use the plant rivets also. Whenever that it is like a scrap. If the plant rivets usage is increased, automatically my margins will increase. That is one. And the third one is yield. Yield is the very, very important thing for the Midani. If the yield improves, my margin improves. So initially I will get the yield of 30 to 40%. If the yield goes up by 45%, my margin goes up. Like that, if yield increases, when materials are produced, when expertise, that is when period goes, automatically yield also goes. We will know what technology, what our PAG has to do, where to improve the melting performance.
Mr. Rao, thank you so much for explaining to us how this business works and how your margins are likely to improve as well next year. Given your optimism of at least 10%, maybe not 20%, analysts will go with around 17 to 18% or 15 to 18% in terms of top line growth. Margins last year were 20%. This year you're saying will be 25%. Can they improve beyond that next year, FY26? If you could give us a sense of that. And secondly, exports as well. You said exports were close to 67 crore in the last year. You were expecting close to 120 crore this year. With all that's happening geopolitically, next year, what kind of export number can we do?
This year, actually, exports, Midani started exports for the last 3 years only. See, the exports also started, last of OEMs are coming forward to Midani and they are giving the small quantities order. Because no OEM gives a bulk order. They will check the performance of the supplier in the initial period because they are sourcing from India. what they will do, either Pratt & Whitney or Airbus or GE or Safran, all these people, they will give for a lesser quantity initially. Go on, they will increase. Today, I have already executed for this year 60 crores. And in my hand, I have 40 crores order. And another 30 crores order I am expecting. So probably I may, near 100 crores I will execute this year. Near to 100 crores, 80 to 100 crores. Next year, once this order is executed, we are expecting huge orders. Huge in the sense, not in thousands, it will be in hundreds only. So definitely, we wanted to cross 100 next year, FY26.
FY26, it will be more than 100 crores of exports.
Yes,
and this year, you will reach closer to 100.
Nearly 100.
Very quickly, Mr. Rao, have you heard from the government of India if they want to do any kind of OFS or any kind of selling? They have more than 70% in the company. You have heard, or that's not on the cards?
Earlier, there was a proposal in the year 21, but the government is not mentioning anything. Maybe they might be wait and see. Now, you are aware that Midani share price has gone up to 500 and now it is reached to 260. It is just because of the, this world condition and all defense sector prices are coming down. It is only, maybe it has reached to something which is far low. It is not a correct price. Definitely it will go up because market correction will be there. It all depends on the internationally what is happening.
All right, Mr. Rao, it's good to have you on the show. We'll want to have you more often. We hope to have you at the end of this fiscal year or when you declare your numbers as well. But thanks a lot for joining in, and we look forward to interacting you more often. More than 10% growth for FY26. FY25 will be a flattish year, and they're optimistic that the exports will gradually pick up. For the time being, slip into a short break. But on the other side, we'll focus on the big story. Competition concerns for cables and wires players, they are back. As Ultratech, they have eyed their foray into the space. The management of RR Cable will be joining in on the other side. Don't go anywhere.
A bit unusual, but not totally unprecedented, because in the last decade, 2015 we had a similar situation, 2017 also. At least 4 to 5 occasions in the last decade, temperatures have been in the range of 37 to 39. So you can't call it unprecedented, but yes, it's a bit early, a little bit unusual.
So ma'am, can we expect a dip in the temperature in the next 5-6 days? Is that a possibility?
You can expect a small dip, but not a dip that will give you any respite.
The story of this morning has been the cables and wires industry after Ultratech has made their announcement of a foray into this business with an investment of 1,800 crore over the next 2 years. Well, the jury is still out on what Ultratech does, but everyone's very worried about what happens to the cables and wires business because, you know, Aditya Birla Group entering a segment has disrupted the segment. The most recent example of that has been with the paints industry itself. And the stock market tells you that. RR Kabel down almost 13%, and that's not the only stock. We have a bunch of other stocks as well, the likes of KEI, Havells, Polycab, all of them lower, some off lows, but most of them still sitting with cuts. Rajesh Jain, who's the Chief Financial Officer of RR Kabel, now joins in to discuss this itself. Thanks a lot, Mr. Jain, for joining in. And, you know, that's the first question. Mr. Birla, entering the cables and wires space, are you worried about increasing competition in this space? Not from the, new disruptor, but also the incumbents, because everyone will now look to protect their turf. In light of all of this, what happens to your own growth plans and margins?
Thanks for us having on your channel. See, if you see, this is very big industry and like almost 85-90,000 the industry size was last year, and it is further grown by almost 13 to 15%. And this is such a fragmented industry, and there are not many even unorganized player also. So if a big player comes like this is always a nice move where more strong player will be like get bigger margin of market share. And though it is very like quick reactions from market, and it is very like on negative side market is concerning. But what I see, this is like for players like us, it is good time that we can also have our growth plan intact, and we see good consolidation in market. But it is not that much like disruptive what market is reacting as per me.
No, Mr. Jain, the problem is when the Birla Group went into paints, we know what happened over there. Those stocks were trading at a high multiple of 65, 70 times approximately. From there on, we have seen only competition got, very, very aggressive. Profitability has come under pressure. Now, for a company like you, for the time being, you're saying there is enough space. You know, Ultratech as well can come and be part of the pie. The fear is your growth plans could get altered. Will that be the case? What are the growth plans that you have, say, for the next few years? Industry, as you said, is growing in early teens. And also your profitability, sir, is only at around 6.5% approximately, which could come under pressure with a new player. Your comment on both these two, revenue growth and margins.
Yeah. So first, when we see from like margin point of view, first you need to see that it will take at least like 2 to 3 years to come into production, and again getting a sizable size of production and getting established in market. It may be another journey of 2 to 3 years. So it will altogether like 4 to 5 years minimum to take sizable size even in this overall industry, which will be like around 1.5 lakhs by FY 28 or 29. So that is one vision. And secondly, see, from profitability point of view, it is not about pricing. It is more about the own strength of every company. Every company, if you see, like right now we have 4 to 5 players, and every one have their own pricing strategy, own market placement, and plant placement. If pricing is the only criteria, then the lowest one will in the industry can have 80-90% of market share. That cannot be possible in any industry. So for me, it seems that whosoever have a good quality, good distribution channel over the years, like even if you see, it takes time of 15-20 years to build that kind of dealer channel, distribution channel. And this is quite different from paint industry also, where you have very limited number of distributor, and but in wire and cable.
So Mr. Jain, Mr. Jain, you're saying it's not a threat. What kind of growth can you deliver from here on? And what kind of profitability can you deliver? Because the street is very, very nervous. Your stock price is down 12%, but you're saying that things will be fine. So give us your aspiration then. Industry is likely to grow in early teens. I think it's 80,000 crore industry that goes to 1 lakh plus crore. What about you?
So we'll always like aim to grow at the higher end, higher from the industry growth, and profitability, of course, since we are at the lower side of the ladder, so we have our own plan to improve and bring into like double-digit margins by the FY 28, and that is our ambition for wire and cable industry. And growth, of course, it should be higher than industry growth.
Mr. Jain, typically what happens when, a large disruptor does enter the industry, and this is something that we've seen in the paint industry as well, while they aim for the top couple of spots, which is what, the Aditya Birla Group has its stated intent as well, to be in leadership positions in, the segments that it operates in. The lower market share participants are either looking for consolidation or looking for sale, etc. Do you think there is a possibility where an offer is made for a company like RR Kabel by any of the existing players or Aditya Birla Group itself, you all would consider sale?
No, I think this is pure guess from your side, but nothing is on board like that, and we are
not a guess, sir. Not a guess. We're talking about possibilities, sir. Instead of getting into a rumble, it's like getting into somewhere. Someone is writing a big check and saying, Mr. Jain, we rather give you a good offer. You don't participate in this race. You take the check and move away. Could that be an option?
No, I cannot comment on that right now.
Yeah, sure. No
position to comment on that.
Okay, and again, we reiterate, it's not guesswork, right? In the paint industry as well, while the Birlas entered, everyone was looking at the top two. AkzoNobel decided to fold its operations in India. So that's something that we were, trying to see whether that plays out in an industry like yours as well. But just finally, before we let you go, for the very near term, you have a target of 15% volume growth in the fourth quarter. Next year, you're targeting 15 to 20% sort of volume growth as well. Those are intact with margins around, almost 100, 150 basis points improvement that you've been targeting every year. Will that happen at least the next couple of years?
Yeah. Yes, we are on track and we are focusing on that only. And our focus is how we achieve growth in terms of volumes and value and improving our profit margin. And this will not be changed by this development.
All right, we take that point and we will obviously keep connecting with you as and when we get more developments in the industry, not just, from the Birla side, the incumbents, but also from your end as well. Thank you so much for joining in and giving us your time and explaining to us the situation. For now, you're not worried, but the street seems to be a little worried with a decline of 12.5% in your stock price and that of all the other cable companies as well. Take a short break, come back, focus on the markets, and we will, look at individual stocks which are moving around too.
Over the last decade, if you're a global asset allocator, where would you have made money? You didn't need to put money offshore from the US over the last decade. What we would say there is that the valuation differential between EM and DM now is at its largest point that it's been for many years. Therefore, when we're being approached by our global clients, they're very much aware and cognizant of the fact that they have a large overweight in the US and they tend to have large underweights in emerging markets. What I would say is that when we look at emerging markets at the moment, we're very constructive on emerging markets. When we're looking at India itself, I think the selling pressure here really has come about from the tremendous bull market which we've had in India over the last 3 years. And as we went into the end of last year, valuations on India became stretched. So all it took was a slight slowdown in the credit markets, in the credit cycle, in loan growth, and some earnings expectations, and that led to money coming out of India. I certainly don't think the bull case for India has changed, but I think with all long-term bull markets that you have, and that's what we believe is happening in India, you will get these pullbacks and a reset, and I think you'll see a return of FII, certainly in the second half of the year, once those valuations get back to those long-term averages. There are a couple of themes I'd like to go through there. I think the internet platforms in India, the duration of growth that you have within the Indian internet platforms is quite extraordinary. And I think that's something we'd be very interested in. So whether that's the food delivery side, whether that's the online travel side, whether it's the fintech side, those are all businesses that we're familiar with. And we'd be very positive on those on a longer term basis. And I think this pullback gives a good opportunity within those individual areas.
When we started the show, the light on my head was green. That was the Nifty Bank. And now it's on Nigel's head as well. Nifty and Sensex, both of them in the green. The problem is the middle of the two of us. That's the mid-cap index, which is currently in the red. So that's something that we'll keep an eye out on through the remainder of this day. For now, we'll leave the markets mild green. The mid-cap index in the red. The Nifty Bank doing a lot better. With that, let's wrap up on Chartbusters. Trading Hour comes up next.
Good morning. Welcome to Thursday's edition of Trading Hour. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. I am Rima. With me is Vivek, and it's very, very quiet on the benchmark indices. It's just blinking red and green on the Nifty and the Sensex. The problem is in the broader markets, the mid-cap index is down close to about 0.8%. The small-cap index is a cut of more than 1%. But thank God, we've got the banks which are holding up. The Nifty Bank is the only sector which is currently up in the green, and that's got a gain of close to about 300 points. All the other sector, whether it's metals, real estate, auto, IT, all in the red.
Absolutely right. It's a news-heavy, handover that we received post, the one-day break that we've received. And like you mentioned, it's only the banks that have managed to hold out, especially banks with NBFC exposures. they are the ones that are actually gaining the most or that have the most beta. Look at names like AU Small Finance Bank, RBL Bank, Bandhan Bank, these banks with their MFI books, these are the ones that are doing very well in the session. All of them up close to 5%. The other set of stocks that are doing quite well are the NBFC pack. Remember, because the risk weighting as far as bank exposure or borrowing to NBFCs is concerned, that too has been significantly reduced. And on the back of that, have a look at L&T Finance, Aditya Birla Capital, M&M Financial Services, Chola, all of these stocks doing quite well. And the other set of stocks that are doing quite well are the MFI names and the small finance banks. So Credit Access Grameen, that stock is the top gainer when it comes to the NSE 500 index. Ujjivan Small Finance Bank, 5-Star Bills Finance, these are stocks that are doing quite well. But one sector that you've been focusing on since morning is the cable and wireless bank. One large entrant, and overnight most of these stocks have taken a hit of close to 15 to 20%.
Indeed, big PED rating. KEI Industries opened with a cut of about 10%, but now it's down close to about 18%. So the sell-off is only deepened as the days progress. But these are the two big stories. Banks on the way up, NBFC banks, MFIs on the way up, and on the way down, you've got Ultratech Cement and the cable and wires stocks which are under pressure. And these two themes are dominating today's trading action. So let's address them. Abhishek is now joining in with more on banks, NBFCs, MFIs, and how RBI reducing the risk weight benefits these.
Well, to begin with, RBI has reduced the risk weight requirement for certain loans that are being given by banks to certain categories like MFI, NBFCs, etc. So bank loan growth to NBFC, which was growing at a rapid pace of 30% plus in November of last year, that is November of 2023. Prior to that, it was growing at 30%, and that's when the brakes were put on. So RBI had increased the risk weight assets at that point of time for loans that banks gave to NBFC various segments. So out of that few segments, the risk weight assets, that requirement has been lowered down because the loan growth, which was around 30% plus at that point of time, has now gone down to 7% YOY growth as per December data of RBI. So they have restored the risk weight asset requirement for some of these segments like loans to microfinance segment. The risk weight assets have been reduced by 25% with respect to requirement over there. And bank loans to NBFC over there also, the risk weight assets have been lowered by 25%. So what this means is that effectively the cost of funds that the other lenders borrow from banks, that will see a marginal tape off given the fact that risk weight requirements have come down. So IIFL Securities has written a note. They say that 7 to 170 basis points CET1 benefit they see for lenders, especially banks. So a higher benefit is for Bandhan Bank, Bank of Baroda, Ujjivan and IndusInd Bank. And if you take a look at the stock prices, they augur the same. Back to you.
Thank you so much, Abhishek, for joining us and giving us a sense of the entire move that benefits the BFSI space. Well, the other set of stocks that are in focus are the cable and wiring companies. Remember, Ultratech Cement has planned to enter the cable and wire segment. Upasna is here with more details and the kind of sell-off that these companies have seen today.
Well, cables and wire segment is under pressure today as the street fears the competitive pressure with the entry of Ultratech's Cement foray into the cables and wires segment. Now, Ultratech plans to enter cables and wires segment with an investment of 1,800 crore over the period of 2 years, and the company aims to meet the growing demand for wires and cables across various sectors. Now, cable and wire industry has witnessed a CAGR of nearly about 13% between FY19 to FY24. And with the entry of Ultratech, this may intensify competition for the existing large players. Now, if we look at the FY24 market share of the top players, Polycab stands at 26%, KEI at 12%, and Havells around 11%. Now, brokerages like HSBC is of the view that this is likely to have a material impact on the growth and margin trajectory beyond FY27 for these players, and it has lowered the target price of the major players from 7 to about 23%. Smallest cut for Havells, but similar cuts for cables and wire names like Polycab and KEI. Now, if we come to Havells, the HSBC has a buy rating on the stock, and the target price is cut by nearly about 6.5% at 1,730 per share. Polycab, the brokerage has a buy rating, and target price is cut as high as 20% to 6,250 per share. KEI, it has a hold rating, and target price is cut by 23% to 3,450. And lastly, RR Kabel, it has given a buy rating with a target price of 1,260. Now, Jefferies believes that it foresees a lower competitive impact on Polycab as compared to other B2C players like Finolex and Havells, and it has preferred Polycab as one of the key picks in the segment. Now, Morgan Stanley says that this has come as a big of a surprise, but it foresees no concern going forward for these companies. So all in all, cables and wires segment is under focus, and Street fears high competitive pressures with the entry of Ultratech Cement into the space.
The Street fears, Upasana, but the management so far at least seem to be holding the faith, because we chatted with KEI Industries earlier today and they believe that the cables and wires industries can accommodate another large player, and it will take them at least 3 years to start production and then another 3 to 4 years to start building the brand, and therefore they don't think the entry is going to disrupt the industry anytime soon. Listen in to Mr. Anil Gupta of KEI Industries.
This and the market space is big enough to give space to another player. Number one. Number two, Ultratech will take minimum 3 years to start their production. Whatever somebody may say on paper, 2 years, but we have our long experience in developing the industries. Number three, it will take minimum another 3 to 4 years to or 5 years to develop the brand for wires. They may not be able to disrupt the market by just slashing the prices, because it is in this space it is very difficult to increase the prices once you slash them. There will be no problem in margin expansions because this comes by economies of scale. And I have said that we have no fear in our growth plan of 20% plus for next 5 years, doubling our turnover to 25,000 crore. And we are rapidly growing in the export markets. I see that in next 2 years, 20% of our sales will be coming from export markets. There is no question of any rethinking of capex. In this year, we are doing a capex of close to 800 crore. Or next year, the capex will be 1,000 crore, which is ongoing at our new plant coming up at Sanand. And in the next financial year also, we will be doing a capex of close to 800 crore. We will not be reviewing or reducing our capex plan, and our growth trajectory will remain the same.
Well, that was the management of KEI Industries saying and remaining confident that they don't need to reduce any capex plans going forward. But we'll now slip into a short break. Up next, we'll discuss what's buzzing in the commodity space with Manisha Gupta.
Again, and I link this back to what we were talking about, the need to adapt as well as the change as far as the business model is concerned. In a Trump era, with the H-1B issue being the way that it is being dealt with at this point in time, what could it potentially mean as far as the services sector is concerned? What could it mean for Indian IT in the next few years?
So there, I think two parts to what you ask, and there I'll talk a little bit more about Infosys. We've built over the last few years a more resilient business, especially for the US. We've made sure we built out more and more local delivery and digital centers. We've got now more staff which are local. Over 60% of our teams in the US are local. We built quite a strong nearshore capability for the US. So we feel better prepared if there are any changes. So far, we've not seen any changes.
We're talking about human genius and human ingenuity as well, and we were just talking about moving from people to platform. Now, what actually happens on the workforce? Because this is a sector that has been driving, employment for a young country, for a young demographic like India. What happens to the people part of this business now? Let's talk about that. What happens to entry-level jobs, for instance? What are we talking about in the next 5 years?
So there, first, in the existing employees that we have, there's huge reskilling. So there's a constant move, especially with generative AI, but all through when we were having digital or cloud or cyber, a lot of reskilling today. at least within Infosys, over 270,000 people more ready for AI. So that's the first element. Second, in terms of new roles, we've already shared this last quarter. For the next financial year, starting April.
Welcome back to Trading Hour. Well, let's now shift our focus to the commodity space. Manisha joins in, and today we're focusing on copper, right?
Well, yes, we are, Vivek, and that is because the copper prices have been very, very volatile. We've seen prices gain up by 2% on Tuesday night, and yesterday there was some profit taking. So for this week, now we are in the negative by nearly 2%. For the month, we are still 7% on the higher side. And when you look at this year, copper is one of the better performing metals there with nearly 13% of gains. Well, the latest volatility comes in after US has ordered investigation into potential tariffs when it comes to copper imports within the country. Well, when you look at the US markets itself, US imports nearly 45% of its copper needs, and much of that really comes in from China and various American states there. When you look at the copper prices, there has been support also because of the demand coming in from conventional sectors, and then electrification, military and construction as well. So everywhere that you look, the markets seem to be really forecasting that going forward in the next 4 or 5 years, you could be looking at copper deficit growing in the international markets there. Importantly, it is about Chile, Canada and Peru, which account for nearly 90% of refined copper and mining into the international worlds. China's investment also in Congo seems to be increasing. So China is in a very strong state. If you look at smelters as a number, there are more than dozens that China has vis-a-vis 2 that US has. So clearly, this is to ensure that the dominance that China has and various other countries can be brought down. But at this point in time, even as you are looking at various investments coming into these countries, China's Congo investments are much on the higher side, and Congo, by the way, is the second largest copper miner at this point in time. So there's a lot moving in the international markets right now, and how the tariffs impact, and if the tariffs do come in, how they impact copper availability is something that the street is looking for. At this point in time, we've seen some buying come back into the Asian and the European markets.
Thank you very much, Manisha, for that. We'll get into a break. Before that, here is a small programming note for all our viewers. CNBC-TV18 and HSBC India are back with Season 2 of SME Champion Awards. The prestigious platform celebrates SMEs that are pushing boundaries, making an impact and shaping the future. Nominations are now open. Scan the QR code now. Submit your entry for SME Champion Awards Season 2.
Something like 15 to 20,000 new campus hires, which shows the same sort of direction of what we were discussing earlier, which is there is growth, there is productivity, and there is new work from these technologies. All of that combined gives us confidence to have new people joining from the campus.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go.
Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC-TV18, now streaming live 24/7 on YouTube. How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajar at these times on CNBC-TV18 and CNBC-TV18.com.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest running show on startups and entrepreneurship, celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21, only on CNBC-TV18 and CNBC-TV18.com. CNBC-TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of
Welcome back. Let's talk about the market technicals and where we are headed, because the sell-off in the mid-cap space is accelerating. The mid-cap index is now down more than 500 points. So it's a bit worrying. Shivangi Sarda from Motilal Oswal Financial Services is now joining in. Shivangi, it just looks like there is banks and then the rest of the market which is under pressure. What have you made of today's trading session? The strength in the banking index, does it have more legs to carry on from here? Because after the gap up, it's not that it continues to build on the strength. And what about the rest of the market? What is the index telling you?
Very good morning, Rima. Thank you for having me. So we've seen that absolutely rightly said that banking index is one side of the market and the rest of the market is trying to pull it down, especially IT, which has dented the entire market. Now, coming to Nifty first, we've seen that, after the slightly negative opening, we've seen that there has been some sort of a range-bound move. Now, Nifty index has got stuck within a very narrow range from the last 3 trading sessions, which is making the option premiums quite sticky at these levels. India VIX has cooled off, which is kind of creating some sort of lackluster move within a band here for Nifty. But the good part is there is a base formation that the Nifty index has been respecting. Now, talking about levels, we are expecting a strong support at 22,250 marks. But for the expiry point of view, which is the monthly expiry, we could expect some volatile swings in the last hour. So 22,250 would be an important support to watch out for the upside levels of 22,800 marks. So upside is slightly capped because of the call writers, which are still yet to unwind their position for the fresh leg of rally. Now, talking about Bank Nifty, we have seen outperformance here. Clearly, NBFCs are also supporting and contributing majorly from the last few weeks to this index. Now, the smaller banking names, which were earlier showing interest, at the start of the week, have now again started to pick up, especially some of the PSU names. So these stocks will be on radar, but Bank Nifty is comparatively better placed than Nifty. So we could go for a bullish stance in Bank Nifty for the next levels of around 49,500 with a support of 48,500 zones.
Thanks, Shivangi, for your index level views. Any individual stocks you're liking or you feel can be shorts at the current point of time?
Absolutely. So first on my radar is Bajaj Finance. So we've seen that this stock has come out of its cluster zone, and 8,500 earlier was the level which the stock was not able to surpass. So now clearly there is a pole and flag pattern formation breakout on the daily frame. Now stock has been excellently respecting its key exponential moving averages on daily frame, and even on the month-on-month basis, we've seen follow-up is quite strong after the breakout. So overall, stock is quite well placed. There has been long built up in this one consistently in this entire series, and rollovers are also quite positive for the next series that we welcome. So, recommending a buy here with a target of 9,050 levels with a support of 8,500 levels. Now, the second pick on my radar is SRF. This stock has been witnessing a good short covering move. And after the, softness of the last 15 trading sessions, we are seeing buying interest emerge here again. Now, the dent wasn't so much, so there has been a pullback move from the exactly retracement level, which makes it quite positive here. Now, there is a good potential upside for this one with a good amount of call unwinding happening. So recommending a buy here with a target of 29.80 levels and a stop of 27.90.
Thank you so much, Shwangi. SRF recall, had an analyst meet recently and a whole host of brokerages have come back quite positive. But as we now slip into a short break, here's some good news for our viewers. India's business news leader is now just a click away. Introducing CNBC-TV18's all-new app. Get instant access to breaking news, in-depth articles and financial world updates at your fingertips. Download the CNBC-TV18 app now from the Apple Store or the Google Play Store, or just scan the QR code on your screen.
And more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhatt.
India Business Hour live on YouTube at CNBC-TV18 weeknights at 7 p.m.
What investors should do now is to very carefully assess the kind of valuations that they're paying for, get out of the relatively expensive stocks, may stay invested in the relatively cheaper ones, and also the kind of niche market leaders. We're actually seeing this not just in this sector, but in all across India. It's the market leaders who are able to command pricing. It's the market leaders who are able to gain market shares. I have been saying this since late last year and on your channels also, that India is overvalued. And at that time, in late September, early October, Indian valuation premium compared to Asia ex Japan was about 90%. Now that has declined. Nifty 50 or BSE Sensex, the frontline indices, their valuations have declined. 1 year forward P declined from 24 to 25 to about 20 right now, which is closer to the long-term average.
Similarly, if you go within MFIs, you'll realize that a lot of the reticence or reservations that banks have with lending to certain MFIs has to do with how they perceive the fundamentals of the MFI business today. But you have nailed it when you said that this is a critical communication of regulatory intent. Yes, there's been focus on liquidity. We have already seen rate cuts, and these are probably the first signs we are seeing of credit policy easing, and that bodes very well for the sector, both banks and as well as NBFCs. It shows that the regulatory focus is shifting from towards growth accommodative in a meaningful way, and that has to bode well. I absolutely agree with you. As far as the arithmetic of the capital release goes, it obviously favors or has a greater marginal impact with those who are nearest to the minimum capitalization red line. So you are thinking PSU banks. That's the first order impact.
I'm absolutely clear that this and the market space is big enough to give space to another player. Number one. Number two, Ultratech will take minimum 3 years to start their production. Whatever somebody may say on paper, 2 years, but we have our
Welcome back to Trading Hour. Well, the sell-off as far as the broader end of the markets continues to accelerate. The small cap index is now down almost 1.6%. The Nifty continues to trade very flat, but with a slightly negative bias. Manish Jain, head of fund management from Centrum, joins us now to discuss market fundamentals and his top sectoral picks. Thank you so much for joining us, Manish. Would you at this point of time have a look at any of the cable and wiring companies? All of them are now cheaper by 15 to 20% since the start of the day.
Yeah, this whole carnage, if I may use that term, in the last 1.5 months has been pretty unrelenting. And it's not just about one sector or the other, but if you do a very careful bottom-up sort of an analysis, then what I think you'll realize is that across sectors today, and specifically more so in the small cap genre, you will find a phenomenal number of companies that have all corrected anywhere between 30 to 40, maybe in some cases 50%, where the dent in earnings has not really been very significant. These have all now come down into what you call basically as a value zone, where you have anywhere between 10 to 20 P multiple on a 1 year forward basis for companies that you're looking at, still confident about 20% plus sort of earnings growth from that perspective. So my sense over here is that this is a market which is not meant for panic. This is a market which is not meant to sit on the sidelines, but we are reaching a point where we are almost at the bottom end of the whole, bear rally, and the turnaround, in my view, is just around the corner. So take advantage of that situation and actually put in more money where your conviction is.
Manish, so incrementally, where will you be allocating funds?
Like I said, I wouldn't look at it more from a top-down perspective, but more have a bottom-up approach. There are sectors where we've seen a very significant amount of correction, where we are, at least as a fund house, deploying our money. There is the NBFC space, which looks very interesting at this juncture. There are hospitals, there is hotels, which are again looking very, very interesting. Manufacturing companies, selectively discretionary consumption companies, retail companies. So in that genre, in that basket. And if you have more of a value orientation at this juncture, looking at a large capish sort of a portfolio, then maybe large cap banks also are not very bad at this point in time.
Manish, sorry, just to get the view on Havells, KEI, Finolex, if someone has a position, an investment in these stocks, what is the advice?
So the sector looks interesting. These are good quality companies, great management, and all of them, like we discussed at the beginning of this call, they have kind of corrected fairly significantly from the peak. But from a 3-year perspective, the outlook kind of looks absolutely intact. So I would actually hold on to my positions, if not top it up.
Understood. So you don't mind actually adding on to some of these names. So what do you do with a name like Ultratech or companies that have significant capex, especially in fast-growing sectors? Is that would you buy the dip over there as well?
Cement at this moment, probably not, because there are more interesting ideas that are available in the market in the sectors that I outlined earlier. Where the risk reward is much more favorably inclined, where the stocks have gone down in a value zone. So if you look at the whole market very carefully, and if you scan the whole universe fairly carefully, I think the realization that you set is that there is a lot of money to be made at this juncture, provided we have a little bit of gut, a little bit of gumption, a little bit of conviction to back ourselves. Then there are stocks that are available at now in the small cap space, 10, 12 PE multiple, looking at 20 plus earnings growth at a peg of 0.5. I wouldn't necessarily want to bet incrementally big on cement sector at this juncture. Probably not, no.
Do you want to tell us some of these small mid caps which are trading at 10, 20 times PE?
So like I said, there are NBFCs that look very interesting. There are hospitals which are looking very, very interesting. There are hospitality stocks, particularly in the hotel space, which are looking very, very interesting. Some of these South-based real estate companies which are looking fairly interesting. So small and micro cap is a space where I'll go at this juncture, because the time to be defensive, in my view, is kind of completely over. Right? That defensive portfolio is kind of over. I think Q3 earnings was the bottom of it. Earnings growth will improve. There is a rate cut that has happened. I think the market stabilization is coming through now, and you will see Q1 onwards market starting to rally back again. So I think I'll prepare the portfolio with that orientation in mind.
Manish, bold call, you're calling for the bottom as far as Q3 was concerned. Now, within financials, you said you do have a preference for NBFCs. Now, one space that's seen quite a bit of selling pressure has been the MFI space. Is that a space that you like? Would you add, positions over there? And any sectors that you would like to avoid, even at this point of time, post-correction?
Yeah, probably I wouldn't incrementally look at betting big on, say, something like a pharma. That's one sector that I'll probably avoid a little bit. I'll be a little selective as far as my calls on autos are concerned, for example. Again, wouldn't be betting big as a basket over here. But as far as NBFC and banks are concerned, see, the call is fairly simple, which is that the whole asset quality cycle that we've seen emerging out in the last 2 odd quarters or thereabouts I think is by and large now looking like it's going to be over. Probably by Q4, you should see the bottom end of it. And Q1 onwards, you should start seeing improvement in asset quality coming through. So from that perspective, if you have, as an investor, 6 months sort of a patience to weather out the storm, I think it's a great time to build positions in the NBFC and in the large cap banking space, where we do expect a little bit of traction to come through in consumption and consequently in the overall credit growth because of the RBI rate cut. I don't think one is going to be enough. There are going to be probably at least, if not two, then at least one more rate cut which is going to happen. So because of that, the sector should get a little bit of a traction with the asset quality bottoming out. I think it's a great time to actually look at the sector. It's a little contra call, but I think should work.
And in real estate, it's only the South-based real estate companies which look interesting to you.
Yeah, because,
why is that? What are the tailwinds?
See, the larger developers tend to be a little more expensive from a risk-reward perspective, right? The valuation gap is massive. But the smaller developers, especially the South ones, have not really had a great quarter this time. So the correction has been fairly intense over there. So from a valuation perspective, purely valuation perspective, the risk-reward tends to be much better over there.
Manish, two sectors that have borne the brunt of selling pressure due to tariff-related concerns. Number one has been auto, also on the back of a likely disruptor coming in. How do you view auto at the current levels? And pharma, you said that you will stay away, but post April 1, will you take a relook at the sector?
See, when you look at the whole tariff war situation with US, and there's some little bit of analysis that we've kind of done in that space, there are three sectors which are going to get burnt the most if and when that incremental tariffs from US happen. Number one is going to be pharma. Number two is going to be chemicals. And the biggest, I think, is going to be textiles, right? So in that order. Now, from that perspective, and given the rally we have had in pharma, given the valuations where they are from a 2-year perspective, I think pharma is probably best avoided at this juncture, especially, like I said, when there are so many opportunities which are available in the market, not necessary to lean on pharma at this juncture. So that's how I'm looking at things. But other than that, I think autos, not as a basket. See, more from a, disruption perspective, when you look at EV, I think it's going to be a long-drawn battle, and I'm assuming you're referring to the entry of Tesla eventually at a certain point of time. Then the point is EVs are a long way to go as far as disruption is concerned for a meaningful contribution to the bottom line perspective. Infrastructure still kind of continues to be a fairly bit of a challenge. EV is still never going to be your first car that you buy. It's always going to be a second, maybe third car that you'll buy. Because even in a city like Bombay, Delhi, charging infra is a huge problem. But having said that, if you get an interesting bet at this juncture, especially in the four-wheeler space, maybe not two-wheelers, I wouldn't really mind having a look at it with something that can be a little bit of a leaning towards, say, entry-level cars, maybe something that could be a leaning towards, the value segment. Right. The people who are salaried 12 lakhs of income and less, which can be target audience for that, I think that can be a great bet to have, especially given that the pipeline inventory has all cleared out in this current quarter.
Thank you so much, Manish, for joining us and giving us your views on the markets as well as your fundamental picks, in terms of sectors especially. Time now for a short break. The management of Seagull India joins us to discuss their future outlook and more.
Gross NPA of the lenders increased by more than 32% in H2 FY24 versus H1 FY24. This compares to a decline of 32.5% in H2 FY23 when compared to H1 FY23. We had highlighted in May of 2024 that rural market has come under stress. Q1 FY25 showed further deterioration in their asset quality. So from May of 2024 to now, most of the lenders have given negative returns versus positive return that you are seeing on Nifty.
But on to our series of year-enders, and we are putting the spotlight today on the microfinance sector, and it witnessed pain in this year, and that is expected to continue in 2025 as well.
Developing the industries. Number three, it will take another 3 to 4 years to or 5 years to develop the brand for wires, and also to if they come at all in the cables, it will take many years to get the approvals from different customers, different utilities, different departments, and also, develop their channels.
A bit unusual but not totally unprecedented, because in the last decade, 2015 we had a similar situation, 2017 also, at least 4 to 5 occasions in the last decade temperatures have been in the range of 37 to 39. So you can't call it unprecedented, but yes, it's a bit early, a little bit unusual.
So ma'am, can we expect a dip in the temperature in the next 5-6 days? Is that a possibility?
You can expect a small dip, but not a dip that will give you any respite.
Welcome back to Trading Hour. Well, Seagull India is in focus as the company achieved financial closure for 2 of its projects in Uttar Pradesh. Bhagat Singh, the Group CFO at Seagull India, joins us now to discuss this as well as the outlook for FY26. Thank you so much, Mr. Singh, for joining us. First up, give us a sense of what exactly the financial closure means in terms of execution for the Ayodhya bypass project that you have on board. When do collections actually kick in for this particular project? And what kind of margins can we expect from you in this particular project?
Good morning. Thank you for inviting us for this session. So we are pleased to inform you that the company has achieved the financial closure of both our Ayodhya HAM projects. So precisely, we are going to construct the 2 HAM projects measuring 67.57 kilometers in the UP region, Ayodhya. And we are expecting that the work will start precisely. We are going to receive the appointed date for both the HAM projects in the month of March or maximum by April 25. And this is going to create a very positive impact, not only for the Seagull India Limited, but yes, for the overall infrastructure development of the Uttar Pradesh. By securing this contract, Seagull India Limited has proved its credentials to be one of the key players for executing the large size EPC projects for India.
Understood that. Mr. Singh, the other thing which we want to ask you, especially in terms of EBITDA margins, Q3 when we saw EBITDA margins, there was a significant dip. Give us a sense in terms of upcoming projects. What are the projects where you're getting paid for execution? What are the projects where you're actually performing the O&M part of the entire road project. So we understand that O&M margins will be higher, and going forward, what is the kind of steady state EBITDA margins we can expect?
Fine. Before that, I need to make you understand what is a HAM project precisely. In the HAM projects, 40% of the payment you receive during the construction period and remaining 60% is payable to the concessionaire in the coming 15 years in the form of annuity. And the entire O&M of the project will be done by the concessionaire itself for the rest of the 15 years. Now, coming to your point on EBITDA, I would like to once again clarify that the company EBITDA margin is divided into two parts. One is pure EPC margin, which the company derived by executing the road projects, pure EPC work, be it metro, be it a road projects. So that the company has given a guidance in our last earning calls also that we are maintaining between 11.5 to 12.5. That is for sure. Now, over and above that, the other incomes which contribute towards the further elevation of EBITDA from pure EPC to the total EBITDA, that is FDR income, royalty income, bonus and claim. Now, all these incomes are irregular income and it's booked by the company as and when received, because claims are received whenever it is sanctioned and approved paid by the authority. Bonus is received when you complete the work beforehand from the authority. Other income is received when you have the FDR. Now, in each and every quarter, these four types of incomes are not regular and is received as and when awarded by the authority. As far as FDR income is concerned, we are expecting FDR income to decline and PBT to be increased further, because post-listing and post the AA rating of the company has been able to release its FDR from the banks and is utilizing the released FDR from the banks for further supporting its NWC position and reduction of a debt. On account of a reduction of a debt, the company is able to save a substantial amount of its financial cost, which is contributing towards the further improvement in the PBT. So the margin we are expecting to continue further in the time to come, but we need to understand the bifurcation of the total EBITDA into pure EBITDA and the other income. And as far as the future outlook is concerned, I would like to further emphasize the fact that the company is working for the further modernization and growth with a massive vision of 5 to 7 years. We are not basically a road company or a highway company. We are a infrastructure company having a diverse presence across more than 13 states in India, and our focus is not only towards road. As we speak, we have an order book of 13,000 crores with a good diversification into roads. We are into metro projects, we are into railways projects, we are also into tunneling. And going forward, our focus is also towards water and irrigation projects, solar projects, and that for a EPC. So we are towards a path of building a well-diversified order book.
We get that. Right, Mr. Singh. Mr. Singh, so currently at the end of Q3, where did your order book stand at? Q4, what has been the order inflow so far? End of FY25, where will the order book be? And FY26, what is the order prospect pipeline?
Our order as on Q3 last 31st December 2024 was 11,702 crores, which is reported. We have guided to the investors that we would be receiving, we are targeting to receive an order inflow of 5,000 crore in the financial year 24-25, against which we have already received order inflow approximately touching 4,500 crores. Remaining 500 is left, and so we are expecting that in the coming of the March, what we have already bidded contracts worth rupees 23,000 crores towards various authorities. So we are expecting that in the month of the March, if the bids get open and we turn out to be L1, we are expecting that this difference of 500 crores would be fully recovered. Going forward, in the times to come, we are expecting that we are targeting to get order inflow of 5 to 7,000 crores, precisely 1.25 times to 1.5 times of the turnover that we are going to execute every year, to keep our order book 3 to 4 times of the revenue book to bill ratio in the future.
Understood that. Now, talking about the order prospect pipeline, could you give us a sense, especially as far as NHAI ordering is concerned? It's been quite muted as far as FY25 is concerned. FY26, what are the kind of indications you're getting? Also, in terms of the bids that you actually go ahead and participate in, what is the win ratio that you typically have? So that will give us a sense of the order prospect as well as what is it that Seagull can garner.
As far as the orders slow growth rate is concerned, so your point is correct, and I accept that point. But I think it is a matter of a concern for those companies which are heavily relying on the authority and they have a low order book as we speak. As far as Seagull India is concerned, so as I mentioned, we have a good order book giving a visibility of next 2 to 3 years with high degree of certainty. So it is not a cause of a concern for Seagull India, to be very precise. Going forward, as I mentioned, that we are targeting a good tendering and good bidding in the water and irrigation and solar segment and more structure work. Metro station, we are expecting a good growth prospects, good tendering in the metro stations work also. So we are expecting a good order inflow across all these sectors in the financial year 25 to 26. As far as the winning ratio is concerned, so strike ratio in the past used to range from 10 to 20%, and we expect that in the future for FY 25-26, we will be able to maintain this strike ratio. But one thing I would like to specially mention here, the fact is, for us, what matter is getting an order with the envisaged EBITDA margin and providing a good, consistent return to the investor rather than maintaining a strike ratio.
Thank you so much, Mr. Singh, for joining us, giving us a sense of the order prospect pipeline, as well as the update as far as the financial closure for the Ayodhya bypass projects were concerned. Well, time now for a short break. We'll get you excerpts of our conversation with Vijay Jaipuria, who's the CEO of Delhi International Airport, on the other side.
Over the last decade, if you're a global asset allocator, like, where would you have made money? Like, you didn't need to put money offshore from the US over the last decade. What we would say there is that the valuation differential between EM and DM now is at its largest point that it's been for many years. Therefore, when we're being approached by our global clients, they're very much aware and cognizant of the fact that they have a large overweight in the US and they tend to have large underweights in emerging markets. What I'd say is that when we look at emerging markets at the moment, we're very constructive on emerging markets. When we're looking at India itself, I think the selling pressure here really has come about from the tremendous bull market which we've had in India over the last 3 years. And as we went into the end of last year, valuations on India became stretched. So all it took was a slight slowdown in the credit markets, in the credit cycle, in loan growth, and some earnings expectations, and that led to money coming out of India. I certainly don't think the bull case for India has changed, but I think with all long-term bull markets that you have, and that's what we believe is happening in India, you will get these pullbacks and a reset, and I think you'll see a return of FII, certainly in the second half of the year, once those valuations get back to those long-term averages. There are a couple of themes I'd like to go through there. I think the internet platforms in India, the duration of growth that you have within the Indian internet platforms is quite extraordinary. And I think that's something we'd be very interested in. So whether that's the food delivery side, whether that's the online travel side, whether it's the fintech side, those are all businesses that we're familiar with, and we'd be very positive on those on a longer term basis. And I think this pullback gives a good opportunity within those individual areas.
Welcome back. Now, Terminal 1 of the Delhi International Airport is set to reopen by April of this year, post which Terminal 2 will shut down for further repairs and revamp. To know more about the expansion plan, CNBC-TV18's Abhimanyu Sharma caught up with Viday Jaipuriyar, CEO of Delhi International Airport, and began by asking about the expansion strategy. Listen in.
As far as expansion strategy is concerned, I think we have just come out of a major expansion work, which has entailed the new Terminal 1, as well as the new runway and Eastern Cross taxiway. So these are the three major elements. However, there are a lot of other elements also which are part of it, whether it is in terms of new parking stands in T1, T1 being equipped with 22 boarding bridges, and there are some parallel taxiways which actually reduces the taxiing time. So all these have been part of that expansion. Even in Terminal 3, we have put up additional check-in counters, as well as expanded the international to international transfer facility. So the next expansion is going to be immediately. The requirement is that of increasing the international capacity, because we have got in Terminal 3, there are 2 piers which are dedicated to international, and there are 2 piers which are dedicated to domestic. The plan is to convert one of the domestic piers into international, because international, our capacity is 20 million. We already have got a throughput of close to about 22 to 24 million, which we have started seeing. So that work should start sometime in April and will take about 4 to 5 months' time, which will increase our international capacity by 50%. In the meantime, since Terminal 1 is going to be fully operational, so the traffic from T2 as well as one of the piers in T3, we will shift them to T1, which has got enough capacity. And T2 then will be shut down for about 4 to 5 months, which will ensure that we have got a more modernized facility on the air side as well as on the terminal side. And the passenger, it will be then ready for better passenger experience.
The transition period which you just spoke of for shutting down and of reopening of terminals, of course, would be accompanied by an increase in passenger traffic, both for domestic as well as international routes. Now, of course, the Delhi International Airport and also the adjoining areas, other parts of the country are also witnessing a surge in air traffic. What kind of expansion plans or debt plans are there in the offing? Because we also understand there's also another airport coming up within Delhi NCR itself. Do you feel the opening of that airport is going to take some flights away from here, and possibly would it impact travel plans, especially for short distance flights? Because we do understand that Delhi NCR may be termed as a single region by space or by definition, but it's sprawling over hundreds of square kilometers. So do you think it would be a dampener as far as short routes are concerned?
Okay, you have asked 2 questions. One is that whether we will have capacity constraint. No, we will not have capacity constraint, because we are deconstraining any capacity constraint that we are currently facing. So by August, September, I will have international capacity, which is more than sufficient for the next 3 to 4 years' time. Even domestic capacity, which currently we are handling about 54 million passengers. So between T3, 1 pier, and T1 itself, I have 58 million capacity. T2 also will be shut only for about 5 months. So August, September, I will have another 15 million coming in. So I have headroom for growth in both the places. Now, talking about second airport, there is enough scope for second airport also to actually grow, because we have seen a fantastic increase in the aviation sector, and with the kind of positive influence from government, as well as the different kind of new incentives, whether it is Udan scheme, whether it is any of the other supporting schemes which are actually coming in. It is going to keep on growing, and there is enough for both the airports to actually operate in a region and give better passenger experience.
Speaking of tariffs, of course, there have been several tariff increases, many of them driven by commercial considerations, many of them driven by higher ATF prices. Do you feel there would be any cushion as far as prices are concerned moving ahead? Because we understand skyrocketing prices on several routes, and I'm not just talking about special occasions like Diwali or New Year, but even other points of time where we have witnessed these price increases. Do you feel such cross-subsidization is possibly going to decrease such kind of price shocks? Because we understand the market is highly unregulated with respect to airfare prices, but do you feel there would be any cushion for passengers in the times to come?
Only thing that I can assure you is that airport charges are not the ones which contribute to that, because airport charges are only about 1.5 to 2% of the total base airfare charges. So, and even with this increase, possibly that 1.5% will go to about 2.5%. So that is not the contributing factor. The rest depends on demand and supply situation, because it's a dynamic pricing. So as the supply keeps on increasing of number of seats, definitely there should be a easing off of the airfares. But I am not an expert to comment on that.
Well, that was a very interesting conversation that our colleague Abhimanyu had with the management there at Delhi International Airport. With that, it's a wrap on this edition of Trading Hour. Stay tuned. Halftime Report is up next.
But, again...
Even as frontline indices see little change, mid-caps continue to come under selling pressure. Industrials, powers are the big losers while financials eke out some gains.
Ultratech takes a detour from its cemented growth path to invest about 1,800 crore rupees in a cables and wires facility in Gujarat. The move, aimed to fortify its construction business, raises capital allocation concerns. The stock slips.
Stocks of cables and wire makers takes a drubbing on the news of Ultratech's entry, but KEI Industries and RR Kabel both remain sanguine. They see no near-term impact due to the gestation and ramp-up period required, and with the industry on a strong growth path.
The RBI has rolled back its earlier increase in risk weights for NBFCs and micro-lenders in relief to such borrowers. This step is seen as one among many by the central bank to ease norms. Stocks of these lenders rally. Hello and welcome. You're watching us here on Halftime Report. We come to you live from the CNBC-TV18 Motilal Oswal studio. I'm Mangalam Malu. With me, Hormas Fatakia. Well, another day where the frontline indices not doing too much. The mid-cap index is the one which is actually taking a bit of a drubbing. The Nifty Bank is outperforming today. The mid-cap index now down by 1.3%. At the lowest point of today's trading session, we have 2,100 stocks which are declining for 470 stocks which are advancing. It's also the February series expiry. And the way the market is poised right now, it looks like a fifth straight month of decline, something that has happened last only in 1996, Hormas.
I don't know what you were doing in 1996. But
I would like to believe I wasn't born, but no, I was born, Hormas.
But yeah, it's history books that you don't want to rewrite in such a fashion, but it is what it is. The index at the lowest point of the day, but still trading in a very narrow range. Still 22,500 is the one that they need to defend as of now. But the broader markets, they are the ones under pressure, specifically led by the cables and wire stocks. We'll get to those in just a bit because they are the ones that are the big underperformers in today's trading session. The small cap index is down 2%, the mid cap index too taking a similar sort of a drubbing. But some of the other names though that are not doing very well in today's trading session is Vijaya Diagnostics is one of them, 9.5% lower. That stock had seen a bit of a spike in Tuesday's trading session before we went into the holiday, and that had seen a 13-14% jump. It's come off almost 10% after that. The other one is Varun Beverages. They had delayed the date of their Ghana acquisition by 1 month, and that is one of those reasons maybe why the stock is seeing the kind of drubbing at the lowest point of the day now, 7.5% lower for Varun Beverages. But the story of the morning, the story of the day has been Ultratech and its foray into the cables and wire space. That stock is down almost 6%, and that has taken the other cables and wire stocks down with it as well. Nigel is joining in with more on this. Nigel, good afternoon.
Well, that's right. That's the big story of the day. Ultratech has announced its foray into the cables and wires business, which has made the cables and wires sector itself very, very nervous. But let's tell you a little bit more about this. They're going to be putting around 1,800 crores over the next 2 years. By December 2026, they expect this, this unit in Gujarat, Bharuch to, in fact, be up and running. So that's the commissioning date that they're talking about. The key reason is they're looking at extending their presence in the construction value chain. Now, why has Ultratech basically looked into the cables and wires business? A few factors out here. One is the business itself. The industry tailwind is there because the industry is growing at around 13-14% as we have seen in the past. It's going to be moving from around 80,000 crore industry to around 1 lakh crore industry. Besides that, their raw material sourcing could be better because Hindalco is part of the group entity. So aluminium, copper as well could be made more available. The key reason they highlight though is they're focusing on strengthening its building products division. As of now, Ultratech Building Solutions already has 4,400 outlets. So they want to build onto that. Margin-wise, well, it will be relatively lower because you have seen that players in this space, they function at around 8 to around 12% approximately. So maybe a 10% margin is what you could work with. However, the ROC, currently on the cement business, they get roughly around 15% ROC. But in the cables and wires business, industry, most of those peers, they get around 25%. So margins could be relatively lower, but ROC will be higher. What is the concern then? Why is Ultratech down? The street is fearing the capital allocation wars, which wasn't the case now. They were only focusing on the core cement business. The other factor is, why couldn't they do it via Grasim? That's the other option they could have had. How do the numbers stack up? 1,800 crores is not big for a company that generates cash flows of more than 10,000 crores. As a percentage of the annual capex, well, it's less than 10% of that. And the revenue potential could be, given that normal asset turnovers are around 4 to around 5 times, it could be roughly around 7 to around 8,000 crores with margins of low teens. Jeffrey says, yes, you could expect a knee-jerk reaction, but they have a buy rating out there. They say weakness should be used as a buying opportunity. For the time being, the street doesn't like capital allocation, that they have done right now. They would have preferred it to be in their core cement business, which explains why the stock is down by close to around 5.5%. Back to you.
Right, Nigel, thanks a lot for that. So that's one side of the story. Ultratech deciding to allocate 1,800 crores over the next couple of years towards cables and wires business. The street does not like the capital allocation out here, and that's why the stock is down 6%. But on the other hand, what this has done is set a flutter of, selling, or maybe, set the cat among pigeons in the cables and wires industry itself. So KEI industry is down 19%. You have Finolex down 6%. Look at some others, RR Kabel, all of them down in double digits. Havells itself in the morning was down by closer to 9%, though has recovered currently with a cut of just about 5.5%, 6% itself. Big disruption happening in this space. Has all the cables and wires segment investors worried? Are the companies as worried, and what the brokerages are making of it? Upasna joins in with the details of that one. Upasna.
Well, certainly, Mangalam, cable and wire segment is under pressure today as the street fears increasing competitive pressure with the entry of Ultratech Cement. Now, Ultratech Cement plans to enter wire and cable segment with an investment of 1,800 crore as highlighted earlier, as the company aims to meet the demand of growing cables and wires industry growth across the various sectors. Now, cable and wire industry has witnessed a revenue CAGR of nearly about 13% from FY19 to FY24. What the street fears is this entrance of Ultratech may intensify competition for the existing large players. Now, looking at the FY24 market share of the top players, Polycab stands at 26%, followed by KEI, which stands at 12%, followed by Havells, which stands around 11%. Now, brokerages like HSBC is of the view that this entrance is likely to have a material impact on the growth and margin trajectory beyond FY27 of these players. It has lowered the target price somewhere between 7 to 23% of all the major cable and wire key players. Coming to Havells first, the brokerage has given a buy rating with a target price cut nearly about 7% to 1,730 per share. Polycab, it has given a buy rating with a target price cut of nearly 20%, lowering the target price to 6,250. KI Industries, the brokerage has given a hold rating and the target price is cut as high as 23% to 3,450. And lastly, RR Kabel, it has given a buy rating and the target price of 1,260. Now, Jefferies believes that it foresees a lower competitive impact on Polycab as compared to other housing players such as Finolex Cables and Havells, and Polycab continues to remain the key preferred pick for the brokerage. Now, coming to Morgan Stanley, it says that it is surprised with the move of Ultratech entering into the cables and wires segment, but it says it is not concerned about the industry play going forward with this entrance of Ultratech. So all in all, we are seeing all the stocks under pressure on the back of this competitive pressure.
Indeed, the street caught by surprise as well. And interestingly, they compare the FY25 multiples to their 5-year averages. Both Polycab and KEI are still trading above those multiples even after this correction. Where in fact, we spoke to Anil Gupta, the chairman and managing director at KEI Industries, to understand the impact of this foray. Listen into what he had to say.
This and the market space is big enough to give space to another player. Number one. Number two, Ultratech will take minimum 3 years to start their production. Whatever somebody may say on paper, 2 years, but we have our long experience in developing the industries. Number three, it will take another 3 to 4 years to or 5 years to develop the brand for wires. They may not be able to disrupt the market by just slashing the prices, because it is in this space it is very difficult to increase the prices once you slash them.
This is very big industry, and like almost 85-90,000 the industry size was last year, and it is further grown by almost 13 to 15%. And this is such a fragmented industry, and there are not many even unorganized player also. So if a big player comes like this is always a nice move where more strong player will be like get bigger margin of market share. And though it is very like quick reactions from market, and it is very like on negative side, market is concerning. But what I see, this is like for players like us, it is good time that we can also have our growth plan intact, and we see good consolidation in market. But it is not that much like disruptive what market is reacting as per me. So first, when we see from like margin point of view, first you need to see that it will take at least like 2 to 3 years to come into production, and again getting a sizable size of production and getting established in market. It may be another journey of 2 to 3 years. So it is altogether like 4 to 5 years minimum to take sizable size, even in this overall industry, which will be like around 1.5 lakhs by FY28 or 29.
Right, it's an interesting state of affairs right now when you look at the entire cables and wire space, Hormaz. Why is that? Because there were times when the markets are in a good bull run, any diversification from the core was something that was appreciated by the street. When we saw the entry into paint, so we saw entry into other things, the street was appreciating that because that meant newer markets. But now it means margin dilution, and as a result of which the street is a little worried about that. What's interesting is that Ultratech sees opportunity, but Ultratech analysts see capital allocation concerns. The incumbent players, they don't see any fear, but the shareholders of these incumbents, are worried about what those guys could do. So it's a very interesting space to be in right now, and most definitely we'll keep tracking this as we've been tracking the disruption that we saw in the paint space as well. So that was our Insight Edge special segment on Halftime Report in the cables and wires segment as Ultratech made its foray. With that, we'll step into a short break. But as we do that, let's give you some good news to all our viewers. Here's India's business news leader, which is now just a click away on the CNBC-TV18 new app. Whether you're using iOS, whether you're using Android, you will get instant access to breaking news, in-depth analysis, and all the financial world updates. All of them coming to you at your fingertips itself. All you got to do is download the app from either the Apple Store or the Google Play Store. What you can do is scan the QR code. Hormaz is just doing that right now, and you get a link to download the app on your screen. Once you get the app, you get everything on your fingertips. Stay with us.
To what we were talking about, the need to adapt as well as the change as far as the business model is concerned in a Trump era, with the H-1B issue being the way that it is being dealt with at this point in time, what could it potentially mean as far as the services sector is concerned? What could it mean for Indian IT in the next few years?
So there, I think two parts to what you ask, and there I'll talk a little bit more about Infosys. We've built over the last few years a more resilient business, especially for the US. We've made sure we built out more and more local delivery and digital centers. We've got now more staff which are local. Over 60% of our teams in the US are local. We built quite a strong nearshore capability for the US. So we feel better prepared if there are any changes. So far, we've not seen any changes.
We're talking about human genius and human ingenuity as well, and we were just talking about moving from people to platform. Now, what actually happens on the workforce? Because this is a sector that has been driving, employment for a young country, for a young demographic like India. What happens to the people part of this business now? Let's talk about that. What happens to entry-level jobs, for instance? What are we talking about in the next 5 years?
So there, first, in the existing employees that we have, there's huge reskilling. So there's a constant move, especially with generative AI, but all through when we were having digital or cloud or cyber, a lot of reskilling today. at least within Infosys, over 270,000 people more ready for AI. So that's the first element. Second, in terms of new roles, we've already shared this last quarter. For the next financial year, starting April, we will recruit something like 15 to 20,000 new campus hires, which shows the same sort of direction of what we were discussing earlier, which is there is growth, there is productivity, and there is new work from these technologies. All of that combined gives us confidence to have new people joining from the campus.
Welcome back on to corporate conversations. Now the management of EPAC Durables is joining in. Ajay Singhania, the managing director and CEO of the company, is joining in to talk about the road ahead for the company. Mr. Singhania, good afternoon. Thank you so much for joining in. Well, we sitting here in Mumbai are definitely feeling the heat even before the month of March has set in. Has that reflected in your demand trend so far for the air conditioners? What is the trend that you are picking up on ground, and do you see this intensifying further as you go into the peak summer months?
Yeah, so good afternoon. And we never saw the heat wave actually subsiding during the whole of last 12 months. So yes, the momentum continues and it started picking up already with a very sound order book, and further the demand is kept on increasing. So I mean, we're heading on for an extremely good summer season again, it seems.
All right. So what does that mean in terms of numbers? If you could give us a sense, what did you do last summer? How much higher have the orders been for this summer? And are these orders for ODM products or OEM products? Are they margin accretive for a business like yours?
So the entire year, if you look at the calendar year, definitely the industry grew at something like 40% plus, and at EPAC we grew at around 75% in terms of the overall revenue. So the momentum continues. The industry seems to be looking at, again, a repeat like 20-25% growth for this calendar year as well. And at EPAC, we are definitely geared up to beat the total growth. So, I mean, again, we are looking at 40% plus kind of growth for the calendar year or for the financial year 25-26 as well. In terms of order book, yes, extremely sound order book. And the last financial year, I mean, 24-25, definitely we are looking at 55% plus kind of a growth, and repeating a similar performance, 40% plus growth for the next year is definitely on the cards.
All right. And what proportion, if I remember correctly, about 2/3 came in from room air conditioners, right? You have been moving into other consumer durables as well, washing machine being one of them. So I just wanted to understand, heat wave does well for your room air conditioner business. What about the other parts of your business?
Yeah, so the significant change compared to the previous year is, although AC is growing at like 30-40% for us as well, but overall the revenue from ACs from 80% has come down to almost 66% in the last quarter. On the year end, we're looking at the dependence on AC to come to a level of, let's say, 70% around. So overall dependence on AC has reduced from 80% to 70%. Our other segments like the component business and the newly launched large appliances like coolers has already picked up, and washing machine is something we are looking to ramp up from Q1 of the next financial year. So all in all, definitely the other levers are firing for us as well. I mean, the component business and the export business, the small appliances and the large appliances all.
So does the AC business in the scheme of things remain at 70%, Mr. Singhania, or as your other businesses grow, that will come down to a more 60-65% sort of a level? That's part one. And part two is, how is inventory management looking like currently? Because there is some issues of demand-supply mismatch over the last few quarters.
So first of all, AC definitely we continue to have a robust growth, but at the same time, the diversification drive we have taken, we believe that the growth in the other sectors will be much more rapidly. So overall, we want to reduce balance our portfolio in a way that AC comes down to, let's say, around 60% in the next 2 to 3 years. So that's the overall direction we are following, despite growing at 30-40% in AC as well. So that's on one. On the the inventory rationalization, a lot of localization of components have already happened. So that has helped us to reduce our overall inventories. But at the same time, because of the supply chain issues from China, the BIS impact and all that, there is certain mismatch in the industry, but we are well balanced with sufficient inventories of both copper and compressor going forward. So, I mean, we are aligned with our order book and we have sufficient inventory in place.
All right. What about coolers? AC is one of the heat beaters. Coolers are the other. Coolers are a lot more mass market. You have production capacity of 60,000-70,000 per month. If you could give us a sense of what your order book out there is, what the realizations per cooler are, and how margin accretive is that business? Because what we're trying to get at is, while AC is growing fast, you have other businesses which are also ramping up. Capacity utilization will pick up. What are the target margins that one should look at for a business like yours?
So cooler for us is one interesting category we entered in last January. So January 24 is when we entered manufacturing coolers. Last 12 months, we have ramped up cooler production. So starting with like a number of 10,000 per month, today we are almost doing like 45-50,000 coolers every month. So that's the kind of capacity we have currently in place. The interesting thing about cooler is that it's as compared to AC, which has a 6-month manufacturing cycle, cooler almost has a 10-month manufacturing cycle. So that definitely helps us utilize our production capacities and our asset turn, improve our asset turn. Another thing is that on margin side, yes, the margins are almost similar to that of an AC, but at the same time, because the capacity utilization overall improves throughout the year, it helps us improve our asset turn, improve our balance our cost. So that's definitely one good thing we find about the cooler industry, and it's growing. So for next year onwards, again, we have lots of other OEM getting associated, more products coming to us. So we are looking at ramping up our capacities further.
All right, your guidance for this year is up for you.
No additional investment done. So I mean, the fungibility of our manufacturing capacity is definitely helping us get into.
That's incredible. So, your FY25 guidance is up for the viewers on the screen. 2150 crores in terms of revenue, and 7.25 to 7.5% is the margin guidance that you had given us at the end of the third quarter. Now, as things stand for the next year, you believe that you can grow in around that 40% mark when it comes to revenue. What about margins?
Margins will try to maintain at similar levels, EBITDA levels of 7.5 plus minus.
Despite a 40% growth, you do not foresee any improvement in margins, Mr. Singhania? Is it still looking to maintain it, or is this a conservative estimate?
So let's see, improvement is something we're definitely striving for, but when it comes to guidance, I want to be slightly conservative, not give a very... but definitely we're looking to improve further, yeah, purely.
Right, and final question before we let you go. Air fryers will obviously be a very small part of your overall revenue, but how big do you expect this category to be for you, and what's the scalability here?
So air fryer is a very interesting category. It's a localization drive. So it's something which is getting shifted from import to local. And definitely we are looking to ramp up capacities from 50,000 per month to almost 100,000 per month in the next 3 to 4 months. So manufacturing 1 million air fryers in next calendar year, that is 26, is definitely on the cards. And from revenue side, I mean, it's like 200 plus crores, at least in next year, is the kind of revenue guidance we can have on the air fryer alone.
How much does an air fryer sell for typically from a business like yours?
So an ASP of 2,000 is something for us, and then the markets, it's like 3,500 to 4,000 is the market MOP.
Okay, market. So that's how you come to the 200 crore mark, which is 2,000 rupees for 1 million pieces. Okay, thank you so much for joining in and giving us all those data points for analysts to ponder over for the next couple of years. We will most definitely keep track of the temperatures and your sales in conjunction with those temperatures as well. With that, take a short break, come back, talk about the markets. Aditya Agarwala of Invest for Edu joins in with some trading strategies.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go.
Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC-TV18, now streaming live 24/7 on YouTube. How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits and chart wizards. Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajar at these times on CNBC-TV18 and CNBC-TV18.com.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest running show on startups and entrepreneurship, celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21. Only on CNBC-TV18 and CNBC-TV18.com. CNBC-TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhan.
India Business Hour live on YouTube at CNBC-TV18 weeknights at 7 p.m.
What investors should do now is to very carefully assess the kind of valuations that they're paying for, get out of the relatively expensive stocks, may stay invested in the relatively cheaper ones, and also the kind of niche market leaders. You know, we're actually seeing this not just in this sector, but in all across India. It's the market leaders who are able to command pricing. It's the market leaders who are able to gain market shares. I have been saying this since late last year and on your channels also, that India is overvalued. And at that time, in late September, early October, Indian valuation premium compared to Asia ex Japan was about 90%. You know, now that.
Welcome back. You're watching us here on Halftime Report. Even as the Nifty is down about 20 odd points, it's interesting because it is also the February series expiry. If you look at the F&O setup on the day of February series expiry itself, you'll see that, you know, the Nifty has actually seen a big correction over the last 5 trading months itself, or 5 trading series. So you look at October, where the big fall started, 2,000 points shaved off the Nifty. Thereafter, you know, the subsequent months, you had another 1,000 points shaved off. And now February so far, we've lost almost 720 points. This compares with the start of the series itself. And this will make it the 5th series loss for the market and the first time that happens since 1996. So that's how bad, you know, history has been created from a bull standpoint. Bears are happy to be waking up for 5 series after 28 years. What's interesting, however, Hormaz, let's bring out the iron condor once again, which is the 25,550 level. So if you look at the the action that option writers are playing out today, they are selling the 25,550 call and the 25,550 put. Together, you pocket a premium of close to around 30 rupees. So you have the 25,550 put at close to around 22 rupees, the 550 call at around 10 rupees. You sell that, you get about 30 rupees. How do you protect yourself? You buy a 22,600 call and you buy a 22,500 put. 22,600 call available for 4 rupees. 22,500 put is available for about 9 rupees. So in a sense, you are pocketing a premium of 30 rupees. And to protect yourself from a wild swing on either side, you are buying options worth really 14 rupees. Net, you take home 16 rupees. That's the Iron Condor strategy, which is playing out on expiry day today. What does that mean for, the range of the Nifty? For 30 rupees, 35 rupees that you're pocketing, you are expecting the Nifty to stay between the 30-35 rupee range of 22,550 on either side. So that's 22,515 at the lower end, and at the upper end, it's 22,585. Were the markets to move on either side, you've already bought those options that will protect you from that hedge. So that's the iron condor strategy that is playing out by the option writers on expiry day. But in terms of individual stocks, just keep an eye out on a bunch of these names come up for you on the screen. There's Abbott, Atul, Bata, Canfin Homes, GNFC, India Mart. It sounds like Shankar Mahadevan's breathless, but there are 16 stocks exiting FNO trading come tomorrow itself. So last day for all these stocks to trade. So maybe in the last hour, we'll see some wild swings on the names that are flashing for you on the screen, largely because positions will be unwound out here.
I'm not very sure of iron, but bulls definitely need to have nerves of steel to be optimistic in a market like this. Hopefully, March will bring in some bit of cheer for the bulls after 5 straight negative months. Take a short break, but will that optimism happen in March? Aditya Agarwala of Invest for Edu will join us on the other side to answer just that and share some trading strategies as well. Stay tuned.
Hello, how are you? Good. I was doing CNBC for like 30 years. CNBC is only 25. So ये IPO हो क्यों नहीं रहा है, right? That was a comment that you made saying everybody is getting cleared but not us.
I think until 28th November it was not clear that IPO हो रहा है या नहीं हो रहा है.
Maybe the regulators and the government don't want fintech. Fintech as a sector I still see as a sunrise sector. India needs billions of dollars in investment in fintech.
Who breaks the silent period? He speaks only for, in the business and professional setting. You would not imagine he's an introvert. We are also trying to scale up in UPI with innovative products instead of basic, UPI.
So this diversification is going to be crucial for you, isn't it?
It's a person who's probably living in tier 3, 4 town, city. They don't have the means to go to a different place and earn higher returns or get loans, etc. So for them, we solve the problem of access. At heart, she's deeply emotional and she cries a lot.
Really? I would never have thought that.
In our house, we have a competition between her and our kid who can cry more on very silly issues.
You're actually a softie.
I'm actually a softie.
Nifty 50 or BSE Sensex, the frontline indices, their valuations have declined. 1-year forward P declined from 24 to 25 to about 20 right now, which is closer to the long-term average.
Similarly, if you go within MFIs, you'll realize that a lot of the reticence or reservations that banks have with lending to certain MFIs has to do with how they perceive the fundamentals of the MFI business today. But you have nailed it when you said that this is a critical communication of regulatory intent. Yes, there's been focus on liquidity. We have already seen rate cuts, and these are probably the first signs we are seeing of credit policy easing, and that bodes very well for the sector, both banks and as well as NBFCs. It shows that the regulatory focus is shifting from towards growth accommodative in a meaningful way, and that has to bode well. I absolutely agree with you. As far as the arithmetic of the capital release goes, it obviously favors or has a greater marginal impact with those who are nearest to the minimum capitalization red line. So you are thinking PSU banks. That's the first order impact.
I'm absolutely clear that this and the market space is big enough to give space to another player. Number one. Number two, Ultratech will take minimum 3 years to start their production. Whatever somebody may say on paper, 2 years, but we have our long experience in developing the industries. Number three, it will take another 3 to 4 years to or 5 years to develop the brand for wires, and also to, get if they come at all in the cables, it will take many years to get the approvals from different customers, different utilities, different departments, and also, develop their channels.
Welcome back. Still at 22,520 is the Nifty, and Aditya Agarwala, the head of research for investments at Invest for Edu, is joining in on the show right now for a quick chart check. Aditya, good afternoon. Thank you for joining in. Well, do you expect the expiry above 22,500A? If so, where do we go from there? And if not, where do we go from there? And couple that up with your trading ideas as well.
Hi, afternoon, or good afternoon. Thanks for having the show. Afternoon, Mangalam as well. Oh, that's a very tricky question to answer, actually, whether markets will hold on to 22,500 or not. From the looks of it, looks like we're going to expire somewhere around 22,500 for sure. I don't see a sharp sell-off, even if we have to break 22,500 just for a brief period of time, maybe 50, 60 point here and there. I think 22,500 should hold because clearly the back is against the wall right now for the bulls, and every pullback is getting sold off. So it's little extreme pessimism that I see on the charts as well. Oversold levels, we're trading at a couple of positive divergences on multiple time frame charts as well. So everything is pointing towards a short covering rally from here on almost. Maybe give or take, like I mentioned, 50, 60 points from here on. You can't rule that out. But if you can bear that in your trading, I think it's a good time to look at some of long trades, given the fact that risk to reward is in favor of going long at current levels, and look at how Bank Nifty is outperforming today. So Bank Nifty is the catalyst. I think if Nifty has to go up from here, so 49,000 at the Bank Nifties, I'm very closely. If 49,000 is taken out decisively and trades above that towards the fag end of the trading session, I think Nifty will also show some kind of strength. And maybe I think 22,700 or 23,000 is what I'm looking on the Nifty for the next expiry. I would say rather next couple of weeks. So I'm not too pessimistic at the current point of time. But yes, prices have yet to confirm, and 22,500 I think should hold in today's trading session for sure.
What about
having said that? Yeah.
I just wanted to know, what about individual stocks?
Yeah, I've got one buy and one sell, Mangalam. So the buy recommendation is from the banking space. IndusInd Bank looks interesting to me. I think it's formed a base from here on. It can inch higher. So for a target of 1160, I would take a long trade here with a stop loss at 1030 on the downside. A short on Ipca Laboratories. Pharma is clearly the weak back in today's trading session. I think this weakness is likely to continue. So Ipca Laboratories can be sold for a target of 1270 on the downside, keeping a stop loss at 1420 on the upside.
All right, Aditya, thank you so much for sparing time, joining us today with your views on the index and on specific stocks as well. Take a short break, continue our coverage on the markets this expiry day. Stay tuned.
A bit unusual but not totally unprecedented, because in the last decade, 2015 we had a similar situation, 2017 also. At least 4 to 5 occasions in the last decade, temperatures have been in the range of 37 to 39. So you can't call it unprecedented, but yes, it's a bit early, a little bit unusual.
So ma'am, can we expect a dip in the temperature in the next 5-6 days? Is that a possibility?
You can expect a small dip, but not a dip that will give you any respite.
Welcome back. Let's get an exclusive chat now. My colleague Shilpa Ranipeta caught up with the CEO of Trent P. Venkatesalu to discuss about their business momentum and growth outlook. She began by asking about the consumer demand sentiment. Listen in.
I do think it does vary by market. And also, I've always maintained in various interactions, Shilpa, that these things are never linear. Right. If we look at the trend business itself over the last 10-15 years, have we had a completely smooth run over quarters, years, months? Not at all. Right. And if you look at it over a period of time, if you look at it over the medium term, you do get a very consistent play out on what happens to the market. And which player succeeds, which brand succeeds, etc. is a different question. Right. And I'm obviously very biased. But I do not think India as a market, India as a consumer space is going to be any less interesting in the next 5 or 10 years.
Right, fair enough. And what is the way forward or the plans currently, if you could tell us, for Zudio? Because in your results, you also announced a store optimization plan. So will the fast-paced expansion that we've been seeing for Zudio, will that slow down? How are you looking at the store expansion and the business expansion for Zudio?
My chairman spoke about it in the shareholders meeting. We put out stuff every quarter. I don't think so we've changed any of the commentary. I think the best way to comment about it is look at every time we put out our commentary in the quarterly results. I do think we're quite enthusiastic about where we are going as a business, Shilpa. And the market, I do think, over the medium to long term will be also very interesting. There are enough challenges and wrinkles to fix at any given point in time. And we'll continue to grapple with them.
But something that you can give us on Zudio, what the business is looking like for you going forward. How do you look at closing this fiscal with Zudio and the kind of plans that you have for the next?
I'm not going to obviously answer anything specific, but I do think I can say that we are quite enthused by both our brands in the fashion space, and we are also enthused by Star in the food space, definitely so. And we'll continue to build on the existing platforms, and we do think over the medium to long term, we'll have a very interesting play to be had.
So will Zudio continue to be the growth driver for you, or will it be Westside, Zudio and Starquick? Like, what do you see as the growth driver for Trent?
We do think all these three are growth engines, and Zudio is definitely one of them. Westside is also very important as a growth driver in the portfolio. And I've said this in the past, Shilpa, that we think we are more of a platform. We would like it to be a platform. We don't want to be a Zudio business or a Westside business or a Star business, but a platform which originates, incubates and scales brands, which has some common threads.
Right. And Star Bazaar also, do you have aggressive expansion plans for that? Because currently you're just there in 3 places. More cities, more states, is that something that you're looking at for Star Bazaar?
We have said this, and we're quite excited about where Star is going. We do think we have a model which is quite differentiated. We'll build with the same playbook that we have in the fashion side of the business. And as far as the expansion program is concerned, watch out.
I just wanted to quickly check with you also on the Zudio front. Zudio Beauty is also something that you have been expanding. What are the plans there? And also, can you give us a sense of how much non-apparel segments are also doing for Zudio? How much is it bringing in?
Shilpa, I've got this question many times over, and hence we've started reporting it on a quarterly basis, at least giving commentary on it. So the emerging categories, which include innerwear, beauty and footwear, now accounts for about 20% of the lifestyle propositions that we have.
Right. But are you looking at more standalone Zudio Beauty stores also? How big is the beauty portfolio for you?
Beauty is material out of this 20% beauty. Is it material? Yes. And is it something which is exciting for us? Yes. But are we applying the same playbook? Very much so. We have completely own branded, completely non-distributed, and definitely not advertising led, and so on and so forth. So are we approaching beauty the same way as we would approach any of our other lifestyle propositions? Very much so. And are we excited for it as a category? Yes. How much we turn around and do standalone stores, how much we do inside Westside, inside Zudio, etc. is a matter of play out, Shilpa. Right. So we'll see.
But it's definitely under consideration. That's what I'm trying to understand.
We already have some.
Yeah, I know. So more of that.
Let's figure it out.
Okay. But the response has been good initially?
It's been encouraging, in general very encouraging. And also the proposition is not completely different from what we have in Zudio or Westside for that matter. Right. They are akin propositions in the sense they are relevant for their respective brands.
Right. And how do you see the competitive intensity playing out currently? Because a lot of other players in the value fashion space have also come up, across every large apparel player. So how do you see the competitive intensity playing out?
India was always competitive, Shilpa. It was never a non-competitive market. And to that extent, if you have really no choice as a business playing in this space, being relevant to the customer.
Right.
The whole trick is constantly change and see how you can be more relevant. And if you're relevant, you have a good chance of being differentiated. And if you're differentiated, hopefully you have a good way of being relevant to the customer. So it's kind of a circular reference in that sense. But I do think we need to change, constantly improve and be relevant to the customer. That's the way forward.
The management of trend in a rare interaction there with CNBC-TV18 on the road ahead. By the way, Mangalam was mentioning the F&O exclusions in today's trading session. A couple of names already under pressure. Naveen Fluorine, one of those exclusions, is down 4.5%. Dr. Lal too, at the lowest point of the day now, trading with losses of over 3% in today's trading session. Many more F&O exclusions. We'll talk about them as the day goes by. We'll take a short break. On the other side, Manisha Gupta joins in with Ajay Kedia, who is the director at Kedia Commodities. Stay tuned. We'll be right back.
Over the last decade, if you're a global asset allocator, like, where would you have made money? Like, you didn't need to put money offshore from the US over the last decade. What we would say there is that the valuation differential between EM and DM now is at its largest point that it's been for many years. Therefore, when we're being approached by our global clients, they're very much aware and cognizant of the fact that they have a large overweight in the US and they tend to have large underweights in emerging markets. What I would say is that when we look at emerging markets at the moment, we're very constructive on emerging markets. When we're looking at India itself, I think the selling pressure here really has come about from the tremendous bull market which we've had in India over the last 3 years. And as we went into the end of last year, valuations on India became stretched. So all it took was a slight slowdown in the credit markets, in the credit cycle, in loan growth, and some earnings expectations, and that led to money coming out of India. I certainly don't think the bull case for India has changed, but I think with all long-term bull markets that you have, and that's what we believe is happening in India, you will get these pullbacks and a reset, and I think you'll see a return of FII, certainly in the second half of the year, once those valuations get back to those long-term averages. There are a couple of themes I'd like to go through there. I think the internet platforms in India, the duration of growth that you have within the Indian internet platforms is quite extraordinary. And I think that's something we'd be very interested in. So whether that's the food delivery side, whether that's the online travel side, whether it's the fintech side, those are all businesses that we're familiar with, and we'd be very positive on those on a longer term basis. And I think this pullback gives a good opportunity within those individual areas.
Welcome back, and joining us on the show now is Ajay Kedia. He's director at Kedia Commodities. Ajay, hi, thank you for joining in. The Q question really is about gold, because we've seen the prices come off its highs after almost $29.60 an ounce. We are trading below 2,900. First of all, would you call this a profit booking, or this is an opportunity to start buying into the space?
Very good afternoon, Manjay. Definitely, it could be a profit booking, because already we have seen prices was under correction till 25.40 in the month of November. We have seen a low, and since then it's almost $400 rally we have seen. Nothing has been changed in last couple of months. We still have Donald Trump as our US president, and we know the man is known for its tweet. So I can't predict on Donald Trump that what will be the next tweet. But as of now, definitely we have seen a multiple rejection around 29.50, 60 zone. So unless and until we don't have any strong reason, I think $3,000 is going to be slightly little tough for gold to breach as of now. So I think a technical profit booking could be possible. Maybe this fall could be towards 28.56 as the immediate support.
Ajay, the other thing that the markets really seem to be reading on is in sense of the sovereign gold bonds, where the expectation is that you still have a hard task ahead of the government, 61 more tranches to be redeemed, and that would continue to go on until 2032. What's your sense on the gold prices if you look at such a big period there, and what really should the investors be looking forward to?
Yeah, I think gold bond was a very attractive bet for investor to look, because since 2014 we have seen when this tension has started. Earlier to this, we Indians generally consume gold. We don't buy or we don't invest. We generally consume. But looking to the bond, there was a new opportunity that we can invest in gold. We can take a return as other asset class like equity and other asset class work out. So it was a very attractive bet for all investors. But I think it might be a nightmare for government, because looking to the sharp rise post-COVID, what we have seen in gold prices is slightly a nightmare. But I think immediately inflow in ETF has been increased, and people are now moving from equity to commodity. So there are other options are available, like secondary market they can purchase, but definitely a good investment opportunity has been, I think it will be a nightmare for government, and investor will definitely move for some other, because the craze for gold is going to be there in 2025 also.
What also is your sense for silver prices now? Because we did see multi-month highs onto this one as well, but silver, like various other base metal prices, also has not been able to hold on to its gains. So when you look at silver and also copper, Ajay, what would be the near-term targets or near-term strategies for a couple of these now?
Coming first on silver, right now gold-silver ratio is very close to 90, which clearly shows the silver is still underperforming as compared to gold. The reason behind is the, we can say, industrial demand, because post-COVID and war, Russia-Ukraine concern has still not picked up as an industrial demand. No doubt, futures have been quite good with the green and clean energy demand, which will help silver to go further to the level of $38, $40 this year. But as of now, nothing has been putting up from China side. So I think some consolidation would be there between $30 to 34 in international, in domestic market. It can take slight more time to breach 1 lakh psychological level. As of now, 90,000 to 1 lakh could be the level we can see for next couple of months. But overall, I think as compared to gold, silver would be attractive bet as we move to the year end. Coming on the copper, still since last year, we have seen a very good talk is going for EV demand or industrial demand should put up on a positive side. But I think a rally has already been seen in last couple of months from the level of 810 to almost 870 on MCX. In international and LME, prices are slightly consolidating in the range of 9,300 to 96, let's say. So I think some sort of profit booking could be possible. But overall, I think if we talk about copper, I'm expecting more room to be there. But before that, a drop towards 850, 855 would be a good level to re-enter, targeting at least 900 level mark in next couple of months.
All right, Ajay, thank you so much for sparing time and sharing with us some key levels on all of these commodities and precious metals. Manisha, thank you for joining in as well. With that, it's a wrap on this edition of Halftime Report Business Lunch for the next 30 minutes.
But, you know, again, and I link this back to what we were talking about, the need to adapt as well as the change as far as the business model is concerned in a Trump era, with the H-1B issue being the way that it is being dealt with at this point in time. What could it potentially mean as far as the services sector is concerned? What could it mean for Indian IT in the next few years?
So there, I think two parts to what you ask, and there I'll talk a little bit more about Infosys. We've built over the last few years a more resilient business, especially for the US. We've made sure we built out more and more local delivery and digital centers. We've got now more.
Even as frontline indices see little change, mid-caps continue to come under selling pressure. Industrials and power are the big losers, while financials eke out some gains. Ultratech takes a detour from its cemented growth path to invest 1,800 crore rupees in cables and wires facility in Gujarat. The move aimed to fortify its construction business raises capital allocation concerns. The stock slips. Stocks of cables and wires makers take a drubbing on the news of Ultratech's entry, but KEI Industries and RR Kabel are sanguine. They are seeing no near-term impact due to the gestation and ramp-up period required, with the industry on a strong growth path. RBI has rolled back its earlier increase in risk weights for NBFCs and micro-lenders in relief to such borrowers. The step is seen as one among many by central bank to ease the norms. Stocks of lenders rally. Hello, good afternoon. You've tuned into CNBC-TV18. You're watching Business Lunch from live from the CNBC-TV18 Motilal Oswal studios. I'm Vinny Motiwala, and thank you so much for tuning in as always this afternoon. A quick look at what the market is doing today. A very muted day of trade that we're seeing coming in for the markets. Look at the Nifty. Open up in the green, then saw in the red, and now it's been at that level, 22,500. So in that range of 22,500 to 22,600 is where the Nifty was. Opened up there, but then yes, off the day's lowest, at the day's lowest point. And obviously, do not forget, we are seeing in terms of a bit of a volatility coming in because of the expiry as well. Other than that, let's look at the banking side, because that's managing to hold on to some bit of a green. So Nifty Bank, that's managing to hold on to 0.5% of gains, while almost that's where it started the day. It's managing to hold on to 48,800 levels, 0.5% of gain. Mid and small cap, like you saw on the screen as well, was actually underperforming today. Mid cap down 1.3%, small cap is down 1.8% in trade. So underperformance is coming in from the broader markets today. Financials is the only one which is managing to hold on to gains, right? So like we saw Nifty Bank, that's managing to hold on to gains. But yes, in terms of the moves that are coming in, Ultratech Cement, M&M, Kotak Mahindra Bank and ITC among the losers. Banking side, financial names obviously managing to hold on to some bit of a gain. Real estate names also are something that has been a bit under pressure in today's trading session. Nifty Realty is down almost 2%. So that's where we're seeing among the top losers is Realty as well as the Auto Pack. But yes, that's how the market setup is looking like. Not much of an excitement there. Bit near the day's lowest point right now is what the market is trading at. Let's watch out for the second half of the trading session. Will be interesting to see where we move in during the next half of the day. Ultratech Cement, let's talk about that, because that's slipping in day today after the company has taken a detour from its cemented growth path to invest 1,800 crore rupees in the cables and wires facility in Gujarat. And this move is aimed to fortify the construction business of the company. Cable and wires companies are falling today. Upasna is here to give us more details on this one. Upasna?
Well, certainly, cables and wires segment is seeing pressure today on the back of higher competitive pressure with the entry of Ultratech. Now, Ultratech plans to enter the cable and wire segment with an investment of 1,800 crore over 2 years. The company aims to meet the growing demand of wires and cables across various sectors, and wires and cable industry, there has been a positive industry tailwind as the sector has witnessed a CAGR of around 13% from FY19 to FY24. Now, the street is fearing the intensification of competition for the existing large players. Now, if we look at the FY24 market share of the top players, Polycab stands at 26%, KEI at 12%, followed by Havells, which stands around 11%. Now, HSBC believes that the entry of Ultratech is likely to have a material impact on growth and margins after the commissioning of its plant for the major players, that is beyond FY27. It has lowered the target price of the major players between 7 to 23%. It has given a buy rating on Havells with the target price cut by 7% to 1,730. Polycab, it has given a buy rating but has cut the target price by 20% to 6,250. On KEI, it has given a hold rating and target price cut by 23% to 3,450. And lastly, on RR Kabil, it has given a buy rating and cut the target price to 1,260 per share. Now, Jefferies believes that it foresees a lower competition impact on Polycab as compared to other housing players like Finolex Cables and Havells, and Polycab remains the preferred pick for the brokerage. Now, Morgan Stanley says this move is certainly a big surprise, but it is not concerned about the growth outlook for these companies going forward. So all in all, cables and wires segment remains in focus today, seeing pressure on the back of competitive intensity.
Okay, Upasana, thank you so much for that. That's why we're seeing some bit of a pressure, like Upasana detailed out the reasons as well. But in fact, we spoke to Anil Gupta, who's the chairman and managing director at KEI Industries, as well as Rajesh Jain, CFO at RR Kabil, to understand the impact of Ultratech's foray. Listen into what they had to say.
This and the market space is big enough to give space to another player. Number one. Number two, Ultratech will take minimum 3 years to start their production. Whatever somebody may say on paper, 2 years, but we have our long experience in developing the industries. Number three, it will take minimum another 3 to 4 years to or 5 years to develop the brand for wires. They may not be able to disrupt the market by just slashing the prices, because it is in this space it is very difficult to increase the prices once you slash them. There will be no problem in margin expansions because this comes by economies of scale. And I have said that we have no fear in our growth plan of 20% plus for next 5 years, doubling our turnover to 25,000 crore. And we are rapidly growing in the export markets. I see that in next 2 years, 20% of our sales will be coming from export markets. There is no question of any rethinking of capex. In this year, we are doing a capex of close to 800 crore, or next year the capex will be 1,000 crore, which is ongoing at our new plant coming up at Sanand. And in the next financial year also, we will be doing a capex of close to 800 crore. We will not be reviewing or reducing our capex plan, and I mean our growth trajectory will remain the same.
This is very big industry, and like almost 85-90,000 the industry size was last year, and it is further grown by almost 13 to 15%. And this is such a fragmented industry, and there are not many even unorganized player also. So if a big player comes like this is always a nice move where more strong player will be like get bigger margin of market share. And though it is very like quick reactions from market, and it is very like on negative side market is concerning. But what I see, this is like for players like us, it is good time that we can also have our growth plan intact, and we see good consolidation in market. But it is not that much like disruptive what market is reacting as per me. So first, when we see from like margin point of view, first you need to see that it will take at least like 2 to 3 years to come into production, and again getting a sizable size of production and getting established in market. It may be another journey of 2 to 3 years. So it will altogether like 4 to 5 years minimum to take sizable size, even in this overall industry, which will be like around 1.5 lakhs by FY28 or 29.
Okay, on that note, we're going to step into a very short break, viewers. Don't go anywhere because we'll bring you more news and updates on the other side.
Which are local. Over 60% of our teams in the US are local. We built quite a strong nearshore capability for the US. So we feel better prepared if there are any changes. So far, we've not seen any changes.
We're talking about human genius and human ingenuity as well, and we were just talking about moving from people to platform. Now, what actually happens on the workforce? Because this is a sector that has been driving, employment for a young country, for a young demographic like India. What happens to the people part of this business now? Let's talk about that. What happens to entry-level jobs, for instance? What are we talking about in the next 5 years?
So there, first, in the existing employees that we have, there's huge reskilling. So there's a constant move, especially with generative AI, but all through when we were having digital or cloud or cyber, a lot of reskilling today, at least within Infosys, over 270,000 people more ready for AI. So that's the first element. Second, in terms of new roles, we've already shared this last quarter. For the next financial year, starting April, we will recruit something like 15 to 20,000 new campus hires, which shows the same sort of direction of what we were discussing earlier, which is there is growth, there is productivity, and there is new work from these technologies. All of that combined gives us confidence to have new people joining from the campus.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC-TV18, now streaming live 24/7 on YouTube. How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajar at these times on CNBC-TV18 and CNBC-TV18.com.
What does it take?
Hello and welcome to this very special conversation. Over the last few days, we've had corporate stalwarts like Uday Kotak, Harsh Goenka, and now economist and PMAC member Sanjeev Sanyal speak about the decline in interest among the younger generation of big businesses, big business families in India in running and building out businesses. Uday Kotak said, and I quote, "I would love to see this generation be hungry for success and build operational businesses. Even today, I firmly believe that the next generation must work hard and create businesses rather than becoming financial investors too early in life." Harsh Goenka writes this morning, "Modern kinds believe in passive income, active vacations and aggressive networking at yacht parties. Who needs the stress of managing employees and production lines when you can just manage a diversified stock portfolio and an impressive sneaker collection. Sanjeev Sanyal tweeted today, it'll come up on your screen, "I'm glad that the business elite has woken up to the real danger that their heirs are becoming too soft. Instead of leveraging their wealth to take bigger risks, they create family offices." It's not the full quote, but the operative part of the quote. Is this a wake-up call for the next generation in business? How justified is some of this criticism? Is it a bit too harsh? Let's discuss this with two veteran investors. Devina Mehra is with me here in our studios. Deepak Shenoy is joining us from Bangalore. Thank you very much, Devina. Thank you very much, Deepak, for joining us on this very interesting topic. So let me just dive straight in, Devina. How justified is, the basic thrust of the message which Uday Kotak, Harsh Goenka, and of course Sanjeev Sanyal are backing?
Okay, there are two or three aspects to it. For the first, let me just read out a quote to you. "Our youth now love luxury. They have bad manners, contempt for authority, show disrespect for their elders, love chatter in place of exercise. They contradict their parents, gobble up their food, and tyrannize their teachers." Guess when this quote is from?
Sounds like my kids.
This is from 79 AD, graffiti on the walls of Pompeii. Oh. And the actual quote goes back even further to Greek plays. Right. So this is what every generation thinks of the next generation, that the next generation is going down the drain, not working hard enough, and so on. So that's one part. The other part, of course, is that businesses, especially manufacturing businesses in India, are difficult to run. I was talking to an older industrialist who sold out his business a few years ago, and now he was telling me that his son has opted to start a manufacturing business. And he said, I actually dissuaded him for a while, saying, do you know what it entails, And because there's so many regulatory authorities, from the municipality to getting water, electricity, labor laws, just so many rent seekers. And he says, because we've done it before, we could do it. But my son said, if we don't do it, who will do it? But that's the one hurdle. The other thing is, even if you look at the history of business families, normally beyond generation 3, it becomes difficult because the first person had the hunger, built it. The second generation also saw some part of that struggle. The third generation is normally born in luxury. So so maybe a new set of hungry entrepreneurs take the place of the old business families. That is also, but the fact is it is difficult to do business, especially manufacturing business in India, no doubt about that.
But you began with a very fundamental basic point. Each generation feels that
yes,
the next generation is useless. It's not.
Yes, but human civilization has continued to progress. So obviously that's not the right viewpoint.
Absolutely. I think you make some very good points. Deepak, come in on this. Where do you stand?
Prashant, I completely agree. I think my thing is, my contention is with one point. Why do we need the children of rich people to set up the next set of industries? Isn't it so that the hunger that the normal person has to rise through the ranks or to build their own businesses is what's going to drive the next set of industries? So whether it is, look at a lot of industries that have been set up. A lot of them have been set up by first generation entrepreneurs. Where are the next set of first generation entrepreneurs? I think the idea now is the science of the children, or the children of those who have become rich are now investing in those companies and calling them startup investing or whatever it is. And then also spending the money, which is both, I think, are great things, because if you don't have the hunger, at least you give the money to the person who has the hunger. And secondly, you spend so that it increases the incomes of all the people who provide you the services or products that allow you to spend. So I think both things are useful. We are complaining, I think, mostly because we think that this is a misallocation of capital, but it's not a misallocation of capital. They are actually investing in other businesses. They are not going and buying gold and real estate. So I think in that context, this is not a bad thing. We should encourage new entrepreneurs to come in. Whatever barriers there are for new entrepreneurs to come up, I think we should change that. It's like, I sweat in a factory so that my children need not. But just because, let's say I become rich enough, if my children chose to sit in an AC office, they will just have to use that money to fund someone else who's going to sweat in another factory. So I think that that process should continue. And like Devina said, we will always think less of the next generation. There was a number of people who are currently, who are big businessmen, were thought of as people who may not be able to run their parents' companies when their parents passed away and so on. But turns out some of them were actually quite capable. So I think some of it may be unfounded as well, that they won't be able to do it at all.
But both of you agree, Deepak and Devina, Deepak, you go first, that this actually is happening. It may not, it's right or wrong is a different matter, but this essentially is the trend. I mean, it's clearly visible in the businesses that you speak with, both of you speak with so many businesses, long histories. Deepak, you agree, right? It is happening.
Yes, some of this is a natural consequence also, because you sell your business for a few thousand crores. Now, to start a new business also may not take that few thousand crores in the first place. And then the scale of starting something at a few thousand crores is different from starting something at a 50 or 60 crores. So you choose to instead say, okay, listen, I'll spend my time diversifying, investing in other people's businesses, which I understand very well. Very few people sit in there saying, listen, I'm going to go build the next big massive thing. And those people who have the vision, of course, they will go ahead. But a lot of people, and this is worldwide, not just India. I think it is in the US as well. It's in Europe as well. The next gen need not necessarily run the businesses that their parents set up. Sometimes they hire external managers. And that's why professional managers take over large businesses, even those with names. Larsen and Toubro were names. There were few people's names. Yeah. Goldman Sachs were people's names. So it's not that there's anybody from the Goldman family or the Sachs family running Goldman Sachs now. It's just that they've professionalized in that sense. So I think it's worldwide, it's happening, and it's the correct way to happen. Capital should be allocated to people who are hungry.
But it is also true that, some of the biggest business families back in the 90s, etc., we don't want to name them. They no longer really exist in that way. They were some of the richest families, right?
Yeah,
back,
that's what I'm saying.
25, 30 years ago.
That the generation, beyond a point, the wealth doesn't go beyond a certain number of generations, or at least the businesses don't go. And the original Sensex had, this is something I've written about repeatedly, you had the JK, the Mafatlals, the Thapars, the Scindias, and those were all old businesses. The original Sensex had only one young company, which was Indian Hotels. All others were decades old companies, and many of them became irrelevant, and some because of the family thing, others like they could not adapt to the changing times, like Premier Automobiles or Hindustan Motors, whereas the two-wheeler companies code and Maruti code, Maruti of course was already a new gen, but that's the whole point, that some businesses will go out, other businesses will come in, and normally the new entrepreneur has more hunger.
So as Deepak says, at least they're getting funding.
Yes, that's the good part, that now funding is far easier. When I set up my business, there was no cachet to setting up a business or being a startup or any money being available, any of that. That was a negative to give up a good job and start something.
How much of this is because of how well, because all three gentlemen have mentioned, financialization, people getting, Mr. Kotak talked about getting into financial markets too early, right? I think Harsh Goenka talks about that. Sanjeev Sanyal also refers to it. How much of it is a consequence of markets having had a very extraordinary run for the last 3-4 years? Because the rate of return in markets became so compelling that it was far higher than what the underlying businesses were earning. So it may actually be a more recent phenomenon in that sense.
That's part of it, but then it also means that the business that you are running gets a certain multiple. So that also, so it's not as if that it doesn't become lucrative, because if your business lists or is eventually going to list, you will get a multiple of what you're earning, and there also the robust financial market helps. Right now, of course, you've had cases, and that's in one way good, that even loss-making companies can go public, and there's still a market for that. So that part I don't think is a negative, because that means capital is available, capital is mobile, especially in a country like India, which was always very capital starved. So any avenue of capital raising that came out, there was a rush at the door. And any company which had lots of cash just sat on it because you knew that when you needed cash, you may not be able to raise it. That was the nature of the capital markets, has gotten a bit better from there. So that's all for the good. And as Deepak mentioned, yes, I mean, if you don't want to run a business, if you're investing in other businesses, that's also a good use of capital.
Deepak, coming on this point, I mean, essentially what we are seeing, this shift towards setting up family offices, being involved in markets, managing money in that sense, right? That's essentially markets, right? Over the last 3-4 years, returns have been far higher than what average returns have been for indices going back 25-30 years.
I think in general, if you look at the markets returning 12 to 13% over a very long period of time, and perhaps mid caps returning even more than that, this is roughly a reasonable ROE for even a manufacturing business to have. Although people target 15%, 20%, they end up with something like 11, 12% anyway. So if you're getting an ROE of 12% only on a manufacturing business that you set up, then having an ROE of about 12, 13% in the markets is roughly the same. You're not getting super normal ones. And I mean, to a certain extent, it's the Indian industrialist mentality of largely being trading level organizations, not doing a lot more of the research element in their manufacturing setups, that leads industrialists to kind of believe they'll stick at the 12, 13% ROEs. Whereas if you look at a lot of the knowledge economy sectors, ROEs are upwards of 25, 30%. So ask me today if I would set up a software business with the ROEs at 30, 35%, I think that's much better than investing that money in the markets. But ask the manufacturer who's mostly buying, say, parts from abroad and you know, making machines where there's not too much IP, or making things that there's not too much IP in, then there's not that much ROE in that business. And then you can might as well stick you know, it to this part of the business, as in the, you know, investing in other people's businesses instead. I think, you know, we have to change perhaps even the thought process around manufacturing, where, you know, you will get a little more in terms of IP research, something that is peculiar to you, that does much better. Build your own brands, for instance. I think that has a lot of return. And by the way, there's nothing wrong with that. There was a person who sold this fog deodorant, Mr. Patel, I forget his first name, but you know, he built a phenomenal business, and I think long term it would have been a great ROE had he continued to run it. But he sold the entire business, got a lot of money. He has started another business on his own, but his next generation, if they were to get the money, I don't think they'd probably go down that route. They might go down the investing route. It is perfectly fine there. I think it's just about, you know, getting higher returns of capital. If you reduce stock market returns, will this money go back to manufacturing? I mean, I think it's a fundamental problem. People don't want to, rather than they see more return in markets. They don't want to go to shop floors. The same people don't. So they will still rather invest in other people who will find the shop floors and build the next set of businesses.
I would like to say that Indian IT are not really knowledge companies or R&D companies. In fact, that has been my bugbear with the Indian IT, that in spite of sitting on cash for 2 decades plus, they have not even spent 50 crores on R&D. They have not done anything. In fact, many of the manufacturing companies have done more R&D. You look at, I mean, just as an example, Bajaj Auto. I mean, it's reinvented itself so many times, and now including now with electric vehicles. Whereas IT companies have not really at all. I mean, if you look at the per person productivity of IT companies here and what is IT companies in the US, let us say, it's a world apart, and that has been the case. You have not even tried to bridge that gap.
But I think, as both of you said, Devina and Deepak, you know, financial investors, great, both in listed companies, unlisted companies, new businesses, we 100% need that. But we also need manufacturing, right? And that is 100% has to be done. And I think that is the point which people like Uday Kotak, Harsh Goenka and Sanjeev Sanyal have also been sort of making. And that kind of goes back. It's chicken and egg, what Devina started with, that maybe we need to ease processes, and, you know, the ability to actually make and set up these businesses also needs to be focused on. That can only happen as far as regulation from the government side. And of course, they've been trying as well. Devina and Deepak, thank you very much, both of you, for joining us. It's a very interesting conversation, and it's a conversation we will continue having and discussing over the next many weeks. Thank you.
largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest running show on startups and entrepreneurship, celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21, only on CNBC-TV18 and CNBC-TV18.com. CNBC-TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhan.
India Business Hour live on YouTube at CNBC-TV18 weeknights at 7 p.m.
What investors should do now is to very carefully assess the kind of valuations that they're paying for, get out of the relatively expensive stocks, may stay invested in the relatively cheaper ones, and also the kind of niche market leaders. You know, we're actually seeing this not just in this sector, but in all across India. It's the market leaders who are able to command pricing. It's the market leaders who are able to gain market shares. I have been saying this since late last year and on your channels also, that India is overvalued. And at that time, in late September, early October, Indian valuation premium compared to Asia ex Japan was about 90%. You know, now that has declined. You know, Nifty 50 or BSE Sensex, the frontline indices, their valuations have declined. 1-year forward PE declined from 24 to 25 to about 20 right now, which is closer to the long-term average.
Similarly, if you go within MFIs, you'll realize that a lot of the reticence or reservations that banks have with lending to certain MFIs has to do with how they perceive the fundamentals of the MFI business today. But you have nailed it when you said that this is a critical communication of regulatory intent. Yes, there's been focus on liquidity. We have already seen rate cuts, and these are probably the first signs we are seeing of credit policy easing, and that bodes very well for the sector, both banks and as well as NBFCs. It shows that the regulatory focus is shifting from towards growth accommodative in a meaningful way, and that has to bode well. I absolutely agree with you. As far as the arithmetic of the capital release goes, it obviously favors or has a greater marginal impact with those who are nearest to the minimum capitalization red line. So you are thinking PSU banks. That's the first order impact.
I'm absolutely clear that this and the market space is big enough to give space to another player. Number one. Number two, Ultratech will take minimum 3 years to start their production. Whatever somebody may say on paper, 2 years, but we have our long experience in developing the industries. Number three, it will take another 3 to 4 years to or 5 years to develop the brand for wires, and also to
Good afternoon and welcome to Mid-Cap Radar, live from the CNBC-TV18 Motilal Oswal studio. I am Vivek Iyer, And with me today is Hormaz Fatakia. Hormaz will be joining me in a bit. He's standing by the wall. A little later, he'll take us through all of the mid-cap stocks that are moving around in the session. But it's 1:35 p.m. this Thursday afternoon. Remember, it's the last Thursday of the February month. And it also means that it is the F&O expiry as far as the February series is concerned. Our markets look set to end the February series on a very subdued note. But the broader markets are the ones that are seeing significant amount of pain. In fact, if you look at the small cap index, continues to hover around with cuts of close to 1.7%, and the mid cap index a little over 1%, and 1.1% to be precise is the kind of cut that the mid cap index is seeing. The market breadth is very negative, with declines far outpacing the advances. But as promised, Hormaz is standing by the wall. Hormaz, take us through the list of stocks in the broader end of the markets that are seeing significant moves today.
It's a big yawning gap that you can see between the advances and the declines in today's session, and equally yawning are the participants on the Nifty as well on this expiry session. Hopefully the last hour or so might bring in some action as well. But we'll start off with the story of the day, and that is the cable and wire stocks that are seeing very sharp cuts on Ultratech's foray into this segment. KEI, Polycab, RR Kabel 17 to 19 to 20% lower. Havells not seeing as much of an impact, but still down 6%, as is Finolex Cables, which is down to the lowest point of the day as well. On the flip side though, every single NBFC that you pick up in today's trading session is trading in the green, and that is after RBI's relief beat. Credit Access Grameen, that's up 13% now. AU Small Finance Bank, Chola Mandalam and 5-Star Business Finance, and a lot of these NBFCs are seeing some bit of relief after the announcements made by the Reserve Bank of India. Some of the other stocks that are in focus in today's session are those that will be seeing an exclusion from the futures and options segment, today being the last day in the F&O space, and they are seeing some unwinding of positions. PVR, Inox, Navin Fluorine. Mind you, these are just 4 out of the 16 names that will be excluded from the F&O segment. On the volumes front, there are very little names that are bucking the trend though, but Inox India is one of them, 10% higher on strong volumes. SRF, after some positive management commentary, is doing well. And on the flip side, Praj Industries is trading with cuts of around 5.5% on very sharp, on very high volumes. And lastly, some other names that are bucking the trend in today's session. Kirloskar Brothers is at the highest point of the day, 7% higher there, as is EIH, Bayer Corp and Bajaj Holdings too, having a good day at the office, gains of close to 5%.
Thank you so much, Hormaz, for taking us through the list of stocks in the broader end of the market that are making the moves today. And you've actually managed to find some green on the screen. Our market participants haven't been able to do that so often today. But now is as good a time as any to welcome Vinay Rajani from HDFC Securities for a technical check on the market. Thank you so much for joining us, Vinay. Where do you see the expiry? We have another couple of hours to go. Do you expect some bounce as far as the Nifty is concerned, or do you expect the indices to remain range bound?
Yeah, so good afternoon and thanks for having me on the show. So till now, derivative data is suggesting a muted activity in the markets, and we don't expect any larger movement on the either side as far as the derivative data is concerned. And the primary trend has been negative. Nifty has been trading below all moving averages, which indicates that the trend has been negative. So yes, the bias is on the negative side, but as far as expiries is concerned, it might remain between the range of 22,500 to 22,550. So we don't expect any larger move in the market. But overall, yes, we are, as I said, we are into a downtrend, and the support which we see for the Nifty is around 22,450, which happens to be the 76.4% retracement of the entire rally, which was registered from 4th June bottom to the all-time high. So that is a strong support we see in the Nifty as an overall trend, and this has been the 5th consecutive month where Nifty has been falling, and it has been quite a long time that we have not seen recovery. So let us see how it goes. But yes, there is a strong support at 22,450 according to our analysis.
All right, Vinay, thank you so much for sparing time. We could not take your stock picks due to paucity of time, but thank you for sparing time and joining us today on the show. Take a short break. Up next, we get you excerpts from our conversation with Akhil Ravi, who is the CEO of Origin Pharma Services, on the other side. Stay tuned.
if they come at all in the cables, it will take many years to get the approvals from different customers, different utilities, different departments, and also, develop their channels.
A bit unusual but not totally unprecedented, because in the last decade, 2015 we had a similar situation, 2017 also, at least 4 to 5 occasions in the last decade temperatures have been in the range of 37 to 39. So you can't call it unprecedented, but yes, it's a bit early, a little bit unusual.
So ma'am, can we expect a dip in the temperature in the next 5-6 days? Is that a possibility?
You can expect a small dip, but not a dip that will give you any respite.
Welcome back. Now on the sidelines of the BioAsia Summit, Dr. Reddy's subsidiary Origin Pharmaceutical Services, which is involved in the Contract Research Development Manufacturing Organization or CDMO, offering truly integrated CRO and CDMO services for all the small and large molecules to global innovative pharma and biotech companies, spoke with our colleague Vinny on the CDMO opportunity and the growth potential. Listen in.
If you look at the global CDMO industry, it's roughly about 140 to 150 billion. India's size is only 3 billion. And Asia's size is about 35 to 40 billion. So if you see, the growth potential of the industry is quite high. I think there are a few tailwinds which is potentially going to help the Indian industry. Number one, a lot of the Western companies are looking at redistributing their supply chains, both from US, Europe and China. China plus one seems to be a theme. It is played out in different forms and shapes. Second is there is a lot of pricing pressure with Inflation Reduction Act in the US, and also likewise similar acts in Japan. So companies are looking to reduce the cost of their supply chain and manufacturing. And I think there is a growing talent base in India, especially with chemistry and chemical engineering. And I think a combination of these three factors is enabling the industry to grow. So I think that is the big potential for the industry, for us to go be less than 3% market share to hopefully at least 10 to 12% over the next sort of decade or so.
This is for the industry as a whole.
For the whole industry, yes.
And for you, what are you aiming at the company?
So, if you look at, if this plays out, we are looking at roughly 14 to 16% CAGR for the next sort of 5 to 6 years for the industry. So as an aspiration, obviously, we would like to be well above that in industry
14 to
curve.
16% at
right?
least.
So we hope to be at, double-digit CAGR, compounded annual growth rate for the next sort of 5 to 6 years.
So around 20%.
Sure.
I could say that,
Yes.
at least. Yeah.
Yes. I would, I hope my CFO is not watching, but yes. But yeah, we would hope to be above this 15% CAGR mark, and that's our internal benchmark.
Sure.
Minimum.
What I want to know is the China Plus One opportunity, which we talk about, and it's there across sectors. Some sectors it didn't play out as much as one was expecting. Is it playing out for pharmaceuticals?
Yeah, I think I'll break into two parts, right? One is there is already an existing supply chain which is there in China, right? And the Chinese manufacturing industry is very strong, right? I know there's a lot to learn for us from the Chinese industry in terms of their investment, automation, talent, skills, engineering, and so on. It is very hard in pharma to shift existing supply chains, which is where the product is already commercial in the market, and so on and so forth, right? What we are seeing more and more is when a new product is being discovered, or new supply chains are being formed, then there is a preference to not have that in China, right? I would not say it is 100% to all companies, but I think it is much more than what it was, say, 2 to 3 years back. So I would say that the expectations of the investors is probably overhyped today. It will take some time to ramp up, but it is happening.
Okay, take some time to ramp up, but it is happening.
Yes.
We are on that path.
Yes.
And costing wise also, would we be able to match that? Because that's a factor as well.
Very, very good question, right? If you look at structural factors, there are some structural factors where China is probably better placed than India as a whole. One, first and foremost, cost of capital is lower, and the CDMO industry and manufacturing industry is very capital intensive, right? Second is there's a very good supply ecosystem within China, where it is slightly cheaper than here in India, right? So they have some structural factors which make them much more competitive when you look at large volume, early stage sort of reactions. However, I think by combining our innovation abilities combined with our strong sort of talent pool, I think we can be at par, right? I would not say that we will be better in terms of purely on cost, but I think we can definitely be at par. I think if you look at it, customers also value other factors when making a decision beyond cost, which is on transparency, communication, openness, and I think that is there within our innate sort of service culture of our industry in India. And I think on those factors, companies are coming to India. When they visit our facilities, they feel that this is on par with any manufacturing site globally.
Okay.
Right. One of the customers told us when they visited our biologics facility that I could be in California or in Hyderabad right now. Right. So once they see the campus, see the facilities,
what we have to offer,
what we have already invested, I think then the companies are opening up, and that is where we see that as more and more companies come to India, they will see the opportunities there for them to trust us with their products, with their novel molecules.
So those inquiries are getting converted to clients, right? Because we know that everyone is getting a lot more inquiries because of China Plus One or what's happening in Russia. Everyone wants to move a bit and focus to other countries. Is that client being converted? Few companies have mentioned about it, that they are getting clients from US and UK. Is that happening for you as well?
It's a very good question. I think I would say inquiries on average are about 50 to 60% higher compared to the last couple of years, and we are seeing that consistently over the last few quarters. Conversions are happening, but in pharma they will be slow, right? What we are seeing is existing customers who already have established their trust with certain partners, adding more and more business over there, and entering a supply chain for a new customer typically has a 1 to 2 year cycle. It is a combination of convincing the management, various audits, safety, quality, sustainability, various audits, and then you actually start the work. And then that's only the validation phase. The real money happens many years later. So I would imagine it to be a slow pickup, but it will be sustainable.
Slow pickup, but something once it comes in,
yes,
they're going to be here because they trust you, and that's when your growth will also start
we
increasing.
also need to ensure that we invest in that trust, and that is something I think the entire industry is working towards.
Well, that was a very interesting conversation that Winnie had with the management of Origins Pharma, which is a subsidiary of Dr. Reddy. Well, as we now slip into a short break, here's some good news for our viewers. India's business news leader is now just a click away, introducing CNBC TV18's all-new app. Get instant access to breaking news, in-depth articles, and financial world updates at your fingertips. Download the CNBC TV18 app now from the Apple Store or Google Play Store, or just scan the QR code on your screen.
Over the last decade, if you're a global asset allocator, like, where would you have made money? Like, you didn't need to put money offshore from the US over the last decade. What we would say there is that the valuation differential between EM and DM now is at its largest point that it's been for many years. Therefore, when we're being approached by our global clients, they're very much aware and cognizant of the fact that they have a large overweight in the US and they tend to have large underweights in emerging markets. What I would say is that when we look at emerging markets at the moment, we're very constructive on emerging markets. When we're looking at India itself, I think the selling pressure here really has come about from the tremendous bull market which we've had in India over the last 3 years. And as we went into the end of last year, valuations on India became stretched. So all it took was a slight slowdown in the credit markets, in the credit cycle, in loan growth, and some earnings expectations, and that led to money coming out of India. I certainly don't think the bull case for India has changed, but I think with all long-term bull markets that you have, and that's what we believe is happening in India, you will get these pullbacks and a reset, and I think you'll see a return of FII, certainly in the second half of the year, once those valuations get back to those long-term averages. There are a couple of themes I'd like to go through there. I think the internet platforms in India, the duration of growth that you have within the Indian internet.
Welcome back to Midcap Radar. Well, it's now time for another exclusive today. Our colleague Shilpa spoke to Kulin Lalbhai, who's the vice chairman of Arvind Fashions, and began by asking about the demand sentiment. Let's listen in to excerpts from that conversation.
I think generally we've had 3-4 quarters of the demand being on the subdued side. And I would say that if you ask me currently, we are not seeing any major breakout in terms of growth. But I do believe that with some of the decisions taken in the budget this year, and as we move into the summers, I'm cautiously optimistic that we should start seeing the impact of some of these decisions, because there has been money put into the pockets of the middle class, and I'm sure the consumption cycle will start building. Another thing I'm seeing in the market is whenever it's a market which is a little bit more challenging, the brands which are stronger and relatively are able to execute better tend to gain market share. So as far as we are quite happy where we are concerned that we've been able to have like-for-like growth which has beaten the general market averages, and I think we will continue to ensure that even in this kind of market, we achieve kind of the growth ambition we have set for us.
Speaking of footwear, there was some focus that you were putting on adjacencies beyond just apparel, right? Just wanted to understand what's the update there? How's been your growth strategy when it comes to growing adjacent categories for Arvind?
So that's one of our growth drivers. It's currently around 15% of our business, and we intend it to become around 30% of our business in the years to come.
Yeah.
And within adjacencies, footwear is something which we are very excited about. That's close to 10% of the business overall for us.
Yeah.
And we believe that this whole area of casual sneakers is an area we find very exciting. So in Arvind Fashions, we are now almost selling 2.5 million sneakers across our brands, and we're also planning to get into footwear manufacturing of sneakers because it's similar to garment manufacturing, which is our skill set. So we believe that an end-to-end exciting opportunity exists in the footwear sector, eventually maybe even for exports.
Right. This manufacturing that you're talking about will be for across your brands, any specific brand, a new brand for sneakers?
No, we are first planning to produce for our own Arvind Fashion, say US Polo, which is the largest brand. So we'll first produce for our own brands, and then as we expand our capacities, we would want to start then producing for the world, like how we do in textiles.
Shilpa there in an exclusive conversation with Arvind Fashions. We call time on this edition of Midcap Radar. The benchmark indices, though, are absolutely quiet. But what's not quiet, though, is the Midcap Index. That is down still over 1%, and the Small Cap Index has seen even greater pain. The Nifty Bank, though, is the one that's outperforming as of now. For the final 90 minutes, though, MF Corner takes you to the other side along with Closing Bell. But from Vivek, me and the team that put this show together, thank you so much for watching.
Quite extraordinary, and I think that's something we'd be very interested in. So whether that's the food delivery side, whether that's the online travel side, whether it's the fintech side, those are all businesses that we're familiar with, and we'd be very positive on those on a longer term basis. And I think this pullback gives a good opportunity within those individual areas.
afternoon. You've tuned into Mutual Fund Corner on CNBC-TV18. I'm Vinny Motiwala. Thank you so much for tuning in. And today what we're going to be discussing is all the queries that you all have sent us related to mutual funds. What mutual funds should you all be looking at? Is it the right time to pick up mid, small cap funds? You have sent out a whole host of queries. To answer all of that, we have Nasser Salim, Managing Director at Flexi Capital, joining in with us. Nasser, thank you so much for joining in with us as always. It's always a pleasure having you and listening to your views. Today we're going to be just discussing queries. We have a whole host of them, so I'm going to get started quickly with them. We have the first query. This is coming in from Dev Chikara, who's writing to us from Nagpur. Now, he's saying that he's looking to invest a lump sum amount of 1 crore rupees in a staggered way in a Kotak Debt Hybrid Fund, Quant Multi-Asset Fund, Kotak Equity Options, as well as Tata Small Cap Fund is what they're looking at. And he's asking that, what should he be doing now? He has an investment horizon of 4 to 7 years. Whether he should continue with this mix that he's holding on to, is it the right mix that he has right now, or any changes that you would be recommending?
Good afternoon. Thank you very much for having me back on your show. It's always a pleasure to be with all of you. A quick one. He's obviously been investing, and one of the few things that when we look at this, when I hear this question is keeping in mind the investment horizon and fund selection. We assume that it is an aggressive risk profile because that is paramount to the entire discussion. And the suggested split to him, in my opinion, would be a shortlisted options of 80% in equity as an asset class and 20% in fixed income. And a staggering lump sum could help smooth market timing, especially given where we are today in terms of market volatility, capturing uncorrelated exposures. I think a longer time horizon will also allow better deployment and better opportunities for an exit down the line. Broadly, we feel that a split between, and in the equity basket, 70% core and a 30% thematic should that flavor should do well for him. A combination of large flexi, as far as flexi cap is concerned, in terms of large cap, in terms of core, and in the satellite, we would want him to add a little bit of consumption in banking and financial services. Also, because we all know very well that given where we are in terms of the announcements in the recent budget, that may bode well, and add a little bit of gold and silver as well, which should be able to navigate him to his end objectives. However, the appropriateness of these categories depends on his risk tolerance and liquidity needs.
Okay. So interesting set coming in there, and allocation-wise also, Nasser has given those list of names that you could look as well, and you saw it in the graphics also playing there as well. Let's move on to the next query for today. We have Munira Julu Pullur, who's writing to us from from Tamil Nadu, and he's saying that he's done some monthly SIPs of 1,000 rupees. One is in SBI Blue Chip Fund, Tata Digital India Fund, as well as SBI Small Cap Fund, a regular plan growth. For the last 3 years is what he's been doing in terms of SIPs. Wants to know whether he should continue for the long term with this, or any changes that is recommended on this one. Your view on this, what is the suggestion that you have for this one?
So again, clearly, when we look at these kind of allocations, I think one of the few points that we keep talking to all the prospective investors is please have a clear discussion with your certified professionals on the way forward on core and satellite. I think those are very important in today's times, especially where we are in the markets. We assume again that this investor is an aggressive risk profile. Continuing SIPs in these funds, especially more volatile categories like thematic and small cap, can help benefit from rupee cost of averaging, and therefore, depending on the over long-term horizon, you can continue. There is a lot of comfort today from our perspective, not recommended in shortlisted options in large caps, relative to small and mid caps is what we feel, and therefore, one of the few things that we wish to add at least is please allocate some options available in the large cap category between Nippon and ICICI. We also feel that there could be some addition in FlexiCap, which is not there in the portfolio, and in the satellite, again, a little bit of consumption in banking and financial services. We've shortlisted those options, between the ICICI, SBI, and Nippon, and a few other like Sundaram. I think a combination of these broadly will suit more favorably over the next few years. Yeah.
Okay, surely again a list of names and interesting names coming in there from Nasser as well, and what you should be doing there. Let's move on to the third query for today. We have Lakshman, who's writing to us from Hyderabad. Now he's saying, although he has a SIP of 60,000 rupees, and this has been for at least 5 years in Motilal Oswal Mid Cap Fund as well as SBI Blue Chip Fund. Again, that name is coming up as well, Nasser. Wants to know the outlook for the long term, what should they be doing right now? I think, everyone's worried, Nasser, given that, some of these mid and small cap have started giving those negative return because of the recent corrections that we've seen. So I think that worry is coming in on this front. But what would your suggestion be? Motilal Oswal Mid Cap Fund and SBI Blue Chip Fund, 60,000 rupees, I think, is what he said that he's investing right now through SIPs.
So very clearly, I think, to your point on mid caps, I think specifically for the example that we've just mentioned on the fund, Motilal Mid Cap has been outperforming its benchmark on multiple time horizons, which is definitely available on data. The fund has corrected 20% from its top. However, this should not affect SIP investors with a long-term view. Our view on SIP, it should not be stopped. It should continue to go because it's a long-term question of wealth. SBI Blue Chip has recently, he's already been investing in SBI Blue Chip again. It's a good story there. I don't think there is anything much to worry on. Additional details regarding risk tolerance and financial objectives should be refined and defined by him on his outlook. Our view is that he can continue with these two. There's no need to stop in SIPs in any of these categories. Large and mid cap is long-term intact. A monthly SIP of 60,000, approximately 5 years of a kind of a time horizon. The expected return in equity historically has always been close to about 12%. That's what we should go with an estimate. The invested amount should be roughly about 36 odd lakhs in terms of cost of capital. Total value, which means after 60 months from now, the value should at about 12%, roughly should be about 48.66 lakhs. So an increment of about 12.7 lakhs over a period of 5 years, augurs well. So clearly, the view is not to stop SIPs in those two.
Okay, let's move on to the next query then for today, and this one is coming in from Prakash. Prakash is writing to us from Chennai. He's saying that he's invested 50,000 rupees per annum in NPS last year, but it is not continuing. He's not continuing with that investment as there is no tax benefit that he's seeing, significant one there. So he says that his other investments include 15,000 rupees per month investment in the Old Provident Fund and 12,000 rupees per month investment in superannuation savings with LIC. So wants to know whether this is a good investment strategy for a retirement purpose.
Okay. So very clearly, I think the current mix across NPS, Provident Fund, and the superannuation plan that is being shared by him represents a diversified retirement strategy. I think that's it seems to be in the right set of the category of basket. We assume that he's a conservative risk profile investor, primary objective being a retirement corpus here. A review of asset allocation considering factors such as inflation and expected retirement and his age might be warranted as of now. So it will be beneficial to kind of assess, the retirement income needs and other financial commitments before making any changes. Our suggestion on some of the shortlisted funds clearly is that there could be some addition in arbitrage as a category. That is something which, will augur well for him. There is a new category post the budget that came in last year, which gives you long-term capital gain benefits of if you hold it for more than 2 years and above. LTCG of 12.5% there. We feel that there could be some allocation between an income plus as a category, which is available from a large asset house, fund house. It's income plus arbitrage as a category. Then there is hybrids, which you can't miss. Clearly, I think some of the category in hybrids, such as the BAF, as a category is looking interesting in these times and for retirement from a long to a medium term perspective. And even a category called the arbitrage plus or the equity savings, which has a bit of equity thrown in to get you a better inflation adjusted returns as compared to a pure fixed income play. So I think that is something which may augur well.
Okay, Nasser, thank you so much for that detailed explanation there for the doubt that came in from Prakash. Beg your pardon. On that note, we're going to take a very short break, viewers. Don't go anywhere, because on the other side also we'll continue solving all the stock queries related to mutual funds with Nasser Salim, so don't go anywhere.
But, again, and I link this back to what we were talking about, the need to adapt as well as the change as far as the business model is concerned. In a Trump era, with the H-1B issue being the way that it is being dealt with at this point in time, what could it potentially mean as far as the services sector is concerned? What could it mean for Indian IT in the next few years?
So there, I think two parts to what you ask, and there I'll talk a little bit more about Infosys. We've built over the last few years a more resilient business, especially for the US. We've made sure we built out more and more local delivery and digital centers. We've got now more staff which are local. Over 60% of our teams in the US are local. We built quite a strong nearshore capability for the US. So we feel better prepared if there are any changes. So far, we've not seen any changes.
We're talking about human genius and human ingenuity as well, and we were just talking about moving from people to platform. Now, what actually happens on the workforce? Because this is a sector that has been driving, employment for a young country, for a young demographic like India. What happens to the people part of this business now? Let's talk about that. What happens to entry-level jobs, for instance? What are we talking about in the next 5 years?
So there, first, in the existing employees that we have, there's huge reskilling. So there's a constant move, especially with generative AI, but all through when we were having digital or cloud or cyber, a lot of reskilling today, at least within Infosys, over 270,000 people more ready for AI. So that's the first element. Second, in terms of new roles, we've already shared this last quarter. For the next financial.
Welcome back. Thanks for staying tuned into Mutual Fund Corner on CNBC-TV18. Let's move on and keep it going with all those queries that you all have sent for mutual fund. We have Nasser Salim, who's still here to solve the doubts. Nasser, let's move on to the next one. We have Deepak Joshi, who's writing to us from Karnataka. He says that his daughter wants to invest through SIPs and wants to know which funds can she pick to invest in? Starting out at a younger age, what is it that you would suggest? There's a lot of options that are there. Which is the best one right now?
Clearly, Vinny, I think for a young investor, our recommendation to Deepak Joshi is for a young investor, starting with SIPs and a diversified portfolio is the best mantra to start making and generating wealth. Typically leaning towards equity funds, and can be a good way to harness long-term growth. The specific choice of shortlisted funds also should consider risk tolerance and investment horizon. I think those are very key basics that we need to keep a check on. I think our assessment is that a combination of some large caps with some flexi cap options and some a bit of combination of index funds can also kind of help her engage in the market, invest through SIPs in these funds. So we've given a mix of large and flexi cap funds. Our recommended lists are obviously top is the Nippon and ICICI and the large cap, and then there is in flexi cap we feel the HDFC is our top choice. And on the index, we can look at any one of the index funds like the HDFC or the ICICI index funds as well, which are promising.
Okay, Nippon, ICICI, HDFC Flexi are some of the names that I'm reading coming in from Nasser. Let's move on to the next query, and this is for a young investor, just saying, so clarifying that point as well. Let's move on to the next query for today. Joy Rohan, who is writing to us from Noida, wants to know whether one should do a monthly SIP, daily SIP, lump sum. I think this will differ according to the age group as well, and what we are planning to do in terms of your goals, Nasser?
Absolutely, very in the level of involvement and the age. I think those are both are very important in this to this question. I think monthly SIPs are the most common approach, as we all are aware of, offering a more balance between convenience and market exposure. When I say convenience, it's monthly in a particular day that goes in a month, and you know about them. Daily SIPs, on the other hand, may be more suitable for investors who are highly engaged and can closely monitor their portfolios. Though they can often incur high transaction costs, right? That's one thing that we need to be a little conversant to. The other thing is lump sum investments can be beneficial if you have a sizable amount to deploy during favorable market conditions and after consulting, obviously, your regulated professionals. I think the decision clearly, in this case, should solely be guided by one's risk profile, in this case, Joy's risk profile, market outlook, and transaction cost considerations. I think those are broadly points that I would like to allude to.
Okay, let's move on to the next query. We have Aunitra Jha, who's writing to us from Mumbai. She says she's looking to create a corpus of 6 crores by 2038. Her portfolio is just 1 year old right now at almost no gains. Wants to know the guidance for the portfolio strategy, suggestions on mutual funds, and amount of distribution to achieve this target. How much should she be investing to achieve the target by 2038? Nasser, an interesting target, I think, is coming in from her as well. So what should she be doing?
Interesting number, an interesting target, Vinny, and we wish her all the best. I think so. 2 or 3 key points there, Vinny. One is that our current allocation across various represents a mix of large caps, mid and small cap infrastructure and thematic exposures. Achieving a target corpus by 2038 will depend a lot on market performance. I must tell you, rebalancing and aligning her risk tolerance, with the end objectives. It might be useful to review and possibly streamline overlapping exposures, particularly in small cap categories that I can see, to avoid any concentration risk. Now, what we feel is that, again, the same names, clearly large cap, we could add about 1/3 corpus, 1/3 in flexi cap, and in index also 1/3. So there we feel that between the Nippon, HDFCs, and Parak in terms of flexi cap can be added to her portfolio. The other quick one is that, the index funds I just spoke to you about, whether it's the ICICI Sensex or the UTI Nifty 50, can also be looked at and can get to her desired number. The one point that I want to allude to here is, and to stick my neck out, is to say that her expectation long term should not be more than 12% on equity returns. And based on that number, the corpus value in 2038, if she's looking at that number, the total monthly SIP required for a corpus of 6 crores today at 12% rate of return is 1,55,000, and therefore the additional monthly SIP that is required for her to be doing is basically another 67,000. We've assumed that she's given a number of 10,56,000 as a current corpus value. So clearly, an additional amount of 67,000 in those category of funds that I just kind of shortlisted.
Okay, an interesting amount. Still more required if you want to reach your target over there. And let's move on to the next query. Prakash Desanur, who's writing to us from Jaipur, holding 1 crore rupees of mutual funds, most of which are currently in mid-cap. So obviously, that portfolio has seen a bit of a subduedness. And he's saying that he was making a profit of around 27 lakhs 4 months ago. Now, obviously, it's a different story. What is the way forward if you're holding a mid-cap fund right now, Nasser?
So clearly, mid-caps as a category have taken a hit over the past 6 months, with mid-cap 150 index correcting to almost as 18%, if I am correct, from its 52-week high, which was in September of 2024. Market fluctuations, my recommendation to him is, and to the viewers, is market fluctuations are common, and short-term declines may not necessarily impact the long-term outcomes if the fundamentals remain strong, which is what we are saying consistently. Before making any changes, consider whether the mid-cap exposure still fits his portfolio. with his long-term objectives. If so, a more prudent decision would be right to hold through the volatility and draw down through the long term, especially since the sector has already experienced a heavy correction. So don't get dissuaded because of the correction. This is part of the cycle. Equity as an asset class tends to behave like this, and in the longer term, because you have a long-term horizon, the current strategy that you're holding in should fit into the overall perspective. You should not be overexposed to mid-cap as a category. And for that, I think that is where you need to consult a more detailed approach to a certified person.
Okay. Nasir, the next query, Manthan Shah is writing to us from Mumbai, says that currently he's investing in mid and small cap funds, again similar to that. Should he start increasing the SIP? That's also a question, since you were talking about mid and small cap. Should one actually start increasing the SIP amount in good funds?
So clearly, SIP is the best tool to achieve cost of averaging. If you invested in small and mid caps, you can continue those, but what we're suggesting is again do a full-fledged review on large, mid, and small. If you've not captured as a category in large, please get into large cap as a category today. The valuations are far more favorable, and SIPs should definitely continue for the longer term. As long as you have full idea that you've not been overexposed to a particular market cap and you're well diversified within the portfolio.
Okay. Nasir, we have this last one. Nikhil is writing to us from Gujarat, wants to invest in multi or flexi cap funds for the long term from an ETF account. Does this make sense? A quick one on this.
So flexi cap as a category, we feel could vote better in terms of your end objectives because they have the flexibility to move between market caps and offers more volatility in terms of better returns. Also in near term could be a little volatile, but in the medium to long term has always better risk-adjusted return. So as long as you've done your risk tolerance measure, you've had that discussion with your financial advisor, distributor, you may continue to do so.
Okay, Nasir, thank you so much, for joining in with us on the show, solving all those mutual fund related doubts from our viewers. We still have a whole host of them. I think we'll have to reconnect at some point of time again. But thank you so much, Nasir, and thank you so much, viewers, for sending us all those queries of yours. Hope we have managed to answer as many as we can. On that note, it's a goodbye from myself as well as the team who put this show together. Don't go anywhere. You have Closing Bell up next.
We will recruit something like 15 to 20,000 new campus hires, which shows the same sort of direction of what we were discussing earlier, which is there is growth, there is productivity, and there is new work from these technologies. All of that combined gives us confidence to have new people joining from the campus.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC-TV18, now streaming live 24/7 on YouTube. How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajar at these times on CNBC-TV18 and CNBC-TV18.com.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest running show on startups and entrepreneurship. Celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21. Only on CNBC-TV18 and CNBC-TV18.com. CNBC-TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of
to understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC-TV18 Motilal Oswal studio.
The Taiwanese index too trading above the flat line with gains of around 0.25%.
President Zelensky is going to be coming on Friday. That's now confirmed.
They're proposing to put down a capex of close to around 1,800 crores over the next 2 years.
So Nifty, of course, on Tuesday, which is the last session, ended lower, and of course, no signs of reversal yet. 0.2 higher on the Nifty, so let's go with that one first. 0.4 on the Nifty Bank.
Unrelated diversification, non-core diversification is always bad news.
It will take minimum another 3 to 4 years to, or 5 years to develop the brand for wires.
With this kind of change in risk weight, I think around 40,000 crore of capital would be released, which can translate into 4 lakh crore of incremental lending.
It is not that much like disruptive what market is reacting as per me.
The mid-cap index is down close to about 0.8%. The small-cap index is a cut of more than 1%.
If you look at it over the medium term, you do get a very consistent play out on what happens to the market.
Broader markets are the ones that are seeing significant amount of pain. In fact, if you look at the small cap index, continues to hover around with cuts of close to 1.7%.
Well, it's an all-boys team once again here on Closing Bell. We are coming to you from the CNBC-TV18 Motilal Oswal studios. Markets are, it's like a traffic light for the Nifty, right? Red and green and almost literally unchanged. Mid-caps and small caps, significant pressure in selling once again. I'm Prashant Nair. With me, my colleagues Nigel and Mangalam. Guys, hi.
Hi, good afternoon. Prashant, remember, taking over from last Tuesday where you said nothing happens in the market, I bring on Mangalam, and that's exactly what's happening today as well. Absolutely nothing. I don't remember the time when I was on Closing Bell at the time the market was at even more than 20 points higher on the frontline index.
And today's expiry day.
It's all well planned, Mangalam.
So we are flat as of now. We have Mangalam and we have expiry. So I don't think we'll end around 22,550. We should be much higher or much lower. So let's see how that goes. But you know, in today's trading session, to be fair, you have a lot of stocks that are seeing big moves. You know, you have these cables and wires players that are down for obvious reasons. In the last few minutes, take a look at Credit Access Grameen. The stock is up 18%. Massive volumes. It's at the high point of the day. But you know, that's telling you there are select counters that are doing well and some of them still getting hammered. You know, so plenty of action in the broader market.
Yeah, sorry.
No, I was just saying, even if you look at the Nifty, even if it expires at 22,550, two things will happen. One, it will create history on the downside once again. 5 straight months of losses, the first time that happened since all the way since 1996. And the second part is all those who've written the 22,550 straddle, which is a call and a put together, will be making a lot of money because that's the strike which has been most active since morning. We've been, you know, looking at this 22,550 sort of straddle out here. So for all those option writers, actually, if the market does nothing, it would be a great expiry for them.
It's almost like that. It's fixed on the tape, 22,550 as we speak right now. Nothing at all. But I mean, absolutely flat, nothing at all. But broader markets, right? Significant pressure once again. And I'm just looking at the NSE advanced decline is some 4:1 in favor of declines once again. So that's not good news out there. But I think, as Nigel said, lots of single stocks moving. Credit Access, I think by 10:30 it was up. It was significantly higher. I remember 13-14%, but it's now about 18%. And it's the number one volume-led gainer on the NSE as things stand. Polycab is down 18% as the number 2 place in terms of volume-led move. That is, of course, on the downside, right? Credit is down 18, up 18. Polycab is down 18. There is Ultratech, which is down 5. Again, significant volume-led move. KEI is down 20%. Look at something like a BSE. BSE is down 6%. I'm not sure if this is a recent move. It was not there in the morning, at least. The fall happened at about 9. Yeah, actually, the big fall, the big down move happened about 9:20. So I guess, and then of course it's kind of plateaued out. It's been down since, but that's a big one. Inox India, we spotted this in the morning. It's up about 8%. Shriram Finance is up about 5%. Havells is down 5.5%, 6%, and Varun Beverages is down 6.5%. Again. I mean, the big sell-off happened from about 470, 475 levels to about 440, which is where it has kind of plateaued out for the last few hours or so. So lots of specific single stock action with volumes both on the way down, more on the way down, but also some on the way up.
You spoke about Varun Beverages. The entire consumer discretionary pack, the urban consumer pack has come in for a bit of selling. So you pull up something like a United Breweries. That's moved to the low point of trade. Alongside that, you have United Spirits. That too has dropped to the low point of trade. And just pull up the intraday chart of Jubilant Foodworks. Jubilant Foodworks was holding up in the green as the analyst day is currently underway. We saw the presentation. No, major negative out there from the presentation, apart from the fact that Popeyes hasn't been mentioned as much as the street would have liked them to. But that stock too has seen a bit of a sell-off right now, even as the analyst day is underway. We are seeing this sell-off in a lot of these names, which are basically urban consumer discretionary plays. Nykaa, for instance, too, has now slipped to the low point of trade, a cut of almost 2.5% from the high point. So there are pockets which are seeing some bit of pressure, Nigel.
Well, that's right. I think easier said than done, but I think investors could take heart from what Mr. Virat Kohli said, post that innings. He said he ignores all the noise, he sticks to the basics, and he keeps at it. And ultimately, the runs come about. So I know it's a difficult times. All of our portfolios, in terms of the SIP, the mutual fund portfolios as well, that gains have virtually been wiped out. But I guess in the longer term, things should look up. And that's why I think maturity of investors is called for right now. And, I think you need to keep it going. That's what I'm doing as well. So just taking a page of what Virat said the other day. Ignore the noise, stick to the basics. The runs will ultimately come. So it's a difficult phase that market participants are going to. Mood is extremely somber.
Just try and hold on to your wicket.
Yeah.
Just try and hold on to your wicket. Don't lose your wicket. In the stock market parlance, that would mean basically don't over leverage or don't get into any mistake that may make you adventurous.
The time for mistakes is gone, guys.
Yeah.
Now you've got to just, you're in it. So you've got to just endure.
Back yourself.
And get through this phase as well. So we'll help you do that. We'll get you lots of opinion. Let's quickly get in the first one, at least from a very near-term perspective. Mitesh is with us to tell you how to position yourself, any trades out there. Mitesh, afternoon Nifty, and also just look at the mid and small cap indices because they're down another 1.5%, 2% each. So how are they set up?
So Nifty, I think, Prashant, nothing much has happened. In fact, you could have, if you're a Nifty trader, you could have been on a vacation and come back very happily. But again, as I said, I think, the pace of fall is declining. That's the only positive thing. I think, coming out of a negative movement, getting into sideways movement is not a bad idea, though I'm still not sure that we've begun a big contraction. But I think it looks like that 22,610, 15 and about 22,510, 510 to about 22,500 is the near-term range. Let's see which direction do we break out from. My sense is that in case there has to be reversal, we have to have a stronger and much violent move, which can possibly give a bullish candle, which can engulf multiple this negative, slowly declining candles. So, but till then happens, I think just wait it out. And on the stock side, I have one buy and one sell. On the buying side is Navin Florin just trying to reverse from oversold levels. So we'll keep a very tight stop at 36.85 and look for a bounce back to about 3,800 plus kind of levels. And on the sell side is Sun TV, which has reversed on the negative side. So sell here with a stop at about 580 for targets of 550.
Okay, all right. I wanted your call, Mitesh, on a few of these steel names. Again, that buzzes that maybe we're close to hearing something with regard to protection. And if I pull up, some of these names, whether it is, Tata Steel, JSW Steel, NMDC, all of them have moved to the high point of the day. So any view or any of these names, and also the other rank underperformer has been Coal India. But in the last 1 hour or so, that stock has spiked up. We know valuations are okay. There's a dividend player out there. There is some buzz that maybe since now we don't have any state elections for the next few months, maybe that price hike could be pushed through, some part of it. So those are all the potential reasons, and that's why the stock is at the high point of the day. Any view on some of these metal names or the mining major, Coal India as well? Anything looking good on the charts?
See, before a couple of days back, if you just rewind the markets, we had good activity happening on the charts of Hindalco, and then SAIL also rallied. But I think that rally has fizzled out. So while today they are up, I don't see a big reversal kind of a thing happening, except Tata Steel, which has a positive structure, and if it can sustain above this 134 mark, which is only about 3.5 points lower, then I think good chance that it should attempt 141, and then maybe on the upside, in the best case scenario, around 148, 150 level. So that's about it. Could be a trading rally over here, but I don't like most of the names, despite the fact that they are up today, except for Tata Steel, because there's no bigger sign of a reversal happening on the the upside.
Do you have a view on Bharti Hexacom?
Bharti Hexacom, no, I'm not track. Sorry.
All right, take that point. Thank you, Mitesh. We'll come back to you soon. The stock of the day, definitely from the frontline end, is Ultratech. Under pressure post its decision to enter the wires and cables segment. Nigel, a couple of years ago, the announcement was on paints. Now it's cables and wires. Street is worried about, where it goes from here.
Well, that's right. The disruptors, right? That's the big fear. And Ultratech, late on Tuesday, they had announced that they're going to go ahead and they're looking at the cables and wires business. For this, they're going to be spending close to around 1,800 crores over the next 2 years. By December 2026, they expect the plant to be commissioned, and the plant's going to be located in Bharuch, which is in Gujarat. Now, why are they doing this? There's an industry tailwind because the industry is growing at around 13% approximately. It's an 80,000 crore industry that's expected to go to around 1 lakh. So that's the industry tailwind. Backward integration could help them because Hindalco is into aluminum as well as copper. So maybe some kind of support on raw material. Point number 3 is they're talking about Ultratech Building Solutions business, which has around 4,400 outlets. And they want to build on that. How do they fund this? Well, via a mix of debt as well as internal accruals. And remember, for Ultratech Cement, this will be hardly 10% of the total annual capex that they spend. So it'll be very, very small. They throw up cash flows of close to around 10,000 crores approximately. So it's very, very small in that scheme of things. What do the numbers suggest? They're putting 1,800 crores. Revenues at peak could be close to around 7 to around 8,000 crores. And margins that they'll generate will be in early teens. Now, if you're looking at the profitability at the margins as well as the ROC that comes up for you on the screen, in comparison to their core cement business, these margins will be relatively lower. But in terms of ROC, that's return on capital employed, it will be relatively better. The big question, why doesn't the street like it? The street wants them to focus on your core business. You're the master of cement. You stick to cement and keep it as clean as possible. They haven't done that. So capital allocation woes have returned. Point number 1. Second factor is, if you want to do this as a group, you should have done it under Grasim. Why are you putting it under Ultratech? So those are the two pain points. Jefferies, they had come out of the north. They're saying we're positive on the stock. If there's a knee-jerk reaction, they would consider it as a buying opportunity. So that's what they had to say. For the time being, the stock is down close to around 5% or thereabouts. And Ultratech basically has announced 1,800 crores of capex. They have lost market capitalization of around 12,000 crores. But the ones that are getting harder hit are the entire cables and wires businesses, because put it together, the total market capitalization that's eroded today is close to around 30,000 crores. So let's find out from Upasana more about that. Upasana, my big boy Ultratech making an entry into your space. Your space is very, very, nervous, and they're fearing that this is that big pains moment. Tell us more, Upasana.
Certainly, Nigel, my sector, that is cables and wire, is feeling the pain. The street fears the competitive pressure from the entry of Ultratech Cement into the cables and wire segment. Now, the company aims to meet the growing demand from cables and wires across various sectors, and the industry tailwind also remains positive, as cables and wires industry has witnessed a revenue CAGR of 13% in the past 5 years, that is from FY19 to 24. Now, let us look at the impact on cables and wires companies. Now, this may intensify the competition for existing large players. Now, we talk about FY24 market share. The top players such as Polycab, it stands at 26%. KI Industries stands around 12%, followed by Havells, which stands around 11%. Now, HSBC is of the view that this move is likely to have a material impact on revenue growth and margins of these players beyond FY27, that is after the commissioning of the plan, and it has lowered its target price between 7 to 23% for all the major players in the space. It has given a buy rating on Havells with a target price cut by 6.5% to 1730 per share. Polycab, it has given a buy rating, target price cut as high as 20% to 6250 per share. KEI, it has given a hold rating and target price cut by 23% to 3450 per share. And RR Kabil, it has given a buy rating with a target price of 1260 per share. Now, Jefferies believes that it foresees a lower competitive impact on Polycab as compared to other housing B2C players, that is Finolex Cables and Havells, and it says that the Polycab continues to remain the preferred pick in this space. Morgan Stanley says that this move has surprised the street, but it does not see any concerns going forward. So all in all, these sector remained in focus, and now when we talk about the valuations of these companies, even after the steep correction, valuations are still above 5-year average is what we are seeing. So this space certainly remains the key focus and theme in today's trading session.
Thanks a lot to Upasana for putting all those factors down very, very neatly. So for the time being, the street is very, very nervous on prospects of players from the cables and wires business. But we spoke to a couple of players, spoke to both KEI Industries as well as RR Cable. Both of them, they believe that things are fine. The industry has enough of capacity to take in a new player as well, and they are confident about growth and profitability. Let's hear them out.
This and the market space is big enough to give space to another player. Number one. Number two, Ultratech will take minimum 3 years to start their production. Whatever somebody may say on paper, 2 years, but we have our long experience in developing the industries. Number three, it will take minimum another 3 to 4 years to or 5 years to develop the brand for wires. They may not be able to disrupt the market by just slashing the prices, because it is in this space, it is very difficult to increase the prices once you slash them. There will be no problem in margin expansions because this comes by economies of scale. And I have said that we have no fear in our growth plan of 20% plus for next 5 years, doubling our turnover to 25,000 crore. And we are rapidly growing in the export markets. I see that in next 2 years, 20% of our sales will be coming from export markets. There is no question of any rethinking of capex. In this year, we are doing a capex of close to 800 crore, or next year the capex will be 1,000 crore, which is ongoing at our new plant coming up at Sanand. And in the next financial year also, we will be doing a capex of close to 800 crore. We will not be reviewing or reducing our capex plan, and our growth trajectory will remain the same.
This is very big industry, and like almost 85-90,000 the industry size was last year, and it is further grown by almost 13 to 15%. And this is such a fragmented industry, and there are not many even unorganized player also. So if a big player comes like this is always a nice move where more strong player will be get bigger margin of market share. And though it is very quick reactions from market, and it is very on negative side market is concerning. But what I see, this is for players like us, it is good time that we can also have our growth plan intact, and we see good consolidation in market. But it is not that much disruptive what market is reacting as per me.
All right, let's get an expert view. We have Manish Valecha, the research analyst at Anand Rathi Institutional Equities, who joins us on the show. Hi, Manish. Good afternoon. Good to see you in. Normally, we call you and we ask you, what about the cement industry? I know the last many years, we have had a lot of chats on that. But now let's talk about the space that's being challenged, because the big boy Ultratech is eyeing the cables and wires business. All the stocks are down. What is your recommendation? Do you believe that this is a good buying opportunity? Because a lot of investors are very, very nervous about this big conglomerate getting into their space. Your take.
Hi, Nigel. Thank you for having me on the show. A quick, working that we did on the announcements. So basically, if I work out on Ultratech's plans in terms of numbers, They are looking to commit 1,800 crores in capex, which on a 3.5-4 times asset turn gives them a 6,000 to 7,000 crore of revenue. Now, let's say 90% utilization with 8 to 9% PAT margin gives them about 600 to 650 crores of profits in the first year of full operation. Even if I give them a 30 to 40 times of multiple, that works out to be 22,000 crores of market cap. But the impact today in the top 5 players itself is about 31,000 crores, which has been wiped out. I think from the cables and wires business perspective, there is slightly an overreaction, and this could be an opportunity to buy into these names.
In that case, what would your pecking order be?
We like Polycab, followed by KEI, and then Finolex cables.
Just a left field thought. If Ultratech really wants to be very aggressive in this, they can totally erode the margins of all other players, right? Lead into a price war, because with the kind of cash that they generate, it won't make a very big dent to their EBITDA, but in return, they will get the entire market. And as a result of which, all the others will get disrupted. Is that a possibility? Do you fear that would happen?
Yes, that's very typical of both Ultratech as well as the group. I think we have seen it multiple times, both in cement as well as on the paint side. I do not deny that there could be an impact in the first or second year of operations where there is a fight for market share. And maybe once they have reached a 3 to 5% market share, I think that is when the margin or the race for cutting on margins will end there. So we believe, maybe there will be 1 or 2 years of impact, that too in FY 28 and 29. That could disrupt the market a bit. By the time the other players will also gear up in their defense. So I don't see a very big impact coming in.
You don't see a very big impact coming in, but there's a possibility that it could happen in FY 28 or FY 29. But you would remain a buyer on these stocks, right? Are we getting that correct?
Yes, I think the reaction to a large extent has already happened. So yes.
Okay, so you think almost all the bad news is in the price post today's damage, right?
Yes, more or less. Yes.
Okay. All right, Manish, just a question. Everyone's talking about, because of recency bias, everyone's talking about what happened in the paints division. But we need to keep in mind that those paint stocks were trading at multiples of 65, 70 times as well, which we did see a big derating out there. These companies are in the vicinity of 30 to 35 times odd. Do you think there's a valuation derating that will take place also? Or do you think, it's pretty much okay right now post this correction?
So I think there were two major differences. One, as you mentioned, they were at 60, 65 times. And second, that industry itself was not growing, right? Compared to these companies, in fact, the impact should have been much lesser, given the industry itself is growing at 11 to 12% CAGR for last 3-4 years, and in fact going forward also looking at 13% kind of CAGR to grow in the next 3-4 years, and they are trading at a much lower multiple with given their current return ratio profile. So I don't think a similar kind of an impact should be warranted for wires and cables. What happened in paints?
All right, Manish, thank you so much for joining in and giving us your view on the space. You remain a buyer. You believe that today's reaction has everything priced in. And, Polycab and KEI in particular are stocks you like from the pack that has seen the most amount of destruction in today's trading session. Let's move on then. Let's get in Deven Choksi of DR Choksi Finserv Private Limited as well. Deven, always a pleasure speaking with you. There are two big stories today. One is the cables and wires. The other one is the NBFC pack. The NBFC pack, because of RBI's relaxed lending norms towards microfinance institutions and NBFCs, has all of them buzzing today. The top Nifty gainer right now as we speak is, Shriram Finance, and you have a bunch of others as well. Credit Axis Grameen, for instance, which was pointed out at the start of the show, up in double digits, almost 20%. Do you think this is a big game changer or perhaps a very good relief for this space, and as a result of which, would you be a buyer here?
Good afternoon, Mangal. Well, I think on the overall basis, with a 40,000 crore book size available from the RBI side to the banks, I think could translate into a significantly large amount of loan book as far as the ability of NBFCs to lend further is concerned. And that could possibly be a game changer in a way that I think the liquidity infused could possibly bring the growth at a faster pace. Now, I think generalizing that would be a little bit tricky because in the microfinance space, I think the major amount of stress is on the NPA as well. So some of the NBFCs, which are larger banks, larger NBFCs, I think they would probably, I think, be cautious in lending and expanding their book on that side. So I think it would be very selective. In my viewpoint, I think the likes of Bajaj Finance could possibly remain very, very strong and firm given the kind of money that is getting released and further, I think, available for the purpose of expanding their book size, which is already about 340,000 crores. So in my viewpoint, I think the selectively, one will have to look at this entire book, though positive, but companies will remain cautious in lending and expanding their book, at least I think in the microfinance space.
Right. Just hold on to that thought. On Tuesday, we had pointed out a bunch of stocks which would be in focus on account of getting out of F&O, right? We had weird moves coming in, wild moves coming in on Canfin Homes and Bata India on the previous trading session. Now look at Sun TV. Sun TV gets out of F&O from today as well. So a lot of unwinding taking place out there. The other one we're looking at is United Breweries. So Bata is down about 4.5%. Sun TV is the one which has taken a harder knock, more swift, down about 6.5%. And just pull up the intraday chart of something like a United Breweries as well. That too has moved to the low point of trade. The other stocks which are on our radar and the ones which are getting out, City Union Bank, that too is at the low point of trade. And we are seeing some, decline in names like Metropolis too. Metropolis too has fallen at to the low point of today's trading session. So as we move towards expiry, all these 16 stocks, the list of which once again comes up for you on the screen shortly, will see some bit of wild moves as positions are unwound as we move towards expiry, and these stocks cease to trade in the F&O pack itself from tomorrow. With that, we'll slip into a short break, come back. On the other side, we have Vivek Paul of BlackRock Investment talking about the market fundamentals on the other side.
That drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhat.
India Business Hour live on YouTube at CNBC-TV18 weeknights at 7 p.m.
What investors should do now is to very carefully assess the kind of valuations that they're paying for, get out of the relatively expensive stocks, may stay invested in the relatively cheaper ones, and also the kind of niche market leaders. We're actually seeing this not just in this sector, but in all across India. It's the market leaders who are able to command pricing. It's the market leaders who are able to gain market shares. I have been saying this since late last year and on your channels also, that India is overvalued. And at that time, in late September, early October, Indian valuation premium compared to Asia ex Japan was about 90%. Now that has declined. Nifty 50 or BSE Sensex, the frontline indices, their valuations have declined. 1-year forward P declined from 24 to 25 to about 20 right now, which is closer to the long-term average.
Similarly, if you go within MFIs, you'll realize that a lot of the reticence or reservations that banks have with lending to certain MFIs has to do with how they perceive the fundamentals of the MFI business today. But you have nailed it when you said that this is a critical communication of regulatory intent. Yes, there's been focus on liquidity. We have already seen rate cuts, and these are probably the first signs we are seeing of credit policy easing, and that bodes very well for the sector, both banks and as well as NBFCs. It shows that the regulatory focus is shifting from towards growth accommodative in a meaningful way, and that has to bode well. I absolutely agree with you. As far as the arithmetic of the capital release goes, it obviously favors or has a greater marginal impact with those who are nearest to the minimum capitalization red line. So you are thinking PSU banks. That's the first order impact.
I'm absolutely clear that this and the market space is big enough to give space to another player. Number one. Number two, Ultratech will take minimum 3 years to start their product.
Okay, welcome back. We got the market, which is absolutely flat, nothing at all, except of course lots of single stocks. If that is what you're focused on, but the Nifty will not give you that impression because it's almost unchanged from yesterday's close. Vivek Paul is head of portfolio research at BlackRock Investment Institute. Vivek, good to have you with us here. Thank you for joining us. You know, the question that a lot of people are asking is maybe the price damage, and I think the point also is that India and the US have been really tightly correlated for about 2-3 years now before this leg of correction started. So now many are wondering whether, the correction in India has been meaningful, especially at a stock level. In the US, are we just at the beginning of a pullback, a correction? And if that would happen, what would it mean? So just start there, Vivek, in terms of how you're thinking about these two markets.
Hey, Prashant, great to see you. Thanks for having me on again. So, yeah, I think you're right that for a bunch of time there was a really strong positive story that was being made for India and the United States, and happened at a similar time. I think we're now in a period where we're going to start to see more regional divergence between those two countries and more broadly. We're not in an environment where there's one common story that means that all markets are going to go up or down. And I think in the United States, it's very much a story about AI, about tech, and in India, it's a story about a cyclical downturn and the kind of the period of kind of consolidation around that. On a go-forward basis, I think structural opportunities also look different. I think in India, there's like a broad market dynamic which is linked to the demographic story. I think in the United States, there's a broad story as well, but also their leadership in AI, I think, is crucial to their positive case going forward.
All right. Hi, Vivek. Good afternoon and good to see you in. This is Nigel on this side. Vivek, in your note, you've mentioned that India as well as Taiwan, they looked a little bit expensive. Now, the Indian markets have pulled back, and, a lot of economic indicators on ground actually say that our economy is in fine shape. The markets could be wobbly, maybe it ran ahead of itself. But now some of those, those factors on ground are actually looking good, whether it's credit growth and various other, factors. And given that valuation-wise, we're a little below the long-term averages. Do you think the Indian markets have corrected enough? Because I'm looking at your top markets that you like. I think you like the Japanese market. China, you had preference out there as well. Is it time to look at India now?
Hey, Nigel. Well, so I agree. So if I look at the long-run asset allocation recommendations that we make, so if you are holding an allocation for the next 5 to 10 years, India would actually be one of our top picks. So on a sort of structural basis, we're telling a story of leaning into India, especially given the correction we've seen. Now, I think what you're referring to is our shorter horizon views of maybe sort of 3-6 months, where actually there continues to be uncertainty. It's linked to tariffs. It's linked to a bunch of other cyclical domestic factors. And I think that's why, as of right now, in the very near term, maybe there are other areas where we kind of lean into more. But if you had a 5 to 10 year horizon, India would indeed be one of those areas we'd hold above benchmark.
So what would be the things that would have to change for you to change your short-term horizon for India as well? Do we have to fall more, or do you have to look at some more high-frequency data? Or maybe China has to fall in a little more trouble than what India is in right now?
I think it's a relative story, exactly to the point you made. So I think, we've been overweight on a near run China for a little period of time. We see there being opportunities, particularly with the DeepSeek news around the tech industry there in particular. So this is a relative story as much as it is an absolute story. Valuations for us actually don't look particularly stretched on long run measures for India. They're stretched relative to comparatively recent history, but if you assume interest rates in the future look different to how they have in the past, we don't actually find them that expensive. So it's more to do with certainty and relative value opportunities elsewhere. In terms of certainty, it's hard to see how we will get certainty around some, for instance, key cyclical dynamics around things like tariffs in the very near run, which is why for the period of time now, it's not really something that we're looking at. If there was to be a major correction that we thought was mispriced, of course, we would look there. But I think for us, it's more of a story whereby once we get that certainty over near run dynamics, that's when we lean in.
What tariffs matter so much for India? Because, a large part of our economy is domestic focused. A large part of our economy is, consumption oriented as against export oriented. Would tariffs impact just those specific sectors, or would it impact the market on the whole?
Well, it's a great point, because I think it depends not just on the direct situation with India, but also it depends upon more broadly the global dynamic too. And anytime we're talking about this, there's a lot of uncertainty that we've got to consider, right? So uncertainty around the levels, uncertainty around the pass-through mechanisms. So yes, I think that's a factor to consider. But again, we take a step back. There is uncertainty at a macro level more broadly. There is policy uncertainty when it comes to the path of inflation, which existed before the last few months and will continue to exist into the future. That has an impact on the relative strength of the US dollar, as well as some of the other dynamics we're talking about. So I think there are structural dynamics that tariffs play into, but it's not just a tariff story.
So in the near term, Vivek, what's it? India versus China. What's your preference was China, but now is it getting a little bit skewed in terms of that preference? Is India getting some points as well?
Well, this
just
is
in the
point,
near term.
I think,
in the near term.
Yeah. In the near term, I think in the near term, it continues to be a story for us where we lean into China now. I think if you think about the drivers of that, the technology story, the broadening out of the technology story, that is something that continues to favor China. So on a relative basis, we think we continue to be there for now. But exactly to the point that we've talked about earlier, when we start getting clarity around some of those uncertainties on the Indian picture, and if we have this continued bull market run in China, then the relative valuation story becomes a little bit different. So for us right now, on the relative basis, there's still room to run in the current positioning that we have.
Vivek, just very specifically, do you think the top is in for US Magnificent Seven?
Okay,
it's been an exceptional run.
It has.
Yeah, sorry, go on.
I'm sorry, Prashant. Sorry to interrupt. So, look, I think it all depends upon what you believe in the future, right? On any historical measure, you're right to highlight the fact that those stocks are expensive relative to history. But relative to history, I think, is a crucial point. If you start to take out, for instance, past earnings and think about what future earnings could be, yeah, you need to see something in the future that is unlikely relative to history, but it's not unprecedented. You need to see something that might be in the course of the top 10% relative earnings path in the future to justify current CAPE levels. But if you believe, like we do, that we're in an environment of structural transformation and AI is going to be as important when we look back as previous industrial revolutions, well, maybe that can indeed occur. So undoubtedly, it's the case that relative to past measures, it's expensive. But I don't think that automatically means that you should not be holding them. And we would continue to hold those large stocks as of now.
You'd continue to hold those large stocks as of now. Point taken. It'll take a brave person, right, to sometimes, I think if you go back and look at the example of 99, 2000, even people who eventually turned right, were wrong for a long time and stocks ran up. You think we are in that kind of a moment, the final hurrah in that sense, Vivek, or you don't think so? This is okay. And it's durable, perhaps a little slower, but basically we're headed higher in that space.
I think we're headed higher. And I think the reason is that we're still to see, if you like, only the start of the potential impacts of AI globally, right? We're still scratching the surface in terms of the adoption that could occur. We're still scratching the surface in terms of the productivity benefits that could occur. Now, I'm not saying that there's no chance of a correction in the near run. That always exists, and that exists perhaps even more so in an environment of macro uncertainty that we're seeing. And you're right to point out the big valuation upswing. But I think, whether or not the current companies are all the winners of the future, I'm not sure. But I do believe that the US has some of those companies that are best placed to take advantage of the structural transformations that we're seeing. So look, to summarize, yes, you're right to point out that it's expensive relative to the past. And it would indeed take a brave man or woman to kind of call the top. I'm not doing that, not because I don't want to be brave, but because I genuinely believe that this is an AI revolution that we're still scratching the surface of.
Yeah, absolutely. Vivek, thank you very much for joining us. Good speaking with you. Appreciate your time here. Still a grand total of 6 points on the Nifty. 22,550 is where we're at. We take a break. We are back. We'll tell you what's happening in dealing rooms. Nimesh has been working the phones. He'll get you a real-time intel. So that's coming up in just a bit.
somebody may say on paper 2 years, but we have our long experience in developing the industries. Number 3, it will take another 3 to 4 years to or 5 years to develop the brand for wires, and also to get if they come at all in the cables, it will take many years to get the approvals from different customers, different utilities, different departments, and also develop their channels.
A bit unusual, but not totally unprecedented, because in the last decade, 2015 we had a similar situation, 2017 also, at least 4 to 5 occasions in the last decade, temperatures have been in the range of 37 to 39. So you can't call it unprecedented, but yes, it's a bit early, a little bit unusual.
So ma'am, can we expect a dip in the temperature in the next 5-6 days? Is that a possibility?
You can expect a small dip, but not a dip that will give you any respite.
Welcome back. Well, keep an eye out on a few stocks. GNFC is one such stock that's down close to around 10%. I think that's one of the stocks that are moving out of the F&O market from tomorrow itself. So today's the last day. That is the reason why that stock at the low point of the day, 10% down. PVR, Inox as well is now down close to around 6.5%.
That's the other one that's going out as well.
Yeah, so a couple of these names, they are down because they won't be available for trading in the F&O market from tomorrow onwards. Today is their final day, and that explains why we're seeing some bit of big reaction on some of these names. Let's get in Nimesh though, as promised. He's been working the phone lines. Nimesh, what's the buzz? How's the mood?
Well, Nigel, the mood is completely downbeat and panic, right? Clearly, now there is panic now. There is so much of pessimism in the market that every pullback wants to get sold into. So that's the kind of mood. And actually today the best barometer is the cable and wire stocks, right? Everything is down at day's low. Any pullback attempt got sold into. And just look at the numbers. For an 1800 crore capex that Ultratech wants to do, we've seen a market cap erosion of close to 50,000 crores across all these names, including Ultratech. So, that explains the kind of mood which is there in the market currently. There is selling from the FI, so that trend continues. Within that, I guess, again, there is selling in the real estate names today. On the other side, a bit of buying, or you can say a bit of shift happening to the financial stocks. Largely, they are under-owned, and valuation is at comfort. And the fact that now the regulator has turned a bit positive is something where investors are taking a note of that. And so clearly there is a bit of sector shift happening to the financials. But net, the mid-cap index is down 1%, small cap down 2%, and there is clearly panic across the broader market names, Nigel.
Right, we take that point. Nigel spoke about a couple of stocks which were falling on account of exiting F&O tomorrow. Atul, on the other hand, is moved to the high point of trade. That is another stock which is exiting F&O as well. So maybe some bit of positioning or position adjustment which is taking place out there. But Nimesh, speaking about individual stocks, while the mood is downbeat, do we have some tidbits on individual stocks?
Yes, Maglam. So the first target on my list is Oberoi Realty. I spoke about selling across the real estate name. Oberoi stands out on back of aggressive selling. So that's been a big underperformer of this series. And even after the recent underperformance, there is supply in stocks like Oberoi Realty. So that's the first name. Second stock is AB Capital. That's been buzzing in trade today, largely on back of buy flows, but also there was a Morgan Stanley tactical buy as well. Again, valuation comfort is there, and the fact that a lot of brokerages have turned positive. There's a bit of buying interest in stocks like AB Capital. The third stock is Redington India. This is interesting. In a weak market throughout this series, this month the stock is up 20%, and consistently for the last couple of days, I'm getting a sense of buying flows at leading FIDs. So it looks like some accumulation is happening in Redington at current levels. So that's the third stock. And the last is Dolphin Offshore. We normally don't talk about this name. There was a large block in pre-open today, and after that the stock is locked at 5% upper circuit. I understand one of the FPI holder, who's a large holder there in Dolphin Offshore, that's the potential seller in today's block. So disclosures in terms of who's bought could be very interesting in Dolphin Offshore.
Okay, all right. We'll keep an eye out on that. Nimesh, thanks a lot for giving us that quick take. By the way, one positive is, the number of stocks that are advancing from a little sub that 400 odd, it's moved to around 500. So a couple of names, I think, are seeing good amount of buying, and they've turned around a little bit. So it's headed towards 500 stocks. Mitesh Thakkar is back with us. Mitesh, the market's not moved at all. 2-point move on the Nifty. What's your take?
I think that's the thing here. I think hardly any kind of movement happening. So, well, I would say that just avoid trading the index, trade with stock-specific biases. I think that's something which may be a good way of. Sorry.
Give us your picks.
Sure. So on the stock side of BTS and Zomato with a stop at about 227.5 for targets of 233, 234. Maybe even higher levels. And Torrent Power is something which has come on my radar. Torrent Power, and that's a BTSC as well. I would suggest to stop just below levels of 1304 and a target of 1330 on the upside.
Okay, all right. Thanks a lot for that, Mitesh. Well, let's hop across to my colleague Ritu. She's here to give us all the latest with regard to UCO Bank's fundraising plans. Ritu, take it away.
We've been given to understand from our sources that state-run UCO Bank has deferred its foreign roadshows for the proposed 2,000 crore rupee QIP that the bank is looking to raise. This roadshow was scheduled to take place on the 24th and 25th of February across Hong Kong and Singapore, but has now been deferred. Now, our sources within the bank indicate that the bank will now attempt to hold these roadshows in the second week of March or later. Keep in mind that the bank had planned this 2,000 crore rupee QIP, which was recently approved by the Government of India, to comply with SEBI's minimum public shareholding norms. As of December end, the Government of India held about 95.39% stake in UCO Bank, and after this 2,000 crore rupee QIP, the government stake was expected to fall by 3%. UCO Bank's capital adequacy ratio stood at about 16.25% and its Tier 1 capital at 14.17% as of the end of the third quarter. Now, the management had guided that they won't close this QIP in the current financial year, which means in this quarter itself, but with the deferment of the IPO, it remains unclear whether or not UCO will be able to conclude this QIP in the month of March itself.
All right, Ritu, thank you very much for that. Let's move on to another interesting conversation that we had earlier in the day. Remember, corporate stalwarts like Uday Kotak, Harsh Goenka, and now economist and PMEAC member Sanjeev Sanyal have spoken out about the decline in interest amongst the next gen of big business families in running and building and expanding their own businesses. Instead, they say what's interesting many of these sort of next gen youngsters is managing money and being in stock markets. So I caught up with Devina Mehra and Deepak Shenoy and sort of for a quick discussion around this. Lots of reasons, lots of opinion. So just want to play out a quick bit from this piece. Listen in.
Yeah, there are 2 or 3 aspects to it. For the first, let me just read out a quote to you. Our youth now love luxury. They have bad manners, contempt for authority, show disrespect for their elders, love chatter in place of exercise. They contradict their parents, gobble up their food, and tyrannize their teachers. Guess when this quote is from.
Sound like my kids.
This is from 79 AD, graffiti on the walls of Pompeii. Oh. And the actual code goes back even further to Greek plays. Right. So this is what every generation thinks of the next generation, that the next generation is going down the drain, not working hard enough, and so on. So that's one part. The other part, of course, is that businesses, especially manufacturing businesses in India, are difficult to run. I was talking to an older industrialist who sold out his business a few years ago, and now he was telling me that his son has opted to start a manufacturing business. And he said, I actually dissuaded him for a while, saying, do you know what it entails? You know, and because there's so many regulatory authorities, from the municipality to getting water, electricity, labor laws, just so many rent seekers. And he says, because we've done it before, we could do it. But my son said, you know, if we don't do it, who will do it? But that's the one hurdle. The other thing is, even if you look at the history of business families, normally beyond generation 3, it becomes difficult because the first person had the hunger, built it. The second generation also saw some part of that struggle. The third generation is normally born in luxury. So so maybe a new set of hungry entrepreneurs take the place of the old business families. That is also, but the fact is it is difficult to do business, especially manufacturing business in India, no doubt about that.
But you began with a very fundamental basic point. Each generation feels that
yes,
the next generation is useless. It's not. I mean,
yes, but human civilization has continued to progress. So obviously that's not the right viewpoint.
Absolutely, absolutely. I think you make some very good points. Deepak, come in on this. Where do you stand?
So, I mean, Prashant, I completely agree. I think my thing is, my contention is with one point. Why do we need the children of rich people to set up the next set of industries? Isn't it so that the hunger that the normal person has to rise through the ranks or to build their own businesses is what's going to drive the next set of industries? So whether it is, look at a lot of industries that have been set up. A lot of them have set up by first generation entrepreneurs. Where are the next set of first generation entrepreneurs? I think the idea now is the science of the children, or the children of those who have become rich are now investing in those companies and calling them startup investing or whatever it is. And then also spending the money, which is both, I think, are great things, because if you don't have the hunger, at least you give the money to the person who has the hunger. And secondly, you spend so that it increases the incomes of all the people who provide you the services or products that allow you to spend. So I think both things are useful. We are complaining, I think, mostly because we think that this is a misallocation of capital, but it's not a misallocation of capital. They are actually investing in other businesses. They are not going and buying gold and real estate. So I think in that context, this is not a bad thing. We should encourage new entrepreneurs to come in. Whatever barriers there are for new entrepreneurs to come up, I think we should change that. It's like, I sweat in a factory so that my children need not. But just because, let's say I become rich enough, if my children chose to sit in an AC office, they will just have to use that money to fund someone else who's going to sweat in another factory. So I think that, that process should continue. And like Devina said, we will always think less of the next generation. There was a number of people who are currently, who are big businessmen, were thought of as people who may not be able to run their parents' companies when their parents passed away and so on. But turns out some of them were actually quite capable. So I think, some of it may be unfounded as well, that they won't be able to do it at all.
But both of you agree, Deepak and Devina, Deepak, you go first, that this actually is happening. It may not, it's right or wrong is a different matter, but this essentially is the trend. I mean, it's clearly visible in the businesses that you speak with, both of you speak with so many businesses, long histories. Deepak, you agree, right? It is happening.
Yes, some of this is a natural consequence also, because you sell your business for a few thousand crores. Now, to start a new business also may not take that few thousand crores in the first place. And then the scale of starting something at a few thousand crores is different from starting something at a 50 or 60 crores. So you choose to instead say, okay, listen, I'll spend my time diversifying, investing in other people's businesses, which I understand very well. Very few people sit in there saying, listen, I'm going to go build the next big massive thing. And those people who have the vision, of course, they will go ahead. But a lot of people, and this is worldwide, not just India. I think it is in the US as well. It's in Europe as well. The next gen need not necessarily run the businesses that their parents set up. Sometimes they hire external managers. And that's why professional managers take over large businesses, even those with names.
Okay, well, you can go online, find the entire discussion. We'll continue to play out, some of the sound bites from that chat. But it's a discussion which is happening online, offline, and lots of opinions, of course, coming through as well. We'll take a quick commercial break here. Markets are down about 10 points. Here's some good news for our viewers. India's business news leaders now a click away, introducing CNBC-TV18. It's an all-new app. Get instant access to breaking news, in-depth articles, financial world updates at your fingertips. Download the app now from the Apple Store or Google Play Store, or just scan the QR code on your screen now.
Over the last decade, if you're a global asset allocator, where would you have made money? You didn't need to put money offshore from the US over the last decade. What we would say there is that the valuation differential between EM and DM now is at its largest point that it's been for many years. Therefore, when we're being approached by our global clients, they're very much aware and cognizant of the fact that they have a large overweight in the US and they tend to have large underweights in emerging markets. What I would say is that when we look at emerging markets at the moment, we're very constructive on emerging markets. When we're looking at India itself, I think the selling pressure here really has come about from the tremendous bull market which we've had in India over the last 3 years. And as we went into the end of last year, valuations on India became stretched. So all it took was a slight slowdown in the credit markets.
You're watching us here on Closing Bell, 4 minutes to the end of February series expiry. And it's a very, very interesting market which is playing out right now. Typical of expiry where the index is stuck to one level itself. The Nifty, you would see, is down about 14 points. That's not much looking at the way the Nifty Bank has fallen. Pull up the intraday chart of the Nifty Bank. When we started the show, the Nifty Bank was up by about 2/3%. It's given up nearly all its gains and currently sitting with just about 40-50 points in terms of gain. So you would say, what is it that is supporting the Nifty while the Nifty Bank is dragging it down? Pull up two indices. One is the Nifty IT index. So, Wipro has moved to the high point of trade. Infosys has done well. You have the IT index, which is supporting the index. So there has been some recovery from the lows from there. And the second one is Reliance. Pull up the intraday chart of Reliance. That stock too has recovered about, 0.75% from the lows, currently at the high point of trade. So you have Reliance and IT doing, some support to the Nifty as against the Nifty Bank, which is dragging it lower. All in all, the net impact on the Nifty is just about 15 points. Classic expiry related play which is taking place out there, even as the broader markets continue to sell off. The mid-cap index once again at the lower end of today's trading range. Good time to welcome Ambrish Baliga on the show. Ambrish, in a market which has seen such a big correction, I'm sure a lot of stocks have caught your attention when it comes to becoming attractive after the fall right now. Do you have any on your list?
Yeah, I've got one stock for today, which is Gabriel India. It's a key player in the automotive suspension industry since the last 60 years plus. They manufacture shock absorbers, struts and coil springs and supplying to OEMs as well as aftermarket. And they have a very strong market share of about 40% in the aftermarket channel. And they are present across the segments, two-wheelers, three-wheelers, where they have a 65% market share. About 23% is in passenger cars, about 10% of the revenue comes from commercial vehicles, and they also provide suspensions for premium coaches for the railways. Last few years, they've been focusing on e-two-wheeler segment, and they've developed a lightweight, energy-efficient suspension system, and currently they have about 87% of the market share in this segment. And recently, they diversified into the sunroof category, and that's the other growing vertical. So the company has a vision and goal to become the top 5 shock absorber manufacturers of the world. So that's a decently tall task and should be achievable in the next couple of years. So expecting an EPS of about 21 for FY27 with a target price of about 630.
Okay, all right. Hi, Ambrish. Let's squeeze in one more. Trend, like it or not?
In fact, Trent, I still see a further fall from here, looking at the way consumption has slowed down and the sort of pressures which are there as far as Trent is concerned on their margins. So, at levels of closer to about 4,200, 4,300, I think one could look at buying Trent. And at those levels, it becomes decent from a valuation perspective. Because I think about 2 months back also you had asked me, and at that time also I told you possibly levels of 5,500 or 5,000. But then, when it came to those levels, we have revised our target down. So closer to about 4,200, I think we should look at it.
Got it. Okay, all right. Amrish, we got a lot more questions for you, and we'll follow up with that in markets forward. But for the time being, we need to wind down the markets. Well, we're going to be going home virtually at the low point of the day. It's an expiry-related factor that played out towards the end. What dragged in today's trading session? Ultratech Cement being a little too ambitious for what the street like. Stock down 5%. You had Trent that was down close to around 3%. Once a darling, 8,000 rupee plus. Now it's down to sub 5,000 rupees. Bajaj Auto, 2.5% low in today's trading session. And Mahindra was giving signs of a fight back. Well, that got sold into in today's trading session, down close to around 2.5%. What did well? Well, some of these NBFCs and lenders from the financial space, they did well. Shriram Finance, finding its winning ways, up close to around 5%. Bajaj Finserv, Bajaj Finance, both of them did well. Hindalco, the Kotak upgrade seems to have done the trick for them. That stock was up close to around 2%, and Sun Pharma as well was higher. But Manglam, the real pain was in the broader markets. Tell us more.
The pain continues for the broader markets. And as we speak, the Nifty actually has ended a historic series once again, down 730 points for the February series, making it the 5th consecutive series of losses for the first time since 1996 itself. So that's as far as the expiry-related play happened. The broader markets down almost 700 points for the mid-cap index, 2,200 stocks in the red. for almost 473 stocks in the green. What were the ones in the red? It was the cable and wires players that took everyone's attention today, down anywhere between 10 to 20% depending on the name you're looking at. Polycab at one point down now 19%. KEI Industries down 21%. We had a sharp cut on names like Havells, etc. as well. The other group of stocks that actually sold off were the ones that are exiting the F&O trade from tomorrow itself. So we had GNFC down about 10%, a big cut on names like PVR, Inox, among others too. Varun Beverages was one which was down almost 7% in today's trading session from the broader markets as well. A couple of stocks that did better. We had Just Dial, which ended about 6% higher. Ather was up 5%, and a lot of these NBFCs which did a lot better on hopes of some more relaxations coming in from the RBI. So AU Small Finance Bank, we had Chola and L&T Finance, all of them higher.
Okay, well, I think we're going to wrap up things here from all of us. Goodbye. Thank you very much for staying with us. But don't go anywhere. Markets Forward will pick up on all the action in just a bit.
In loan growth and some earnings expectations, and that led to money coming out of India. I certainly don't think the bull case for India has changed, but I think with all long-term bull markets that you have, and that's what we believe is happening in India, you will get these pullbacks and a reset, and I think you'll see a return of FII, certainly in the second half of the year, once those valuations get back to those long-term averages. There are a couple of themes I'd like to go through there. I think the internet platforms in India, the duration of growth that you have within the Indian internet platforms is quite extraordinary. And I think that's something we'd be very interested in. So whether that's the food delivery side, whether that's the online travel side, whether it's the fintech side, those are all businesses that we're familiar with, and we'd be very positive on those on a longer term basis. And I think this pullback gives a good opportunity within those individual areas.
The Sensex and the Nifty trade flat while financials and metals gain in trade. The mid-caps feel the heat. Real estate and auto list among the top losers today.
Stocks of cable and wire companies stripped in trade after Ultratech announced its foray into cables and wires with an investment of 1,800 crore rupees.
A big relief for NBFCs and micro lenders. This after the RBI eases the risk weight norms on certain loans. Stocks rally on the back of the announcement. Hello and welcome to a fresh edition of Markets Forward, your go-to show where we'll tell you what all went on today in trading action and we'll set you up for tomorrow as well. I'm Nigel and with me is Rima. Well, Rima, a flattish session, but the pain in the broader market continues. And with today, in fact, another down series, the bears will feel on top. Fifth straight series, we're down.
Yeah, and that's not happened in nearly 28 years. And in the last 5 series, the Nifty's lost 14%.
Ooh.
Of that, 4% has come in just in the February series. But today, when you just look at the benchmark indices, absolutely quiet, very range bound. The Nifty traded in less than 100-point range, and by the end of it, it was just 2 points down on the Nifty. The Sensex was up close to about 100 points. But as Nigel said, the problem and the pain is in the broader markets. The mid-cap index fell more than 1%, small cap index even more. Look at the advanced decline ratio. We had 2,200 stocks with a negative tick versus less than 500 stocks, which managed to advance in today's trading session. Banks too gave up all their gains in the last 1 hour of trade. The final tick on the Nifty bank is positive, and that's because of averaging. But generally, you would have seen a sharp downtick in the Nifty bank in the last 1 hour of trade. Individual stories, well, while the Nifty bank gave up its gains, NBFCs were higher in trade, lots of them dominating headlines, and on the way down, cables and wires. So these were the 2 big stories. We'll talk more about it in our show today. We'll track all the big news, the key developments in the Lal Street, the top corporate voices, and the events to track. But let's also, tell you what the big movers and shakers of the day are. Hormus is now joining in.
It was a quiet end to what was a forgettable series for the markets, but the broader markets did not reflect that kind of a sentiment in today's trading session. Starting off, of course, with the story, the sector and the stocks of the entire day, and that were the wires and cables companies. A 200 million foray from Ultratech has resulted in a $3.5 billion erosion in the market cap of these 5 companies: KEI, Polycab, RR Kabel, Havels and Phenolex, all of them, and 3 of them ending with losses of 18 to 21%, and the other 2 as well seeing 6 to 7% of losses in today's trading session. On the flip side though, every single NBFC that you would open up in today's trading session ended in the green, and it was Credit Access Grameen that led the charge. There was a bit of a cool off towards the later part of the trading session, but still ending with gains of around 9%. AU Small Finance Bank, Shriram Finance, L&T, M&M, all of them ending with healthy gains in today's session after the RBI relief that came in on the norms there. Some of the stocks that are getting excluded from the FNO space in today's session saw a bit of a sell-off today. GNFC ending 10.5% lower. Sun TV, PVR, Inox, all of them seeing sharp cuts. Of course, these are just 5 out of the 16 names that will be excluded from the FNO space. It was a 4th day of losses for the real estate sector, among the top sectoral losers in today's trading session, with Prestige Estates and Phoenix Mills leading the pack, and most of the others too seeing losses of anywhere between 2 to 3%. And lastly, some green that came in on the screen, barring the NBFCs. It was Bharti Hexacom that ended 5% higher. Inox India saw a sharp sell-off towards the close of the trade, but ending only 2% higher. At one point was up almost 10%. Just Dial, after some positive brokerage commentary. Bajaj Holdings and Bear Corp too having a good day at the office today.
Well, thanks a lot for that, Hormus. Well, those are all the top stock movers in today's trading session. Let's hop across to our guests. We have Amrish Balika as well as Ruchit Jain of Motilal Oswal who joins us on the show. Hi, gentlemen. Thanks a lot for joining in. Ruchit, what are the odds? March is going to be a good month for the bulls. It's been the bears all the way. As Rima just told us, a 13 to 14% cut is what we've seen on the Nifty. Do you think it's getting a little bit excessive? And do you think maybe with 22,000 as a stop, you expect this market to bounce up?
Yes, hi, very good afternoon, Nigel. Nigel, if you look at last few trading sessions, I think every pullback move is getting sold into. But what has changed now that some of the large cap names have stopped going down, but the mid caps and the small caps are still witnessing a continuation of the downtrend. So we believe that March series could be a mixed bag where we won't see any significant down move in benchmark index or the large cap stocks. But until we get any signs of reversal in these mid caps and the small cap names, I think the broader markets would not see any kind of significant run up, at least in the first half of the series. So I think for the next series, we are also advising our traders to focus more on the larger names. Today also we saw that some of the names from the banking and the NBFC space did well. In fact, Nifty Private Bank and Nifty Financial Services, these are only indices where the January lows have not been breached yet. So clearly a relative outperformance has been seen in the private banks and NBFC space. And I think such stock specific or sector specific outperformance would be seen in the March series, but definitely no signs of bottoming for the broader market. So mid caps and small caps, I think maybe some more pain could continue.
Okay, pain for the broader markets, but maybe for the headline index, there could be some hope. Well, stay with us. I'm actually going to come across to you and ask you about the cables and wires business, but let's run you through the news piece first. UltraTech Cement, they have announced their plans that they want to move in the cables and wires business, and for that, they're going to be spending 1,800 crores. They're going to be setting up a facility in Bharuch, that's in Gujarat, and they expected to get commissioned by December 2026. Now, why will they be thinking about something like this? One is that the industry itself is growing at 13-14%. Industry size from 80,000 crores is expected to go to 1 lakh crore. The other factor is they have Hindalco, which makes copper as well as aluminium. So in that case, there is some backward integration. And also they're talking about UltraTech Business Solutions. They believe they want to grow that part of the business, which currently has close to around 4,400 stores. Even on the return ratio basis, well, that is relatively more attractive. So margins of the cables and wires business will be relatively low in comparison to the core cement business. Around 10% approximately, that compares with around 15%. However, the ROC, as you can see, of a cables and wires business is much better. How do the numbers stack up? 1,800 crores is what they're putting in. Revenue potential will be 7,000 to 8,000 crores odd. Margins will be in the vicinity of close to around 11% or thereabouts. And as a percentage of their total annual capex, it's very, very small. It'll be less than 10% of that. What did the street like? Why was UltraTech under pressure? Because the street says you're diversifying. There's question mark in terms of the asset capital allocation. So the street didn't like that. Instead, if you had plans like this, you should have rather done it under Grasim. A brokerage like Jefferies, they said that they believe this dip in the stock price is actually a buying opportunity. So UltraTech's plan to get into the cables and wires business didn't meet with a very, very good response from the street. But the sector that was under pressure was all the names, whether you talk about Polycab, Havells, or even KEI, all of them did see a sharp downtick. In fact, let's hop across to Upasana. Upasana, UltraTech saying they want to put in 1,800 crores. The market capitalization of UltraTech itself, well, that one did come down by close to around, to give you a couple of numbers, Rima, 1,800 crores is what they want to spend. UltraTech's market capitalization erosion was close to around 12,000 crores. And all the cables and wires players put it together lost more than 30,000 crores of market capitalization. So this 1,800 crore investment, led to market capitalization getting wiped out of close to around 40,000 crores. But Upasana is with us. Upasana, tell us more.
Well, cable and wire segment saw very sharp sell-off today, as highlighted by you also, Nigel. Now, UltraTech Cement plans to enter wire and cable segment with an investment of 1,800 crore. Now, what is the street eyeing on? The street thinks that this may intensify competition for existing large players. Now, if we look at FY24 market share of the top players, Polycab stands at 26%, KEI at 12%, followed by Havells, which stands around 11%. Now, HSBC believes that this entrance of UltraTech is likely to have a material impact on major companies' growth and margins beyond FY27, that is after commissioning of the plant, and it has lowered the target price of all the major players between 7 to 23%. On Havells, it has given a buy rating with the target price cut of 6.5% to 1,730 per share. Polycab also it has given a buy rating and cut the target price by 20% to 6,250. KI Industry, the brokerage has given a hold rating, cut the target price by 23% to 3,450. And lastly, on RR Kabil, HSBC has given a buy rating and target price of 1,260. Now, Jefferies believes that it foresees a lower competitive impact on Polycab as compared to other B2C and housing players like Finolex Cables and Havells, and it continues to prefer Polycab as its top preferred pick in the sector. Now, Motilal Oswal says that the earnings of cables and wire companies will not be impacted until the plant is commissioned. Cable and wire players may experience a valuation derating in the multiples going forward. While there will be no change in earning estimates for these companies over the next 2 years, there could be a derating in their valuation multiples due to entry of a sizable large player. Now, when we look at the valuations currently, even after the steep correction that was seen today amongst all these major players, valuations are still above the 5-year average, up nearly about 25 to 50% above their 5-year average is what we are seeing. Hence, this space remained in focus today on the back of this.
This is very big industry, and like almost 85-90,000 the industry size was last year, and it is further grown by almost 13 to 15%. And this is such a fragmented industry, and there are not many even unorganized player also. So if a big player comes like this is always a nice move where more strong player will be like get bigger margin of market share. And though it is very like quick reactions from market, and it is very like on negative side market is concerning. But what I see, this is like for players like us, it is good time that we can also have our growth plan intact, and we see good consolidation in market. But it is not that much like disruptive what market is reacting as per me. So first, when we see from like margin point of view, first you need to see that it will take at least like 2 to 3 years to come into production, and again getting a sizable size of production and getting established in market. It may be another journey of 2 to 3 years. So it is altogether like 4 to 5 years minimum to take sizable size, even in this overall industry, which will be like around 1.5 lakhs by FY28 or 29.
This and the market space is big enough to give space to another player. Number one. Number two, Ultratech will take minimum 3 years to start their production. Whatever somebody may say on paper, 2 years, but we have our long experience in developing the industries. Number three, it will take another 3 to 4 years to or 5 years to develop the brand for wires. They may not be able to disrupt the market by just slashing the prices, because it is in this space it is very difficult to increase the prices once you slash them.
Okay, all right. Well, Amrish, I wanted your view on this. It seems Ultratech Cement has been the disruptor today, disrupted its own stock price and the industry as well. What would you do? Tell us. Buy Ultratech after this correction, and from these cables and wires players, in a single day, they've lost 10 to 20% of the market capitalization. Buy or not?
Yeah, I'll come to that. But before that, I'll just tell you that when they were entering the paint segment, I mean, we thought they won't be able to make any dent. But finally, they did. Asian Paints has lost some market share. Their margins are under pressure. Again, I'm not commenting on the long term, but at least in the short term, it has created issues for the existing players. And now the arguments are the same. Selling paints is different compared to selling cement. And now the cable manufacturers are saying selling paints and cement is different compared to selling cables. But then today, people would look at Birlas differently. I mean, you go back 2 decades, Reliance had planned retail. Many had, in fact, written off, saying that they don't have the mindset to do retail. And that's history now. So deep pockets and the ability to attract the best professionals, I think that makes a lot of difference, which they have done it extremely well. I think the big question next is, this Birla group runs something called Birla Pivot. I mean, that's a B2B e-commerce platform for building materials. I don't know how many people are aware of this. It seems that they want to fill up the supply side with all the in-house brands. So they've done paints. Now they are doing cables and wires. I don't know what next. I mean, it could be tiles. It could be sanitary ware. I think we have to just wait and watch. Now, I mean, what should we pick up when stocks have fallen like this? Yes, since the announcement has just come, the effect will be short term, and then there'll be a gap. And finally, when they finally launch their brand, that's the time you'll see the real effect, like the way we saw for Asian Paints and the other paint stocks. So, I mean, after this fall, maybe if Polycab falls possibly either 400, 500 rupees, closer to the levels which we had seen in December, January 2024, I mean, post those IT raids, I think at that price, Polycab becomes a decent buy, at least for a decent bounce back in the short to medium term.
Ruchit, in the cables and wires space, is there any trade? Maybe someone can still go short at can short at these levels, or is there a buying opportunity which emerges?
See, there was already a gap down opening today, and we have seen almost on an average 18 to 20% down move in most of the names. So I think the risk reward ratio for going short does not become favorable, since the stop losses will be too far if you open a fresh trade over here. But definitely, I won't advise doing bottom fishing as well, just because the stock has fallen 18-20%, because many of the stocks have seen a very high volume sell-off, and whenever we see that selling is supported by high volumes, those stocks tend to underperform in the markets going in, and already the broader markets are not doing well. So I think not a good time to do any bottom fishing as well over here. It's better to ignore any kind of trading opportunities in space for now.
And Ultratech, what is the chart telling you?
So I think Ultratech Cement, the longer term chart structure still seems positive, because we have seen that high top, high bottoms structure getting continued on the monthly charts. So maybe this would be a short term reaction to the news flows. And if I look at some retracements of the previous up move, then somewhere in the range of 9,500 to 10,000, the stock should manage to form a good bottom in this week. So I think yes, if we get the stock below 10,000, then those ideally should be good levels to start buying Ultratech Cement over there.
Amrish, Ruchit, thank you very much for joining us today. We will slip into a very short break. On the other side, we'll tell you why banks and NBFCs gained in trade, along with the top corporate voices of the day. Welcome back. You're watching Markets Forward, and in a big relief for NBFCs and micro lenders came through after RBI eased risk weight norms on certain loans. NBFCs and MFI stocks rallied on the back of this announcement. Abhishek is here with the details.
Well, RBI has reduced the risk weight asset requirement for certain loans that is in the category of MFI and loans to NBFCs from banks. So if you take a look, the bank loans to NBFC sector was growing at 30% plus on a YOY basis last year when the ban was put in place with respect to increasing the risk weight asset, and hence the loans became costly. Now the growth from banks to NBFC as of December data shows at 7% YOY, which might have led to this kind of a relaxation coming in from RBI. So they have restored the risk weight asset on the lower side back to where it was pre-November last year, that is 2023. So microfinance loans risk weight assets have been reduced by 25%, and bank loans to NBFCs also by 25%. Now IFS Securities has written that there will be an impact of anywhere between 7 basis point to 170 basis point for banks CET1 ratio, that is common equity tier 1 ratio. So higher benefit will be for Bandhan Bank, Bank of Baroda, Ujjivan and IndusInd Bank as well. So stocks which gained in trade today were Bandhan Bank, Credit, RBL Bank, L&T Finance, Chola, Shriram Finance, AU Small Finance Bank as well. Back to you.
All right, Abhishek, thanks a lot for that. Well, let's take a look at all the key corporate voices that join us during the course of the day. First up, Sidma SGS Technology. They guide to grow at around 30-35% in FY26, and they expect to achieve 7.5% margins. The management also expects exports to grow by around 20% and hit close to around 1,000 crores in the next fiscal.
The management of Muthoot Finance believes opening of new branches will aid loan growth. They expect AUM growth to be between 25 to 30% for this year on a standalone basis.
And lastly, Titagarh Rail System bets big on the shipbuilding as well as the marine businesses to bolster its growth trajectory. It also plans to construct additional yards in the eastern and the western regions. They believe the next 6 months are vital for the shipbuilding vertical.
And before we wrap the show, we'll bring you some of the key market events to watch tomorrow. Abhishek is here with that.
Well, Rima, to begin with respect to India, watch out for RBI, which will come out with key data with respect to the business momentum of the bank. So deposit growth and loan growth will be seen closely. Deposit growth last time was around 10.3% YOY and loan growth last time around was at 11.4% YOY, leading to the highest ever credit deposit ratio for the banking sector. Forex reserve data will be given out by RBI. It was around $636 billion last time around. Watch out for other data with respect to India infrastructure output, GDP growth rate, as well as fiscal year GDP growth rate second estimate will come out. With respect to USA, watch out for the core PCE price index month on month. It is expected to grow at 0.3% versus 0.2% last time around. Personal spending month on month, it's estimated to decline with growth rate coming down to 0.1% month on month versus 0.7% month on month that it had come last time around. With respect to RBI, they will inject liquidity through a 10 billion forex swap auction for a tenure of 3 years, which will be conducted tomorrow. This will be the second forex swap action by RBI in a month. Last time they had done $5 billion forex swap in Jan. With respect to some of the key other events to watch out is IRDA, that is IREDA, as well as Tata Tech. They will be included in the FNO effective tomorrow. MSCI announced changes pertaining to February index. The review adjustment will be taking place tomorrow in trade. Back to you.
Thanks a lot for that, Abhishek. Well, on that note, though, we'll have to wrap up on this edition of Markets Forward. We'll be back with more news and updates. So stay tuned. We'll be back on the other side.
But, again, and I link this back to what we were talking about, the need to adapt as well as the change as far as the business model is concerned. In a Trump era, with the H-1B issue being the way that it is being dealt with at this point in time, what could it potentially mean as far as the services sector is concerned? What could it mean for Indian IT in the next few years?
So there, I think two parts to what you ask, and there I'll talk a little bit more about Infosys. We've built over the last few years a more resilient business, especially for the US. We've made sure we built out more and more local delivery and digital centers. We've got now more staff which are local. Over 60% of our teams in the US are local. We built quite a strong nearshore capability for the US. So we feel better prepared if there are any changes. So far, we've not seen any changes.
We're talking about human genius and human ingenuity as well, and we were just talking about moving from people to platform. Now, what actually happens on the workforce? Because this is a sector that has been driving, employment for a young country, for a young demographic like India. What happens to the people part of this business now? Let's talk about that. What happens to entry-level jobs, for instance? What are we talking about in the next 5 years?
So there, first, in the existing employees that we have, there's huge reskilling. So there's a constant move, especially with generative AI, but all through when we were having digital or cloud or cyber, a lot of reskilling today, at least within Infosys, over 270,000 people more ready for AI. So that's the first element. Second, in terms of new roles, we've already shared this last quarter. For the next financial year, starting April, we will recruit something like 15 to 20,000 new campus hires. which shows the same sort of direction of what we were discussing earlier, which is there is growth, there is productivity, and there is new work from these technologies. All of that combined gives us confidence to have new people joining from the campus.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC-TV18, now streaming live 24/7 on YouTube. How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bad.
Hello and welcome to Business 360. I'm Shireen Bhan. The top stories that we're tracking for you this evening. The Sensex and the Nifty decline again, but mid-cap see sharper cuts. The Lal Street is on course to post losses for the fifth straight month. This will be the longest losing streak in 29 years. From cement to cables, Birla Group's Ultratech to invest 1,800 crore rupees to set up a facility to manufacture cables and wires in Gujarat. The stock declines on capital allocation concerns. Shares of cable and wire makers also fall due to heightened competition. The tenure of SEBI Chief Madhavi Puri Butch ends on the 1st of March. Sources say top bureaucrats at North Block like Tuhin Kanta Pandey and Ajay Seth, along with Petroleum Secretary Pankaj Jain and SEBI member KC Varshne, are likely contenders for the top job. State-run UCO Bank defers foreign roadshows for its proposed 2,000 crore rupee fundraise. Sources say the roadshows scheduled earlier this week will now be held in March, raising doubts over concluding the stake sale this quarter. US President Donald Trump's $5 million golden visa offering a path to US citizenship is the most expensive in the world, but about 10,000 Indian millionaires migrated abroad last year, with the UAE being the top destination, offering citizenship for about $500,000.
Is anybody unhappy with Elon? If you are, well, throw him out of here.
Is anybody unhappy with Elon Musk? Asked Donald Trump as his first cabinet meeting of the second term. The meeting highlighted the efforts by Musk and his team to shrink the government. Musk is not officially a member of the cabinet and his appointment was not vetted or cleared by the US Congress, yet he was there. The Supreme Court pulls up customs and GST officials for misusing arrest powers, calls for errant officers to be punished, rules that customs officers do not enjoy the same powers as police officers. Those facing prosecution can seek anticipatory bail even if the case is not registered. Also on the show today, Uday Kotak's lament on fading animal spirits and the heirs of business houses walking away from the family business find support with Harsh Goenka and Sanjeev Sanyal, but not everyone is downbeat on the next gen. Well, let's start with the market action. The Sensex and the Nifty ending flat after a choppy session. Both indices are down nearly 4% this month and are on track to post losses for the fifth straight month. That's the Sensex closing just about in positive territory. It's flat closing for the Nifty. The mid-cap index down over 1% and the small-cap index losing about 1.5%. This is going to be the longest losing streak that we've seen in the last 29 years for our markets, so pressure continues. And staying with markets, SEBI Chief Madhavi Puri Butch's tenure ends on the 1st of March. She was the first person not from the Indian Administrative Service to lead the market regulator, also the first woman. Sources say the search panel to find a successor is likely to have considered some top bureaucrats and a SEBI insider. Timsy standing by with the details. Timsy.
Yes, what sources are indicating that the search panel may have considered the candidature of these 4 names, to be precise. Top on the list is Finance Secretary Tuhin Kanta Pandey, followed by DEA Secretary Ajay Seth, also Petroleum Secretary Pankaj Jain, and whole-time member to SEBI, KC Varshney, who's also an IRS officer. So let's see what happens finally, because the term of current SEBI chief ends on 1st of March, and the orders are expected on the same day, is what sources indicate. We'll have to wait and watch for the orders, because ACC is soon likely to issue the final verdict. Back to you.
Okay, Timsy, many thanks. The likely contenders, we'll have to wait for the official confirmation. Now, the Reserve Bank has reversed its decision to increase the risk weight on bank loans to NBFCs. The move is expected to free up significant capital for banks. AU Small Finance Bank, Ujjivan Small Finance Bank and Jana Small Finance Bank clocked strong gains following the announcement. The revised policy will kick in from the 1st of April. The big corporate story, Birla Group's Ultratech Cement has announced a foray into the wires and cables business. The cement major will invest 1,800 crore rupees to set up a facility to manufacture cables and wires in Gujarat. The stock down 5% on concerns about capital allocation and debt reduction. Meanwhile, shares of cable and wire makers also saw a sharp sell-off on account of the possibility of heightened competition. Nigel is here with more. Nigel, Ultratech Cement, KEI Industries, RR Kabil, all down in the red. Look at the move on RR Kabil, down almost 20%. What's going on here?
Well, that's right. Ultratech has announced its plans to move into the cables and wires business in the next 2 years. For this, they laid out a capex of close to around 1,800 crores. And this unit will be coming up in Bharuch in Gujarat. Most of the funding will be done via internal accruals or some borrowings as well. Remember, they generate cash flows of more than 10,000 crores, so it will be relatively very small for them. What makes Ultratech look at the cables and wires business? It has the industry tailwind, right? The industry has been growing by close to around 13 to around 14%. The industry size is 80,000 crores, headed to 1 lakh crores. There's an industry tailwind. Also, they could be looking at some backward synergies, that is. They can source the aluminium as well as copper from Hindalco itself, which is a group company. And thirdly, Ultratech Building Solutions has close to around 4,400 outlets, and they've said they want to strengthen this vertical of their business as well. So those are the broad reasons. What about margins? Margins in the cables and wires business will be relatively lower because they'll be in that vicinity of around 8 to around 12%, which compares with Ultratech cement margins of close to around 15%. However, on the return on capital employed front, well, it is relatively better because on the core cement business, the ROC is close to 15%. However, on the cables and wires business, you get ROC of close to around 25% or thereabouts. How do the numbers stack up? Well, they're going to be spending close to around 1,800 crores, which is close to around 10% of their annual capital expenditure. So not large in that sense. What is the asset turnover? Well, if they're putting 1,800 crores, in all probability at optimal levels, they could generate close to around 7 to 8,000 crores with margins in the vicinity of around 11% or thereabouts. What doesn't the street like them? Well, the street is questioning their capital allocation. Why should they look at investing in a non-cement business? So capital allocation worry was one factor that dragged down the stock. The second factor is if the group wanted to do this, the street argues they could have done it through Grasim. Brokerage reports had come out, and Jefferies, though they maintain their positive stance on the stock, they say that in fact there is a knee-jerk reaction. They will consider it as a buying opportunity. Finally, the street didn't like this foray of Ultratech Cement into the cables and wires business, but who really felt the heat was the incumbent cable and wires players. That's why you had Havells, Polycab, KEI, all of them were under pressure because the fear is this the paints moment for the cables and wires business? After all, when Grasim moved into the paints business, well, we did see all those paints companies did see a lot of selling pressure, margins compressed, as well as valuations.
All right, Nigel, many thanks for joining us. In Stock-Specific Action, Trends Managing Director Venkateshwala spoke to Shilpa Ranipeta on what was a rare interview. He said Zudio is one of the company's strongest growth engines, adding that 20% of Zudio's sales are from emerging non-fashion categories like beauty and footwear. Take a look.
We are quite enthused by both our brands in the fashion space, and we are also enthused by Star in the food space, definitely so. And we'll continue to build on the existing platforms, and we do think over the medium to long term, we'll have a very interesting play to be had.
So will Zudio continue to be the growth driver for you, or will it be Westside, Zudio and Starquick? Like, what do you see as the growth driver for Trend?
We do think all these three are growth engines, and Zudio is definitely one of them. So the emerging categories, which include innerwear, beauty and footwear, now accounts for about 20% of the lifestyle propositions that we have.
But from one retailer to another, Arvind Fashions is planning to manufacture sneakers. The company's vice chairman, Kulin Lanbai, is upbeat on footwear as a segment to achieve high growth. Take a look.
We believe that this whole area of casual sneakers is an area we find very exciting. So in Arvind Fashions, we are now almost selling 2.5 million sneakers across our brands, and we're also planning to get into footwear manufacturing of sneakers because it's similar to garment manufacturing, which is our skill set. So we believe that an end-to-end exciting opportunity exists in the footwear sector.
And furniture giant IKEA believes that India can become a billion-dollar market for the Swedish furnish maker, even as its losses have widened. Speaking to my colleague Shivani Bazar's IKEA India CEO Suzanne Palvera said that IKEA has already invested 10,500 crore rupees and will commit more. The company is making its entry into the Delhi NCR region with an online-first approach backed by a new supply chain hub to meet growing demand. From the 1st of March, customers in Delhi and 9 nearby cities will be able to order IKEA products from their app or website. Take a look.
We are very excited to finally be here. Of course, something we have been looking forward to for a long time, and so does many people in Delhi and the surrounding cities. So we have taken our time to learn from the first phase of expanding in 3 markets, in Hyderabad, in Mumbai and in Bangalore, and setting up for a good launch in Delhi. And now we are ready and we are here. And what we have learned is it's good to go with online first. Yeah. We have set up the backbone with the whole of supply. We have inaugurated a CDC with a partner in south of Gurugram. And all of that is now set together with the delivery and the service partners. And then, of course, we will complement with physical presence in the region. Online is an increasingly important, but it doesn't take away the need for experiencing, getting inspiration in an IKEA store, touch and feel. It doesn't take away the need of digital solutions and capabilities like planning systems and like creative tool, an app where you can plan your home, services connected to that. All that needs to play together to make the customer experience at its best. So I see it's not going to take over, but it's an increasingly important part, but the other part we believe strongly will play an important part in the future. We committed to 10,500 crores, and that is booked and consumed in the investments we have done, including the 2 major projects we have in Noida and in Gurugram. Yeah. Since then, we have gone into depth in looking at India, the opportunities, the market as such, the growth, the economic outlook, and together in the whole of IKEA and the whole value chain, we have agreed that India is a growth market and a priority market for IKEA. When we came to India, we made a commitment to do 30% local sourcing together with the government, and that is what we deliver to today. Together in the IKEA value chain with the IKEA organization working with sourcing, we now look into the opportunities. We support the government's initiative to make in India. We see a big opportunity to build up this category further in the country.
IKEA's India chief. State-run UCO Bank has deferred its foreign roadshows for its proposed 2,000 crore rupee fundraise. Sources tell CNBC-TV18 that roadshows which were scheduled for earlier this week will now be held in March. Ritu standing by with more. Ritu.
Well, thank you for that. We've been given to understand from our sources that state-run UCO Bank has deferred its foreign roadshows for the proposed 2,000 crore rupee QIP that the bank is looking to raise. This roadshow was scheduled to take place on the 24th and 25th of February across Hong Kong and Singapore, but has now been deferred. Now, our sources within the bank indicate that the bank will now attempt to hold these roadshows in the second week of March or later. Keep in mind that the bank had planned this 2,000 crore rupee QIP, which was recently approved by the Government of India to comply with SEBI's minimum public shareholding norms. As of December end, the Government of India held about 95.39% stake in UCO Bank, and after this 2,000 crore rupee QIP, the government stake was expected to fall by 3%. UCO Bank's capital adequacy ratio stood at about 16.25% and its Tier 1 capital at 14.17% as of the end of the third quarter. Now, the management had guided that they won't close this QIP in the current financial year, which means in this quarter itself. But with the deferment of the IPO, it remains unclear whether or not UCO will be able to conclude this QIP in the month of March itself.
Ritu, many thanks. US President Donald Trump's $5 million golden visa offering a path to US citizenship is the most expensive in the world. About 10,000 Indian millionaires migrated abroad last year, with UAE being the top destination, offering citizenship for about $500,000. Parikshit is standing by with more on Trump's plan and how it compares with the rest of the world. Parikshit.
US President Donald Trump has announced that the new $5 million golden visa program will offer a path to citizenship, just like the EB-5. This will also provide you a green card and permanent legal residency. But the golden visa program would replace the 35-year-old EB-5 immigrant investor visa program and also raise the minimum investment requirement as under EB-5 from $1 million to $5 million. So this is a huge increase and would make this the most expensive golden visa in the world. US Commerce Secretary Howard Lutnick said this is being done to do away with visa fraud and other nonsense related to EB-5. The White House also said this would not require congressional approval. Trump said US could actually sell 10 million golden visas to reduce the trade deficit the country has. Close to 135,000 EB-5 visas have been issued in the last 24 years alone. 14,169 of them were issued in 2024, which is the highest since 2017. Among the biggest beneficiaries of the EB-5 program over the last 10 years are first China, which had 34,700 EB-5 visas issued, followed by Vietnam at 6,300 and India at 3,800 over the last 9 to 10 years. Now, here's how other golden visa nations stack up. Close to 100 nations around the world offer golden visas. UAE's golden visa is the most preferred one and costs around $544,000, followed by Portugal at $523,000. UK would cost you a whopping $2.5 million. Greece would be around $262,800, and Italy would be around $261,000. Close to 10,000 Indian millionaires have migrated abroad in 2 years, according to different reports. 16 lakh Indians have surrendered their citizenship since 2011 and settled in 135 nations, according to a parliamentary reply.
All right, so let's see if the golden card succeeds in ratcheting up numbers. Parikshit, many thanks for joining us. President Trump asked if anyone was unhappy with Elon Musk in the first cabinet meeting of his second term. Trump also lauded Musk's efforts to shrink the government. Remember, the tech billionaire is not officially a member of the cabinet and his appointment was not vetted or cleared by the US Congress.
Elon, let the cabinet speak just for a second. Is anybody unhappy with Elon? If you are, we'll throw him out of here. Is anybody unhappy? They have a lot of respect for Elon and that he's doing this, and some disagree a little bit, but I will tell you, for the most part, I think everyone's not only happy, they're thrilled.
President Trump has in fact threatened to impose 25% reciprocal tariff on European cars and other goods. During his first cabinet meeting, Trump claimed that the EU was formed to take advantage of the US. Trump also said that new tariffs on imports from Mexico and Canada will come into effect from the 2nd of April. However, the White House contradicted him by saying that the March 4th deadline for these tariffs will still remain in effect.
We have made a decision. We'll be announcing it very soon, and it'll be 25%. Generally speaking, and that'll be on cars and all other things. And European Union is a different case than Canada, different kind of case. They've really taken advantage of us in a different way.
More Trump tariff talk. Up next, the Supreme Court pulls up the customs and GST officials for misusing arrest powers, calls for errant officers to be punished. That and more when we return.
This time on CNBC-TV18 and CNBC-TV18.com.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. from chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest-running show on startups and entrepreneurship, celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21, only on CNBC-TV18 and CNBC-TV18.com. CNBC-TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhat.
India Business Hour live on YouTube at CNBC TV18 weeknights at 7 p.m.
What investors should do now is to very carefully assess the kind of valuations that they're paying for, get out of the relatively expensive stocks, may stay invested in the relatively cheaper ones, and also the kind of niche market leaders. We're actually seeing this not just in this sector, but in all across India. It's the market leaders who are able to command pricing. It's the market leaders who are able to gain market shares. I have been saying this since late last year and on your channels also, that India is overvalued. And at that time, in late September, early October, Indian valuation premium compared to Asia ex-Japan was about 90%. Now that has declined. Nifty 50 or BSE Sensex, the frontline indices, their valuations have declined. 1-year forward P declined from 24 to 25 to about 20 right now, which is closer to the long-term average.
Similarly, if you go within MFIs, you'll realize that a lot of the reticence or reservations that banks have with lending to certain MFIs has to do with how they perceive the fundamentals of the MFI business today. But you have nailed it when you said that this is a critical communication of regulatory intent. Yes, there's been focus on liquidity. We have already seen rate cuts, and these are probably the first signs we are seeing of credit policy easing, and that bodes very well for the sector, both banks and as well as NBFCs. It shows that the regulatory focus is shifting from towards growth accommodative in a meaningful way, and that has to bode well. I absolutely agree with you. As far as the arithmetic of the capital release goes, it obviously favors or has a greater marginal.
The Supreme Court has pulled up customs and GST officials for misusing arrest powers. The apex court called for errant officers to be punished and ruled that customs officers do not enjoy the same powers as police officers. Ashmit is standing by with more details. Ashmit, give us a background to this case and the implications of what the court has said.
Well, let's bear in mind that there were a batch of applications adding up to over 279, which had raised multiple questions with respect to powers available to customs and GST officials. One of the concerns that had been raised is that the arrest power of these customs and GST officials is being misused by them to coerce the companies into paying the amounts in question, and this is something that was brought to the attention of the court. The court, by way of today's judgment, very clearly holds that there is some merit in the argument that has been given, that there is a potential abuse of this arrest provision for coercing money out of these companies, saying that this is not something that is conscionable, not something that the court will allow, is not something that is consistent with the Indian law. Going on to say that as far as the errant officers are concerned, there needs to be some accountability in terms of departmental inquiries, and with respect to the companies, they will always have the remedy, the liberty of moving the court for seeking some relief. But the court didn't stop there. It went a step further and said that the customs officials cannot be deemed to be police officers, and therefore they do not have the same power. The Supreme Court also saying that the remedies, the reliefs, the protections that are granted, the safeguards that are granted for an accused under the CRPC, which is now the BNSS, will also be available to parties facing prosecution under the GST and Customs Act. And finally, on the issue of anticipatory bail, here again the Supreme Court said, even in cases where an FIR has not been registered, parties in question can seek an anticipatory bail. So a number of reliefs. We're, of course, awaiting the final copy of the order.
All right, Ashmit, many thanks for joining us. We told you first, it's now official. The Union Cabinet has approved an agreement between India and Israel for collaboration in exploring and processing critical minerals. The partnership involves the use of AI and machine learning for exploration. India will also appoint nodal officers in overseas missions in countries with large mineral reserves. Minister for Coal and Mines, G. Kishan Reddy, said India is looking for opportunities to mine for cobalt, copper and lithium in 15 to 20 countries.
हम सऊदी से चर्चा कर रहे हैं, अर्जेंटीना से चर्चा कर रहे हैं और टेक्नोलॉजी के लिए इजराइल से भी चर्चा कर रहे हैं और टेक्नोलॉजी के अमेरिका के साथ भी चर्चा कर रहे हैं, अलग अलग देशों से भी एमओयू कर रहे हैं। एक एक्शन प्लान तो है, एक्शन प्लान के अंदर ही हमारा 25 क्रिटिकल मिनरल्स जो इंपोर्ट करते हैं उसके लिए फ्री ड्यूटी फ्री किया है।
Harsh Goenka, chairperson of the RPG Group, has echoed Uday Kotak's stance on fading animal spirits among heirs or wealthy business owners in India. Goenka said, and I quote, "Modern science believe in passive income, active vacations and aggressive networking at yacht parties. Who needs the stress of managing employees and production lines when you can just manage a diversified stock portfolio?" Top economist and former government advisor Sanjeev Sanyal also weighed in. He said, "I'm glad that the business elite has woken up to the real danger that their heirs are becoming too soft. Instead of leveraging their wealth to take bigger risks, they create family offices," end of quote. But not everyone agrees. We spoke with Devina Mehra of First Global and Deepak Shenoy of Capital Mind, who believe this is neither a new or an India-specific phenomena, nor one to be worried about. As Shenoy put it, Goldman and Sachs do not run Goldman Sachs, so why should Indian family businesses be any different?
Our youth now love luxury. They have bad manners, contempt for authority, show disrespect for their elders, love chatter in place of exercise. They contradict their parents, gobble up their food, and tyrannize their teachers. Guess when this quote is from?
Sound like my kids.
This is from 79 AD, graffiti on the walls of Pompeii. Oh. And the actual quote goes back even further to Greek plays.
Right.
So this is what every generation thinks of the next generation, that the next generation is going down the drain, not working hard enough.
Children of those who have become rich are now investing in those companies and calling them startup investing or whatever it is. And then also spending the money, which is both, I think, are great things, because if you don't have the hunger, at least you give the money to the person who has the hunger. And secondly, you spend so that it increases the incomes of all the people who provide you the services that or products that allow you to spend. So I think both things are useful.
Well, splitting heirs quite literally. With that, it is time for us to wrap up this edition of Business 360. The news will continue. Stay right there. You're back in a minute on CNBC-TV18.
Those who are nearest to the minimum capitalization red line. So you are thinking PSU banks. That's the first order impact.
I'm absolutely clear that this and the market space is big enough to give space to another player. Number one. Number two, Ultratech will take minimum 3 years to start their production. Whatever somebody may say on paper, 2 years, but we have our long experience in developing the industries. Number three, it will take another 3 to 4 years to or 5 years to develop the brand for wires, and also to get the, if they come at all in the cables, it will take many years to get the approvals from different customers, different utilities, different departments, and also, develop their channels.
a bit unusual, but not totally unprecedented, because in the last decade, 2015 we had a similar situation, 2017 also. At least 4 to 5 occasions in the last decade, temperatures have been in the range of 37 to 39. So you can't call it unprecedented, but yes, it's a bit early, a little bit unusual.
So ma'am, can we expect a dip in the temperature in the next 5-6 days? Is that a possibility?
You can expect a small dip, but not a dip that will give you any respite.
Hello and welcome to Indianomics. On Tuesday, the Reserve Bank reduced the amount of capital that banks need to set aside to give loans to NBFCs and microfinance companies. Immediately, the cost of funds for NBFCs and MFIs falls, but the bigger message from the loosening of rules is that RBI seems to be determined to do everything to spur growth. Look at the sequence of events in the past quarter. First, on December 9th came the CRR cut, which brought in 1.13 lakh crore immediately into the system. Second, since Jan 1st, the Reserve Bank has infused 1.38 lakh crore by buying bonds through the open market operations, OMOs as we call it. Third, it started daily repo operations since January 15th to give banks temporary liquidity comfort. Fourth, it has done $5 billion of FX swaps in January and is doing another $10 billion swap on February 28. Together, they will infuse 1.3 lakh crore into the system. That's a liquidity increase. That's on the liquidity increase. On policy, we got the first rate cut, the first in 5 years, on February 7th, and finally, earlier this week, as I just said, lowering the curbs on loans to NBFCs. Now, separately, the Reserve Bank has also reduced prepayment penalties, and that can spur in its own way MSME borrowing. So now the big question, is all this enough to spur bank lending? More importantly, is it enough to spur growth, and will economists now increase their GDP growth forecasts for FY26? What more can RBI do? I have with me an elite panel, Mr. S.S. Mundra, former Reserve Bank of India Deputy Governor and former Chairman of BOB, now Chairman of Samman Capital, of course, Chairman of BSE as well. Suresh Ganapathy, the finance company's expert from Macquarie Capital, and Nikhil Gupta, the economist from Motilal Oswal. Gentlemen, thank you very much indeed for your time. Mr. Mundra, to you first, sir. A huge set of policy announcements, but most important is the last one, that the NBFC loans will now cost less. Do you have a confidence that Reserve Bank is going all out to improve credit growth, or should we look at it as a very incremental step? You know, if you can wear your DG hat, the NBFC's loan to NBFCs was growing at 30% in 2023. Now it has come down to 7%. We are happy, we have changed. This has got nothing to do with overall policy reset. How should we look at it?
Okay. First of all, Lata, I would look at it like this. Probably to my mind, at least I don't recall a series of events. It will be one of its points that the risk weights have been increased and then they brought down within such a short, window frame of the time. Normally, this kind of action is taken. It remains for quite some time, and before the things settle down. So, at least you may correct me, but I don't recall. So it means quite clearly the data point which are available to RBI and also the data point which are publicly available, there had been a sharp deceleration. RBI is surely, I think, looking to boost the growth. I look at it like probably the first action was kind of a message to the lending community. Lending community has responded to that message, as we can see from the data point, and now that action is reversed. So probably with the expectation that a message has been conveyed, and now this message would be kept in mind in the future behavior of the lender. So now it is for the lending community to stick to the discipline which has been brought by this. But coming back to the point, now with this kind of change in risk weight, I think around 40,000 crore of capital would be released, which can translate into 4 lakh crore of incremental lending. And now if you look at the other measures of providing the liquidity, because, okay, if you have the capital, but if you don't have the liquidity, then the end result would not be the same. So it's a combination that the capital is made available, liquidity is made available. Key question would be, to my mind, whether this incremental lending would go to the productive sector or it will go to boost the consumption. Nothing wrong in either way, but again, I think the lending going to productive sector is a more welcome situation, but then depends on what kind of demand is coming, what kind of confidence level that sector is looking at it. Consumption growth is fine, only the precaution, it should not again result into making the people over indebted. Which has its own set of problem, and then there could be in the federal system there could be actions by other players which we have already seen. So I stop it here, but this is how I look at this big picture.
Fair point, sir. Actually, to be fair, the Reserve Bank has not reduced the risk weight on unsecured loans. They're very correctly giving a message that NBFC loans need not suffer anymore because NBFC sources of funds appear to have gotten more balanced. It was too dependent on banks. Now they have kind of corrected it and depending more on market. It seems to be the spur to consumption, at least I can't see it. They have still kept the cork on unsecured loans. But Suresh, for a more immediate, reaction, do you think we can see NBFCs as the biggest beneficiaries? Their margins improve and their loan growth improves. Can we come to that conclusion?
Yeah, look, all these things will take time, Lata, to play out, right? It's not going to be quite immediate because of the fact that the liquidity in the current markets are still pretty tight. So nothing is going to happen before the end of this financial year. And then, of course, you start off on a weaker footing on April to June because seasonally it's a pretty weak quarter. So all these things will take time. A point which I would like to just drive across on this 40,000 crores and 4 lakh crore number. Look, I mean, this is all notional calculation, right? See, at the end of the day, you have to understand that the system common equity tier 1 was already running at 13.5%. This only adds an additional 20 basis points, theoretically, right? You can anyways go down to 12-11% and could have lent that money. The bigger problem is that of demand and not of supply, to be very honest. At this point in time, the RBI is doing whatever it could do from the supply side angle. We really need to see demand picking up. And for that, we have to see what could be the implications of the tax cuts and how exactly the overall market responds to that. So of course, at the margin, the NBFCs get the relief, but I would not really immediately pencil in growth numbers coming into the financial statements for either banks or NBFCs in the immediate future.
Well, Nikhil, question to you is that do you see all this as a concerted policy push towards growth? And therefore, are you changing your opinion, if not your actual number, on growth, say 3 quarters down the line?
All right. So, no, I'm not changing my growth projections as of now. And I would also want to point out that, yes, if you look at all you mentioned at the beginning of this show, various steps that the RBI has taken, but we also need to understand that what happened recently is a part of the entire sequence. And you rightly pointed out that they have not touched the risk weightage on unsecured loans. Right. So this is a very targeted measure. They want to provide probably some relief to NBFCs and MFIs, which are too dependent on bank, and especially for non-PSL borrowings. It is PSL was never into risk weights were never changed for PSL borrowings. So it's only for non-PSL. and they are still keeping those unsecured risk weightage what they were revised to in November 2023.
That's right.
So it more looks like a targeted measure where they want to probably provide some relief for NBFCs and MFIs, not definitely to boost GDP growth or to boost the consumption-led loans. Overall, it is possible that all these measures may allow some extra room to the NBFCs and MFIs to lend out more. But again, if anything, it would be only incremental, because I don't think NBFCs were too tight on supply front. They did not have money to lend to the borrowers if there was any demand. Because again, when I spoke with our NBFCs analyst, he was very clear that when in November 23, these risk weights were increased, the impact on NBFCs in terms of their cost of borrowings was not very significant. And if that is so, now when those risk weights have been reduced out, the impact would again not be so significant.
Okay.
So I'm not very sure if I would take it as a sign that credit growth is going to be much higher than what we were expecting.
So Suresh is not raising EPS estimates, and Nikhil is not raising growth forecasts for the coming year. But you know, why speak to an analyst, Nikhil? We have here a person who has lent loans as a banker and is still supervising an NBFC, which is lending loans for housing finance companies. So, Mr. Mundra, you know, how will a bank chairman or a bank MD or a NBFC chief look at the sequence of events? Will they press on the accelerator and lend more because they see policy in favor? Or do you think that the reality on the ground, I mean, you would know better, is the reality on the ground not such that loan growth will necessarily increase?
The NBFCs continue to remain an important cog in the wheel as far as the last mile lending is concerned. And I think for a variety of reasons, banks had also been finding it a good vehicle for their overall credit growth to keep on accommodating the NBFC, which has quite constrained, as you can see from the recent data point. So while I don't think that suddenly it will create a huge kind of enthusiasm that you just open the tap for NBFCs, NBFCs would also not be expecting that. But I believe that from the point where we are at this point of time, probably there would be a more benign attitude in accommodating NBFCs for their credit needs. And NBFCs would have that capacity, while Nikhil has mentioned some point of time, but I think is a diverse field. There are many players, but I think they would, it will enhance their ability to little push up their credit. So on both sides, on the bank's books as well as the NBFC book, I won't say it will be something revolutionary or something that suddenly a great change will come, but there would certainly be an incremental positive move from this. This is what my reading is.
Okay. Okay, point taken, sir. The other step that the Reserve Bank announced is that prepayment penalty will not be imposed on MSMEs under 7.5 crore loans. That will allow easier loan shopping by the MSMEs. Will these complex of steps, liquidity, rate cut and risk weights, create animal spirits in the lenders? That's the question we'll ask our guests after the short break.
Over the last decade, if you're a global asset allocator, like where would you have made money? Like you didn't need to put money offshore from the US over the last decade. What we would say there is that the valuation differential between EM and DM now is at its largest point that it's been for many years. Therefore, when we're being approached by our global clients, they're very much aware and cognizant of the fact that they have a large overweight in the US and they tend to have large underweights in emerging markets. What I would say is that when we look at emerging markets at the moment, we're very constructive on emerging markets. When we're looking at India itself, I think the selling pressure here really has come about from the tremendous bull market which we've had in India over the last 3 years. And as we went into the end of last year, valuations on India became stretched. So all it took was a slight slowdown in the credit markets, in the credit cycle, in loan growth, and some earnings expectations, and that led to money coming out of India. I certainly don't think the bull case for India has changed, but I think with all long-term bull markets that you have, and that's what we believe is happening in India, you will get these pullbacks and a reset, and I think you'll see a return of FII.
Welcome back to Indianomics. The Reserve Bank has announced a bunch of measures to spur growth, and we have been speaking to Mr. S.S. Mundra, former DG of the Reserve Bank, Suresh Gadpati, Managing Director, Head of Financial Services, Macquarie Capital, and Nikhil Gupta, Chief Economist at Motilal Oswal, on whether growth and EPSs of finance companies will see a boost. The answers so far have been from all our three experts, well, not so much. The key point is that people lend when they sense that policy is a tailwind. The animal spirits come up. So that's the question I want to address now. Mr. Mundra, in that context, this prepayment penalty being waived, until now, this is only a draft rule now, but what the Reserve Bank has done is that, of course, there is no prepayment penalty if an individual like me prepays her loan, but MSMEs were not included in this. Now MSMEs up to 7.5 lakh crore loans will not be punished if they do a prepayment, which is very good for them because then they can do some loan shopping. You know, go to the lowest lender when they see one. Do you see this as a big step, a good step, or a confusing step?
Okay, Lata, just before the break, you were associating the waiver of prepayment penalty with the growth. To my mind, there is no direct correlation between these two.
Okay.
I don't think it has anything to spur the growth. Yes, certainly is a move towards the fair practice. But to be very frankly, I'm little confused and surprised with this latest set. Of course, these are the draft regulations. And of course, it is with a disclaimer I am mentioning because RBI may have good reason to come with the draft which they have come with. They have a better access to the data point and the more nuanced breakup within the industry. But to my mind, any regulation should, at least three things should be there. It should be principle-based, it should be consistent, and it should be non-discriminatory. Somehow, from the basis of all the information which is publicly available, I'm finding that this draft is falling short in all the three categories somewhere or other. It's a long discourse, but I would presently only cover why I'm talking about the principle-based. If time permits, I will talk about the consistency and non-discriminatory as well. Now, see, why prepayment penalty is levied? What is the principle? Let us understand. There could be two situations. One is time mismatch. In the sense, if I give you a simple example, that as a lender, I source fund from somewhere for a particular duration and lend to someone for the same duration. And if someone is prepaying, then there is a ALM mismatch, time mismatch is there. Real life, it doesn't happen because it's a moving pool. Lender is collecting money from various places, lending, and banker's job is to really arbitrage on the time. You borrow short, you lend long, and you earn the spread. So principle-wise, that issue is not involved here. But the second issue, why prepayment? Because in a loan which a bank has raised the money on a particular rate and then lent and earn a spread. Now, if it is prepaid, they are required to redeploy it. There is a possibility that redeployment could be at a lesser rate than what was the loan which was prepayment, and bank stand to lose. But that is where why it is not exempted on the fixed this rate loan and on the floating. Because in floating rate loan, even if loan would have continued, the borrower would have been benefited by the reduced rate of interest as a principal. And that is why on a floating rate loan, this waiver, that is the principal. So principal-wise, is fine. I mean to say this is how. But what I'm trying to say, the principle is equally applicable to all kind of borrower. The situation which is there for an individual or for a MSC up to 7.5 crore is equally true for a MSC which is above 7.5 crore or for a medium enterprise or even for a large borrower. So that is why when it is applied selectively, somehow I feel is not, then is not completely principle based for all the category of borrowers.
Let me come to the other two gentlemen also to get their views. Suresh, I would think that this also helps good loan shopping by the MSMEs. I agree that this is not as revolutionary a step. It was more intended for fair practices. The NBFC rule is bigger. But do you think an NBFC lender, say an Umesh Revankar or the Rajiv Jain of Bajaj Finance, would now get the view that there is a tailwind behind us? RBI is on our side in terms of growth. You don't think that spurs animal spirits?
No, on the contrary, it's a headwind for them, because remember that a lot of banks were not charging some of these prepayment penalties, and the RBI has very clearly said in the circular that the supervisory audits revealed that the policies were quite inconsistent across several organizations, that they were charging prepayment penalties. So what exactly happens is, by doing this, you're reducing the switching cost. So for example, without taking any NBFC name, say an XYZ NBFC, which is maybe a AAA or a AA rated NBFC, was intentionally imposing a prepayment penalty so that the borrower didn't want to go to a bank. Now, of course, he cannot enforce that, and therefore that guy shops around and goes to a bank, right? So therefore, the NBFCs will be pressurized to reduce the rates. And I do agree with Mr. Mundra that this has no growth implication as such. This is obviously a benefit being given to the customer. On the contrary, there will be pressure on two line items because of this, more so for the NBFCs, because they are the ones who have been charging some of these prepayment penalty rates and foreclosure charges on many of these floating rate loans. So the pressure will come in the form of lower margins because you will have to reduce your rates competing with the other banks. And the second thing would be in form of fee income, because that foreclosure income will no longer be there. So it's actually bottom line. It may not be very significant, but definitely affects.
Sorry, probably I didn't phrase my question properly. My point was that including this and the other steps, will an NBFC take home the view that the Reserve Bank is now pro-growth? Will that sentiment, I'm a great believer in this concept of animal spirits. It's not often the dynamics of the economy, but the sense that, this is a good time, that normally spurs economic growth. Nikhil, your thoughts? I'm not referring to any specific instance. I'm referring to the whole ecosystem of sentiment created by the Reserve Bank from the CRR cut of December 8 up to this NBFC risk weight. Do these complex of events, create a kind of an animal spirit spur for, lenders, both bankers and NBFCs?
Yes, Lata sir, definitely this is a reversal of what we saw a year before December 24. And that is definitely positive for all the lenders, NBFCs, banks, or MFIs. Does it lead to animal spirit? I think that would be probably stretching it a little bit. Whatever the RBI has done, we also need to consider some other factors that are there, which we know for a fact. For example, I was looking at loan to deposit ratio or credit to deposit ratio when I include loans and investments of banks and look at it as ratio to deposits. We know it was on the minds of the policymakers. And now when I was looking at this data, it is close to all-time high. So it has slightly increased from what it was a year ago. And in conjunction with rising LD or CD ratio of the entire banking system, we have seen that the liquidity deficit has also widened in the past few weeks or past few fortnights.
Okay.
So if you take home the conclusion that all these measures are going to push credit growth, then we need to be very clear about where do we want loan deposit ratio, credit deposit ratio to be, what would happen to liquidity deficit, which the RBI has been trying to control or bring it in line, or trying to keep it moderate as much as possible using various tools that it has at its disposal. So just because you have done some things, and again, I want to highlight they have not changed risk weights on unsecured personal loans, which is a very big thing for me, at least as of now. I do not take it as a very clear signal that the RBI is all out to push credit growth in the country, to push it higher. On the other hand, they are definitely not as tight as they were a year ago, let's say 2024 entire. Since December, things have changed. But would it lead to higher credit growth? Would it bring back animal spirits? Probably stretching a little.
Okay, all right, fine. Then I probably got carried away in my enthusiasm. Some steps have been taken, but it doesn't go a very long way. And I would really be on RBI's side if they do not reduce risk weights on unsecured loans just yet. The kind of stories we are getting from both MFIs and unsecured loans, credit card loans, is not very positive. As a regulator, I would be worried. Mr. Mundra, the last word is to you. Let's end it on that prepayment penalty note that you wanted to say. We have a couple of minutes. What would you want the Reserve Bank to do on this issue?
Yes. So just number one, if you look at the very quickly, all the individual borrowers are out of it. Individual borrowers for business are out of it. MSCs up to 7.5 crore are out of it.
Yes.
All the large borrowers in any case, I mean, the general practice, when the interest reset is due for their loan and floating loan, they always have a prepayment option, either with no penalty or with a very notional penalty. That is the reality. It means it leaves only a segment of MSCB about 7.5 crore and medium enterprises.
Okay.
I don't know why. So that is why I was talking about discrimination and inconsistency. So I will be very quickly, I will have a 3 asks. Number one, it should be uniform across the borrowers and the lenders based on principle. That is number one. Number two, to my mind, now lock-in period is waived in this draft circular. I think there should be a reasonable lock-in period which should be permitted so that the lenders are allowed to do a more consistent business planning.
Okay.
It should not be, very strict, but there should be a reasonable lock-in period, which should be. And the third point, I would say reasonable prepayment penalty can be allowed, because when you get the prepayment and before you redeploy, theoretically the money is invested in treasury operations, which yield little less. And a loan, when it is given, also involves administrative and operational costs. So something which is very, very, reasonable, only covering this kind of cost may also be considered. So I would say these are the 3 asks I would have in my mind.
Okay. Well, thank you very much, Mr. Mundra, and I hope the message is heard and you will write to the Reserve Bank before March 31st. But the key takeaways from the other gentlemen on growth itself is, even as Mr. Mundra pointed out, this is not an all-out signal. After all, the risk weight on unsecured loans has not been lowered. So Nikhil Gupta not changing his growth forecast just yet, considering the, of course, huge headwinds from the tariff issue itself and other growth constraints. Suresh Ganapathy also not changing any of his EPS or net interest margin forecasts for the companies that are being tracked. Nevertheless, the market in a slightly happy mood after these announcements. Thank you very much for joining us with your 360-degree perspective, Nikhil, Suresh and Mr. Mundra. And thank you everyone for watching Economics.
Of the year once those valuations get back to those long-term averages. There are a couple of themes I'd like to go through there. I think the internet platforms in India, the duration of growth that you have within the Indian internet platforms is quite extraordinary. And I think that's something we'd be very interested in. So whether that's the food delivery side, whether that's the online travel side, whether it's the fintech side, those are all businesses that we're familiar with, and we'd be very positive on those on a longer term basis. And I think this pullback gives a good opportunity within those individual areas.
Hello and welcome to News Center. I'm Parikshit Luthra. Uncle Sam is ready to welcome the elite to America. At a time when the Trump administration is on a mass deportation overture, they are ready to hand out permanent residencies to those who can dole out $5 million. Trump has announced that the new $5 million golden visa will offer a path to citizenship, just like the EB-5. This will provide you a green card. The golden visa, a green card holder or a permanent residency, all of these will come with the golden visa program under Donald Trump, but would replace the 35-year-old EB-5 program as well. It would also raise the minimum investment requirement from $1 million to $5 million. U.S. Commerce Secretary Howard Lutnick had said that this is being done to do away with visa fraud and other nonsense under EB-5. The White House also said that this would not require congressional approval. Trump said his administration could sell 10 million golden visas to reduce deficit. Here's how other golden visa countries stack up. Close to 100 nations offer golden visas. UAE's golden visa is the most preferred one and costs over 544,000 US dollars. Portugal's costs around 523,000 US dollars. UK would cost you a whopping $2.5 million. Greece would cost you around $262,000. Italy would cost you around 251,000 US dollars. What does all this mean for Indians wishing to live the American dream? Remember, 10,000 Indian millionaires migrated abroad in the last 2 years, and 16 lakh Indians have surrendered their citizenship since 2011 and settled in 135 nations as per a parliament reply. Let me now go across to Christine Surak, Associate Professor of Political Sociology at the London School of Economics, and she's also the author of The Golden Passport. I'm also joined by Rohit Bharadwaj, Country Head, India and Director, Private Clients at Henley & Partners, Investment Migration Consultancy Firm. Ms. Surak, if I can begin with you, how do you think the Golden Visa program will be different from the EB-5 program, which has already been around for 30 years?
Indeed. So in some ways, Trump's announcement wasn't too terribly surprising because there's been a program in place for quite some time in the U.S. The big difference that he announced in his press conference is the increase in price. It will go up by nearly 5 times. Now, he suggested that that might be sweetened a bit by getting rid of a lot of the bureaucracy and the hassles and the potential fraud that has been going on through the EB-5 program over the years. Currently, if you're an Indian citizen and you're applying for the EB-5 program, your waiting time is likely to be well over 5 years. And so what Trump, in putting up the price, is suggesting that that will be smooth. But of course, whether or not it's worth paying 5 times as much is another question.
Right. Do you think, of course, the price is restrictive, but are there other restrictions which we don't know about just yet?
Well, his press conference was very sketchy on details. There hasn't been a formal policy announcement yet, which he said would come in 2 weeks' time. So I think at that point, even basic questions such as, is it going to be a $5 million donation to the government, or will it be a $5 million investment, which an investor might be able to get back in the end? Even those basics haven't been made clear yet. So there's still a lot of waiting going on.
Right. Let me also get it, Rohit Bharadwaj. Rohit, how do you see this program? Do you see a lesser number of Indians now choosing the United States as an option?
Well, thanks, Parikshit. But I think, the announcement has come very recent. So ideally, it remains to be seen whether, this will be a residence by investment program, similar design as different countries which have designed golden visa with a path to being eligible to apply for a citizenship down the line, or it is a direct to citizenship by investment program, ideally. But having said that, for the Indian families, the aspirationals and the quality of lifestyle, US has always been traditionally for many years, a dream to basically settle and relocate. But looking at right now, the confusion which has arisen, specifically whether the EB-5 program will remain in the current mode, or it is likely to be replaced by the new announced $5 million gold card, is something which we will definitely wait and watch. But having said that, at Henley & Partners, we've actually onboarded many clients, more than 94 nationalities, and the top nationalities include China, Vietnam, and India, specifically for the EB-5 program. The demand is something which we need to wait and watch, as more details will come likely in the coming weeks and months as well.
Right. Professor Surak, if I were to ask you, those Indians, for example, who are currently on H-1B in the US, hoping that they could get a path to permanent residency through an EB-5, how do you think they are going to be impacted in the US?
It's interesting because in his press announcement, he talked about, where President Trump talked about potentially big companies like Google paying for these visas for their employees. And traditionally, that's been a space that has indeed been taken up by the H-1B visas. And the Indian nationals are the largest number of people who've taken up those H-1B visas that are aimed really at tech expertise and bringing that into the US. However, the cost for an H-1B is it's not that expensive at all. There's a cap on the numbers, which I think that cap has been controversial, and those numbers have been hit very, almost within the first few months of every single year. There's much more demand than there's actual supply. But given this huge difference in cost, a lot of people on H-1B visas are actually just kind of earning middle class to upper middle class incomes, in which case 5 million isn't that much. And it's unlikely that the companies themselves are really going to be willing to pay 5 million unless you really are fundamental star talent, in which case there might be other visa options for you that are much cheaper and easier. So it's hard to see this program as doing much to take the pressure off of H-1B, which has been a real key way for Indian tech experts to make it into the US.
Right. Let me go back to Rohit as well. Rohit Bharadwaj, which are the most popular countries? We have been reading reports that UAE is the most preferred destination for Indian businessmen wanting to migrate abroad. Which would be some of the other top destinations right now, according to you?
Well, in terms of the proximity of the location, and of course, the kind of changes that the government has done in UAE definitely has been interest not only for the the Indian diaspora, but also globally from all parts of the world, including the developed nations. We keep on introducing the recent private wealth migration and the number of the wealth creation which is happening all over the world, specifically from developed nations like US and also from India and China. That has seen an uptake, not just in UAE, but also related to a lot of other reasons. A lot of people have understood the concept of having a plan B or a second home, specifically after the lockdown, which we saw roughly 4 years back. So for a wealthy client, who understands the value of diversification in terms of the investments, they also realize that, having a domicile as a diversification strategy as part of the portfolio is something which can be utilized as an insurance policy in the future. So from that aspect, we have seen a certain increase, in the last 3 to 4 years, specifically in the European residents by investment programs or so-called golden visas, from a plan B or second home options in Europe as well. But nonetheless, US and the Commonwealth countries, which are English-speaking nations, from a relocation strategy aspect, that still is widely popular in terms of the interest.
Right. And in your book, The Golden Passport, Professor Surak, you look at the kind of people who look to migrate abroad through golden visas. Could you give us a sense of some of the trends that you've seen over the years? One of the things that Howard Lutnick, the US Commerce Secretary, mentioned when Trump was making this announcement was that we want to do away with visa fraud and all the nonsense related to EB-5. But raising the cost, does it help?
Well, those are two somewhat separate questions. As we heard already, one of the key reasons that have come up in terms of motives for people, especially in a post-COVID world, is a plan B. And there's a lot of reasons around the world: geopolitical instability, the potential of a global pandemic. Just not knowing what's going around the corner means that the plan B mobility possibilities have become one of the dominant motives, in addition to, for the golden passports, just simply easier travel and better visa-free access. And if you're talking about citizenship, there's sometimes business benefits that come with that as well as lifestyle benefits too. So those are the four main drivers around the world. And what's been interesting in looking at demand over the past couple of years has been the rise of U.S. citizens looking to these options. So the U.S. is not just trying to attack the wealthiest and the most talented. It's also, to some degree, sending out the wealthiest and most talented who are looking for their own plan Bs because they're not sure what the future is going to bring. So looking at changes in demand, it's been an interesting space to watch geopolitically. But I think in general, a lot of people these days, especially if they have global lives, they're thinking about wanting to keep all those doors open to them.
Right. Let me ask Rohit a question about reducing deficit. The U.S. administration, especially Donald Trump, while making that announcement, saying that we could offer something like 10 million golden visas and reduce the trade deficit that U.S. has. Do golden visas actually help countries in reducing trade deficits?
I mean, historically, what we've seen is that objective of the governments to introduce such concepts under investment migration is the concept of inviting indirect foreign direct investment in the country, whether it's through capital infusion or any other eligibility requirements. So it is, of course, during the last 4 years, specifically after the lockdowns, when world economy was going through a different, kind of paradigm changes. We do have seen that definitely certain countries have benefit from inviting and increasing the outlay through the foreign investors in that country to invest and get those benefits of residency and citizenship. So that is one of the key aspects still where governments. In fact, what I would say that, as you mentioned earlier, in terms of being one of the most expensive, yes, it can be if this is something which comes as an introduction. But the thing is that there are other few countries which have a similar investment program. So
all right, we're losing that connection. But a very quick question to you, Professor Surak. Do you think this is going to lead to a wealth drain also? Of course, there are about 10,000 Indian millionaires who've traveled abroad or migrated abroad in the last 2 years. If this trend continues as it is, does this also lead to a wealth drain?
It's a complicated question, in part because so much of the Indian diaspora is actually creating successful businesses all around the world. So if you take the case of Dubai, it's not necessarily a lot of successful Indian business people taking money out of India, but they're actually building businesses in other parts of the world and sometimes reinvesting in India. So it's a complicated question to answer. In terms of the programs themselves, I don't think at a $5 million price point, the U.S. is going to get anywhere close to the 1 million applicants that Trump has been predicting. If you look at similar golden visa programs, similarly expensive ones like in Australia, in Singapore, in Hong Kong, where they're in the millions in terms of their price points, they usually they usually get only a couple hundred applications per year. Certainly not the tens of thousands, certainly not the hundreds of thousands, and definitely not the millions. So if Trump launches this program at 5 million, there'll be some people who look for it. It'll be an easy way, for example, if you want to put your children in U.S. schools and you have that sort of money on hand to do it, 5 million is nothing to you. Might as well spend it. But I don't think it's going to have the actual scale of impact that is being projected at this point in time.
Absolutely. Thank you so much, Professor Surak, for joining us. And thank you very much to Rohit Bharadwaj as well. We're taking a short break. But coming up on the other side, we bring you a conversation with former U.S. Ambassador to NATO, Ivo Daalder, on the escalating tensions between U.S. and NATO and the outlook on India, China, and the U.S. relationship going ahead. Stay tuned.
But, again, and I link this back to what we were talking about, the need to adapt as well as the change as far as the business model is concerned. In a Trump era, with the H-1B issue being the way that it is being dealt with at this point in time, what could it potentially mean as far as the services sector is concerned? What could it mean for Indian IT in the next few years?
So there, I think two parts to what you ask, and there I'll talk a little bit more about Infosys. We've built over the last few years a more resilient business.
Former U.S. Ambassador to NATO Ivo Daalder has said that the U.S. President Donald Trump is looking for an economic win with China, which may not be actually good for India. Speaking to me earlier, he said that the president would even risk a geostrategic loss with countries like India to achieve a deal with China. Daalder added that the NATO will continue to persist even if USA withdraws from the organization. I began by asking him about the expectations from the second presidency of Donald Trump.
It's going to be a fundamentally different relationship. Trump 2.0 is not only more demanding, it has no natural points of friction or guardrails or ways to control the impulses of a highly impulsive man, Donald Trump. Trump 1.0 was defined by what we called the adults in the room, the people who came out of a long experience dealing with the government, dealing with the world, whether it was General Mattis or even Rex Tillerson, who had been a major businessman and dealt with the world for decades. And they were able, together with people in the White House, to deal with Trump and try to avoid the worst excesses. Now we have an administration that has no guardrails, in which the Secretary of Defense owes his position to be Secretary of Defense only because he was chosen by Donald Trump, and will do whatever it is that Donald Trump will tell you to do. And that's true for the Secretary of State, it's true for everyone. So it's now the impulse of the president that will drive things. Part of that leads to unpredictability, as one person that I met here in India said, there's one thing that's certain, which is uncertainty. But the other thing that it means is that his worldview, which is actually quite defined, will now define how to deal with the world, which is he doesn't like allies. He believes that we should work with big powers like Russia and China, and that he wants to get the best possible deal out of any relationship. It's highly transactional, win-lose, no leading, just winning.
Right. I'd like to ask you about U.S. relationship with NATO and Europe. Do you think there's going to be a rupture there, considering the kind of speeches top officials like J.D. Vance have made?
Well, I think the fundamental point is that the Europeans think there is a rupture. We are seeing a fundamental shift in European thinking, perhaps best exemplified by what happened in Germany, where, of course, the attack on the German system happened by the vice president in Munich. The German reaction to this was one of outrage, on the one hand, and a realization that something fundamental had broken. So the new Chancellor of Germany, who soon he still has to form a government, but will be the new Chancellor, Mr. Friedrich Merz, took his first opportunity publicly to declare that the United States was no longer a reliable ally and that we needed an independent Europe, even going so far that if that means working outside of NATO, to do so outside of NATO. A German chancellor that really since 1949, independence of West Germany, has relied on the United States for its security, for its sense of self-worth. For a German chancellor to say that is extraordinary. But then we live in extraordinary times.
Right. What about NATO? You have been U.S. ambassador to NATO. Can NATO guarantees for its European partners, will they last actually? And can partners and allies count on those guarantees?
Well, the question, of course, is can they count on the U.S. guarantee? And the U.S. guarantee is a promise. It's a promissory note. You said, if something happens, I will do this. We are now in the age where those promissory notes can be ripped up any day, in which the United States, in an extraordinary measure, votes with Russia, North Korea, and Belarus, the three countries that are actually involved in a war against Ukraine, against not only Ukraine, but every single ally that the United States has. Even a country as China or a country as Iran abstained from that revolution that the United States voted against. And under those circumstances, trusting the United States is going to be more and more difficult. And the impulse will be to say, no, we need to figure out how to be more independent. We will have to invest more in our own defense. Good thing anyway. But in the end, an alliance that has existed for 75 years, whose 75th anniversary we celebrated in July, may not even get to its 76th birthday in its present form. And here's the important thing. NATO will persist. Even if the United States withdraws, 31 countries will be members of NATO, and they will use NATO instruments, they will use NATO procedures, they will use NATO rules to continue to find ways to ensure their collective defense.
Right. Give us a sense of the kind of relationship we could see between US and China, and what kind of impact will that have on the world? We've seen the impact of the tariff wars in the first Trump administration. That rattled stock markets. Nobody likes trade wars, but what could happen now?
So I think actually that what Donald Trump is seeking is an agreement, a big deal with China. I don't think that this is good news for the region. I don't think it's good news for Taiwan. I don't think it's good news for our allies, Japan and Korea. And I'm not even sure it's good news for India. Because it is the geostrategic interest between India and the United States vis-a-vis China that has informed the relationship. I think that Donald Trump is looking for some kind of deal that he can sell as an economic win, even though it's a geostrategic loss, because he doesn't care about the geostrategic losses in the way that American presidents in the past have. He sees Xi Jinping as a genius, as an incredible leader, because he controls, as he says, his 1.4 billion people with an iron fist, not something that we as Democrats, whether you're Indian or American, should admire, but he does. And so I fear that if we're banking on the United States to become anti-Chinese and have a confrontation with China, I don't think that's going to happen, no matter what Marco Rubio and Michael Waltz, the National Security Advisor and Secretary of State, who said before they came in. I think Donald Trump wants a deal, and he is willing to settle for something that may not even be a very good one.
Final two questions would be about the impact of Elon Musk on the relationship with Donald Trump, and also the relationship between US and India. We're already seeing some tension with the kind of work that the Department of Government Efficiency is doing with the defense officials, the State Department, even the FBI, saying you do not need to respond to queries that are coming in from the Department of Government Efficiency. Where do you think we are headed? Do you think this could cause trouble in the US administration?
Well, we don't really know because we have nothing to compare it to. We have never in the history of a country seen an outside person come in with absolutely no experience in government, bring in 40 whiz kids who have absolutely no experience in life, let alone in government, and to tear the entire structure apart. In a way that has no rhyme and no reason. Firing left and right, deciding that this program works and that program works. So we've never seen anything like that. The fact that that he has been able to do this already for, 32 days, and Donald Trump seems to be quite happy with the way it's been going, suggests to me that he can go for quite a while. Now, he will do things that some people will object to and will push back against. This idea that every employee should give 5 bullet points to say what it is that they were going to do, which will be generated into an AI machine in order to then figure out what government should do, which is not how government works. I think will fall by the wayside. But that doesn't mean that if Musk loses on one issue, he can't win on the next 100. The key is, will he and the president look at each other and say, we're better off together than alone? And so far, they're better off together.
All right. My final question then would be, will Musk come and manufacture in India? We've actually brought out a policy to woo companies like Tesla and VinFast of Vietnam and other global EV makers to come make in India, commit to $500 million in manufacturing and get a 15% duty concession on fully built cars. Currently, there's a 100% duty on imported cars into India. Do you think Elon Musk, in the current scheme of things, where the priority of Donald Trump is to make in America, will he come and invest in manufacturing, set up another line in India?
You know, I don't think so. I actually think he may be moving towards giving up on Tesla. Tesla's being outmaneuvered by Chinese EVs in China, which is his largest market. The people who tend to buy electric cars tend to be people who are more liberal and progressive on the Democratic side. His sales in the United States are going down because of his political activities. The same in Europe. So Tesla is in trouble. And it's not just a question of where it produces it anymore. At the moment, it's not clear that the cars it produces will be able to sell over the long term. So I think that is the larger issue for Elon Musk. How important is it for him to continue to play the kind of political games and to have the kind of political influence as he has running X and now this Doge effort vis-a-vis his business interest with regard to Tesla. And so far, it seems to be he's more interested in playing video games and getting into arguments on X and trying to destroy the U.S. government than he is in trying to make Teslas.
All right, that was the former U.S. ambassador to NATO, Ivo Daldar, saying he's not sure if Elon Musk would actually go ahead and invest in manufacturing in India. Let's see what happens in the next few months. With that, it's a wrap on this edition of News Center. More news and updates continue right here.
US, we've made sure we built out more and more local delivery and digital centers. We've got now more staff which are local. Over 60% of our teams in the US are local. We built quite a strong nearshore capability for the US. So we feel better prepared if there are any changes. So far, we've not seen any changes.
We're talking about human genius and human ingenuity as well, and we were just talking about moving from people to platform. Now, what actually happens on the workforce? Because this is a sector that has been driving, employment for a young country, for a young demographic like India. What happens to the people part of this business now? Let's talk about that. What happens to entry-level jobs, for instance? What are we talking about in the next 5 years?
So there, first, in the existing employees that we have, there's huge reskilling. So there's a constant move, especially with generative AI, but all through when we were having digital or cloud or cyber, a lot of reskilling today, at least within Infosys, over 270,000 people more ready for AI. So that's the first element. Second, in terms of new roles, we've already shared this last quarter. For the next financial year, starting April, we will recruit something like 15 to 20,000 new campus hires, which shows the same sort of direction of what we were discussing earlier, which is there is growth, there is productivity, and there is new work from these technologies. All of that combined gives us confidence to have new people joining from the campus.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC-TV18.
She's a trailblazer and a name that commands respect in the world of investing. Devina Mehra, the woman who took India's investing game global, is now here with a book that promises to challenge everything you think you know about money. Money Myths and Mantras isn't just another investment guide. It's a masterclass in cutting through the noise, busting market myths, and arming yourself with the real rules of wealth creation. Why do even the smartest investors get it wrong? What are the biggest lies you've been told about investing? And most importantly, how do you build a winning portfolio in an unpredictable world? Devina Mehra lays it all out with hard data, deep insights, and a no-nonsense approach. Devina, thank you very much for joining us. Congratulations, the book is doing very well.
Yeah, thank you, Prashant. I mean, I had never expected it would become #1 on Amazon among all books. This was like totally beyond expectations.
It stays there.
Yeah.
What gave you the inspiration, first up? A quick, brief sort of outline of, time is hard to find and you wrote a book.
Yeah, I mean, it was vaguely in my head. Actually, it doesn't take me that much time to write, so time was not really, it was just deciding to do it because this entire book has been dictated on my phone. So I didn't even switch on the laptop. So once I know what to say, it doesn't take me time. But the real reason was that I always say that in our business, the input and output is money.
Right.
But for me, the real thrill is in the learning.
Right.
And this is one of the very few professions in the world where 30 years on, you can still say you're learning every day. There's never going to come a time when you know it all.
Yeah.
And because my parents were both professors, so it is kind of the teaching genes are there. So it seems that, once you understand something, you want to also explain it to people that this is the way. Have you looked at it this way? And that was really the journey for me to start writing articles, and then I thought of writing a book and putting it all together.
Yeah. And it's written simply. I mean, a beginner can read it, but also somebody who's been in the markets. I mean, I think one can go through.
Yes.
They'll also find the book useful. So that's something I found unique.
Yeah,
it's not very lay, it's
was
not very complex.
Right.
It's a mix.
Yes, I mean, of course, the insights would be there even for people who have been in the markets a long time.
Yeah.
But I tried to make it as simple as possible and went against the general format. So therefore, there are subheadings, there are things in boxes, just as there used to be in our research reports. There are summaries, and wherever I have made videos on it, there's a QR code to take you to the video. And I've just I've met people saying that, sometimes friends, kids saying, I don't have a background in finance, but I could understand it. So that's very heartening.
That's lovely. So let's talk about a few things from the book. Right? You talk about markets forgetting history.
Right.
What are markets forgetting right now? I mean, let's make it current in the current situation.
Okay, so first of all, in a multiple choice, every viewer will get this right, that equity is a volatile asset class. So everyone knows in theory equity is a volatile asset class, but when you're living through the volatility, it seems like the end of the world.
Correct.
Always. So that is one thing which you forget history. I mean, you look at the last 18, 19 years, almost every year we've had a 10%, at least a double-digit correction, barring, I think, 3 or 4 years. And one of those exceptions years was 2023. So after 2 years, you have seen index correction, which is over 10%. So it's not the end of the world. It is not something which is unexpected. So those are the things you forget. You forget how volatile the small cap segment can be, where the falls in 2008-9 were nearly 80%. And in 18-19 was almost 2/3. So those are all the things which look very good when you look at the past. Yes, I would have bought here and sold there. But when you are living through it, you forget it. You forget the fact, and this is something I keep repeating, that only about 4,500 stocks trade in the market today. Many more have been listed. So many stocks just disappear into the blue yonder. So again, when there is euphoria like there was in 2024, when every riff-raff stock is running, every micro cap is running, you forget how many of these frenzies come and go, how many of IPO frenzies have come and gone, and what happens to the IPOs later. So there are many things of history that are forgotten.
And somehow you just want to believe that maybe this time is different, right?
Famous last words in markets.
Absolutely. So I'm going to, my questions are in no particular order, but I just wanted to, I thought I'll pick out some stuff that I found interesting.
Right.
You say that there is this myth that smart money always wins, right? Tell us some examples, 1 or 2 examples where the so-called smart money got it spectacularly wrong.
I mean, it depends on what you call smart money. So I'm saying, I mean, what the point I make is that don't try to replicate what a successful investor or fund manager did. Because for one, they may not be doing what you think they are doing. And I'm not giving this as a worst example, but simply because Warren Buffett is the most well-known of the investors. You think he buys and holds. But the data shows he sells 85% of what he buys within 2 years. The majority he sells within 6 months. So first of all, your general impression may not be supported by data.
Often you think, well, the guy's been holding the same stuff for 50 years, right?
Yes, but that's not always the case. So, and also whether the performance itself is good. I mean, Warren Buffett has also underperformed the S&P for 20 long years. Of course, his underperformance is a little bit. Ray Dalio has been a spectacular underperformer, but people think like he's some kind of guru and you must follow him. All this apart, you are asking fundamentally the wrong question. That it is not that somebody who is rich and therefore classified as smart, what did they do? The question you should ask is that all the people who followed this strategy, what happened to them? Because, for example, you can have a very high-risk strategy where most people go out of business, but the few survivors multiply their money. So after 4 or 5 cycles of this, there will be a handful left who would have made out spectacularly, but that doesn't mean that that strategy was a good strategy. I mean, Rakesh Jhunjhunwala, somebody asked him that you made your money through trading and now you say don't trade. He said, I might be a smoker, but I might still tell my kid not to smoke. Yeah. And many of, again, you know, in hindsight, all these, somebody gets classified as smart, but, you know, you don't know in the beginning. Even that person did not know in the beginning where they would make their money.
Yeah, yeah. And of course, I mean, past success does not guarantee future.
Of course. I mean, that is why, I mean, one of the people who many people like to follow is Peter Lynch. And I say that Peter Lynch, I give him credit not for his stock picking, but the fact that after a 14-year spectacular run, he knew that this is not replicable. And he retired in his mid-40s. You know, as early as that, because he knew that was a particular time in a particular market and that will not be replicated. So I give him a lot of credit for that.
Getting out right at the top.
Yes, exactly.
You know, you say investing is a loser's game,
right,
in the book. What do you mean by that?
So this is an old article of Charles Ellis, I think it's a 1970s article, that, and it's a mind-opening article that goes beyond investing, which is that everything in life is either a winner's game or a loser's game. So either you play, you know, superbly and aggressively to win in a winner's game, whereas in a loser's game, you play not to lose. So, for example, aviation, in J.R.D. Tata's time or Charles Lindbergh's time, it was an adventure sport. It was a winner's game. That famous flight, Karachi-London, you know, there some part didn't work. He wound a wire around something and made the plane fly. He missed airfields altogether and so on. But now there's only one way to fly the aircraft. Go by the checklist, make no mistakes. Yeah. And so also, I mean, tennis at a Grand Slam level is a winner's game. At your mohalla level, you should play not to lose.
It's a game of attrition.
Yes, exactly. Exactly. So same thing with investing. Maybe in our grandparents' time, it was a winner's game when information was not generally available. Getting annual reports was a problem. There were no Excel sheets. Now all the data is available. In fact, by law, a company cannot give differential information to anyone. So now you have this masses of data. You have the brightest people in the market. Now you have to play not to lose. Not to lose doesn't mean that you never book losses. In fact, you have to book losses by having stop loss, for example. By taking the small losses, you have to ensure that you don't take a huge and crippling hit on your capital. So you win if you don't lose. So.
But it's not, I mean, the idea is not to go completely defensive. It's not about buying defensive companies. I mean, that's the...
No, because those themes come and go. I always say in the markets, no theme lasts forever. No asset class, no country, no sector, no investing style for that matter.
You emphasize the need in the book for global diversification, right?
Yes.
And many will say, well, this is the fastest growing economy in the world.
Right.
So why do it?
Okay, two things. For one, I always give the statistic that when I started working, the dollar was 12 rupees. So there's been an 87% depreciation in the course of a single career. So when you're talking of your long-term financial goals, 10-year, 20-year, 30-year hands, there's no way you can forget this fact. So that's one. The other thing which you said about fastest growing economies, which were the fastest growing economies in the 90s? They were the Asian tigers. Right. India aspired to become an Asian tiger. And then came 1 year in 98, 99, when in 1 year, in dollar terms, all those Asian markets were down between 50% for Taiwan and 90% for Indonesia, and Thailand, South Korea, etc., all in between that 50 and 90. And that was a wake-up call for me. But that was the reason why I went global, why First Global became not just the first Indian, we were the first Asian members of the London Stock Exchange in 99. And so that was one of the reasons why. The other was that, I was bored of the same old companies. But coming back to this, that was a wake-up call, because I had worked in Indonesia for a few months in my Citibank days. And I said, today, if I was in Indonesia, my net worth would have been wiped out by 90%. And this is the danger of having all your eggs in one basket. So
you call it single country, single currency?
Yes, CARS, single country, single currency, single asset risk. So let's say you are only in Indian equities. So that's like being in India in rupees, in equities. So that's putting all your eggs in one basket. That you should never do. And over a period of time, at least 30-40% of your investment should be global. And global doesn't mean the US. US is not the world. It has been doing very well for the last 10-12 years. It will not always do well. There have been periods when your US has underperformed hugely. 2003 to 7 is a good example. Emerging market index itself went up 3.5-4 times. India went up 6 times in that period. And US was an absolute laggard. So leadership changes, so it should be truly global. And because it's a cause for me, we have a product that is truly global that starts at $10,000, only 8.5 lakh rupees. Because I think Indians do not think global enough. And part of the reason is that we did not have this avenue when we were growing up.
Right.
There was no, you could not send capital abroad till a few years ago.
It's allowed now up to a limit, etc. And mutual funds also.
But the limit is very generous.
Right.
It is 250,000 per person per year. That is, a family of 4 can send out $1 million every year. That's like way above the limit anyone requires other than the family offices.
Devina, stay with us. I'm going to take a very quick commercial break here. Let's take that break. Stay with us. And we are in conversation with Devina Mehra. We're discussing the very interesting book, Money, Myths and Mantras. Stay with us.
Streaming live 24/7 on YouTube. How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajar at these times on CNBC-TV18 and CNBC-TV18.com.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest-running show on startups and entrepreneurship, celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21. Only on CNBC-TV18 and CNBC-TV18.com. CNBC-TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhatt.
India Business Hour live on YouTube at CNBC-TV18 weeknights at 7 p.m.
What investors should do now is to very carefully assess the kind of valuations that they're paying for, get out of the relatively expensive stocks, may stay invested in the relatively cheaper ones, and also the kind of niche market leaders. We're actually seeing this not just in this sector, but in all across India. It's the market leaders who are able to command pricing. It's the market leaders who are able to gain market shares. I have been saying this since
Welcome back. We're in conversation with analyst turned fund manager turned author Devina Mehra is with us. And we're talking about her latest book, Money, Myths and Mantras. Devina, you also sort of advocate a hare-ish approach, H-A-R-E.
Right.
Instead of a buy and forget, right, kind of an approach. Why is that and what does it mean really? I mean,
okay, so first
looking for the exits constantly, or is that what it means?
No, I mean, see, being the hare is our mascot, our company mascot. And the reason we have the hare is because a hare is very agile, very fast, but it can also change direction very fast.
Right.
And also, it has 360-degree vision, which is what you aspire to.
Right.
So that was the reason we picked the hare. And hare, as I said, no theme lasts forever. So always we reevaluate all that we hold in either our PMS or our global funds every quarter from base zero. Because one of my...
But a viewer who is watching, is it possible for the lay investor? I mean, you know, somebody who does who's working 9 to 5 and is investing money for the long term.
Okay, so in that case, I would say, first of all, what is the long term? You look at the original Sensex list. What did it have? It had paper, textile, shipping, all of which have scrolled off. Or it had Premier Automobiles, Hindustan Motors, it had JK Thapar Group, Mafatlal Group, all of those. So what is a blue chip at a point in time? Itself changes. You look at the Sensex and Nifty, at one point there were no banks in it. Now banks dominate. Banks and financials dominate. At one point it was full of PSUs, ONGC, VS.
Just as an example, if you invested in the index, you essentially got the returns, I mean, despite all the shuffling over a 25-year period, you got 12-13% kind of compounded returns.
Yeah, 12-13%, yes. But I'm saying that people, so that's why I have a chapter there saying, should you be a do-it-yourself investor in the first place? Because as you said, you have a day job, you are not doing this full time. So look at your track record as you would look at the track record of any fund manager. And do you want to give 100% to this fund manager, which is you? Probably not. But you still want to be involved, you want to be able to talk at parties, then give some, keep some play money, maybe 10-20% of your corpus, but use professionals for the rest. So because, I mean, the value, to my mind, an active fund manager adds is risk management. So typically you will find most investors or fund managers talking about how they pick stocks to invest in. Very rarely will you find anyone talking in depth about risk management or when they sell. So always quiz your finance professional on that, not just how you buy, but how you sell.
Absolutely. Be the house, not the gambler is another one of the mantras that you highlight. I mean, what does it mean for an investor, Devina? How does one do that? And what does it mean, really?
Yeah, it means because in a casino, the casino has an advantage. So let us say in roulette, they have a 1 on 37 advantage because if the ball comes to 0, no one gets any payoff. So on a 1 or 2 turn basis, you might get that advantage, you might win. But because there are so many runs, the casino will always win. So always make sure that, that investing is a game of skill and luck. So you have to maximize the skill factor and minimize the luck factor, because the luck can favor you one time and not favor you another time. So always look at that aspect. And I mean, almost anything in life other than chess are a game of skill and luck. So that is why, for example...
How does one do it?
So for example, we have a diversified portfolio. So that's one of the things, that you don't have too much skew towards any one sector or any one stock. So diversified doesn't just mean the number of stocks, because even if you have 20 stocks and they're broadly in, 3 industries, it's almost like having 3 stocks. So those are the basic risk management, that have it diversified, have a stop loss. So those are some of the things you can do at your individual level. But most important, think about what kind of companies you want to buy. What is your criteria? Because often people might say, this kind of growth I want, this kind of return ratio. But when you look at their actual portfolio, those stocks are not the stocks which have those characteristics, because what you have done is you bought something recommended by a friend, something you saw on TV, something in a Telegram group.
And suddenly you have this bunch of stocks which are completely different from what your objective is.
Yes, or what you said your criteria was.
Devina, you say that in the book you write that stocks are like buses or trains, if you wish. There's always another one coming, the next one coming, right?
Yeah.
The FOMO has been such a driving force in these markets because everyone is chasing returns, everybody's seeing the next guy make money. That's a powerful impulse to fight.
Yeah. So, I mean, this is one of my favorite Richard Branson quotes, that opportunities are like buses and there's always another one coming along. And FOMO is very hard-coded within us. That's the thing, Prashant. A lot of things, our brain is not optimized for investing at all or for the good of our portfolio. It evolved with two objectives, survival and procreation. And you asked about this FOMO. This FOMO is so deeply embedded in us precisely because in our hunter-gatherer days, if you got thrown out of the tribe or you went out of the tribe, you definitely could not procreate, you probably could not survive. So we are the progeny of people, we are the progeny of people who chose to stay with the tribe. So that staying with the tribe instinct is very strong. However, in the markets, if you chase whatever has done well of late, whether it is a theme, whether it's like whatever, defense stocks, PSU stocks, your small cap, or whatever, gold now. So if you chase whatever has just done well in the recent past, you will systematically underperform. This is data. So in fact, I often say that if you want an easy thumb rule on where there is froth in the market, look at where the new fund offerings are coming, because that's almost always the peak of that cycle. And that's not true just of 1 year. If you look at year 2000, a lot of tech funds were launched. Yep. You look at 2021 in India, you had a series of NASDAQ funds. So you are always chasing what has done well recently, and that's always a losing strategy. So those are the things you must keep in mind.
Devina, you've had a long journey, starting on the sell side, servicing institutional clients, then on the buy side, managing money, going global. You've seen a long sweep of history as far as Indian capital markets go. What do you wish you knew back then that you know now?
A whole lot of things. I didn't know much back then because the securities research as a business did not exist till 1993, till the market was opened up to foreign institutions. In fact, that was the trigger for me to start this business, saying now the market will professionalize. But even when I was doing my MBA at IIM Ahmedabad, there was no course on securities research because that career did not exist. So I've learned it all along the way. But I would say one of the sort of counterintuitive things is that what defines a mistake. In theory, again, you know that this is a game of probability, of ambiguity, because you don't know the future. And that's one of the first things I used to teach analysts, because I only hired freshers in research. That in studies you have that one question has one answer. Here there is ambiguity, but even so, it took me a long time to kind of think that what is a mistake, because earlier you thought a mistake meant something you said this was a buy and that stock didn't do well, or you said this was a sell and the stock actually went up. But now you realize that since everything is a game of probability, the outcome doesn't necessarily tell you what is a mistake. It should be whether your decision process was right or wrong, because sometimes low probability events happen. So for example, people will think that if you didn't buy Apple in the initial years, you must have been a dodo. But the fact is, for 20 years, Apple gave no return. 17 years, zero return. Even 20 years, the compounding was some 2% when US interest rates used to be many times that. And even after Steve Jobs came back, for 7 years, every year it was marginal profit or marginal loss. So it was not as if that, and it came close to bankruptcy. Amazon came close to bankruptcy, so did Tesla. So sometimes they could just as well have gone bankrupt. So that's the whole point, that you have to evaluate the decision process. At times I have made a lot of money on something which was patently a wrong decision. Something else happened to change the fortune of that stock, but the decision was wrong. And so also I have heard some of the big names saying, some stock got stuck because in the physical days, because I wanted to sell it, but I couldn't sell it because signature differs ho gaya, and then I made a lot of money on it. So, so both here, the point is that, again, we are hardwired that for our successes, we credit ourselves. And when things go wrong, we are looking for villains. that this management chore hai, operator ne chala diya, central banker ne ye kar diya. But both in successes and failures, there's an element of luck. So always remember that.
Devina, it's a fantastic book, I must say. I've gone through it. Money, Myths and Mantra. And I think the viewers will enjoy it, as they will our conversation as well. Thank you very much for dropping by and talking to us about it.
Thank you for having me, Prashant.
Well, enjoy the book. Check it out. Thank you very much for staying with us.
Last year, and on your channels also, that India is overvalued, and at that time, in late September, early October, Indian valuation premium compared to Asia ex-Japan was about 90%. Now that has declined. Nifty 50 or BSE Sensex, the frontline indices, their valuations have declined. 1-year forward P declined from 24 to 25 to about 20 right now, which is closer to the long-term average.
Similarly, if you go within MFIs, you'll realize that a lot of the reticence or reservations that banks have with lending to certain MFIs has to do with how they perceive the fundamentals of the MFI business today. But you have nailed it when you said that this is a critical communication of regulatory intent. Yes, there's been focus on liquidity. We have already seen rate cuts, and these are probably the first signs we are seeing of credit policy easing, and that bodes very well for the sector, both banks and as well as NBFCs. It shows that the regulatory focus is shifting from towards growth accommodative in a meaningful way, and that has to bode well. I absolutely agree with you. As far as the arithmetic of the capital release goes, it obviously favors or has a greater marginal impact with those who are nearest to the minimum capitalization red line. So you are thinking PSU banks. That's the first order impact.
I'm absolutely clear that this and the market space is big enough to give space to another player. Number one. Number two, Ultratech will take minimum 3 years to start their production. Whatever somebody may say on paper, 2 years, but we have our long experience in developing the industries. Number three, it will take another 3 to 4 years to or 5 years to develop the brand for wires, and also to get if they come at all in the cables, it will take many years to get the approvals from different customers, different utilities, different departments, and also develop their channels.
Hello and welcome to Business 360. I'm Shireen Bhan. The top stories that we're tracking for you this evening. The Sensex and the Nifty decline again, but mid-cap see sharper cuts. Dalal Street is on course to post losses for the fifth straight month. This will be the longest losing streak in 29 years. From cement to cables, Birla Group's Ultratech to invest 1,800 crore rupees to set up a facility to manufacture cables and wires in Gujarat. The stock declines on capital allocation concerns. Shares of cable and wire makers also fall due to heightened competition. The tenure of SEBI Chief Madhavi Puri Butch ends on the 1st of March. Sources say top bureaucrats at North Block like Tuhin Kanta Pandey and Ajay Seth, along with Petroleum Secretary Pankaj Jain and SEBI member KC Varshne, are likely contenders for the top job. State-run UCO Bank defers foreign road shows for its proposed 2,000 crore rupee fundraise. Sources say the road shows scheduled earlier this week will now be held in March, raising doubts over concluding the stake sale this quarter. U.S. President Donald Trump's $5 million golden visa offering a path to U.S. citizenship is the most expensive in the world, but about 10,000 Indian millionaires migrated abroad last year, with the UAE being the top destination, offering citizenship for about $500,000.
Is anybody unhappy with Elon? If you are, well, throw him out of here.
anybody unhappy with Elon Musk, asked Donald Trump as his first cabinet meeting of the second term. The meeting highlighted the efforts by Musk and his team to shrink the government. Musk is not officially a member of the cabinet and his appointment was not vetted or cleared by the US Congress, yet he was there. The Supreme Court pulls up customs and GST officials for misusing arrest powers, calls for errant officers to be punished, rules that customs officers do not enjoy the same powers as police officers. Those facing prosecution can seek anticipatory bail even if the case is not registered. Also on the show today, Uday Kotak's lament on fading animal spirits and the heirs of business houses walking away from the family business find support with Harsh Goenka and Sanjeev Sanyal, but not everyone is downbeat on the next gen. Well, let's start with the market action. The Sensex and the Nifty ending flat after a choppy session. Both indices are down nearly 4% this month and are on track to post losses for the fifth straight month. That's the Sensex closing just about in positive territory. It's flat closing for the Nifty. The mid-cap index down over 1% and the small-cap index losing about 1.5%. This is going to be the longest losing streak that we've seen in the last 29 years for our markets, so pressure continues. And staying with markets, SEBI Chief Madhavi Puri Butch's tenure ends on the 1st of March. She was the first person not from the Indian Administrative Service to lead the market regulator, also the first woman. Sources say the search panel to find a successor is likely to have considered some top bureaucrats and a SEBI insider. Timsy standing by with the details. Timsy.
Yes, what sources are indicating that the search panel may have considered the candidature of these four names, to be precise. Top on the list is Finance Secretary Tuhin Kanta Pandey, followed by DEA Secretary Ajay Seth, also Petroleum Secretary Pankaj Jain and whole-time member to SEBI, KC Varshney, who's also an IRS officer. So let's see what happens finally, because the term of current SEBI chief ends on 1st of March and the orders are expected on the same day, is what sources indicate. We'll have to wait and watch for the orders because ACC is soon likely to issue the final verdict. Back to you.
Okay, Timsy, many thanks. The likely contenders, we'll have to wait for the official confirmation. Now, the Reserve Bank has reversed its decision to increase the risk weight on bank loans to NBFCs. The move is expected to free up significant capital for banks. AU Small Finance Bank, Ujjivan Small Finance Bank and Jana Small Finance Bank clocked strong gains following the announcement. The revised policy will kick in from the 1st of April. The big corporate story, Birla Group's Ultratech Cement has announced a foray into the wires and cables business. The cement major will invest 1,800 crore rupees to set up a facility to manufacture cables and wires in Gujarat. The stock down 5% on concerns about capital allocation and debt reduction. Meanwhile, shares of cable and wire makers also saw a sharp sell-off on account of the possibility of heightened competition. Nigel is here with more. Nigel, Ultratech Cement, KEI Industries, RR Kabil, all down in the red. Look at the move on RR Kabil, down almost 20%. What's going on here?
Well, that's right. Ultratech has announced its plans to move into the cables and wires business in the next 2 years. For this, they laid out a capex of close to around 1,800 crores. And this unit will be coming up in Bharuch in Gujarat. Most of the funding will be done via internal accruals or some borrowings as well. Remember, they generate cash flows of more than 10,000 crores, so it will be relatively very small for them. What makes Ultratech look at the cables and wires business? It has the industry tailwind, right? The industry has been growing by close to around 13 to around 14%. The industry size is 80,000 crores, headed to 1 lakh crores. So there's an industry tailwind. Also, they could be looking at some backward synergies, that is, they can source the aluminium as well as copper from Hindalco itself, which is a group company. And thirdly, Ultratech Building Solutions has close to around 4,400 outlets, and they've said they want to strengthen this vertical of their business as well. So those are the broad reasons. What about margins? Margins in the cables and wires business will be relatively lower because they'll be in that vicinity of around 8 to around 12%, which compares with Ultratech cement margins of close to around 15%. However, on the return on capital employed front, well, it is relatively better because on the core cement business, the ROC is close to 15%. However, on the cables and wires business, you get ROC of close to around 25% or thereabouts. How do the numbers stack up? Well, they're going to be spending close to around 1,800 crores, which is close to around 10% of their annual capital expenditure. So not large in that sense. What is the asset turnover? Well, if they're putting 1,800 crores, in all probability at optimal levels, they could generate close to around 7,000 to 8,000 crores with margins in the vicinity of around 11% or thereabouts. What doesn't the street like them? Well, the street is questioning their capital allocation. Why should they look at investing in a non-cement business? So capital allocation body was one factor that dragged down the stock. The second factor is if the group wanted to do this, the street argues they could have done it through Grasim. Brokerage reports had come out, and Jefferies, though they maintain their positive stance on the stock, they say that in fact there is a knee-jerk reaction. They will consider it as a buying opportunity. Finally, the street didn't like this foray of Ultratech Cement into the cables and wires business, but who really felt the heat was the incumbent cable and wires players. That's why you had Havells, Polycab, KEI, all of them were under pressure because the fear is this the paints moment for the cables and wires business? After all, when Grasim moved into the paints business, well, we did see all those paints companies did see a lot of selling pressure, margins compressed, as well as valuations.
All right, Nigel, many thanks for joining us. In Stock-Specific Action, Trends Managing Director Venkateshwala spoke to Shilpa Ranipeta on what was a rare interview. He said Zudio is one of the company's strongest growth engines, adding that 20% of Zudio's sales are from emerging non-fashion categories like beauty and footwear. Take a look.
We are quite enthused by both our brands in the fashion space, and we are also enthused by Star in the food space, definitely so. And we'll continue to build on the existing platforms, and we do think over the medium to long term, we'll have a very interesting play to be had.
So will Zudio continue to be the growth driver for you, or will it be Westside, Zudio and Starquick? Like, what do you see as the growth driver for Trend?
We do think all these three are growth engines, and Zudio is definitely one of them. So the emerging categories, which include innerwear, beauty and footwear, now accounts for about 20% of the lifestyle propositions that we have.
Well, from one retailer to another, Arvind Fashions is planning to manufacture sneakers. The company's vice chairman, Kulin Lanbai, is upbeat on footwear as a segment to achieve high growth. Take a look.
We believe that this whole area of casual sneakers is an area we find very exciting. So in Arvind Fashions, we are now almost selling 2.5 million sneakers across our brands, and we're also planning to get into footwear manufacturing of sneakers because it's similar to garment manufacturing, which is our skill set. So we believe that an end-to-end exciting opportunity exists in the footwear sector.
And furniture giant IKEA believes that India can become a billion-dollar market for the Swedish furnish maker, even as its losses have widened. Speaking to my colleague Shivani Bazar's IKEA India CEO Suzanne Palvera said that IKEA has already invested 10,500 crore rupees and will commit more. The company is making its entry into the Delhi NCR region with an online-first approach backed by a new supply chain hub to meet growing demand. From the 1st of March, customers in Delhi and 9 nearby cities will be able to order IKEA products from their app or website. Take a look.
We are very excited to finally be here. Of course, something we have been looking forward to for a long time, and so does many people in Delhi and the surrounding cities. So we have taken our time to learn from the first phase of expanding in 3 markets, in Hyderabad, in Mumbai and in Bangalore, and setting up for a good launch in Delhi. And now we are ready and we are here. And what we have learned is it's good to go with online first. Yeah. We have set up the backbone with the whole of supply. We have inaugurated a CDC with a partner in south of Gurugram. And all of that is now set together with the delivery and the service partners. And then, of course, we will complement with physical presence in the region. Online is an increasingly important, but it doesn't take away the need for experiencing, getting inspiration in an IKEA store, touch and feel. It doesn't take away the need of digital solutions and capabilities like planning systems and like creative tool, an app where you can plan your home, services connected to that. All that needs to play together to make the customer experience at its best. So I see it's not going to take over, but it's an increasingly important part, but the other part we believe strongly will play an important part in the future. We committed to 10,500 crores, and that is booked and consumed in the investments we have done, including the 2 major projects we have in Noida and in Gurugram. Yeah. Since then, we have gone into depth in looking at India, the opportunities, the market as such, the growth, the economic outlook, and together in the whole of IKEA and the whole value chain, we have agreed that India is a growth market and a priority market for IKEA. When we came to India, we made a commitment to do 30% local sourcing together with the government, and that is what we deliver to today. together in the IKEA value chain with the IKEA organization working with sourcing, we now look into the opportunities. We support the government's initiative to make in India. We see a big opportunity to build up this category further in the country.
IKEA's India chief. State-run UCO Bank has deferred its foreign roadshows for its proposed 2,000 crore rupee fundraise. Sources tell CNBC-TV18 that roadshows which were scheduled for earlier this week will now be held in March. Ritu standing by with more. Ritu.
Well, thank you for that. We've been given to understand from our sources that state-run UCO Bank has deferred its foreign roadshows for the proposed 2,000 crore rupee QIP that the bank is looking to raise. This roadshow was scheduled to take place on the 24th and 25th of February across Hong Kong and Singapore, but has now been deferred. Now, our sources within the bank indicate that the bank will now attempt to hold these roadshows in the second week of March or later. Keep in mind that the bank had planned this 2,000 crore rupee QIP, which was recently approved by the Government of India to comply with SEBI's minimum public shareholding norms. As of December end, the Government of India held about 95.39% stake in UCO Bank, and after this 2,000 crore rupee QIP, the government stake was expected to fall by 3%. UCO Bank's capital adequacy ratio stood at about 16.25% and its Tier 1 capital at 14.17% as of the end of the third quarter. Now, the management had guided that they won't close this QIP in the current financial year, which means in this quarter itself, but with the deferment of the IPO, it remains unclear whether or not UCO will be able to conclude this QIP in the month of March itself.
Ritu, many thanks. US President Donald Trump's $5 million golden visa offering a path to US citizenship is the most expensive in the world. About 10,000 Indian millionaires migrated abroad last year, with UAE being the top destination, offering citizenship for about $500,000. Parikshit is standing by with more on Trump's plan and how it compares with the rest of the world. Parikshit.
US President Donald Trump has announced that the new $5 million golden visa program will offer a path to citizenship, just like the EB-5. This will also provide you a green card and permanent legal residency. But the golden visa program would replace the 35-year-old EB-5 immigrant investor visa program and also raise the minimum investment requirement as under EB-5 from $1 million to $5 million. So this is a huge increase and would make this the most expensive golden visa in the world. US Commerce Secretary Howard Lutnick said this is being done to do away with visa fraud and other nonsense related to EB-5. The White House also said this would not require congressional approval. Trump said US could actually sell 10 million golden visas to reduce the trade deficit the country has. Close to 135,000 EB-5 visas have been issued in the last 24 years alone. 14,169 of them were issued in 2024, which is the highest since 2017. Among the biggest beneficiaries of the EB-5 program over the last 10 years are first, China, which had 34,700 EB-5 visas issued, followed by Vietnam at 6,300 and India at 3,800 over the last 9 to 10 years. Now, here's how other golden visa nations stack up. Close to 100 nations around the world offer golden visas. UAE's golden visa is the most preferred one and costs around $544,000, followed by Portugal at $523,000. UK would cost you a whopping $2.5 million. Greece would be around $262,800, and Italy would be around $261,000. Close to 10,000 Indian millionaires have migrated abroad in 2 years, according to different reports. 16 lakh Indians have surrendered their citizenship since 2011 and settled in 135 nations, according to a parliamentary reply.
All right, so let's see if the golden card succeeds in ratcheting up numbers. Parikshit, many thanks for joining us. President Trump asked if anyone was unhappy with Elon Musk in the first cabinet meeting of his second term. Trump also lauded Musk's efforts to shrink the government. Remember, the tech billionaire is not officially a member of the cabinet and his appointment was not vetted or cleared by the US Congress.
Elon, let the cabinet speak just for a second. Anybody unhappy with Elon? If you are, we'll throw him out of here. Is anybody unhappy? They have a lot of respect for Elon and that he's doing this, and some disagree a little bit, but I will tell you, for the most part, I think everyone's not only happy, they're thrilled.
President Trump has in fact threatened to impose 25% reciprocal tariff on European cars and other goods. During his first cabinet meeting, Trump claimed that the EU was formed to take advantage of the US. Trump also said that new tariffs on imports from Mexico and Canada will come into effect from the 2nd of April. However, the White House contradicted him by saying that the March 4th deadline for these tariffs will still remain in effect.
We have made a decision. We'll be announcing it very soon, and it'll be 25%. Generally speaking, and that'll be on cars and all other things. And European Union is a different case than Canada, different kind of case. They've really taken advantage of us in a different way.
More Trump tariff talk. Up next, the Supreme Court pulled up the customs and GST officials for misusing arrest powers, calls for errant officers to be punished. That and more when we return.
I'm absolutely clear that this and the market space is big enough to give space to another player. Number one. Number two, Ultratech will take minimum 3 years to start their production. Whatever somebody may say on paper, 2 years, but we have our long experience in developing the industries. Number three, it will take another 3 to 4 years to, or 5 years to develop the brand for wires, and also to get the, if they come at all in the cables, it will take many years to get the approvals from different customers, different utilities, different departments, and also develop their channels.
Similarly, if you go within MFIs, you'll realize that a lot of the reticence or reservations that banks have with lending to certain MFIs has to do with how they perceive the fundamentals of the MFI business today. But you have nailed it when you said that this is a critical communication of regulatory intent. Yes, there's been focus on liquidity. We have already seen rate cuts, and these are probably the first signs we are seeing of credit policy easing, and that bodes very well for the sector, both banks and as well as NBFCs. It shows that the regulatory focus is shifting from towards growth accommodative in a meaningful way, and that has to bode well. I absolutely agree with you. As far as the arithmetic of the capital release goes, it obviously favors or has a greater marginal impact with those who are nearest to the minimum capitalization red line. So you are thinking PSU banks. That's the first order impact.
What investors should do now is to very carefully assess the kind of valuations that they're paying for, get out of the relatively expensive stocks, may stay invested in the relatively cheaper ones, and also the kind of niche market leaders. We're actually seeing this not just in this sector, but in all across India.
The Supreme Court has pulled up customs and GST officials for misusing arrest powers. The apex court called for errant officers to be punished and ruled that customs officers do not enjoy the same powers as police officers. Ashmit is standing by with more details. Ashmit, give us a background to this case and the implications of what the court has said.
Well, let's bear in mind that there were a batch of applications adding up to over 279, which had raised multiple questions with respect to powers available to customs and GST officials. One of the concerns that had been raised is that the arrest power of these customs and GST officials is being misused by them to coerce the companies into paying the amounts in question, and this is something that was brought to the attention of the court. The court, by way of today's judgment, very clearly holds that there is some merit in the argument that has been given, that there is a potential abuse of this arrest provision for coercing money out of these companies, saying that this is not something that is conscionable, not something that the court will allow, is not something that is consistent with the Indian law. Going on to say that as far as the errant officers are concerned, there needs to be some accountability in terms of departmental inquiries, and with respect to the companies, they will always have the remedy, the liberty of moving the court for seeking some relief. But the court didn't stop there. It went a step further and said that the customs officials cannot be deemed to be police officers, and therefore they do not have the same power. The Supreme Court also saying that the remedies, the reliefs, the protections that are granted, the safeguards that are granted for an accused under the CRPC, which is now the BNSS, will also be available to parties facing prosecution under the GST and Customs Act. And finally, on the issue of anticipatory bail, here again the Supreme Court said, even in cases where an FIR has not been registered, parties in question can seek an anticipatory bail. So a number of reliefs. We're, of course, awaiting the final copy of the order.
All right, Ashmit, many thanks for joining us. We told you first, it's now official. The Union Cabinet has approved an agreement between India and Israel for collaboration in exploring and processing critical minerals. The partnership involves the use of AI and machine learning for exploration. India will also appoint nodal officers in overseas missions in countries with large mineral reserves. Minister for Coal and Mines, G. Kishan Reddy, said India is looking for opportunities to mine for cobalt, copper and lithium in 15 to 20 countries.
हम सऊदी से चर्चा कर रहे हैं, अर्जेंटीना से चर्चा कर रहे हैं, और टेक्नोलॉजी के लिए इजराइल से भी चर्चा कर रहे हैं, और टेक्नोलॉजी के अमेरिका के साथ भी चर्चा कर रहे हैं, अलग अलग देशों से भी MOU कर रहे हैं. एक एक्शन प्लान तो है, एक्शन प्लान के अंदर ही हमारा 25 क्रिटिकल मिनरल्स जो इंपोर्ट करते हैं उसके लिए ड्यूटी फ्री किया है.
Harsh Goenka, chairperson of the RPG Group, has echoed Uday Kotak's stance on fading animal spirits among heirs of wealthy business owners in India. Goenka said, and I quote, modern science believe in passive income, active vacations and aggressive networking at yacht parties. Who needs the stress of managing employees and production lines when you can just manage a diversified stock portfolio? Top economist and former government advisor Sanjeev Sanyal also weighed in. He said, I'm glad that the business elite has woken up to the real danger that their heirs are becoming too soft. Instead of leveraging their wealth to take bigger risks, they create family offices, end of quote. But not everyone agrees. We spoke with Devina Mehra of First Global and Deepak Shenoy of Capital Mind, who believe this is neither a new or an India-specific phenomena, nor one to be worried about. As Shenoy put it, Goldman & Sachs do not run Goldman Sachs, so why should Indian family businesses be any different?
Our youth now love luxury. They have bad manners, contempt for authority, show disrespect for their elders, love chatter in place of exercise. They contradict their parents, gobble up their food and tyrannize their teachers. Guess when this quote is from.
Sound like my kids.
This is from 79 AD, graffiti on the walls of Pompeii. Oh. And the actual quote goes back even further to Greek plays.
Right.
So this is what every generation thinks of the next generation, that the next generation is going down the drain, not working hard enough.
Children of those who have become rich are now investing in those companies and calling them startup investing or whatever it is. And then also spending the money, which is both, I think, are great things, because if you don't have the hunger, at least you give the money to the person who has the hunger. And secondly, you spend so that it increases the incomes of all the people who provide you the services that or products that allow you to spend. So I think both things are useful.
Well, splitting heirs quite literally. With that, it is time for us to wrap up this edition of Business 360. The news will continue. Stay right there. You're back in a minute on CNBC-TV18.
Leaders who are able to command pricing. It's the market leaders who are able to gain market shares. I have been saying this since late last year and on your channels also, that India is overvalued. And at that time, in late September, early October, Indian valuation premium compared to Asia ex Japan was about 90%. Now that has declined. Nifty 50 or BSE Sensex, the frontline indices, their valuations have declined. 1 year forward P declined from 24 to 25 to about 20 right now, which is closer to the long-term average.
informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go.
Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC-TV18, now streaming live 24/7 on YouTube. How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajar at these times on CNBC-TV18 and CNBC-TV18.com.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest running show on startups and entrepreneurship, celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21, only on CNBC-TV18 and CNBC-TV18.com. CNBC-TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhatt.
India Business Hour live on YouTube at CNBC-TV18, weeknights at 7 p.m.
I'm absolutely clear that this and the market space is big enough to give space to another player.
Hello and welcome to Startup Street. I'm Shruti Mishra. We continue to bring you all the action from Web Summit Qatar 2025 as small businesses continue to play a pivotal role in driving economic growth across emerging markets. Fintech has emerged as a powerful force in transforming the way these businesses operate, scale and thrive. I caught up with 3 leaders who are at the forefront of this transformation. I caught up with Faisal Toukan, the co-founder and CEO of Zina. I also caught up with Islam Shauki, the co-founder and CEO of Paymob, and Ahmed Kushan, the CEO of FlapCap. Take a look as we discuss small businesses' big fintech impact. Gentlemen, welcome to the panel. And first of all, let me start with a broad question. In your opinion, what is that one most significant way that fintech has impacted businesses in emerging markets? Faisal.
Definitely. So I think I appreciate the easy first question, but when it comes to fintech in emerging markets, what's happened recently is that it's basically democratized finance. And what I mean by that is that with the advent, I know there's a lot of buzzwords here, but with the advent of automation and AI and self-service, you're really able to provide a personalized experience for every single SME or small and medium business as if they were an enterprise customer, right?
Yeah.
And if you look, flashback 4 years ago or so, that was not the case.
All right, Islam. So he said democratization and customization.
No, I mean, I'm echoing my colleague, is that access to the tools to help SMEs accept digital transactions that are essential for them to grow, I think is the really big part that happened. I think we're at an inflection point between a phase of enablement where SMBs and actually even consumer didn't have the tools to pay digitally. And now we're moving into this activation phase where they started having these tools. Now it's the time to actually make them transact. And this is where all the tools and the vertical kind of SaaS and use cases that are being built, obviously in lending or in consumer, that will be extremely important.
Sure, Emma, do you agree with both of them?
Yeah. So for us, like the most exciting impact, of course, for fintech is widening the access to finance for SMEs.
Yeah.
SMEs represent the majority of the businesses created, the number of people employed, and big part of the GDP of our region. However, very small part of the finance goes to them. And fintech has been able to leverage all the growing alternative data sources to be able to widen the access to financing.
Yeah.
And I think this is one of the most impactful areas for SMEs from fintech, essentially.
All right. Let me go back to Faisal. Faisal, you know, Zina is revolutionizing payments in the UAE. How do you approach tailoring fintech solutions to these regions, catering to the specific needs of businesses?
Okay, so a really interesting number about the UAE is 2 years ago, there were 300,000 SMEs in the UAE. Today, there's around 610,000, and by 2030, there's set to be around 1 to 1.1 million. So there's a massive growing segment of these small businesses that need very, very personalized needs to grow their business, right? What you have to do when you're working with SMEs, especially at that scale, is you actually have to build solutions that are very, very self-service. What I mean by that is that everything from the way you educate the customer about the product from the moment they see it on a billboard, down to the moment they see it on the app store, down to the moment they sign up and they get these automated emails, need to be very, very customized towards their journey and their needs.
Yeah.
Now, again, it goes back to the theme we talked about before, but this is all done through automation, right? So the way to personalize things is basically to do something called a product-led strategy and lead with the product journey first, and then advertising, marketing, and sales second. Right?
Okay.
So that's how you do so.
All right, Islam, you know, PayMob, it has empowered many small businesses with digital payment solutions. What are the most common challenges that you see businesses face when they adopt fintech, and how does PayMob empower them?
So definitely the start of it is demand side. So when we started in Egypt, we go to an SME and tell them, guys, do you need a POS? They'd say no. We don't have. We've been operating for the past 20, 30 years, and we're doing okay. And then the next question that we would ask is, how many clients that came into this store and said they want to buy something and actually wanted to pay with a card, and all of a sudden you said no, and you lost this transaction. So the guy would say, I had this 2 times last month or 2 times last week. So I'll tell them, like, when you start adopting digital ways to accept transactions, you're tapping into new sources of fund. It's not only cash, tapping into credit, wallets, buy now, pay later. So our rationale is that we want to help SMBs grow, and we do this by helping them get access to as many funding sources as we can. So in Egypt, we accommodate more than 40 modes of payment. So from wallets to installment plans to the normal card scheme and the local scheme. So our rationale is, as the more payment methods, the more the probability of the product to be sold, and hopefully the more revenue or profit for the organization.
All right. Ahmed, you know, FlapCap focuses on providing financial solutions for SMEs. What is that one underappreciated fintech tool that small businesses must use to scale effectively?
So again, like the superpower now of SMEs is that most of the transactional data are within third-party providers. So now if I have a little shop, a little retail shop, I'm running a POS machine that maybe 80% of all the transactions are being captured on. Maybe I'm selling a restaurant, selling on an aggregator, like a delivery platform, and I have a big part of the volume also of my sales going through it. This is ultimately the biggest gem that the SME is creating for people like us, lenders, because once you have your house in order, as Islam was mentioning, once you have these data, when we get access to it, we are able to understand your business, underwrite it, and take comfort where others, like other typical lenders, like the banks and the other legacy financing institutions, would never be comfortable. So essentially, the biggest advice is try to digitize.
Okay.
Go with the wave. Don't try to resist it. You will become obsolete. You will have access to less financing solutions and other value-added services, and you will be falling behind. It's not even like you're building an advantage, but you will be falling behind in a way.
So clearly there are challenges in adoption, and Faisal, how do you overcome the trust barrier, where small businesses are hesitant to adopt to these new fintech tools, and especially in regions where cash is king?
Okay, it's interesting that you say that. The way to overcome trust is through just two means. Number one is licensing is taken extremely seriously in this region, and for a good reason. I mean, you're dealing with people's money at the end of the day, right? So it's a very, very high barrier to entry. And I think we were just chatting backstage, and our license at some point took 2 years each to get right from the central bank. But again, it's because they take it very seriously. The good news is once you have that badge, we've seen basically, and once we got that license, we saw an instant conversion in people using the platform, right? So that's number one. Work with the regulators to verify yourself and get yourself basically being, right, give yourself that kind of, that stamp. Second is word of mouth, to be honest. The more people that use the platform, the more there's a positive network effect of people using it. And our biggest acquisition channel by far, which accounts for 65% of all inbound acquisition on Zina, is organic.
Okay.
So 65% of people sign up to Zina just because they've seen it out in the wild, right? So I think those are the two leading kind of reasons.
So you've clearly built a lot of trust there. Islam, picking up from what Faisal just said, I kind of want to know that how does education is key. You have to educate these small businesses on how these fintech tools are going to empower them. So how does PayMob do that to ensure that these businesses are maximizing their fintech tools?
So from us, I think human touch is very important in order to be able to do so. That's why we have almost 1,000 people in Egypt, for instance, that every day are onboarding merchants. First of all, people need this trust, and this trust we don't see, especially if they're 100% cash, we don't see that it will come only from kind of digital. People need to see who are we dealing with. Obviously, to Faisal's point, the association with the financial being licensed is something that obviously gives trust. Again, it's a journey. So when we go to SME, it's not like 100% of their business, like they turn cash to digital in one day.
Yeah.
Like it's a journey. We have a team that is working with them on how can they expedite this journey, because to Kusha's point, the more they become digital, again, the more they see value to it. Imagine if you're still getting payroll now cash. You wouldn't be able to get a credit card. You wouldn't be able to get a mortgage. You wouldn't be, so SMBs are starting to realize, oh my God, there's no like digital trail for my transactions, so I cannot get access to the financial sector. So when you kind of frame this value proposition to them, and step by step they started seeing the fruits out of this, they become more keen on actually adopting new digital innovations.
All right. One big challenge that small businesses face is access to capital. Ahmed, if you can throw some light on how Flapcard services help small business owners, get access to overcome the traditional roadblocks to financing.
So the magic word here is digital data sources, right?
Okay.
Again, any data source that you're using that can be verifiable for a company like me, whether it is the POS you're using, the e-commerce platform you're selling from, even the banking data, as long as you have a big part of your amount of your transactions going through it, transfers, checks, the more you create digital information trail around your economic transactions, the more it is to be used by companies and fintechs that offer finances, and essentially even it removes the hassle from the SME to be preparing a lot of applications, a lot of documents to be submitted. Everything is in the data. If you have it in good order, then you can leverage it in nice ways.
Number one. Number two, Ultratech will take minimum 3 years to start their production. Whatever somebody may say on paper, 2 years, but we have our long experience in developing the industries. Number three, it will take another 3 to 4 years to or 5 years to develop the brand for wires, and also to get if they come at all in the cables, it will take many years to get the approvals from different customers, different utilities, different departments, and also develop their channels.
Similarly, if you go with MFIs, you'll realize that a lot of the reticence or reservations that banks have with lending to certain MFIs has to do with how they perceive the fundamentals of the MFI business today. But you have nailed it when you said that this is a critical communication of regulatory intent. Yes, there's been focus on liquidity. We have already seen rate cuts, and these are probably the first signs we are seeing of credit policy easing, and that bodes very well for the sector, both banks and as well as NBFCs. It shows that the regulatory focus is shifting from towards growth accommodative in a meaningful way, and that has to bode well. I absolutely agree with you. As far as the arithmetic of the capital release goes, it obviously favors or has a greater marginal impact with those who are nearest to the minimum capitalization red line. So you are thinking PSU banks. That's the first order impact.
What investors should do now is to very carefully assess the kind of valuations that they're paying for, get out of the relatively expensive stocks, may stay invested in the relatively cheaper ones, and also the kind of niche market leaders. We're actually seeing this not just in this sector, but in all across India. It's the market leaders who are able to command pricing. It's the market leaders who are able to gain market shares. I have been saying this since late last year and on your channels also, that India is overvalued. And at that time, in late September, early October, Indian valuation premium compared to Asia ex-Japan was about 90%. Now that has declined. Nifty 50 or Nifty Sensex, the frontline indices, their valuations have declined. 1 year forward P declined from 24 to 25 to about 20 right now, which is closer to the long-term average.
Faisal, Zeena's success in the UAE is impressive. How do you see the role of fintech in driving financial inclusion in the wider MENA region? And what are you doing in that regard?
So great question. So the thing is about localization in the region is we actually conducted a lot of user interviews across different countries in the region, right? And then we went and we conducted user interviews in Europe. And we actually did a user interview in Mexico just to kind of see how fintech is localized. And what's really interesting is you can take the journey of a fintech player that's tried to expand internationally, and in 99% of cases, fintechs fail to be anything beyond regional.
Okay.
If you look at the winner in North America, it's Chime and it's SoFi. You look at South America, it's Nubank. You look at Europe, it's Revolut. But once they try to cross that regional kind of gap, they tend to fall flat, right? What we've realized is that behaviors in the Middle East are very, very similar. Okay. And I'll give you one insight, if that works. SMEs operate like consumers, where basically they prioritize community over the transaction itself, and that needs to be baked into the user interface, right?
All right. Picking up from that, we're talking about expansion. And how do you see fintech evolving, let's say in the next 5 to 10 years, Islam, to further simplify business operations for small enterprises? What are the big trends that you're spotting?
So obviously, I mean, digitization is a huge trend, whether it's like normal or using AI agents in order to actually simplify like the business processes that goes behind, whether it's reconciliation and all sorts of business operations. At TMOB, we're super bullish about stablecoins. We think that it would be a huge kind of transformational infrastructure that would turbocharge payments and will actually I always say that digital is at a disadvantage on cash, because when you pay someone in cash, cash settles instantly. But when you pay them digitally, it settles T plus X and it doesn't settle on the weekend. But in stablecoins, especially when it comes to cross-border, I see that if someone can beam money from the UAE to the supplier in India or in South America, that will actually settle in instantly, it will actually improve the cash flow cycle and will remove a lot of pressures on SMBs when it comes to their cash flow capacity. So I think this is an area that I think will really transform this industry in the next at least 5 years.
All right. Ahmed, you know, FlapCap works with businesses to offer flexible financing. What role do you think alternative models, alternative lending models will play in the future of small business growth?
So, like, I think one of the key trends, and everyone is seeing it, what is happening with the LLMs. Like, of course, we have been speaking about AI for so many years. But like AI, the AI we're witnessing now, this is AI 2.0. This is not like the same, like the fancy regressions we had a few years ago. And from us, from a lending perspective, we can see it. We can see a clear path. We can see a clear path with the current technology on how we can reduce down, on the one hand, our cost of operations, right? So this means cheaper cost of capital for SMEs. And more importantly, how can the LLMs help in even expanding more the access to finance by accepting more SMEs that we would be usually not very comfortable with the given capabilities, the growing capabilities of the LLMs to be capturing the financeable from the very, not very financeable. So again, like the AI will be cheapening the cost of capital, widening the access, and essentially adding like significant value for SMEs to be able to grow.
All right. Like we now focus on the need for building stronger ecosystems. You know, small businesses rely on a lot of partnerships, be it banks, payment processors, and suppliers. So, Faisal, you know, how important are partnerships for the success of fintech platforms like Zina? And what types of partnerships do you think are essential to help small businesses grow?
Awesome. I think you guys can probably relate here, but starting a fintech has a way higher kind of lead time to starting any other business. If you want to start a social media company tomorrow, you build an app or you build a web app and you can be up and live in probably a month or so, right? For us, there's a catch-22 between 3 different third parties that you need to solve for. You need to be on good terms with the regulator. You need to be on good terms with the basically banking partners, right? And you need to be on good terms with your investors. And the regulators want capital from your investors want you to be regulated, and your banks want you to be regulated. So you have to catch, right, all 3. It's this kind of web. And fintech is an enabler built on all 3. So as a fintech, you have to be basically very, very diligent when it comes to your internal processes, and you have to build up that trust over time.
Yes.
So usually 0 to 1 for a fintech is much more difficult, but I genuinely believe that 1 to 1,000 tends to be an easier part of the journey.
So what is that missing link, I want to know? How do you make a seamless ecosystem integration for small businesses to grow? What would be the missing link? What is the big ask there?
So I think, I mean, what Kush is doing is really important, because the appetite to lend to SMBs is something that is almost not there, especially when especially in the UAE, because most of the banks have been burnt with what happened in 08. So I think what Kush is doing is really great, because it's a huge missing piece, that credit to SMBs. Again, I think when it comes to the enablement piece, having them, they have POS or any hardware to accept digital transactions has been something of a worry, especially in emerging markets, because again, the POS will cost somewhere around the $200, and with the volume of the SMB, it wouldn't make economic viability. So again, how do you use something else like soft POS, things like digital ways to be able to accept, rather than being fixated on a hardware-led kind of models. I think these are mostly the 2 things that would actually lead. And to your point on partnerships, I mean, payment is at the end of the value chain. Like, you don't wake up in the morning and think, yes, I need a payment gateway today, right? It's you work with a software house, you go on Shopify or Zid or Sella in Saudi. So we try to partner with as many what we call channel partners, people who have access to those SMBs. They're building a digital channel for them, but they don't do payments. So we're trying to partner with them in order to actually empower the solution with payments. So I think this embedded payments, embedded finance, or giving financial services in an embedded way is becoming more and more a big part of our offering.
You agree, Ahmed?
100% I agree. I'm also really positive about the outlook of fintech specifically in the region. Okay. I feel we have so many, like almost all the ingredients needed. You have a growing economy, you have the government support, you have a thriving SME sector. There is real intent from the government to further diversify and make it even bigger. So you have all the ingredients, and of course you have like great talents flowing into the entrepreneurial scene. So we have all the ingredients to make this come together, inshallah. And it's
so
just
what's
a matter
the secret sauce that's going to mix all of these ingredients together?
No specifics, just working, just executing, every one of these guys, and making sure his team works in the morning, goes and speaks to the SMEs he should be speaking to, and the magic will happen by itself.
All right. Ahmed, I also wanted to speak to you about data analytics. Yeah. It is becoming a core part of many fintech solutions. How do you ensure that small businesses, they don't get overwhelmed with the kind of the enormous amount of data that's coming in, and they actually have access to actionable insights?
So honestly, like SMEs, they should not like really bother themselves with big data analytics. Okay. They just keep it there, and when we access it, we can do the work for them. We can make the work for them. In terms honestly, like I see an opportunity. SMEs by nature, they don't have like really fancy talents, to be able to go through these data, and every business is different from the other. But again, like getting back to the AI point, and without overhyping it, but we can see with the growing capabilities that there is potential, there is an opportunity to make these data actionable without a heavy investment from the SMEs into trying to make sense out of it.
All right, before I wrap up, I want to know from each one of you the big advice for small businesses who are looking to adopt fintech solutions. Where should they start, and how can they ensure they're choosing the right tools for long-term success? What would your advice be?
You guys want to go first?
Who wants to go first?
Come sign up to PayMob. No, I'm kidding. It's just, I mean, again, I think any SMB in the world, not even the region, they want to grow their revenue, right? Yeah. So you need to see if this solution, whether it's an AI software or SaaS or payment infrastructure, does this align with what you're doing? Does this offer you what you want? And I think if people started seeing this from this lens, they would see that adopting all of this would make perfect sense to them. Obviously, choosing a provider that it's not only the sales components, the after sales, because again, it's very easy to give you a post or to integrate with you, but if you can't call me when you don't find your cash, it's a really big deal. Like, it's not sending if you're sending a WhatsApp message, it didn't come, you'll send it again. Yeah. But if you're beaming half your salary or paying for groceries and it didn't work out, I don't think you're going to try again. So having this very strong team when it comes to on-field operations or when it comes to merchant support is something we're investing heavily in. And again, this is why we think that you need a lot of people on the ground, because this will actually help give comfort to those SMBs when they need it.
One piece of advice.
My biggest advice would always be, I don't want the SMEs to be super innovators. Just don't be innovation haters, Okay. That's it.
All right.
Yeah, I think
Faisal wanted the final word. Yeah.
I think if raise your expectations from your providers, and if the solution doesn't feel customized to you, then it's probably the wrong solution.
Wonderful. Well, on that note, we'll have to wrap up our conversation. Ahmed, Islam and Faisal, many thanks for joining us here. Thank you for your brilliant insights. It was an absolute honor speaking with all three of you. Thank you so much.
informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go.
Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC-TV18, now streaming live 24/7 on YouTube. How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajar at these times on CNBC-TV18 and CNBC-TV18.com.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest running show on startups and entrepreneurship, celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21, only on CNBC-TV18 and CNBC-TV18.com. CNBC-TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhatt.
India Business Hour live on YouTube at CNBC-TV18 weeknights at 7 p.m.
I'm absolutely clear that this and the market space is big enough to give space to another player. Number one. Number two, Ultratech will take minimum 3 years to start their production. Whatever somebody may say on paper, 2 years, but we have our long experience in developing the industries. Number three, it will take another 3 to 4 years to or 5 years to develop the brand for wires and also to
there was a sense of frustration, a sense of anxiety, but also a sense of excitement कि भाई ये IPO हो क्यों नहीं रहा है, right?
Until 28th November, it was not clear that IPO हो रहा है या नहीं हो रहा है. Whatever can go wrong has gone wrong. Not so great year for fintechs to go listed in India.
All credit to the IPO of pulling this off goes to only one person, and that is Upasana.
Anything that the regulator can do can in fact cause an existential issue. How has that been for the two of you to deal with?
Oh, it's been crazy. And fintech as a sector, I still see as a sunrise sector. But with this kind of environment now, if you see who's investing in fintech, whether it is private companies, is not the preferred sector for investment. But India needs billions of dollars in investment in fintech.
So if you had to start today in this regulatory environment, would you start it? A fintech company?
I would absolutely start. If you had asked any one of my electrical engineering batch, is Bipin the guy who's going to start a company who will take it to IPO? I don't think so.
You were apprehensive of actually joining Bipin and being part of MobiKwik. Why was that?
When we met, very serendipitously, we went to watch a play at India Habitat.
What was the play called?
What Women Want.
So you're fine.
I was not the organizer.
I would say I had the gas. I need the ignition.
Ignition, and she provided that. Pressure on you. You've had a difficult quarter, with the losses widening quite significantly. Has that changed the way that you think about the business?
We know how to build a scaled and profitable fintech company. So, full stop. We know how to do it, and we have done it. But does it mean that the macros will always be the same? Does it mean that things will not change, or you will not have 1 or 2 quarters up and down? The answer is no.
The song that embodies how you're feeling today about MobiKwik and about life in general.
लक्ष्य तो हर हाल में पाना है.
Hello and welcome to this edition of the Young Turks Reloaded podcast. I'm Shireen Bhan. My guests today have an unusual story. They're part of the first generation entrepreneur cohort who decided to start up in India almost 15 years ago. Today, the company that they run is a listed entity, did very well on its listing day, listing at a premium of almost 90%. And of course, since then, we've seen the markets correct, but that is a story that they're going to share with us on where they see MobiKwik in the future. Bipin and Upasana, many thanks for joining us here on Young Turks, and it's great to have you back. And I want to start by talking to you about 18th of December 2024, because that really has been in many ways that milestone moment that you've both been working towards and waiting for. And I want to link this to your comments that was made on one of our programs, Upasana, where there was a sense of frustration, a sense of anxiety, but also a sense of excitement कि भाई ये IPO हो क्यों नहीं रहा है, right? That was a comment that you made saying everybody is getting cleared but not us.
Right. So I think, what they say, that things that you have to work really hard for, finally when you achieve them, I think the sweetness of that victory is amazing. And I think that, kudos to all the tech entrepreneurs in India who have gone public recently and also in 2024. But I would say that the journey for us was, I think, far more tumultuous, far more arduous for various reasons. I think some people have also said that, whatever can go wrong has gone wrong from a climate and environment perspective. So I think it was a not so great year for fintechs to go listed in India. And I think many things happened during the year, also ups and downs in the market. So it was therefore a harder sort of journey for us. And, people are talking about it took us 1 year. We filed our DRHP in January and we completed the IPO in December. But, I want to tell you that we were working on the IPO from 21 because we had also attempted once in 21.
Absolutely.
And, we had some bad luck, even though everything that we had done was perfect, so to speak. So this was really, a long, long sixer that we were waiting to hit, so to speak. And I can tell you that we were both very happy and excited at the final outcome because it was I don't have words. Like, it was extremely hard for us, is what I can say.
Yeah.
I want to add something, about what she said in the beginning. I have seen her pull this IPO off in close quarters, okay? And of course, I've been part of the process as well. But all credit to the IPO of pulling this off goes to only one person, and that is Upasana. And I am not trying to say this just because she's my wife or she's my co-founder. No other person in this kind of environment, in this kind of a space. Please remember, think of O&D quarter when there was so much bad news
around
that had come around fintech, around regulation, around earnings, around digital lending. So much so, one of the guys we were chasing for giving one of the investors, he didn't even give us a meeting. He said, you guys do this, but BNPL or whatever it is. And, we don't look at this space. He said, okay, fine. That's not the only business we do. We have a payments business and lending business. Guess what? Until about 45 days into the process, kickstarting of the roadshow, we didn't even get a meeting from that person. that team. And it was just like, we were like, okay, is this happening? Not happening. Because we knew that getting someone like that mean the IPO is going to get done.
Yeah.
And going to be very super successful versus maybe not happening at all. And over a WhatsApp conversation, she pushed that person saying, okay, you at least give us a meeting. You come for lunch tomorrow in BKC or wherever it is. At least I'll give you a very nice lunch. And, we went there for lunch, and that led to a 3.5-hour meeting, which led to a follow-up, another 4-hour meeting. That led to that particular investor leading our IPO. Now, this is what I say, what Upasana can accomplish. And that is the day when I, put my hats off and said, look, I mean, what is impossible? We talk about impossibles every day, overcoming challenges. But if we can do this in a sector so hard, like so difficult as fintech, then, I think whatever is happening now, it's nothing, right? I mean, we just going to go from strength to strength.
So for you, impossible is nothing. Quite literally, right?
You should hear my motivation playlist.
What is your motivation playlist?
It has an eclectic mix of English, Hindi and Punjabi, but it has never given
up. No, Kashmiri?
Well, Kashmiri also. It has never give up. It has unstoppable. What doesn't kill you makes you stronger. Aam jaise munde hi bade bante hain, and apna time aayega. And like,
this is what
Lakshi to pana hai.
Daily affirmation.
Daily in the morning while taking a jog or while taking a shower. Daily I play it. Daily. I mean, at least I got through the entire sort of hard months of IPO just with, I like music, and it has a power on me, and I can use it to convert my mood and, really.
No, but on a serious note, to Bipin's point that it was touch and go, quite literally. You have that very short, limited window. What made you persevere? What made you not give up?
I'll tell you one simple thing. 10th, 11th, 12th were the offer dates for us. Rather, 10th was Anchor, 11th, 12th, 13th December was the IPO. I think until 28th November, it was not clear that IPO ho raha hai ya nahi ho raha hai. So, literally the last 18 days. Yes. And then we knew that after 15 December, it's just
there's no window.
There's no window, right? Like people go for investors go for vacation, etc. And look what has happened in January. So, I'm thankful to God, I'm thankful to our team Flash, and I'm thankful to Bipin, my colleague Anand and I. We just persevered and, we pushed each other. I might have got the meetings, but it's a team effort, right?
Yeah.
Somebody's the opener, somebody's the closer. That's sort of how, I think about it.
There is a hotel in Mumbai near the airport, right, where we once, during this roadshow, checked in late night. And then we had to take a flight to Singapore the next day, and we came back the night after. And then we came to the reception, and that lady said, "Didn't you just come in yesterday?" I said, "Yeah, we went from Mumbai to Singapore, and now we are back here." Because guess what? We made a pact, like, we're going to stay in Mumbai until the IPO is done. And that's it. And we did it.
But Bipin, I want to go back to the start. As Upasana said, you've had a tumultuous journey when you started in 2009. And there have been many reasons why you probably should not exist today, but you continue to exist, and today you're a listed entity. But I want to go back to your conviction in wanting to start up in 2009. Your family didn't want you to start up. You were the oldest son. You had that responsibility and the baggage of having seen a family business not go through the kind of expectations that you had. The conviction to start up, what made you want to do it?
So firstly, thank you, Shireen, for inviting us here. And I think it's I think more than 15 years later that we are doing the Back on Young Turks.
Yes.
And first time we came, we were shooting from an apartment, which was our first office. So it's great to be here, back again, and reliving those days in terms of how we started up. And that was 2011, and I started up in 2009. Look, I mean, I think I was pretty frustrated with what I was doing just in work, and I wanted to make an impact in my life. And I had multiple options. I thought, maybe I should go study MBA. I'm from IIT Delhi, and, a lot of my peers would go do MBA and get jobs in consulting, banking, earn a lot of money, or go do masters, etc. But I had been working for 6-7 years in India. So the path was clear to me, either go do masters. I think that was pretty much it. And that's when, I got an idea. I got an idea that, all of these things that we are doing with cash, like topping up your phone by going down to the shop. I being the eldest child, I was more responsible, but I was also very lazy because I had 2 younger siblings, and
So
I
send them to recharge your
go
phone.
and do recharge my phone. And sometimes when they were not around, my mom would say, "Why don't you go and do it?" I was super irritated, and I think Upasana can attest to it, how I am. So I was like, why is there no website where I can go and do this? And then that's when I realized, and when I looked at data, there is hundreds and millions of people doing this every day.
Yeah.
And that's, I would say, that's not great for productivity, right? Firstly using cash, and secondly, just wasting time.
Yeah.
So that's how the idea of MobiKwik was born. But honestly, someone like me was not the kind of person who you would vote for to start a company, right? Not
Why
the kind
is
of
that?
person. Look, I mean, if you knew me in college, for example, or in school, I was the most introvert, antisocial, awkward guy you would come across. Good in academics, of course, great in maths.
You made it to IIT Delhi that
Right,
way.
IIT, but within IIT also, right? When you get to IIT, there's so many people who are so smart, right? I mean, participating in sports and dramatics and doing whatnot, and I was not one of them at all. And I was not the topper either. So it's not like academically I was the topper. So if you had asked any one of my electrical engineering batch, is Bipin the guy who's going to start a company who will take it to IPO? I don't think so. I don't think they would have voted for me. But when, it came to taking a plunge and doing something and getting that conviction, is just that at that moment you get that conviction, and then you don't worry about what are the resources that you have to pull this off, right? I'd worked for a few years, and being the eldest son, coming from fairly modest backgrounds, like you said, we used to live in a 5-room house. 1-room house, 5 people. 5 people in a 1-room house, like not 1 bedroom, but 1 room. And so coming from there, cracking IIT, getting a job, saving some money, buying my first house, those were significant achievements for me and also for my family.
I would imagine, yeah.
And to give that all up, to say, let's start from zero. To start a company, I think Upasana had a great role to play in it. Of course, when I met her, she's the kind of person, she pushed me into it. But yes, the desire was there in me to do something, and I think that's how it started. And then once it got started, I think then post that, there was
No looking back.
No looking back.
If they come at all in the cables, it will take many years to get the approvals from different customers, different utilities, different departments, and also, develop their channels.
Similarly, if you go within MFIs, you'll realize that a lot of the reticence or reservations that banks have with lending to certain MFIs has to do with how they perceive the fundamentals of the MFI business today. But you have nailed it when you said that this is a critical communication of regulatory intent. Yes, there's been focus on liquidity. We have already seen rate cuts, and these are probably the first signs we are seeing of credit policy easing, and that bodes very well for the sector, both banks and as well as NBFCs. It shows that the regulatory focus is shifting from towards growth accommodative in a meaningful way, and that has to bode well. I absolutely agree with you. As far as the arithmetic of the capital release goes, it obviously favors or has a greater marginal impact on with those who are nearest to the minimum capitalization red line. So you are thinking PSU banks. That's the first order impact.
What investors should do now is to very carefully assess the kind of valuations that they're paying for, get out of the relatively expensive stocks, may stay invested in the relatively cheaper ones, and also the kind of niche market leaders. We're actually seeing this not just in this sector, but in all across India. It's the market leaders who are able to command pricing. It's the market leaders who are able to gain market shares. I have been saying this since late last year and on your channels also, that India is overvalued. And at that time, in late September, early October, Indian valuation premium compared to Asia ex Japan was about 90%. Now that has declined. Nifty 50 or BSE Sensex, the frontline indices, their valuations have declined. 1 year forward P declined from 24 to 25 to about 20 right now, which is closer to the long-term average.
Wait. Upasana, I want to come to you now because you didn't want to get into MobiKwik. You were apprehensive of actually joining Bipin and being part of MobiKwik. Why was that?
When we met, very serendipitously, we went to watch a play at India Habitat.
What was the play called?
What Women Want.
So you're fine.
I was not the organizer. But we met serendipitously to a friend who had invited a bunch of us. And I was going to say that even in that first meeting, it was very apparent to me that, this guy is going to do something. He's going to achieve something big. But I didn't know that, my life is going to get intertwined with him. So anyway, we became friends over the course of the next few weeks and months. And it became apparent to me that he had this latent ambition that मुझे कुछ बड़ा करना है. And he was probably not getting the encouragement, or he needed one catalyst, I think, to throw him off.
You were the fire starter.
I pushed him off the cliff. It's like, you have to jump. Like, how much are you going to think about it? You've done everything for your parents, family, ghar hai, enough savings hai. So I think he was 28. I'm like, if you're not going to do this for yourself right now, then what is the point? You won't believe. When I met him, he already had the MobiKwik logo. He already had a website. He already had some junior in IITs helping him code the whole thing. He was just not, converting it from a hobby project to a real life.
So you needed that somebody to just push you to take
I mean,
the plunge.
I would say I had the gas. I need the ignition.
Ignition, and she provided that.
He was getting started, and I was very clear that I have moved back from California just to do my own payment startup. So I'm going to do my thing, and you are going to do your thing. Because at that time, our personal equation was also not very clear.
You were not
friends. We were just about to start dating. It was all in flux, and I was like, why create so much, chaos? You do your thing. I'm going to do my thing, but you must do your thing. That much I'll keep pushing you for. So he got started. I was still working on my own ideas, etc. And I think few months after getting started, he left his job. Other people that he had started with, they were doing part-timing, and they had that hopes that this will, go somewhere like immediately. Of course, you have to toil very hard.
Yeah.
So when they left and he was doing it alone, like I literally saw, so we were dating by that time. I literally saw this man work for 22 hours every day, where he's doing business development in the day to go and meet the Docomos and the Airtels of the world. He's doing coding in the evening, and he's doing customer support in the night and finance in the night. I was like, oh my God, ye to kaise hone wala hai? And I still kept like, okay, I'll just help you as a friend. Like, I'm not jumping into this thing. You must find other people. After I saw his commitment and his respect towards his, work. It's like all in, super all in. Then I realized that why am I being a doofus, right? Like his idea is MobiKwik. It's a wallet. मैं तो PayPal में wallet ही करके आई हूँ. I know payments. I know risk. And anyways, I was helping him on those points as a friend. So I'm just being stupid in trying to identify a separate idea and not just doubling down on this. And I think that's sort of when
You also decided.
Yes. 6 months after he had started MobiKwik, I finally said, okay, I'm going to do this full time with you.
Was there a conscious conversation around how you would structure lives at work and outside of work as well?
So we were not married then, but we were living together. We had started living together. And our dining table in the drawing room, that was our workplace. So it was basically about getting from the bedroom to the dining table and starting the work. I think we split that organically. I don't think there was any conscious conversation. It was more like 50-50. You know, if I'm making breakfast, she's making dinner. Things like that. But I think we were super kind of efficient. If I go back and see, you know, as like we're not even 30, so our needs were not that many. Our chores were also not that many.
Right.
So we could focus 80% of our effort and time
on building
MobiKwik. And so I think that was a big plus and helped us kind of, you know, do these things in a way where even if you fight, which were not uncommon, right? I mean, of course, if you're living together and working together, that's part of the ritual, I would say. But you know, yes, I mean, you have to let it out in terms of you're living with a person and you're also building something in terms of what you're doing is not right, what you're doing is this, we should do it this way or that way, or, you know, something about food, right? So I think those things we overcame because we had already become deep as friends to the extent that, you know, these fights couldn't kind of separate us in any way, right? We knew that the fight is going to end. And you're going to ultimately have a silent period followed with a...
Who breaks the silent period? Who makes up? Who's the first
I do.
to
I
make
think
up?
I would like to say I do.
Does he?
Well, I don't know about that. I think he speaks only for, you know, in the business and professional setting, you will not imagine he's an introvert. But at home, it's very hard to get him to talk. So I'm not sure. But theek hai, if you want to take brownie points.
Okay, fine. So she's given that to you, Bipin. But you know, I remember you. I think it was you who made a statement that the two missions that you're on is building MobiKwik into a profitable venture and staying married. Which one is harder?
I would say, you know, both of them require, you know, controlling your emotions, having patience, and enjoying the journey rather than, you know, hoping for some kind of an outcome. And that's what has kept these two missions alive.
One thing has been easy for us, regardless of the challenges in life, whether in personal or professional. I think we have a very simple and similar value system. So I think that keeps us together because we could fight like cats and dogs over, you know, which sofa to buy as an example, or not. But on simple things, you know, on ethics, on responsibility, on how you live your life, I think we have the same sort of moral code, so to speak. So that keeps us together because we know we'll think exactly the same way on this. We got married a few years after we started, and you know, we had our kid 7 years after we had started MobiKwik. I think that was the inflection point when we realized that, you know, we can't be coming home at 9:30, 10 because, I mean, we realized that during the pregnancy itself that we'll have to change our ways of working. I think I became very efficient with my time, and I think he also realized that, you know, when you don't have a kid that you have to go back to, you can be in the office till 10 and you're also having a jolly good time with your colleagues and you're having pizzas for dinner, but that doesn't scale well further, right? So I think after that, we started becoming more conscious about how not to bring work stress to home, how not to bring work arguments to home, and how to cherish the time that we have at home as a couple, as a family, with our kid, with our parents, with our siblings, etc. I think a lot of that evolution has happened in the last 5 to 7 years, where we try to stay actually as far away. In fact, in the office previous to the current office, our seating was also very far away. Like, I'm like, I don't want to see you all day.
Was that conscious? So you don't have work lunches together?
No.
Absolutely
Never.
not.
No.
Never.
Never. I don't recall the last time only the two of us had a lunch together at work.
So that separation, I guess you require your space as well to be able to work on the things that you want to work on. But let's talk about where you find yourselves with MobiKwik today and what the future holds. Today you're a listed entity. How's life changed for you? And I'll ask you this in the context of the fact that, you had a great listing. From the peak that you touched in December of over 600 rupees, it's down 50%, but the markets have also corrected quite significantly. Does that now put pressure on you? You've had a difficult quarter, with the losses widening quite significantly. Has that changed the way that you think about the business?
See, these markets and even I would say BFSI sector, macros, what's happening in US, these are beyond our control. So I cannot control all of it. What I can only control and we can control is our business. And that business has scaled to a level where we achieved certain numbers. Last year, we became profitable. And by the way, we did it since 21 was the last fundraise. We did it without raising any additional funds. And we got to almost 890 crores of revenue and some 30-40 crores of EBITDA. So we know we can do it. We know how to build a scaled and profitable fintech company. So full stop. We know how to do it. And we have done it. Many people think IPO is like the culmination of something.
No, it's actually could potentially be the start of a whole new chapter.
We didn't sell a single share in the IPO. Neither did any one of our shareholders. That tells you about what they think about the future of MobiKwik. I will not comment on things like what the valuation is or what the valuation was or what the stock price is today. Sure. But these are the people who have seen us perform over so many years, overcome challenges and demonstrate resilience to getting us here.
Has your life changed more than Bipin's? Because he's working on the product side of the business, he's working on the tech side of the business. For you, has life changed, Upasana, post the listing?
Well, yes and no. I think that in the process of doing the IPO, I think I've become a complete investment banker, equity research analyst, and equity salesperson all combined into one in the last couple of years. So, not really. I think I've found the right balance in terms of how to present the company, the strengths, and where we are going. Without, I mean, if there's anything you can say about Bipin and Upasana and also the brand MobiKwik is that we are an understated brand and both of our personalities are as such. So I think I always believe that let's do it. Let's do something that creates an amazing impact and then, people will be able to applaud it on their own. There is no point in tom-tomming yourself or what you're gonna do. Let's do it now first. Like if you win a race, then people will automatically know you don't need to do anything about it.
People don't understand what it actually takes to not just build a business, but to cross the kind of milestones that you've been able to cross, to go through the kind of challenges that you've been able to go through in a regulated sector. How has that been for the two of you to deal with?
Oh, it's been crazy. And I had mentioned this to some of the relevant people here when I was attending a meet related to fintech industry growth prospects in Delhi a few weeks back, is that, when you're sitting here in Delhi or Bombay and we are passing regulations or taking action, we think positive or negative, we don't realize that the people who look at companies like us, whether it is private or public, how they think about these decisions and what they understand and comprehend, because it becomes like a pretty big black box where the clear conclusion for a lot of people is maybe the regulators and the government don't want fintech.
Which they've clarified, to try and send out the message that no, that's not the case. That we
But
do
the
want to support
actions
and
that
encourage.
take place, actually point to the contrary, right? For many of them, and then it's hard to justify that actions are against certain entities only, and it's not against a particular sector. But the media blow up that results from that. See, somebody sitting in Singapore, I met a very, very big Swiss bank. We were talking to them earlier in our roadshow. I spent 1 hour with that analyst, a very well-respected analyst, just discussing what does the regulator want. And it was not about MobiKwik. He didn't spend 1 minute on MobiKwik. And I had to educate him, saying that this is what is happening. It's because I think there is a gap in the communication, and that gap, has to be closed. Because fintech as a sector, I still see as a sunrise sector. But with this kind of environment now, if you see who's investing in fintech, whether it is private companies, is not the preferred sector for investment. But India needs billions of dollars in investment in fintech to make the dream of truly inclusive finance happen in India. It's just we have not even scratched the surface.
So if you had to start today in this regulatory environment, would you start it? A fintech company?
I would absolutely start because I have like 10 different ideas.
You have the heart and the appetite for pain.
No, I have not just that. I think, you also learn and evolve. I think the ecosystem has also learned. I have also learned along with it. See, a lot of the innovation, if it's not regulated, there is a very thin line between what you should do and what you shouldn't do.
So that's the point, right? So if the regulator is coming in to say that, look, we want to put the guardrails in place so that innovation doesn't run far ahead of regulation, and that's always a catch-up that's that's on whether in India or globally as well. So you understand the regulator's predicament, but as an entrepreneur, how do you then go around navigating your business?
You built your business on a particular kind of arbitrage, let's say, in the world of finance. And in the world of finance, there are hundreds of arbitrages. You can build a business and make huge amounts of a huge business very quickly. And then suddenly the regulator comes in saying that this is not what we meant, or this is not explicitly allowed. I think that becomes a challenge. Because, look, you've invested money, you've put investors' money, your own time and effort into building something, and suddenly one day you wake up and say this is not allowed. I think now it's happening, a much closer dialogue in terms of what is allowed, how to do things, etc. Especially from a fintech point of view, is now happening, but it wasn't happening few years back. And I think that is where you would have found that many of the companies had missteps, and that means loss of capital and loss of trust, for example.
Reputation, which is crucial in this business.
We haven't spoken about it, but I want to tell you that I think we met maybe 100 investors in our roadshow in October, November last year. Typically all these meetings are 1 to 1.5 hours. In most of these meetings, first we were defending
the sector,
fintech India. Then we are defending, our segments of business within that. And then we are defending our own numbers and our competitive position. Maximum amount of time we had to first defend this aspect only, that fintech industry in India is only going to grow. Yes, it will be a regulated market, but innovation, regulation, and actually adaptability are the key to success here.
That brings me to the question, when you were doing the road shows, and now of course you're already listed, but the question marks on the sector, the question marks on visibility as far as what you're going to be able to do in terms of performance. Will you be profitable? Will the profitability be consistent or not? I mean, how do you respond to that today, Upasana?
So 2-3 things. I think A, we had to show the track record, and B, we had to say that look, in payments, now we've become the largest wallet. Look at our growth. Last year and the last 18 months almost, in every 12-month period, we have grown more than 3x in payments. And unlike other players in payments, we are growing profitably. And in fact, our contribution margin is also improving. And when Then after we have this payments base and we have 2-3 products within payments, we are also trying to scale up in UPI with innovative products instead of basic, UPI, like a RuPay card and a credit card on UPI. So that kind of thing. So we were trying to convince people on the payments growth, and look how much money we are making just in payments. So some of these mutual fund or domestic investors who are very wary of the distribution of financial products that we do, but mainly credit products. And they were like, oh, well, India is going through a cycle.
Yeah.
So, lending is going to be on a low mark. Yeah. So you won't be able to do this. So then we had to explain to some people that just look at how much we are doing in payments. And we've grown 3x.
Yeah.
If I grow this 2x, then again I will be able to continue to be profitable. I don't have to be dependent on distribution of credit products at all, because this is how I'm building the product.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go.
Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC-TV18, now streaming live 24/7 on YouTube. How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajar at these times on CNBC-TV18 and CNBC-TV18.com.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest running show on startups and entrepreneurship, celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21, only on CNBC-TV18 and CNBC-TV18.com. CNBC-TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhan.
India Business Hour live on YouTube at CNBC-TV18 weeknights at 7 p.m.
I'm absolutely clear that this and the market space is big enough to give space to another player. Number one. Number two, Ultratech will take minimum 3 years to start their production. Whatever somebody may say on paper, 2 years, but we have our long experience in developing the industries. Number three, it will take another 3 to 4 years to or 5 years to develop the brand for wires, and also to get the, if they come at all in the cables, it will take many years to get the approvals from different customers, different utilities, different departments, and also develop their channels.
Similarly, if you go within MFIs, you'll realize that a lot of the reticence or reservations that banks have with lending to certain MFIs has to do with how they perceive the fundamentals of the MFI business today. But you have nailed it when you said that this is a critical communication of regulatory intent. Yes, there's been focus on liquidity. We have already seen rate cuts, and these are probably the first signs we are seeing of credit policy easing, and that bodes very well for the sector, both banks and as well as NBFCs. It shows that the regulatory focus is shifting from.
Well, speaking about the long term as well as some of the measures that you've decided to take in the medium term, and I want to talk about the e-rupee launch that you've done, because this is something the RBI is betting very big on, which is the CBDC side of the pieces that they're pushing. But how do you see this, and why did you believe that you wanted to do this, or you have a right to win in this?
So I was invited along with a few others back in April by RBI to have a discussion on CBDC being open, e-rupee being opened up to non-banks. Earlier, it was allowed only for banks for the first year.
Right.
Because it's very easy for banks to do it. Like, you already have the person's savings account. You can just convert it into cash the way you're withdrawing from ATM. But clearly, as we have seen in many sector after sector, ultimately the regulator realizes that maybe the non-banks could do a better job in terms of experience. So we literally did it in a matter of months. We executed end to end with our partners, RBI, NPCI, and Yes Bank, who's our partner. So CBDC, in short, is digital cash, and I think cash in digital form has many advantages. It's as good as physical cash.
Okay.
But it's digital. That transaction is not part of the banking.
Okay.
So it is not known to any banks. No one can trace it. It's fully anonymous. Just like any note which is out there, the only person who knows about that note is RBI.
Yeah.
Same way this digital note is known only by RBI. So I think it has all the advantages of cash.
Upasana, since we're talking about future bets and future opportunities, as you look at the landscape evolving today, and I remember you said that, the marketplace expects us to focus on the competition, but we want to focus much more on the customer. We're obsessed with the customer, not obsessed with the competition. So how do you see the landscape evolving? How do you look at competition? How do you look at what else you can do or be for the customer?
So I think one thing we've seen in the last 10-15 years is that there's been a lot of digitization for finance in India. But most of that digitization has helped people like you and me, who I think are, top 100, top 150 million Indians. And that's where all the private banks and, NBFCs have innovated. So that really is not playing out in terms of finance reaching the tier 2, tier 3 Indians, whether it is a user or a small merchant. So when we think about finance and we think about democratizing financial products, payments is like the least common denominator. And so we know now that, 400 million Indians are transacting digitally using UPI, wallet, their smartphone, etc. So that we continue to double down and grow on. But after that, what is there? There is, distribution of access to credit. There is access to insurance. There is access to investment products.
Yeah.
And in all of these, there will always be people, who are super smart. They can get a financial advisor, or their bank will help them invest in the right things or use the right products. But for the masses, people who are earning 40,000 rupees, 60,000 rupees per month, we see that there is a huge gap. Even if they have taken credit at some point, they have a decent credit score, in all likelihood, due to various procedural requirements, they will not get. And salaried people still have an advantage, but interestingly, most of India is, self-employed, so not salaried. So self-employed में finance में बहुत challenge है. So our focus is, given that we have such a large user base and also small merchant base, we first connect with them over daily life payments, whether we are enabling the merchant to accept payments or we are enabling the user to make the payments. Now, after that, after looking at their KYC, their profile data, etc., we are trying to now diversify in terms of giving them access to the right investment products. So, for example, my user is not so savvy, like they can go to a Zerodha and grow and, figure out how they want to invest their money in, stocks and options, etc. So the products have to be super simple and they have to be fairly risk-free because they will not be able to appreciate the risk and reward. So that's sort of where we are trying to go, that can we work with the OEMs or the financial institutions, banks, insurance companies, mutual fund companies, and can we bring these very super simple products onto our app?
And your financial life, if an AI were to construct it, how would it construct it to your best benefit? Now that's a problem that's definitely unsolved.
Is that a problem you want to solve?
Definitely a very interesting problem that keeps me awake. And when I keep hearing about the advances that are coming and the fact that now AI is becoming cheaper and cheaper, for sure it's a space that we are definitely looking at.
The question being asked is, how many is too many? Fintech or tech fin companies in India, how many is too many? Bipin, I want to start by asking.
So TechFin, I would say TechFin, there is still a lot of space and, a lot of people can come in, because I would say as technology company building for banks and being a solution provider, there is endless opportunity now, especially with AI, how the world of finance and banking is going to change. But when you look at fintech, who's the last large fintech who's born last 2 years, 3 years? Actually, pretty much no one, right? Everyone is pre-COVID, most of them. And so the investors have already given you the message with their purse strings, which are closed for anything which is happening in fintech. So I would argue country as large as India should not be in this situation. There should be a lot more money. There should be a lot more money.
Why shouldn't we have 100 banks?
India as a country needs far more many fintechs, far more investment into what's going to, because the world of fintech is not just one world. It's finance, it's technology. And now with AI, you put it all together. What can you get? Your imagination is the only constraint you have. So I think there's
room for more.
There is huge opportunity. Otherwise, I wouldn't be more bullish today on MobiKwik than I was when I started. I think everything that is happening in finance in India is now at a 10x, 100x scale compared to even a few years ago. Now, I'm not talking about 15 years ago. Compared to 5 years ago, pre-COVID, things are happening at 10x, 100x level. Now, what will happen in the next 5 and 10 years? Solutions may not be the same. And I think innovation is the key. New solutions, we talked about CBDC, we talked about account aggregator, we talked about finance. I think the opportunity is endless.
Banking aspirations, as and when that opens up, if at all, at some point it opens up?
So I would say never to anything. Because whether MobiKwik itself will be just a bank, I don't think so. But what makes sense in the scheme of things for us to provide certain solutions to our customers, never say never.
Never say never. Upasana, I want to get into this question with you because I think we still have a dearth of female founders in this country. You're one of the very few, and you're one of the very, very few in the fintech space. What has that been like for you? Walking into a room which probably still consists of only men in suits. What's that been like for you? What is it that you would like to tell women who are looking at entering this space?
Anything is possible, and you can't let such constraints or soft sort of environmental factors stop you from what you think you can achieve. I mean, it's true. Whether you're trying to be a founder, whether you're trying to be, a pilot, whether you're trying to be Shireen, I mean, there's always a first. And if you will be a pioneer in something, you will have to work a little bit extra to prove yourself. And I think that's what it has been. I think now I can tell you that, I've been doing this for many years. So now it's easier for me to, get the right level of respect. And also I'm able to charm people with my personality. But I think in the early years...
I agree.
In the early years, it results in self-doubt, and you think twice that can I do this, and then
And you also feel pressured. I remember you saying once that you went into a meeting right before you were actually going into your C-section, into delivery, because did you feel compelled to prove a point and hence have to do that? Because there's been pushback from women saying that, look, this also puts the burden of expectations on other women of having to perform at that kind of level. Different life stages.
So firstly, the incident you said is not really a true incident.
No?
My C-section was planned on a Saturday and I was working till Friday, but that was my choice because,
right.
I think I had a comfortable pregnancy. I worked very hard through it, but I think that's how I liked it. I like to be active and upbeat. And so it was a choice. It was not forced on me. But yeah, I will say that we should not create crazy expectations. There are times when you have to give 200% to your work, and you need to have a support system to help you in those situations, especially if you are also a working mother. But there will be times when your personal life needs you 200%. So I found that balance.
Being a woman entrepreneur, being a female entrepreneur, when you're sitting in meetings in a roadshow for IPO, guess what? How many women you meet?
Nobody.
Zero.
Yeah.
Okay. And so while you may say everything is, of course, it's based on merit and of the company that you're building and the business you're building, but it is hard to do that and it's hard to achieve that. And with that, Upasana has actually, having led the IPO, being the face of the IPO for MobiKwik, and done this and being on those one-on-one chats and fights with every particular person who was involved in this process. I think she's broken a glass ceiling, which I hope inspires more women to say that we can start a company and we can take it to IPO.
I certainly hope so. Since you're talking about affirmations in your playlist, end with the song that embodies how you're feeling today about MobiKwik and about life in general.
Oh my God, ये तो मैंने सोचा नहीं था.
कर दो.
Oh my God.
Come on, Vipin, help her.
कोई बताओ. अच्छा. लक्ष्य तो पाना ही था.
हाँ तो गाना तो गाओ.
हाँ यही रास्ता है तेरा, तूने यही पाना है. हाँ यही रास्ता है तेरा. I forgot. क्या?
Share the load.
जाना है.
लक्ष्य तो हर हाल में पाना है.
And what is the lakshya for MobiKwik? A year down the line, where do you believe we will see you?
Well, hopefully far more relaxed, far hopefully bigger business, better business, and having even stronger and bigger ambition for the future than we have today.
We hope that the two of you continue to not just chase your ambition, but also ensure that your dreams are a reality. Thanks very much for sharing MobiKwik story, but also your life stories with us. And we wish the two of you the very best of luck. Appreciate you joining us here on Young Turks Reloaded. With that, it is time for us to wrap up this very interesting conversation with the team from MobiKwik. Lots of advice and nuggets there on living life, building a sustainable enterprise, but more importantly, chasing your ambition and your dreams. From all of us here on the team for now, many thanks for watching. Do stay tuned. There's a lot more coming up right here on CNBC-TV18.
Growth accommodative in a meaningful way, and that has to bode well. I absolutely agree with you. As far as the arithmetic of the capital release goes, it obviously favors or has a greater marginal impact with those who are nearest to the minimum capitalization red line. So you are thinking PSU banks. That's the first order impact.
What investors should do now is to very carefully assess the kind of valuations that they're paying for, get out of the relatively expensive stocks, may stay invested in the relatively cheaper ones and also the kind of niche market leaders. We're actually seeing this not just in this sector, but in all across India. It's the market leaders who are able to command pricing. It's the market leaders who are able to gain market shares. I have been saying this since late last year and on your channels also, that India is overvalued. And at that time, in late September, early October, Indian valuation premium compared to Asia ex Japan was about 90%. Now that has declined. Nifty 50 or BSE Sensex, the frontline indices, their valuations have declined. 1-year forward P declined from 24 to 25 to about 20 right now, which is closer to the long-term average.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go.
Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC-TV18, now streaming live 24/7 on YouTube. How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajar at these times on CNBC-TV18 and CNBC-TV18.com.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest running show on startups and entrepreneurship, celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21, only on CNBC-TV18 and CNBC-TV18.com. CNBC-TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhan.
India Business Hour live on YouTube at CNBC-TV18 weeknights at 7 p.m.
I'm absolutely clear that this and the market space is big enough to give space to another player. Number one. Number two, Ultratech will take minimum.
Hello and welcome to India Business Hour. I'm Parikshit Luthra. Here are the headlines we are tracking this evening. Sensex and Nifty declined once again, but mid-caps see sharper cuts. The Lal Street is on course to post losses for the 5th straight month. This will be the longest losing streak in 29 years. FIIs have sold Indian equities worth $25 billion in the last 5 months. From cement to cables, Birla Group's Ultratech to invest 1,800 crore rupees to set up a facility to manufacture cables and wires in Gujarat. The stock declines on capital allocation concerns. Shares of cable and wire makers also fall due to heightened competition. The tenure of SEBI chief Madhavi Puri Butch ends on the 1st of March. Sources say the top bureaucrats at North Block like Tuhin Kantabante, Ajay Seth, along with Petroleum Secretary Pankaj Jain and SEBI members KC Varshney are likely contenders for the top job at SEBI. US President Donald Trump's $5 million golden visa offering a path to US citizenship. It's going to be the most expensive in the world. About 10,000 Indian millionaires migrated abroad in the last 2 years, with UAE being the top destination.
Is anybody unhappy with Elon? If you are, well, throw him out of here.
Is anyone unhappy with Elon Musk? Asks Donald Trump at his first cabinet meeting of the second term. The meeting highlighted the efforts by Musk and his team to shrink the government. Musk is not officially a member of the cabinet and his appointment was not vetted or cleared by US Congress. Supreme Court pulls up customs and GST officials for misusing arrest powers, calls for errant officers to be punished, rules that custom officers do not enjoy the same powers as police officers. Those facing prosecution can seek anticipatory bail even if a case is not registered. 5 days since the tunnel collapse in Telangana left 8 people trapped. Rescue efforts continue, but no contact established yet, and those trapped are without food and water. State-run UCO Bank defers foreign roadshows for its proposed 2,000 crore rupee fundraise. Sources say roadshows scheduled earlier this week will now be held in March, raising doubts over concluding the stake sale this quarter. Furniture giant IKEA will begin online sales in Delhi and the National Capital Region from the 1st of March. The company is hopeful of India becoming a billion-dollar market despite widening losses. Also on the show today, Uday Kotak's lament on fading animal spirits and the heirs of business houses walking away from the family business find support from Harsh Goenka and Sanjeev Sanyal, but not everyone is downbeat on the next generation. Let's start with the market action. Sensex and Nifty ended flat after a choppy session. Both indices are down nearly 4% this month and are on track to post losses for the 5th straight month. This will be the longest losing streak in 29 years. Mid-caps and small caps remain under pressure, with both indices losing over 1% in trade today. Foreign institutional investors have net sold Indian equities worth $25 billion over the last 5 months. October saw outflows of nearly $11 billion. The selling had eased slightly in November, with December registering a net buy. Then it picked up in January with outflows of over $8 billion. February has seen outflows of over $4 billion so far. And moving on to another important market-related development, SEBI Chief Madhavi Puri Butch, her tenure ends on the 1st of March. She was the first person not from the Indian Administrative Service to lead the regulator. Sources say the search panel to find her successor is likely to have considered some top bureaucrats, including Finance Secretary Tuhin Kantabante, Economic Affairs Secretary Ajay Seth, Union Petroleum Secretary Pankaj Jain, and whole-time member at SEBI KC Varshney among the potential replacements for Madhavi Puri Butch. SEBI has directed mutual fund houses to deploy money raised from new fund offers within 30 business days from the date of allotment. The market regulator said that the measure should be implemented from April 2025 and added that a 30-day extension may be given only in exceptional cases. Currently, there is no time limit for deployment of funds from NFOs. SEBI said that failure to deploy funds on time will bar AMCs from accepting new flows in that scheme. The Reserve Bank has reversed its decision to increase the risk weight on bank loans to NBFCs. The move is expected to free up significant capital for banks. AU Small Finance Bank, Ujjivan Small Finance and Jan Small Finance Bank clocked strong gains following the announcement. The revised policy will kick in from the 1st of April. Moving on to the big corporate story, Birla Group's Ultratech Cement has announced its foray into the wires and cables business. The cement major will invest 1,800 crore rupees to set up a facility to manufacture e-cables and wires in Gujarat. The stock declined 5% on concerns about capital allocation and debt reduction. Shares of cable and wire makers also saw a sharp sell-off due to heightened competition. Nigel D'Souza is here with more. Nigel.
Well, that's right. Ultratech has announced its plans to move into the cables and wires business in the next 2 years. For this, they laid out a capex of close to around 1,800 crores. And this unit will be coming up in Bharuch in Gujarat. Most of the funding will be done via internal accruals or some borrowings as well. Remember, they generate cash flows of more than 10,000 crores, so it will be relatively very small for them. What makes Ultratech look at the cables and wires business? It has the industry tailwind, right? The industry has been growing by close to around 13 to around 14%. The industry size is 80,000 crores, headed to 1 lakh crores. So there's an industry tailwind. Also, they could be looking at some backward synergies, that is. They can source the aluminium as well as copper from Hindalco itself, which is a group company. And thirdly, Ultratech Building Solutions has close to around 4,400 outlets, and they've said they want to strengthen this vertical of their business as well. So those are the broad reasons. What about margins? Margins in the cables and wires business will be relatively lower because they'll be in that vicinity of around 8 to around 12%, which compares with Ultratech cement margins of close to around 15%. However, on the return on capital employed front, well, it is relatively better because on the core cement business, the ROC is close to 15%. However, on the cables and wires business, you get ROC of close to around 25% or thereabouts. How do the numbers stack up? Well, they're going to be spending close to around 1,800 crores, which is close to around 10% of their annual capital expenditure. So not large in that sense. What is the asset turnover? Well, if they're putting 1,800 crores, in all probability at optimal levels, they could generate close to around 7 to 8,000 crores with margins in the vicinity of around 11% or thereabouts. What doesn't the street like them? Well, the street is questioning their capital allocation. Why should they look at investing in a non-cement business? So capital allocation body was one factor that dragged down the stock. The second factor is if the group wanted to do this, the street argues they could have done it through Grasim. Brokerage reports had come out, and Jefferies, though they maintain their positive stance on the stock, they say that in fact there is a knee-jerk reaction. They will consider it as a buying opportunity. Finally, the street didn't like this foray of Ultratech Cement into the cables and wires business, but who really felt the heat was the incumbent cable and wires players. That's why you had Havells, Polycab, KEI, all of them were under pressure because the fear is this the paints moment for the cables and wires business? After all, when Grasim moved into the paints business, well, we did see all those paints companies did see a lot of selling pressure, margins compressed, as well as valuations.
In stock-specific action, Trend's managing director spoke to Shilpa Ranipeta in what was a rare interview. He said Zudio is one of the company's strongest growth engines. He added that 20% of Zudio's sales are coming from emerging non-fashion categories like beauty and footwear. Take a look.
We are quite enthused by both our brands in the fashion space, and we are also enthused by Star in the food space, definitely so. And we'll continue to build on the existing platforms, and we do think over the medium to long term, we'll have a very interesting play to be had.
So will Zudio continue to be the growth driver for you, or will it be Westside, Zudio and Starquick? Like, what do you see as the growth driver for Trend?
We do think all these three are growth engines, and Zudio is definitely one of them. So the emerging categories, which include innerwear, beauty and footwear, now accounts for about 20% of the lifestyle propositions that we have.
From one retailer to another, Arvind Fashions is planning to manufacture sneakers. The company's vice chairman, Kulin Lalabhai, is upbeat on footwear as a segment to achieve high growth.
We believe that this whole area of casual sneakers is an area we find very exciting. So in Arvind Fashions, we are now almost selling 2.5 million sneakers across our brands, and we're also planning to get into footwear manufacturing of sneakers because it's similar to garment manufacturing, which is our skill set. So we believe that an end-to-end exciting opportunity exists in the footwear sector.
And furniture giant IKEA believes India can become $1 billion market for the Swedish company, even as its losses have widened. Speaking to my colleague Shivani Bazar's IKEA India CEO Suzanne Palvera said that IKEA has already invested 10,500 crore rupees and will commit more. The company is making its entry into Delhi NCR with an online-first approach, backed by a new supply chain hub to meet the growing demand. From March 1st, customers in Delhi and 9 nearby cities will also be able to order IKEA products from their app or website.
We are very excited to finally be here. Of course, something we have been looking forward to for a long time, and so does many people in Delhi and the surrounding cities. So we have taken our time to learn from the first phase of expanding in 3 markets, in Hyderabad, in Mumbai and in Bangalore, and setting up for a good launch in Delhi. And now we are ready and we are here. And what we have learned is it's good to go with online first.
Yeah.
We have set up the backbone with the whole of supply. We have inaugurated a CDC with a partner in south of Gurugram. And all of that is now set together with the delivery and the service partners.
And PhonePe has appointed 4 merchant bankers to manage its initial public offering. Sources tell CNBC-TV18 that JP Morgan, Citi India, Morgan Stanley and Kotak Mahindra have been appointed. The company has not officially disclosed its fundraising target. However, a money control report has suggested that it could be aiming to raise billions for a valuation of up to $15 billion. The IPO process is expected to begin in the first week of March. State-run UCO Bank has deferred foreign roadshows for its proposed 2,000 crore rupee fundraise. Sources tell CNBC-TV18 that roadshows which were scheduled for earlier this week will now be held in March. A senior executive has told CNBC-TV18 that the bank plans to conclude the QIP this quarter. The Supreme Court pulls up customs and GST officials for misusing arrest powers. The Apex Court called for errant officers to be punished and ruled that customs officers do not enjoy the same powers as police officers. Ashmit Kumar is here with more details. Ashmit, give us a background to this case and the court's verdict.
Well, let's bear in mind that there were a batch of applications adding up to over 279, which had raised multiple questions with respect to powers available to customs and GST officials. One of the concerns that had been raised is that the arrest power of these customs and GST officials is being misused by them to coerce the companies into paying the amounts in question, and this is something that was brought to the attention of the court. The court, by way of today's judgment, very clearly holds that there is some merit in the argument that has been given, that there is a potential abuse of this arrest provision for coercing money out of these companies, saying that this is not something that is conscionable, not something that the court will allow, is not something that is consistent with the Indian law. Going on to say that as far as the errant officers are concerned, there needs to be some accountability in terms of departmental inquiries, and with respect to the companies, they will always have the remedy, the liberty of moving the court for seeking some relief. But the court didn't stop there. It went a step further and said that the customs officials cannot be deemed to be police officers, and therefore they do not have the same power. The Supreme Court also saying that the remedies, the reliefs, the protections that are granted, the safeguards that are granted for an accused under the CRPC, which is now the BNSS, will also be available to parties facing prosecution under the GST and Customs Act. And finally, on the issue of anticipatory bail, here again the Supreme Court said even in cases where an FIR has not been registered, parties in question can seek an anticipatory bail. So a number of reliefs. We're of course awaiting the final copy of the order.
E-commerce companies and MSMEs have sought easier norms under the new invoice management system on the GST portal. Sources tell CNBC-TV18 that companies have said that the new system increases costs and compliance burden. Timsi Japuria is here with more. Timsi.
As the government gears up to implement the newly launched invoice management system to plug in tax leakages and ensuring smooth GST compliance, industry has flagged some serious concerns to the government, seeking a middle path. Players from e-commerce industry, MSME, industry chambers have approached the government to ease norms, and sources say that the government, including the Finance Ministry and the GST authorities, especially the IT backbone GSTN, are in discussions to iron out the same. According to sources, e-commerce companies and MSMEs say that new invoice management system is likely to increase compliance burden and will increase costs. The industry also flags that there will be incremental liability from rejected credit notes in the new invoice management system. It could also lead to delay in dispute resolution with customers. The new system also has the potential to delay ascertainment of tax liability and much more. Now to be seen is how soon these issues get resolved, as the new facility is likely to be operational from 1st of April.
Uncle Sam is ready to welcome the elite to America. At a time when the Trump administration is on a mass deportation drive, they are ready to hand out permanent residencies to those who can dole out $5 million. Trump has announced that the new $5 million golden visa will offer a path to citizenship. Just like the EB-5, it will give you a green card and a permanent residency. But it would also replace the 35-year-old EB-5 program. It would also raise minimum investment requirement from $1 million to $5 million, a 5-time increase, and makes this the most expensive golden visa in the world. U.S. Commerce Secretary Howard Lutnick said this is being done to do away with visa fraud and other nonsense. The White House also said this would not require congressional approval. Trump said his administration could sell 10 million golden visas to reduce deficit. He claims, and I quote, "It will sell like crazy." Here's how other golden visa countries stack up. Close to 100 nations offer golden visas. UAE's golden visa is the most preferred one and costs around $544,000. What does all of this mean for Indians wishing to live the American dream? Remember, 10,000 Indian millionaires migrated abroad in 2 years, and 16 lakh Indians have surrendered their citizenship since 2011 and settled in 135 nations, as per a parliamentary reply. I spoke to Christine Surak, a professor at the London School of Economics, and Rohit Bharadwaj of investment migration consultancy firm Henley & Partners to understand the ramifications of the announcement from the White House and how could Indians willing to settle in the United States be impacted.
So much of the Indian diaspora is actually creating successful businesses all around the world. So if you take the case of Dubai, it's not necessarily a lot of successful Indian business people taking money out of India, but they're actually building businesses in other parts of the world and sometimes reinvesting in India. In terms of the programs themselves, I don't think at a $5 million price point, the US is going to get anywhere close to the 1 million applicants that Trump has been predicting.
Right now, the confusion which is arisen specifically whether the EB5 program will remain in the current mode or it is likely to be replaced by the new announced 5 million gold card is something which we will definitely wait and watch. For a wealthy client, who understands the value of diversification.